privatization. So I think they will want privatization to happen and FDI to come into the country. So I expect some decisions to be taken on some of the government assets by them this budget.
I think the government has to do something in order to make it easier for companies that have been impacted by the export tariffs. There have to be some incentives on research and development, because we are woefully behind on research and development if you compare it with China and many other countries.
I think my only expectation from the union budget is for our consumers to have more money in their hands. It's good for them.
I've said this once to the finance minister. Please make it as boring as possible. We don't like excitement. We don't like surprises. Actually, I think the budget system should be a 5-year budget, not a 1-year budget. And, it should be, if you ever think of sailing, instead of tacking left, right and center, it should be a broad course. And once in a while, you course correct if there's something happening in the economy.
When you look at budget, I think a lot of time you look at the investment from the government to push the economy up and to make it a better place for the citizens to be. But there's also a side of where we lose out, the leaking bucket as I call it. No? If you look at SME, MSMEs, 90% of them not covered. Whenever you have a catastrophic loss, 25% of SME, MSME go bankrupt and they're able to come back again, which costs 2% of GDP growth for the country. If you look at health again, now quite a bit has been covered from the 10%, 10 crore Indians going below poverty line. The figure has come down to about 4-5 crores now. But still there, the missing middle. Maybe an announcement that it is mandatory for all employers to cover all employees, would take care of putting that together. So universal health, taking care of SME, MSME, taking care of wherever we have an issue in terms of what goes wrong and what impact it has in the economy. I think that focus would also ensure the leaking bucket gets plugged.
We expect the fiscal consolidation to continue. We expect continued direction from the government in terms of how they will continue to spur capex and investment in the economy. Some support needs to be provided to the MSMEs who have lost out in the this whole tariff cycle. Obviously, government has done something, but maybe they need to do something more in terms of credit enhancement and some schemes of that nature. I think government also has to ask itself, and they're already doing it, but a fundamental question whether what they're doing on pushing R&D, pushing startup ventures, can they do much more than what is being done at this stage? We are definitely falling behind to some extent. We don't want to fall in the middle income trap. We need global patents, global brands coming out of India, and at the pace at which it is happening today, I might not be sufficient. So we need to do more.
This is a very important year when it comes to the budget. It's also, because the budget, what I expect from the budget is reinforcement on policy consistency, reinforcement on the right kind of infrastructure spends, reinforcement on the faith that the government has put on the private sector, and I believe that will continue in this budget as well. And I think that's something that's visible to be seen, that with the faith that the government has put on the private sector, the kind of growth we've seen is phenomenal. Just from a renewable standpoint as well, if you look at it, from 10 years ago where renewables were just an ambition to today, renewables being one of the fastest growing globally within India, and renewables also having, set out further targets of getting to 500 gigawatts by 2030. I think it's going to be massive, right? So I think overall from a budget standpoint, I think it's going to be building on all the previous budgets, which is what the government has been doing. And I think that's where the real consistency is visible. And that's the reason why you actually see the growth that you see in India.
At a macro level, given the element of geopolitics and the uncertainty, India has to gradually turn self-reliant. And that's why you see the thrust into manufacturing and local production and things like that. So I'd expect the budget to continue looking at
local
more PLIs for more industries.
PLI at a lower level, but at a larger level, local capability as against any external dependence.
For us, for all the IT services companies, clearly there was a significant provision that happened because of the labor code implications
Yeah.
over the
I think
past.
hit profitability of all.
Absolutely, I think it hit profitability. I think we're looking for a little bit more clarity on the labor code requirements. But no, otherwise I feel that the government has been very supportive of the industry.
We've seen some very good budgets over the last few years that have focused on capex, that have focused on long-term infrastructure building, and that have focused on fiscal discipline. And that's what we would welcome again this time.
I think the reform process we saw last year also some insurance things, some GST rejigs happen. So I'm hoping that even this budget, some more reforms and more deregulation, as we have seen Indian minister speaking here, should happen, and we'll welcome that. And yes, we've always said that telecom is the backbone for a digital economy and a financial inclusion. The taxation on telecom remains still very high. So we are again pleading to the finance minister that it should be rationalized.
We expect the government to continue to spend on infrastructure. I think they have been increasing the infrastructure spend every year, and this financial year the utilization of the infrastructure budget has been very good, and they front loaded it. So we expect that infrastructure spending will continue. And I think that the reforms that they did with the GST corrections last year was phenomenal, and it's really boosted demand in our country. So I think they'll continue on that path. I do expect some announcements to come regarding privatization. So I think they will want privatization to happen and FDI to come into the country. So I expect some decisions to be taken on some of the government assets by them this budget.
I think the government has to do something in order to make it easier for companies that have been impacted by the export tariffs. There have to be some incentives on research and development, because we are woefully behind on research and development if you compare it with China and many other countries.
I think my only expectation from the union budget is for our consumers to have more money in their hands. It's good for them because some of it goes into savings.
Some of that already happened last year,
Last
right?
year was, absolutely. Last year was quite a positive budget that way in terms of just putting more money in the... Also the GST cuts which happened, I think that was important. So that remains, I think, a singular wish from the budget saying we don't wish things for ourselves, but if things flow back into the economy, we benefit as well.
As India heads into Budget 2026, the consumer and retail sector finds itself in a turning point. While the rural demand continues to remain relatively resilient, the urban mass consumption is struggling amid the price sensitivity. The recent quarters show rural volumes consistently outpacing urban growth even as e-commerce and quick commerce gain scale in larger cities. At the same time, FMCG companies are dealing with cost pressures majorly linked to logistics, advertising and compliance, especially as quick commerce expands and last mile delivery becomes more critical. Against this backdrop, industry leaders see Budget 2026 as an important opportunity to push forward a GST 2.0 agenda that will focus on simplifying tax, rationalizing tax rates and reducing friction across the supply chain. A key concern is the inverted duty structure under GST, where companies pay higher tax on inputs and services than on finished goods. This has led to large amounts of underutilized input tax credits locking up working capital in categories taxed at 5%, impacting the margin expansion of the consumer good companies. There is also growing pressure to review GST rates in large mass consumption categories like footwear and apparel priced above Rs 2500 that continues to attract 18% tax, with companies arguing that the rationalization could help revive demand without disrupting their revenue collections. Beyond GST, industry stakeholders are also seeking customs reforms including rationalized duties on raw materials and packaging, faster refunds and digitized dispute resolution to reduce uncertainty and delays. Overall, while recent tax and rate measures may offer some support to the consumption, the sector believes deeper structural reforms will be critical to sustain the growth. For the consumer goods companies, the hope is that the Budget 2026 lays the groundwork for a sustained pickup in consumption over the coming quarters.
Have you ever wondered where your tax money really goes? Why do prices rise even when your income doesn't? Or how one speech in Parliament can impact your salary, savings, and shopping bill? On 1st February 2026, India's Union Budget will be presented for the first time since 2000 on a Sunday, at a moment when global tensions and a 50% US tariff on Indian exports are reshaping our economy. Before the budget numbers start flying, let's pause and decode the key terms that decide how the government earns, spends, and shapes your everyday life. By the end of this video, you won't just hear the budget, you'll actually understand it. Inflation refers to the rise in the overall prices of goods and services in an economy over time. In simple terms, inflation means your money buys less than before. The inflation rate measures how fast prices are increasing. In the budget, inflation is crucial because it affects household expenses, interest rates, government subsidies, and overall economic stability. Fiscal policy is how the government manages the economy through its decisions on taxation and spending. When the government increases spending or cuts taxes, it aims to boost economic growth. When it cuts spending or raises taxes, it tries to control inflation and reduce deficits. Fiscal policy decisions are announced and implemented through the Union Budget. Monetary policy is handled by the Reserve Bank of India, not the government. It involves controlling interest rates and money supply to manage inflation and growth. While fiscal policy appears in the budget, monetary policy works alongside it to keep the economy balanced. The capital budget deals with the government's long-term investments and borrowings. It includes money spent on infrastructure, loans to states, and investments in public enterprises. Simply put, this part of the budget focuses on building assets for the future. Capital receipts are funds that either create liabilities or reduce government assets. These include government borrowings, market loans, treasury bills, foreign loans, and loan recoveries from states and union territories. They help finance large development projects. Capital expenditure, often called CAPEX, is money spent on development and asset creation. This includes building roads, railways, factories, machinery, and infrastructure. Higher capital expenditure is often seen as a sign of long-term economic growth. The revenue budget focuses on the government's day-to-day income and expenses. It includes revenue receipts and revenue expenditure. This part ensures the smooth functioning of government services. Revenue receipts are non-repayable incomes earned by the government. They include tax revenue like income tax, corporate tax, customs and excise duties, and non-tax revenue such as dividends, interest on loans, and fees. These receipts fund regular government operations. Revenue expenditure covers routine expenses that do not create future assets. This includes salaries, pensions, subsidies, and welfare schemes. These expenses support immediate consumption and social security. Understanding these key budget terms helps you better grasp how government decisions affect prices, jobs, growth, and public welfare. As Budget 2026 is unveiled, these concepts will shape discussions on India's economic direction in a rapidly changing global environment.
Good morning and welcome to our special budget coverage right here on Money Control. I am Nandita Khemka. Well, the Finance Minister Nirmala Sitharaman will be presenting her 9th consecutive budget shortly. She presents this budget at a time when economies around the world are in a churn. And the question for India is how to be future ready. Of course, we are here on a Sunday morning. We'll get you a full house. We'll get you all our editors who will be talking about the FM announcements, and we'll also get you big voices, from market perspective and, corporate names, what have you. All of them will be joining us right here this Sunday morning on Money Control. But I also have with me here my colleague Shweta. Of course, Shweta Punj joins in. Shweta, it's a Sunday morning, and FM is, of course, presenting her record 9th budget, making history. But I would love to say that even we are creating history here, working on a Sunday morning, full house, and not just that, we have a full trading session ahead of us. So the markets will be trading, and of course, we will be regularly checking in as to how the markets are faring. But let's start with how to setting the context as to what the backdrop is against which the FM is presenting the budget. Let's put things into context first.
Right, Nandita. So yes, a big, very warm welcome from all of us here at Money Control to all our viewers for tuning in. Like Nandita said, Sunday morning, but Sunday is the new Monday under this Modi government. The context of this budget, Nandita, from a macro perspective, it's if you look at India's macro fundamentals, they're on a very, very strong footing. According to the economic survey, we've seen that, The real term GDP growth for FY26 is estimated at 7.4%, up from 6.5% in the previous fiscal year. If you look at India's economy on a whole host of macro indicators, it's looking very, very solid. But then there are questions around, the underperformance of the rupee. How will India brave the uncertainty? But I just want to point out that in the last several budgets that have been presented by Ms. Nirmala Sitharaman, the context has always been very complicated. You've had the Ukraine war, you've had the pandemic. So, this is a budget where she'll have to do a very, very fine balancing act. And then we also have Ishan standing by with all the data numbers. Ishan, what are the big numbers that you're going to be watching out for?
Hi Shweta, yeah, it's a big day for the budget thing, and also one more part, a lot of numbers this time around and a lot of numbers that we would be focusing on. So first let's go to the fiscal deficit part. The government is most likely to meet the fiscal deficit of 4.4%. The economic survey said it's coming down from 4.8 to 4.4%. That's a big drop there. But would that happen again is the question. If the government does go for a 4% number, how would that pan out and where would it come from? Another big number this time around would be the debt to GDP ratio, which the finance minister said we'll focus on from now onwards. The government has set a target of 50 plus minus 1% by FY31. Right now we are at 56.1. Again, a question here that would arise is, would we reach the 55% mark, or would the finance minister go for a 54% mark this time around? Gross tax revenues, because we're talking about part B being the bigger part this time around rather than part A, tax revenues would be an important issue. Even this time around with the GST cut and the income tax cut here, tax revenues might not reach the level that was once expected. So would the 10.8% growth be there? Look at the last few years and you'll see 33%, about 13%, 14%, 11%, double-digit growth there might be the important aspect. CapEx, of course, will the government keep pace? We are expecting 12 lakh crore or somewhere about, but would that be reached? And if that is reached, that's about a 7% growth. That's lower than what we have seen over the last few years. Look at where CapEx was in 2019-20. It's grown about 4 times since to 11.2 lakh crore in FY26 budget, and most likely the government would be somewhere around that number as well. Defense capex, now again, defense is an important aspect here with 1.8 lakh crore being spent, but subsidies, here is where the government has been making the most difference. Look at how it's declining, minus 24, minus 1.6 and minus 0.4%.
Well, thank you, Ishan. Looking extremely chirpy this Sunday morning, and thanks for getting us what those big numbers would be that we'll be focusing in on. But with that, we'll take a short break and come back to the battery of guests to understand what the FM might do at 11 a.m.
I've said this once to the finance minister. Please make it as boring as possible. We don't like excitement. We don't like surprises. Actually, I think the budget system should be a 5-year budget, not a 1-year budget. And, it should be, if you ever think of sailing, instead of tacking left, right and center, it should be a broad course, and once in a while you course correct if there's something happening in the economy.
When you look at budget, I think a lot of time you look at the investment from the government to push the economy up and to make it a better place for the citizens to be. But there's also a side of where we lose out, the leaking bucket as I call it. If you look at SME, MSMEs, 90% of them not covered. Whenever you have a catastrophic loss, 25% of SME, MSME go bankrupt and they're unable to come back again, which costs 2% of GDP growth for the country. If you look at health again, now quite a bit has been covered from the 10%, 10 crore Indians going below poverty line. The figure has come down to about 4-5 crores now. But still there, the missing middle. Maybe an announcement that it is mandatory for all employers to cover all employees, would take care of putting that together. So universal health, taking care of SME, MSME, taking care of wherever we have an issue in terms of what goes wrong and what impact it has in economy. I think that focus would also ensure the leaking bucket gets plugged.
We expect the fiscal consolidation to continue. We expect continued direction from the government in terms of how they will continue to spur capex and investment in the economy. Some support needs to be provided to the MSMEs who have lost out in the this whole tariff cycle. Obviously, government has done something, but maybe they need to do something more in terms of credit enhancement and some schemes of that nature. I think government also has to ask itself, and they're already doing it, but a fundamental question whether what they're doing on pushing R&D, pushing startup ventures, can they do much more than what is being done at this stage? We are definitely falling behind to some extent. We don't want to fall in the middle income trap. We need global patents, global brands coming out of India, and at the pace at which it is happening today, I might not be sufficient. So we need to do more.
This is a very important year when it comes to the budget. It's also, because one, the budget, what I expect from the budget is reinforcement on policy consistency, reinforcement on the right kind of infrastructure spends, reinforcement on the faith that the government has put on the private sector, and I believe that will continue in this budget as well. And I think that's something that's visible to be seen, that with the faith that the government has put on the private sector, the kind of growth we've seen is phenomenal. Just from a renewable standpoint as well, if you look at it, from 10 years ago where renewables were just an ambition to today, renewables being one of the fastest growing globally within India, and renewables also having set out further targets of getting to 500 gigawatts by 2030. I think it's going to be massive, right? So I think overall from a budget standpoint, I think it's going to be building on all the previous budgets, which is what the government has been doing. And I think that's where the real consistency is visible. And that's the reason why you actually see the growth that you see in India.
At a macro level, given the element of geopolitics and the uncertainty, India has to gradually turn self-reliant. And that's why you see the thrust into manufacturing and local production and things like that. So I'd expect the budget to continue looking at local
more so PLIs for more industries.
PLI at a lower level, but at a larger level, local capability. As against any external dependence.
For us, for all the IT services companies, clearly there was a significant provision that happened because of the labor code implications. Over the
I think hit profitability of all.
Absolutely, I think it hit profitability. I think we're looking for a little bit more clarity on the labor code requirements. But no, otherwise I feel that the government has been very supportive of the industry.
We've seen some very good budgets over the last few years that have focused on capex, that have focused on long-term infrastructure building, and that have focused on fiscal discipline, and that's what we would welcome again this time.
Good morning and welcome to our special budget coverage on Money Control. I am Nandita Khemka. Well, the Finance Minister Nirmala Sitharaman will be presenting her 9th consecutive budget shortly. She presents the budget at a time when economies around the world are in a churn. And the question for India is how to be future ready. Well, we on Money Control will be getting you live and extensive coverage and the biggest of the lineup of guests right through the day till 9 p.m. So let's get the day started. Joining me right now is my colleague Shweta Punj. Shweta, Finance Minister creating history with her 9th consecutive budget. Look at us, we are also creating history in a way, won't you say that? Because, you know, not just the fact that it's 7 a.m. on a Sunday morning and we are here, full house, it's the fact that we have a full trading day ahead of us. So that's something that at least I have never seen in my career. So in a way, even we are creating history, wouldn't you say that?
Absolutely, Nandita, and a very big welcome to all our viewers. It's a budget day. It's on a Sunday, 1st of February. So I think the Modi government has made Sunday the new Monday.
Exactly.
There's a message that goes out, you know, from presenting the budget on a Sunday, which is that this government means business.
Business, yeah.
And if
no
the budget, no holidays. You know, if the budget has to be presented on the 1st of February, it will be presented on the 1st of February.
1st of February.
There was a lot of back and forth whether the budget will get postponed, the budget presentation will it not happen on the 1st? But I guess here we all are, right? And it's a full trading day, full house, absolutely. You know, it's important that we also discuss the context of this budget.
Yeah. Very volatile on the geopolitics front, and of course even stock market front, currency market, bond market, you know, what have you.
Absolutely.
Let's get the day started, set the context.
Right. So from a macro perspective, Nandita, Ms. Sitharaman presents this budget at a time when India's fundamentals are looking very, very good. You know, Indian economy looks to be on a strong footing. If you look at what the economic survey put out, if you look at the first advanced estimates released this month, you have real GDP growth for FY26, which is estimated at 7.4%. Then you have, you know, fiscal deficit, which is looking on track at 4.4% of the GDP. Forex reserves are robust at 701.4 billion. However, having said that, so all the macros are looking good, but we also know that the rupee has been under a lot of pressure. It has hit record lows below 92 to a dollar. And then you also have a nominal GDP growth, which is muted at about 8%. So again, you know, it's not, it's going to be a tough balancing act for Ms. Sitharaman, a complicated budget because you have geopolitically, it's a very volatile situation, and I think that's where the complication comes from. So she'll have to really walk the fine line, and I think everyone's going to be watching out for you know, what the budget does to give private investment a boost, and of course on the rupee front as well. We have Ishan Gera standing by, and we also have Gaurav Chaudhary joining us in the studio right here. Gaurav is consulting editor with Network 18, and we have Ishan on the data wall. Ishan is our data whiz. Ishan, the big numbers that we should be watching out for today.
Thanks, Shweta. You made my job easier, starting with the fiscal deficit part and the macro part. Let's look at the fiscal deficit number. See how it's come down from 6.45 to 4.4% within just a few years. That's a 2 percentage point drop. Now, the question is, would the government be able to keep this momentum on? Would we reach a 4% mark or not? And if we drop below 4%, what would happen? Look here, 3.44% was last time in 2018-19. The big number would be the debt to GDP ratio, which the finance minister talked about the last time, that this would be the focus. The 50% mark by the end of FY31. 56.1 is what we are here. We are expecting somewhere around 55. We can go up till 54 as well, which will give us some room. The economic survey did talk about that. Gross tax revenues, the GST cut came in, the income tax cut came in. That would also be an important part. Look here, that's a double digit growth over the last 5 years. Would the government continue this momentum? And if it does, what does it mean for the nominal growth from this perspective? Another part here is the capex. Would the government keep up the momentum? 3 lakh crore to about 11 lakh crore, and can we go to 12 lakh crore here? Now you can all check this data on our Money Control hub, budget hub, where you can actually check the data, the total budget, compare it with, let's say, a road capex percentage of GDP, or you can see the defense capex, which is going up and up. But what happens when it is compared to the percentage of GDP, and it shows that actually it's not that high. So you can do this all by yourself, look at all the numbers in real time as the budget data comes out. Back to you, Shweta and Nandita.
All right, thanks Ishan, telling us what the big numbers one should be keeping an eye out for in the budget. Of course, fiscal deficit, capex, defense budget, and these are some of the things that will be in focus. But very quickly, before I come to the guests, just want to put things into perspective with respect to how the markets have really behaved. The sentiment has been extremely weak. If you look at the January performance, we've shed somewhere around 3.5 to 4%, 1,000-point cut on the Nifty in the month of January itself. Although budget to budget, the Nifty is up over 7% in rupee terms. We've seen troughs and peaks along the way, but we've grossly underperformed global peers. In dollar terms, the index is up just 2%, while the Kospi is up. The South Korean Kospi is up over 100%. The Taiwanese market has been up 37%. Even the US market since last Feb, it's up somewhere around 10 to 15%. And not just that, even the currency market, as Shweta has mentioned, and even Ishan pointed out some stuff out there. The currency market has been in turmoil. The rupee has fallen to record lows of 92 to the dollar. FIIs, foreign investors, they have been big sellers in Indian markets. They pulled out over 1.6 lakh crore rupees in 2025 alone. And even this year, they are net sellers to the tune of over 30,000 crore rupees. The question is, in this budget, will the FM announce steps that could reverse, the sentiment, especially when it comes to the FII community? Will we see FIIs making a comeback? Will there be announcements to that effect as well or not? That's the key question that we are asking, and that's of course something that the market per se will be watching out for. But on that note, let me bring on board all the the battery of editors that we have in our studios this morning. Gaurav Chaudhary, consulting editor, Network 18 group consulting editor, and we have Sanjeev Shankaran, senior editor, Moneycontrol, joining in. Gaurav, lovely to have you in the morning in our studios, and all of us are here, full house. But let me ask you, what is it that the FM will do differently this time around? Because there are quite a few moving parts, and every year, as Shweta pointed out in her opening commentary, every year we have some challenge or the other that the FM is faced with. This is a record 9th budget, but we have a lot happening globally. Domestically, things are fairly resilient, but geopolitics very uncertain. Currency in turmoil. What is it that the FM will do differently this time around, Gaurav?
The couple of things. One, of course, the economy is in a kind of a peculiar situation. We are in a Goldilocks kind of where growth is up, inflation is down. But having said that, and as Ishan pointed out, the nominal GDP remains a bit of a concern. In last year, on this day, year to date, the finance minister had projected 10.1% of nominal GDP growth, but the first advance estimate says that we are going to grow at about 8%. That's nearly a 2 percentage point drop, which can be a bit of a worry line because everything else is estimated on the basis of nominal GDP growth, and that is why, regardless of the fact that the real GDP could grow at 7.4%, one key number to watch out for is how the government is, or what are the estimates for nominal GDP growth. The other thing that I think this budget is going to be very big on is on artificial intelligence. India now will have to catapult into onto the global high table of artificial intelligence, and the budget as it comes just barely 18-19 days before the AI summit that is taking place in India in terms of scale and influence and representation is almost as big as the G20 summit that's taking place right here in Delhi in about 19 days from now. If you go by what's being projected and what's being talked about, I think India is going to make some big announcement. The budget is going to contain some of those about India's plans on the AI front. This is one bus that we cannot afford to miss. There's also going to be something on the semiconductor front, that is so far as technology is concerned. But on the tax front, which is where the markets are keenly watching out for, there is an existence of double taxation on, we both now have LTCG, STCG and also STT. STT came into being in 2004. It was supposed to replace LTCG and capital gains tax, made a comeback in 2018. there is an effective double taxation in place. One of these will have to go. So there's a lot of expectations riding high on what the finance minister is going to do on this, because this is about market sentiments. This is also about demonstrating the government's intent to walk the talk so far as investment outlook is concerned, and also that India is from a regulator and a tax point of view an easier place to do business in. Clearly there will also be a lot of focus on ease of doing business. We have seen the Jan Vishwas bill introduced in Parliament in August. It wasn't passed in the winter session. I think it's going to be accelerated in this session.
So there, Gaurav has given you a complete lowdown on what you should be expecting today, and what, a quick snapshot of what the government really needs to address in this budget. I also have Sanjeev Shankaran with me. Sanjeev, as you have tracked maybe 30 budgets?
Make it feel so old, yeah.
No, but he's a veteran, right? He's
Absolutely.
tracked so many budgets, and we've worked on several stories together on the budget, really. Sanjeev, when you look at the context in which Ms. Sitharaman is presenting this budget, what are the levers that she really has to work with? Because we know that nominal GDP is down, tax revenues have gone down, there is geopolitical uncertainty, there are sections of the economy that need support. So how do you think will she be able to really do that balancing act? What are the things that what are her options really between higher borrowing and spending restraint?
So, if you were to look at the context of this budget, the global context is one of uncertainty, and India's USP at this time is that it's a beacon of stability, if I can put it that way. And there's also an important domestic context. The Finance Commission report's going to come out, and so that will decide the resource allocation between centre and states for the next 5 years. Now, we've talked a lot before the budget, and a lot of people have been talking about state borrowings. The fiscal stress states are going, are really being put under. So the Finance Commission part is also going to be important, because some of those recommendations the government has accepted will show up in today's budget. So when it comes to stability, I don't think she's going to enhance her borrowing limit, because that's a bad sign for global investors. I mean, one of the great things is that India's, in this context, India's macroeconomic parameters are very good. I mean, that is something that gives a lot of people confidence, despite what you've seen in terms of capital outflows. Now, it's not prudent for any finance minister to jeopardize that USP. So I don't think she will enhance that. In fact, this year we are moving to a new fiscal anchor. That's the debt GDP ratio.
Right.
The centre's debt GDP ratio has gradually begun to come down, and I expect that trend to continue. The problem is the state side, because it's been a bit sticky. They've not been able to bring it down much. I mean, it's fluctuated a bit, but it's generally in the same level. I think there will be some incentives in the budget, perhaps to help them, nudge them in the right direction. And the capital gains, as Gaurav mentioned, is an important point, and I think it's a sore point with a lot of people. I get a feeling they may put it off, though I don't think it's probably something they should address now.
Yeah.
Right. There's a very loud clamour. Yes.
Yeah. Just one point on borrowings, and the centre's debt to GDP ratio is projected to come down to below 50% by 2031, and that was in the last budget. The finance minister announced that we are not going to. It was probably pivoting into a completely new fiscal policy architecture, where the fiscal deficit is no longer going to be the single most important metric for determining borrowing limits. But in replacement to that was the centre's debt to GDP ratio. It's 56.1%. It was estimated for FY26, and in three scenarios, where the nominal GDP growth will be probably less than 10%, then in that instance it will come down to about 51% or so. But having said that, for next year onwards, there is a one big known unknown, and that is the pay commission payouts, and those will start hitting sometime in FY27. And FY28, and the areas which will be effective from January 1, 2026 will be paid out over the next 2 years. And the wage bill goes up significantly. It becomes a perpetual cost, a revenue expenditure for the government, and the state governments will have to take cue. They usually do, and also that is going to significantly raise their wage bills too. How that is going to play out in the centre's debt consolidation program and plan over the next 5 years remains to be seen.
Right.
Sanjeev, tell me one thing. The economic survey pegged growth at 6.8 to 7.2%. That's 7.2%. That's the higher end of the band. And for the medium-term growth, the forecast is at 7%. That's almost 0.5% more than what was projected last year. Do you think that narrative will continue into the budget? Do you think
it will continue into the budget because that the potential growth that was enhanced to 7%. The underlying reasons for it is the capacity of the economy to produce more because of infrastructure upgrades and a lot of other things. And there's digital advancements are supposed to enhance productivity considerably, all of which gives you a potential to do more. So I think that will play into the budget. It will certainly play into the nominal growth. This year, okay, we know that the economic survey has set the benchmark 6.8 to 7.2. I would not be surprised if a lot of budget arithmetic is actually based on the higher band, that's 7.2. It's doable. I don't think it's a major, it's not an impossible target. Certainly, if anything, you could say RBI and the Finance Ministry has probably underestimated the growth for a while. RBI has again had to upgrade its forecasts. So it will play into it, but yeah, the larger point being how this point of pay commission is important because one of the highlights of this government is that the budgets are not really an annual exercise. They there's a sense of continuity there. They're looking a little ahead because politically there's no threat to them, so that's a good thing for them. And I think the pay commission is a very big problem coming up because it's going to squeeze the spending. You can't really enhance borrowings, especially when you're committed yourself to a certain debt GDP glide path. And there's a lot of, it's a deck of cards remain the same, you'll have to shuffle. And the pressure on states, because there's that Me Too thing that if those guys get it, then we need to get better.
And politically, this is always a very complicated.
And let's not forget, a lot of states have followed the centre's revised pension scheme. They've switched there, which means that their costs are going to go up constantly.
Absolutely.
And these are things that you can't really roll back. Actually, talking about the politics of it, I want to bring in Gaurav and Sanjeev, both of you on this. This is also the year when we have crucial state elections coming up. You have West Bengal, you have Assam. So, how does that play out? Because every year we've seen for the past two to 3 years, either there's a general election or there's some state elections. So it's almost like that you have to boost growth. You have to keep your allies happy. You have to ensure that you have to win elections in states where you're not in power.
So, no, correctly said, India is in a state of perpetual elections. And the thing that, on a lighter note, unlike many countries, India's reforms actually follows more of an electoral calendar rather than a fiscal calendar. I think that it's time to decouple that. But having said that, while 5 big state elections are coming, 4 big state elections in Tamil Nadu, Kerala, Assam and West Bengal, and the political stakes are very high both for the BJP and the opposition. Please do bear in mind that this probably could be the last budget before the next biggest state election takes place in UP next year. UP is in February, March next year. So don't be surprised if there's a huge number of, there's a lot of noise around projects and programs involving UP or benefiting UP too, because this budget probably will be the last occasion where the finance minister will get an opportunity to address and create an outreach for that set of voters too. So politics clearly will remain one of the strongest towers of budget making in India. That is something that we cannot delink unless, of course, at some point in time over the next 10 years or so, or probably before that, we get into a situation of one nation, one election, where all state elections and the central election takes place at simultaneously. But until that such time, I don't think it's going to be easy at all to decouple politics from budget making, because the primary priority of a political party is to remain in power, and budget is one of the strongest vehicles to do that.
Sure. Gaurav, particularly for Bengal, it's been very challenging for the government. What, according to you, could swing the voter sentiment there? Could it be execution or could it be monetary?
No, so Bengal remains, if I may say, one of the final frontiers of the BJP. They have been yes, last year they came closer, not significantly closer, but they came closer with about 77 seats in with a majority mark of about 144. So they were halfway there. This time too, they would be hoping that they'll probably form the government. But politics aside, I mean the political situation aside, or the reality or the electoral prospects aside, clearly whatever the government does in the budget is unlikely to have a significant impact on the ground so far as electoral prospects are concerned, because Bengal, the political political ground situation is very, very different compared to say many other states. The fault lines are deeply divided. There is a lot of polarized politics at play there, and the budget can only do as much, even if lots of projects and programs are announced directed towards benefiting West Bengal voters. The impact of that on the final electoral tally, in my view, could be a little limited.
All right. Sanjeev, what are your thoughts on this?
I'll stick my neck out on the political part. I mean, a budget is primarily, it's a political economy exercise, and you can never, at least based on my understanding, you can never decouple the politics from the economic aspect of it. Where I want to stick my neck out is that there is a certain some expenditure that's going to be there. What really matters is where and how you spend it. And I think there is a lot of, amongst all political parties, and increasingly even at the center, there's a feeling that the monthly income transfer to women works wonders politically, and also if you get the target audience right, it does stabilize their household expenses. It does play a very big role that way. And given that we've had a change, including the erstwhile NREJ bill is, now they don't have to spend as much. I would stick my neck out and say we might see an announcement on a national level monthly income transfer.
For women?
For women, yeah. Monthly income transfers will inevitably for
because this budget is also probably going to, set a new rural welfare spending architecture. Narega is no longer going to be part of the budget for the first time in 22 years, because that's been replaced by VB Ramji bill, and also this time it's previously it was centrally, it was 100% funded centrally. Now it has gone into a 60-40 kind of a ratio. So that how that plays out and how that architecture is designed is going to be very, very interesting to see, because Narega was a statutory spending program. This one is also a statutory spending program.
So let's zoom out a little bit. So we have several moving parts to this budget, right? Yeah. You have an increased focus on rural spending. That's something they cannot cut back on. You have the pay commission payouts coming up. You have Trump tariffs to deal with. You have state elections. So when it comes to the levers, going back to where we really started, what is the big message that FM can put out through this budget? I've been speaking to some people and who've been saying that this is the budget where she needs to put out a medium-term growth strategy, because the economic survey told us that what are the things that we need to be looking at, and did not get into how we should get to those things. And I think this budget could be like a vision document. In fact, that's a story that we did yesterday as well. Yes. That this is the budget where we could see a medium-term vision coming out for India, a more visionary kind of budget rather than just a statement of accounts.
No, absolutely. I think you are very right, because this is also the budget where, as Sanjeev said, politically there is no, the government doesn't feel uncomfortable at this point in time. The big state elections they have won, and it's already in the political kitty. The next big state election is UP, which is still more than a year away. There are 4 big states coming. The BJP has certain political stakes in it. But having said that, this is that budget where a lot of experimentation and can be done from a policy point of view. I think they will have to expend lesser time on political risk management in this budget than previous budgets, and that is why you probably could see more risk taking so far as reforms and policies concerned. The clear message is that one clear message that is likely to come out of this budget is the finance minister is going to tell the world that India is a very easy place to do business in. The job is to turn the whole goal is to turn India into a very globally preferred investment destination and hotspot. For that, the procedural and regulatory architecture will have to be put in place, because money always flows to the geography of highest return, and the highest return will always come from places where the regulatory architecture and the policy architecture is friendlier. Ask any businessman, any medium, small enterprise, you will the first thing that they will tell you, it's not the compliance costs are extremely high. Regardless of all that has been done over the last 10-12 years, there are many things that needs to be sorted.
Absolutely. So that's going to be a big focus area, this budget. All right, thanks for that. Sanjeev, thank you so much for joining us. Nandita, over to you.
Well, I just want to see if we can play out some expectations, because we've had some big voices on our, on money control, who have shared their expectations as to, what they would like the FM to do. I think you yourself spoke to PMEAC, right? And, he shared some thoughts with you. I think let's try and listen to what he had to say, and what the expectations this time around from Finance Minister. Let's play it out and let's listen into what he had to say.
Happening. My wish list, I mean, obviously wish list is very long, but if I were to, and look, the government, bottom line, I like to see acceleration on a lot of the fronts that this government.
All right, some market expectations as well. We will get them going. But, since we have our editors right here in the studios with us, let's focus in on some of the, areas where the FM could lay greater emphasis on. And the markets would also be watching out for that. Defense. Defense stocks have been extremely buoyant. Last week, you've seen some of these stocks rally, in double digits, etc. Bharat Electronics, HAL, a lot of these private sector names as well. Right. Of course, the expectations are that 8 to 10% higher allocation to defense. Would that be plausible, or do you think that it could go higher, given the fact that, we've had Operation Sindoor last year, geopolitics across the world, things are very volatile. We have to be, ready, of course, for any exigencies. So in that sense, could it be higher than 10%?
No, clearly there is a strong chance that it could be higher than 10%. Also because, as you rightly said, this is the first budget after Operation Sindoor last year. The government will have to. It's not just about something that had happened last year. Also about building our manufacturing capabilities, and defense manufacturing has been a strong priority for this government. And over the last several years, we have built the capabilities to a certain level. That will remain a primary focus area. Defense manufacturing is also where you actually really gives you the opportunity to move up the technology value chain to a more higher sophisticated level, because as we have seen during Operation Sindoor, today's wars are technology wars more, and the wars were fought on drones rather than anything else. And that is why it is absolutely important that the government continues with the priority and focus area in defense manufacturing, because indigenization of defense manufacturing is something that is going to not just build our manufacturing capabilities, but also enable us to move up the technology value chain.
All right. Thanks, Gaurav, for that. Let's get in some of our external experts as well to take us through what the expectations are from a market standpoint. Of course, heading into the budget, things have been fairly volatile. We've seen the Nifty, slumping quite a bit. In fact, Friday was also a down day for the market. We did see a couple of days of spurt, but that didn't really sustain, and that's been the case. And of course, if you look at the market in the month of January, we've come off quite significantly from record levels as well. But let's get on board Gaurang Shah, of Geojit Financial Services, to understand what his expectations are and what the market will be really watching out for. Gaurang, lovely chatting with you this Sunday morning. It's a long working weekend, but tell us, first of all, FII, outflows. That has been a pain point for the market. Although growth has been good, economy has been resilient, we've seen markets come off quite significantly, 3 to 4% off from record levels. What would you be watching out for from the budget from a market standpoint? Changes in taxes, LTCG, STT, what's on top of your wish list? First, share that with us.
Nandita, thank you so much for having me on the show, and it's really lovely to work this Sunday morning at 7:30 a.m. and talking to all of you all guys about.
You're the only one who said it's lovely to work on a Sunday morning, Gaurang.
Yeah, if you don't like it, you love it, right? You cannot hate it. That's simple as that.
Point taken.
So I think, look, Nandita, the thing is that when it comes to the budget list, it's never ending, right? And expectations are huge from all of us, and very few of us understand that the Honorable Finance Minister, Srimati Nirmala Sitharaman ji, has got a limited amount of, expectations to get fulfilled, right? So you have to keep in mind the fiscal prudence, and you have to at the same time give that push so that the economies get fired on all six cylinders and get to the kind of point that all of us have the expectation in terms of economic growth, in terms of corporate earnings, in terms of ease of doing business, ease of taxes for individuals like you and me, Nandita, and of course, so on and so forth, defense, infrastructure, job creation. So the list is unending, but my sense, to put everything in a perspective and in short, so my sense is that defense will definitely be on the priority list because we have two lovely neighbors sitting on our shoulders, left and right. One, there is Pakistan, other, there is China, and now, of course, Bangladesh. So I think internal security and upgradation of technology for our armed forces is definitely going to be on the cards. And I think the budgetary allocation for defense is going to move the mark upwards north by the finance minister. Spending on internal capex or infrastructure is the second. And if you, of course, spend on infrastructure and capex, etc., then you take care of certain extent, you take care of unemployment also, because employment gets generated quite thick and thin and fast when you take these kind of steps and measures. Then, of course, my sense is that there is a little bit of disparity, not little bit, quite a bit of disparity as far as corporate tax is concerned and individual tax is concerned. So I think with the new tax regime and the fact that all of us are reading that, the old tax regime is something that the government wants to do away with, done and dusted. So how to attract more people to move into the new tax regime? I think over there would be a little bit of changes which will benefit individuals like you and me. Easing of complicated tax structure which creates hurdles for FDI to come in. And of course, with all the tantrums that we've heard from President Trump with respect to tariff, there will be a move towards, increase in consumption. This is very important, Nandita, because, wherever the corporates are right now, no businessman, promoter, entrepreneur would want to invest in more capex unless and until the existing capex reaches a particular level and there is need for further capex. So I think that is one particular point that you will definitely see on moving. And above all, keeping that number close to or at 4.4 in terms of fiscal deficit, or maybe below that. I think it will be a very pleasant surprise if we are able to go below that. But I think that is the mark that Honorable Finance Minister will be having it. But yes, and of course, long-term capital gain tax, short-term capital gain tax. There is a lot of.
That's a perennial, I think.
That's true. Okay, Gaurang, hold that thought. Let me also introduce, in our lineup, N. Mahalakshmi, senior editor, Moneycontrol. Mahalakshmi, I'm sorry to say that you have to see my face for the 7th day on the trot. It's a Sunday, but you have no choice. Even I don't have any choice. But, Shweta very...
No choice either.
So, Shweta very beautifully put things into context as to, what is the backdrop against which FM is presenting her 9th consecutive and historic budget. But, set the context for us when it comes to the market. Quite a few moving parts here as well. We hit record highs, we came off pretty significantly. FIs have not been in the mood to make a comeback, and we've all been banking on it. It's not happening. So, what are the other things that from a market standpoint you would be watching out for? Set the context for us.
No, absolutely, because I was just about to say that, if you're looking for answers in terms of where the market will go from here, and if you're looking for those answers from the finance minister, it's not going to come. It's the wrong place to knock, absolutely, because first of all, market trajectory, the first point I want to make is
you've got to look into that camera.
Sure. So, the first point I want to make is that the GDP trajectory and the earning cycle and the stock market cycle, that is the stock price cycle, are completely different things. So we assume that, if the GDP is strong, if the economy is going gangbusters, that means corporate earnings will be strong and therefore the stock markets will be strong. It holds true over very long periods, but on a year-on-year basis, there is absolutely no correlation or very little correlation. And therefore, this budget, if we are expecting it to change the market narrative, it is not going to happen. Of course, there are one or two levers which markets get trigger happy about, which is the long-term capital gains tax, short-term capital gains tax, etc. And I think this time the narrative is not very strong in terms of whether we should go zero on a long-term capital gains tax or we should reduce the short-term capital gains tax. The arguments in favor of those cuts is very, very weak. I'll come to that in a minute, but a few charts I want to sort of have on the screen. One is, how is the market really looking? Right now, this year we have started on a bad note on top of a very bad 2025. And there is a chart we have which shows the number of companies, how much they have lost in the market. What kind of correction? We always say that, last year 6% we returned on the Nifty, mid caps did worse, small caps did worse. But the number of companies that lost more than 30% or 20%, 30%, where more than 50%, in fact 60 to 65% in mid caps lost more than 30%. In small caps, the number is even more substantial. So, which shows that there is already a lot of pain in the market. And people, when there is, if lots of people are actually not making money, the ability to buy more is also limited. And that is why it is very hard to see where the buying interest will come in from retail investors, which will take this markets higher. Because there are three basic pieces to this, right? Like, who are the three big buyers? The domestic mutual funds, the promoters, and the retail public. Promoters have been selling because they inherently know that these valuations are, even now, despite the stock corrections, are pretty high. And domestic institutions are, of course, buying because they get money from savers who are putting in money every month into SIPs. But the retail investors, who are essentially have a slightly narrower and a short-term outlook, who are the momentum investors, they are hurting. And we can't look for any buying support from that quarter. The second point is valuations. Despite this correction, I mean, 60% of companies have corrected more than 30% in small and mid caps, and yet the PE distribution for the entire market shows us that we are significantly overvalued. So at the headline level, which is on Nifty, we may be at 22 times, but if you look at number of companies which are actually at more than 25 times earnings, it is pretty significant. More than 50-60% of the market is actually in small caps is more than 50 times, 100 times earnings. So, so it's a pretty expensive market if you look at the broad markets, despite the steep correction. And therefore, unless the earnings trajectory decisively changes from here on, by the way, I made the point that the GDP and the earnings and the stock market cycle are different. And therefore, for us to hope that the earnings trajectory will accelerate, the case for that at this point in time doesn't look very strong. Because we haven't seen growth come back to consumption in a very big way, which people were expecting that after GST cuts, we will have a huge change there. That hasn't happened. So we have to still wait and watch for 2-3 quarters to see whether earnings really comes back with a bang, which can change the, start to change the fundamental triggers for the markets. The market setup fundamentally will start to look a little better. But I think it will be very difficult to change the market narrative right now, but when it comes to what can we look for from the budget and the finance minister, I think just a few things that we have been lagging on which will be a general feel-good investments in AI, which is very, very weak, renewables, which can be a very growth, a very high growth sector, semiconductors, nothing has happened on the ground. Will we have some traction there? Can something very concrete be done? In fact, one of our guests, Prashant Khemka, also said that, since investments not come up in a big way in semiconductors, there should be like a Bharat Semiconductors. It should be a PSU that should be floated, because that
PSU.
Yeah, another PSU. Exactly my reaction. I think he thought the same, except that the desperation that some of these things we are really lagging behind, and therefore the government has to put the put the money and get things going on the ground is strong. But of course, the point about whether we need another PSU is
let's bring in Bodhisattva Ganguly also, again a budget veteran. Bodhi, I was asking Sanjeev how many budgets have you reported, and I'm not going to ask you that, but I'm sure you would agree that Ms. Sitharaman is in a very unenviable position today, right? It's a very complicated backdrop at the moment. There's Trump tariffs, there is the private sector that's refusing to step up on the investments. You have FPIs withdrawing money from India. You have a rupee that's looking not very good at this point. Bodhi, the story that we did yesterday, that the part B of the budget speech will present an economic vision, a growth statement for India. How are you reading into that, and what are the things that you're going to be watching out for in this speech?
So, I think, Shweta, the intent of the budget speech, or one of the, and it's dangerous to say these things when we're just 4 hours away from the actual budget speech. But I think what she will try to do in the budget speech is to add to the sense of momentum, which, so after perhaps because the shock of the Trump tariffs, you had the GST cuts. You had the income tax cuts some months before, which had nothing to do with the Trump tariff. So that was an attempt to boost consumption. You've had a number of FTA deals, which we have been pushing. The last one, of course, is the big one, the mother of all deals, the EU FTA. So there is a sense of momentum in the government's narrative, or the government's messaging has been to really push the fact that there is a sense of momentum and that things are back on track despite the geopolitical uncertainties. And so the budget, I think, will push this, will sort of tell this story in a, by making a number of big picture reform announcements. So I think it'll attempt to add to this sense of momentum. If you go later this month, there is the semiconductor. Mahalakshmi referred to the Indian semiconductor story, and there is now and indeed it is true that, for example, even when the stock markets were booming after some months back, one of the weaknesses was that there are no stocks linked to AI or large language models. I mean, that was well understood. But I think there is now so a number of things have happened though, which are positive. One is that some semiconductor factories are the ones by Tata and I think the ones by Micron. There is construction which is going on. So the first India-made semiconductors should get made sometime during the next fiscal 26-27. Secondly, if you look at the some of the of the Mag 7, a few of them have announced very big investments in India. This Microsoft announced 17.5 billion, Amazon announced 35 billion, and Google announced I think the figure is about 5 billion or so. So while these investments are spread over a period of time, it added to the sense of momentum. There is an a big AI event coming up mid-February in a couple of weeks. So the whole narrative, or the whole, so I think the government is now really focused on the India reform story, and that despite the, as I said, the geopolitical uncertainties caused by tariffs and other things in Venezuela and so on and so forth, that the Indian economy is on track. It is while the geopolitical weathers might be rough, the economy is in fairly good shape. It is the world's fastest growing economy. Yes, there are issues, but the government is proactively tackling these issues by initiating a spate of reform measures. So I think that is really what the Part B story is about. I think she will announce a lot of reform measures, a lot of forward-looking stuff.
Yeah.
And I think, while we'll find out in a few hours, I think quite a lot of it could be about semiconductors and AI. Semiconductors, AI, advanced manufacturing.
And deregulation.
Yeah, so deregulation, decriminalization, etc., will be there. But I think but I think there will be a lot of stuff on the new economy, the advanced manufacturing really. I mean, basically AI, semiconductor manufacturing, and perhaps more PLI schemes, GCCs. There could be a tax incentive scheme for GCCs. See, if you look at what is the value addition that India can do for the world economy. China has rare earths, and it has, of course, enormous manufacturing capacity, which is a bother to everybody else. What India has, if you look at right now, its real value addition is in the back end, is in GCCs, where multinationals are setting up GCCs all over the place, and because obviously there is great value that these bring to the table. So I think there will be, in fact, it is now GCCs, along with the traditional, the INFIs and the TCSs, which are driving service exports. So I think there will be schemes to incentivize that. Of course, there is the long-term impact of AI on GCCs remains to be seen, but I think there will be incentives on GCCs and such like.
Hold that thought, Bodhi. Quite a few things, and we'll also talk about the other new economy sectors that could be in focus. But let's bring on board Rajesh Palvia. We have a full trading session ahead of us. Of course, 9:15 is when the markets start trading. Rajesh Palvia of Axis Securities joining in. Rajesh, things not looking all that hunky-dory when it comes to the market. Friday as well, we saw a steep sell-off. Although moves on budget days aren't all that pronounced, there is volatility, but the band is fairly narrow. So what are the levels you are watching out for today, and how are you positioned, Rajesh?
Yeah, hi, good morning everyone. So looking at the volatility in the recent days, we still believe that the same kind of behavior we are going to witness in the budget day itself, and the way markets are shaped up on the near term as well.
Just sort it out. Gaurang, if you can hear me, one pocket that we've spoken about in the studio with our editors as well, defense. The capex is expected to see an increase of 8 to 10% or even higher. Stocks have already seen quite a bit of a run up in the last week or so. How are you positioned in some of these defense names, and would you look at PSUs or the private ones?
I think there's some audio issue.
10-year kind of, I beg your pardon, 3 to 5 year plus kind of time horizon when you pick defense as a theme. And that's because, these companies make highly complex, high precision, high technology related products, right? It's not like, for example, Hindustan Aeronautics Limited gets an order to make Aegis Mk2 aircrafts, the next 5th, 6th generation fighter jets today, and they'll deliver tomorrow. It takes time. Similarly, for whether it is surface-to-air missile, air-to-air missile, high technology combat platforms and products, etc., etc. So we have positive coverage on the PSU names as far as defense is concerned. The names are Bharat Electronics Limited, MTAR Technologies, which incidentally came out with a stellar set of numbers. I think it was yesterday or day before yesterday. Mazgaon Docks, Cochin Shipyard, BHEL. Amongst the private players, we have positive coverage on both sides because of the historical business and the new business. Companies like L&T, Bharat Forge have a mix of both. And like I said, Nandita, it's a little bit longish kind of an investment in defense, 3 to 5 years. And I'm 100% sure that since the time the government made that shift from towards Make in India and Made in India and invite private players via FDI into defense, I think a lot has changed. Some of these companies have done a stellar run. Order book is extremely, extremely strong. So not only is the domestic market healthy for them, but even export market opens up a lot of opportunity. And then, of course, autos is there. Then you have consumption-driven themes, as I mentioned. My sense is accessing credit limits is going to be easier. I'm hoping that the Honorable Finance Minister does something over there. So you have private sector banks, public sector banks, strong NBFCs. And since we are talking about capex, investment, infrastructure, cement as a sectoral thing will also play out well.
All right, cement as well in focus. Of course, infrastructure plays will also be in focus. We'll focus in on the capex, announcement as well. But let's go back to Rajesh then. Rajesh, we were talking about the levels to watch out for on the index today, and also share with us what are your budget trades for today.
Yeah, hi. So looking at the index structure, index is almost trading near to its 200-day moving averages support trajectory. Even if we analyze the other indices also, like Nifty mid cap, Nifty small cap, and other indices are also trying to hold this 200-day moving average, which is very important and critical for the market for near term as well as for the short term perspective. Though we have witnessed a lot of volatility in last couple of weeks, and on ahead of budget also there was volatility in the market, but some of the pockets like defense, banking, automobile, these space are still holding the strength, and I think for trading point of view, these three pockets are looking promising for near term as well as for the short term, as most of the stocks has managed to give breakout on their near term charts. But for indices, I think we believe that 300-400 point volatility would be there on budget day itself, as if we look at the money premiums for a call and put, which is clearly giving a sign that 25,000 would be the major support area, and 25,700-800 would be the major supply zone based on the call put concentration. So I think 400 point either side swing would be there throughout the session. But if we look at the bank Nifty structure, which is showing a sign of strength, so as it's continuously holding above 59,200, 300 mark, which is very important for this near term setup. So I think if it continues to trade above 59,200, I think here we could see some upward momentum and possible rally towards 60,000, 60,200 we could see, as most of the PSU banking basket as well as private bank have contributed in last couple of days to this up move. So I think banking would be one space. But for budget day, I think some of the stocks from the defense one can focus on. BEL is looking very promising, the way stock has managed to give breakout of a long consolidation on long term chart. I think Bharat Electronics can extend its gain. We are projecting target of 475 to 480 on a positional perspective. So buy and accumulate would be the strategy with stop loss of 420. And another space where we are focusing especially for today's session is PSU banking basket, and from that space I think SBI as well as Union Bank, these two stocks one can keep on their buying list. We believe the way SBI is enjoying its all-time high trajectory, I think this stock has potential to extend its gain. We are projecting target of 1120, 1130. On the downside, 1050 needs to keep as a trading stop loss.
Those are some of the budget trades. With that, gentlemen, Rajesh and Gaurang, thanks a lot for taking our time and joining in and sharing your thoughts. Always a pleasure, and look forward to interacting again sometime soon. All right, I think now, let's get in some perspective. I think ML and you guys had a lot of interviews going right ahead of the budget. Let's listen in to some key market experts as to what they are expecting from the finance minister this time around. Take a listen. I think Prashant Khemka, his chunk is on. So, we should just cut to it and listen to what he has to say and what is high on his wish list this time around.
World, my wish list, obviously wish list is very, very long. But if I were to, and look, the government, bottom line, I'd like to see acceleration on a lot of the fronts that this government has been working on over the last 11 years. Particularly, if I were to highlight three areas where the Honorable Prime Minister himself has emphasized Sashakt Bharat, Atmanirbhar Bharat, and Viksit Bharat. Or in other words, Sashakt Bharat is strong, let's say strong India. This year, unlike any other year, right, I think the opportunity is there and the need is there that we should substantially ramp up our defense budget. Defense budget is stuck in about 2% of the GDP for quite some while. And while we have spent a lot on infrastructure in India, defense is the most crucial element of infrastructure. And if it wasn't so, then all that's going on in the recent years in the world should drive home that point that it is very, very crucial form of infrastructure, and it should be at least twice its share of GDP. From 2% should be at least 4-5%, which is what globally a lot of countries are moving towards. And India, with its neighbors on the north side, if anything, should be at the higher end of what other countries are. So that's one that I would like to see. Obviously, we can't double the budget overnight from 2% to 4%, but there should be maybe a roadmap provided or a strong beginning in that direction. Second, I would say in terms of Atmanirbhar or self-reliant Bharat, Atmanirbhar Bharat or self-reliance, again, linked to partly to geopolitics. What the recent years have taught us is we can't be dependent on any single 2 or 3 countries on any crucial aspect, on any crucial import. If you are importing from 50 different countries, that's less of a dependence. But if you are importing from 1, 2, 3, 4 countries, are heavily dependent, that's not sustainable over time. So obviously defense itself is the biggest area probably for indigenization and greater focus on indigenization. But it's not limited to defense. Look at chips. Chips today are part and parcel of everything we use, be it the mobile phone that I'm doing the call through, or be it computers, be it any machinery, security systems, everything, automobiles, everywhere chips are needed. And predominantly most of the semiconductors India imports from a very select few countries in Asia, including China, probably a big component of all of these. We cannot sustain, if we were to think of ourselves as a superpower, which we are and aspire to be. This is not sustainable. You can't be dependent on 2 or 3 countries. One of them is your arch rival. The other one is at risk of being taken over by your arch rival. I'm talking Taiwan here. You can't be dependent and wait for some such eventually to happen and then build this. India is already 30 years behind in semiconductors, right? If not more. We made a start over the last 2-3 years through the PLI scheme and other initiatives. We made a start, but we need a massive push. I'm never a big fan of public sector units, or let me put it this way, I'm not a big fan of government entering areas where private sector can take care of. But here we are so far behind, 30 years behind. I think there is a justification and need for some Bharat Semiconductor Limited or Hindustan Semiconductors Limited, because just private sector may not get there. And you may need government to put all its weight behind, and we need to have a roadmap again that it can't be bridged in the next year or 2, but over the next 5-10 years, we ought to move in that direction to reduce our dependence on Taiwan, China, Korea, and other countries when it comes to chips and semiconductors in general, which are very crucial element of every form of machinery that we use today. And third, towards the Viksit Bharat, or the aspiration to be a developed country by 47, I think the growth rate at which we are growing, 6%, while it's one of the highest in the world, there is room and need for it to be stronger for the job creation that is needed. And for job creation, we need to cut red tape. I mean, Trump says a lot of things that people laugh at, obviously, and we all joke at, but he also says a lot of things that make a lot of sense. At the Davos speech, he talked about cutting 10 regulations for every new regulation they put in place. And he pointed out that they've actually cut 129 regulations or something like that for every new regulation. Who knows? Nobody. Trump says a lot of things which people can keep verifying and are not able to verify. But he also said that other countries can copy too, and there is no harm in copying something that is good. And I think around the world, there is very high degree of maze of complicated regulation that stifle businesses, and businesses are who create jobs. If you have over-regulation in any...
If you want to have Viksit Bharat, you need to have a growth rate of 7 to 8%. For that, you need to have, right now we have investment rate about 30% or so. So
and it's remained that for a really long time.
Yeah, we need to increase it to around 35%, 34% or so. So for that, private investment is important. The public sector, I mean the government has been raising capital expenditure in the last few years. So that itself will help the private sector. And several measures India is adopting. I mean GST, all the reforms India has done. The reforms in also this kind of Atmanirbharat, where competitiveness they are proposing. And then ease of doing business, the deregulation, and recently also several reforms. I mean, for example, the private sector in nuclear energy and 100% FDI in insurance. So all this I think will help private sector to invest. And why private sector is not investing? I mean, some of the industries, they meet me. They said uncertainty and all, but uncertainty will be there in future also. So, and it's the right time because the balance sheets are very good, the corporate balance sheets and bank balance sheets are good. The so-called twin deficit problem, twin balance sheet problem is not there. So I think this is the right time they should invest. And but some of the CMI data shows that there is already some investments are happening.
Some green shoots.
Yeah, private sector in several manufacturing sectors. So that way I'm hopeful in the next few years with these reforms and the government capital expenditure. If you want to have Viksit Bharat, you need to have a growth rate of 7 to 8%. For that, you need to have, right now we have investment rate about 30% or so. So
and it's remained that for a really long time.
Yeah, we need to increase it to around 35%, 34% or so. So for that, private investment is important. The public sector, I mean the government has been raising capital expenditure in the last few years. So that itself will help the private sector. And several measures India is adopting. I mean GST, all the reforms India has done. The reforms in also this kind of Atmanirbharat, where competitiveness they are proposing. And then ease of doing business, the deregulation, and recently also several reforms. I mean, for example, the private sector in nuclear energy and 100% FDI in insurance. So all this I think will help private sector to invest. And why private sector is not investing? I mean, some of the industries, they meet me. They said uncertainty and all, but uncertainty will be there in future also. So, and it's the right time because the balance sheets are very good, the corporate balance sheets and bank balance sheets are good. The so-called twin deficit problem, twin balance sheet problem is not there. So I think this is the right time they should invest. And but some of the CMI data shows that there is already some investments are happening.
Some green shoots.
Yeah, private sector in several manufacturing sectors. So that way I'm hopeful in the next few years with these reforms and the government capital expenditure will have multiplier effects on private investment also.
Good morning.
Hello and welcome to Moneycontrol's live budget coverage. 3 hours to go before Finance Minister Nirmala Sitharaman presents her 9th budget. Now, unlike previous years, market expectations are actually running a bit low given the income tax and the GST bonanza that was already announced in the last 12 months. However, even though expectations may be tame, hopes, as usual, are always running high. Hopes for added reforms, for an additional growth impulse, and yes, maybe even some relief on the capital gains tax front. I'm Surabhi Upadhyay, and with me is Moneycontrol's top editorial and intellectual might in full force. We have with us Bodhisattva Ganguly, Sanjeev Shankaran, N. Mahalakshmi, and Gaurav Chaudhary. Lady and gentlemen, good morning. So B-Day is here. I want to start with a very quick pulse check, mood check / pulse check. Bodhi, let's open with you. Good budget, bad budget, mega budget, non-event budget. What is it going to be?
I think there will be a lot of positive announcements. I think what we are seeing is that the narrative which the government will put forward is that things are on track despite the geopolitical tensions, and you have the big FTA with the EU. So I think the message will be that the reform momentum, reform express is very much on track, and lots of things are happening. And the Indian economy is on course, is on track, going great guns. Lots of reforms are happening, ease of doing business. The government is going gangbusters. So I think that will be the messaging of this budget.
So it's going to be a reform budget.
It will be a reform budget.
Messaging budget.
That's my expectation.
ML, your sense?
I absolutely second that. I think it will be the messaging has to be strong. The messaging will be strong. Because there are fiscal constraints, and the market context does not leave us with any expectation that anything can radically change.
The market is probably going into this budget in the most downbeat manner, right?
Absolutely. I think it's been the worst January in years. So obviously there is nothing that we can do about that. Nothing that the finance minister can do about that except the capital gains tax, which I think she might not do. Is my feeling. So, but the messaging, and that is also something the market will take cognizance of, but will not react to.
Yeah, Sanjeev, that's the conundrum, right? The government technically has done everything it perhaps could and more to spur sentiment, but from a market perspective, the sentiment is just completely missing. So, what will the message be today, you think?
I think it'll stick to the message. I mean, it's cautious optimism in the sense that cautious because the global situation is pretty gloomy. Optimism because I cannot think of a global situation of this kind where India was domestically so robust in terms of the economy. And I think I would second what they're saying. The messaging will be strong. It will be not just for this budget or a single year, but it will be going forward because growth is absolutely essential now, and the messaging on growth will be very, very positive.
Sanjeev, will there be any, Gaurav, will there be any new recipe? Something new she can come out, pull another rabbit out of the hat miraculously?
Surabhi, this is a particularly gloomy budget day here in Delhi. And
it's raining actually.
It's raining outside, and one would hope that by the time the speech ends around 1 o'clock in the afternoon, the mood will lift. Metaphorically and literally, but I think it's going to be a very sharp budget. She will blend immediate imperatives with long-term structural goals. It will be very heavy, in my view, on the artificial intelligence quotient, because this is perhaps going to be an opportunity to demonstrate the government's plans for artificial intelligence and how we catapult onto the global high table. But having said that, she is going to demonstrate the government's intent to walk the talk on reforms, and also a very plucky drive on fiscal consolidation. That is going to be a non-negotiable so far as the fiscal glide path is concerned.
Absolutely, and the fisc has been under pressure because of all the stimulus that's already been given out. So editors, just keep it with us. Give us about 5-6 minutes. We have to wrap up global cues, which actually have an overnight action. Friday onwards has been absolutely dramatic in global markets. We've got a new Fed chief announcement. Yes. We also have a global guest lined up to take note of what's been going on. So allow me to get through that, and then we'll go back to our budget conversation with the editors. So very quickly, let's tell you about the 5 most important global cues that you must be aware of. Remember, today is a Sunday, but it's a trading Sunday, and we've had heightened action Friday onwards on Wall Street. So it's very important to take cognizance of those big headlines. Let's put them up on the board. Number 1. President Trump has finally announced a new Fed chief. Kevin Walsh is going to be the new man taking over from Jerome Powell. Now, markets had a very sharp and a very dramatic reaction to this. Let's tell you a little bit about Kevin Walsh. He's seen as a bit of an inflation and monetary policy hawk by some people. He's no newcomer to the Fed. He's actually served at the Fed in some very, very critical years from 2006 to 2011. He was at the Fed during the midst of the big global financial crisis. And that is where it became very, very apparent that he's not in favor of endless loose monetary policy. So that's something that we have to bear in mind as well. He's also seen as someone who may, sort of toe along with Trump's line initially, may offer a little bit of those rate cuts, but eventually he's seen as someone who will bat for the Fed's independence. He's seen as a person who does have a mind of his own. So that is trigger number one that has really, rallied or rattled markets rather, I should say. So what transpired? US equity markets were fine. They actually on Friday ended lower between about 0.5% to about 1.5%. The VIX did spike, the CBOE VIX. Even the equity market took note of the rumbles, but the rumbles were really felt in the precious metals space and in the currency space. Gold and silver have absolutely crashed. On Friday, in US market action, gold prices tanked 9%. If you thought that was a big headline, silver crashed 30%. We've not seen these kind of moves in the last many decades. The last time we saw something so dramatic was perhaps in the 1980s. Now, why did this happen? Markets, and many will argue that they were running ahead of themselves in any case, precious metals, particularly silver. There was just panic, which was triggered by Kevin Walsh's appointment. As I said, he's seen as a hawk, so people, were jumping to cover those long positions, and it became a bit of a self-fulfilling prophecy. So watch out for this. We have to also watch out for a lot of the stocks relating to this, because some of that was playing out in the Indian market on Friday before this announcement. Stocks like Hindustan Zinc, etc., were down 9-10%. So watch out for the precious metal space. The dollar has taken a lift because he's seen as someone who's not going to be ultra loose in monetary policy. The dollar index has climbed on Friday, that is. It has climbed back towards the 97 handle. And last but not the least, an added worry for India is crude oil prices. As we're looking at trade today, Brent is back to the $70 a barrel mark. Let's not lose sight of that. And that's entirely because of West Asia and concerns around Iran. So these are the top 5 global cues. Let's discuss this with Matt Orton of Raymond James. Matt, great to be speaking with you. And thank you for being up and about for us on a Sunday morning. It's a big day here for us in India. And it's been a bigger, weekend, a bigger Friday on Wall Street, as I was just highlighting for our viewers. Let's start right there, actually. This absolute rumble in the precious metal space, do you think it's a one-day event? Will it continue? What does it mean for equities overall and for India?
Hey, well, first of all, good morning, Shruti. It's great to join, especially on a day like this for India. But going to precious metals to start, it was a painful day for anyone who owns gold. As you know, I've been a proponent for having gold in portfolios, and luckily I've been taking profit as the rally just seemingly continued for a lack of fundamental reasons. But I wouldn't read too much into it. I do not think it was the nomination of Walsh that caused this to happen. I think it was just a blow off top in a speculative rally that went too far too fast, and we're starting to normalize. I would expect there's still probably some more downside as some of the more leveraged long positions continue to get washed out. But at a certain point that we're really approaching pretty soon, given how big the move down was on Friday for us, I think you start to get to a point where those who've missed out on this rally can feel much more comfortable at buying and getting a position in their portfolio. So I do not think that the downside is over, but I think the extent to the downside is probably, it's getting extended, and we'll start to see some stabilization hopefully in the next couple of trading days. So over the next week, it'll be bumpy, but from there I would expect it might resemble the path from October, where you'll build a base and eventually start to move higher.
Okay, so that's the global picture. Matt, let's talk India now. And I must tell our viewers that Matt is probably one of the few foreign investors in India who's kept the faith consistently. He's been picking up stocks bottom up over here. But otherwise, it's been a tough year, Matt. What would you like to see in the Indian budget today?
So I think just confirmation, obviously growth in India has been incredibly strong. So the need to have a big budget, I don't think is there. So I think you're going to have a balance of fiscal, I'd say, prudence, along with very targeted reforms. And so I don't think you're going to see significant tax incentives given to the broader population. You've already had a lot of stimulus brought in through GST reforms and other changes that have happened. I think you're likely and hopefully going to see some investment and perhaps more regulatory reform around manufacturing, finding ways to have partnerships and bring in more foreign direct investment to help build out that manufacturing capacity. Defense is going to be a key area, though a lot of the defense stocks have already moved in advance of those expectations. So the opportunity may have passed for now for investors. But for me, if we don't get a lot of change through this budget and it's more focused on reforms and more marginal changes, I think you want to lean into longer term durable trends. So rather than mass consumption, which benefited from the GST reforms, look towards this idea of premiumization that we've talked about. So some of the more premium automakers that sold off on news of this EU trade deal, I think a lot of those moves are overdone because, again, a lot of those cars are already manufactured in India to begin with, and they don't have market share. So I'm not concerned about the likes of an M&M, which has been one of my favorite names. And so there's a lot of opportunities, I think, to be selective based on where the budget comes. And if perhaps defense disappoints expectations, it could be a good opportunity to get in because it's still a very long-term critical part of investment on the part of India.
Matt, quick last questions, 30 seconds only on the chat now. But capital gains tax, you've been investing in India regardless, but is that a real pain point? And if there is no relief on that today, will that be an added negative? Or do you think, in any case, it's something that foreign investors have learned to live with?
It's something foreign investors have learned to live with. If you invest in India, India is not the only country that has a similar taxation structure, especially in emerging markets. What I care more about is what the RBI is going to say next week as a foreign investor with respect to where interest rates are going and are we ever going to see a stop or at least normalization in the decline of the rupee. And I think that's been more of an issue for foreign investors because the growth picture is fantastic for India. I'm optimistic and hopefully we'll continue to see reform go forward. And fiscal prudence as well. And that should give investors confidence in the long-term growth story that India represents.
Okay. All right, Matt. Thank you very much for setting us up. So that's the foreign view as we gear up for Finance Minister Nirmala Sitharaman's 9th budget. Matt saying foreign investors have made their peace with this 12.5% tax. The question is we need to get those gains. Then we can talk about the tax, right? Matt, thank you very much for joining us on a Sunday. We look forward to, having you back again very, very soon. And we've got our next set of guests joining in as well. We've got Ajit Mishra. We'll just talk about the technical picture in today's specific trades. Ajit, if you could just give us a couple of minutes. We also have Shiv Sehgal joining in. And in a bit, we'll have Trideep also from Edelweiss. Shiv, of course, from Novama. Gentlemen, coming to you in just a second. We're quickly doing a snapshot with the Moneycontrol editors roundtable, the budget roundtable, where our editors have just told us that it's going to be more about reforms and messaging. So let's dive a little deeper quickly on this. Now, on the reforms roadmap, what would be, what is the expectation / wish list on the biggest 2-3 announcements? Anyone? ML, maybe?
Well, Bodhi may be better will articulate it better.
Well, thanks for tossing that to me, but it's very, very risky to predict budget 3 hours out.
Reforms, yeah.
No, so I think there will be, as I said, a lot of messaging on artificial intelligence, possibly an AI policy announcement of some kind, a boost. There's already a semiconductor manufacturing policy boost, but that could get, there could be more funding announcements for it. There could be possibly a policy to incentivize GCCs. Tax breaks and a policy to simply put a PLI version for GCCs. I mean, PLI is for manufacturing, but it's a service sector. Because if you think of it, at this point in time, GCCs is what really is the unique aspect which we bring to the world economy. It is where India is really adding value. We don't have, semiconductor is on our wish list, but we don't actually have any, semiconductor plant or any, any companies which are working on large language models and such things. So, So
Well,
I think
we have, of course, the manufacturing capacity.
manufacturing capacity is coming up, and I think, as I said, in the next fiscal, the first India-made chip should start appearing. But so I think there'll be a heavy tech emphasis, tech, advanced manufacturing, GCC kind of emphasis in the budget. Hopefully, these will not be famous last words.
Well, it might just be a tech budget. That's a nice one, Bodhi. What about you, Gaurav? Sanjeev, would you like to add to it?
Yeah, so I'll taking on from what Bodhi had said, of course it's going to be one of perhaps India's biggest emphasis on technology will be in this budget. Technology is an enabler of economic growth. But having said that, Moneycontrol has done a story on how Part B of this budget speech is going to be significantly different from previous budgets. You will see a lot of inverted duty structure issues getting addressed this time around. Primarily because I think the trigger for that is also because of the Indo-EU FTA, which has been described as the mother of EU deals. So by the time the deal is actually signed over the next 12 months or so, a lot of inverted duty structure issues will get addressed here. It's going to be very high on reforms, particularly on the regulatory and the ease of doing business side. Jan Vishwas bill, which was tabled in Parliament in August 2025, did not pass in the winter session, is going to be passed in the current budget session. Probably it is going to be accelerated, decriminalizing a lot of offences, which has remained a major irritant. And of course, I wouldn't be surprised. We have an STT and we also have an LTCG. There is a great degree of incidence of double taxation. One has to go or has to get significantly reduced. I would not be surprised if these are addressed.
I'm going to come back to that, treacherous tax question in just a bit. But Sanjeev, I mean, from a reform perspective or just a direction perspective, Bodhi called out tech. I think a lot of people are talking about defense. What's your sense?
I think from the reform perspective, something that can have an immediate impact, there will be a lot of announcements on the compliance issues. I mean, because that's let's call it regulatory cholesterol. They will address that. Now, what Bodhi indicated, and what most people do indicate, these are long-term plans where the government is willing to subsidize capital amongst other things. Now, a lot of it depends on how it works out in practice, because not all PLI schemes have worked. The electronics one has worked very well. Some have not really taken off. So, that we'll have to hedge our bets there. But they will certainly, I mean, I think the tech budget is a very good way of putting it. I'm fairly certain, because now with the AI summit just a few days away, I think a little over 2 weeks away, there will be something very big on AI in terms of signaling.
And in terms of sectors, so tech is definitely one that all our editors have called out. Anything else that will get sort of the lion's share of the attention?
In my view, I think there are going to be some big announcement coming on the rare earth segment, the REE, as it is called, the REE ecosystem. There was a national critical mission that was announced last year. I would not be surprised if the government or the finance minister actually announces a non-lapsable fund, because we have to get a rare earth ecosystem in place on a perpetual basis if we want to get our EV goals in place. That is the critical element, and that is going to get a lot of emphasis.
Okay, there you see a glimpse of the slightly foggy and overcast Delhi skies that we were talking about, given the overnight rain. Okay, ML, I'm going to leave the last word with the lady. Now, capital gains is one thing. Mil gaya to bahut acha hai. If not, what does this budget mean for the market?
No, I don't know. Mil gaya to bahut acha is also.
I mean, the tax cut. I don't mean another tax increase.
Exactly. Even the long-term capital gains tax cut, which everybody is, markets will be very happy if you have that. I think even from a market's perspective, beyond today, I'm not sure it is going to be a great idea. Because we put out a graphic saying that if you look at all listed companies and a majority of small cap companies, more than 75% of stocks right now are trading at more than 50 times earnings. So the more and more you push people into a market which is highly valued, you are going to push down their returns in future. Do you really want to create those kind of incentives to push people into an area where their long-term returns are going to be impacted?
So you're
today we will be very happy.
If there is no tax cut, if there is no long-term capital gains tax cut, you're saying it's actually good for the market?
It is good for the market. I think it is good for the market, except that from a foreign investor's perspective, which I think has been as asked for a very long time, that nowhere in the world, and we can pull up that chart because I did a comparison in all the major economies, US, UK, France, Germany, Singapore, China, nowhere do you have a, FPI tax, and the taxation between equity and debt is the same. So we have slightly misaligned tax structure with respect to capital gains, I think. And if she leaves it the way it is, it's fine, but definitely not reduce long-term capital gains tax, which is the ask. And this is not the time to bridge the yawning gap between equity and debt either, because equity is anyway suffering, right? So today you don't want to spoil sentiment and make people feel the a negative wealth effect on stock market.
ML's counter arguments are against everything that I've heard in the last I think 2 months on what the market is craving for. But there's solid thought behind that. Okay, quick last. I think we've got a next set of guests waiting.
No, so there are two ways of doing it. She can bring down the tax on debt towards equity, because the tax on debt is actually 39% of the highest bank. Or the other way to do it is to raise the tax on equity to equalize it with debt. I do not think that is going to happen at all. I think the chances of that are close to zero. But
no, I think reduction in debt taxation is a distinct possibility, because the government has been talking about, the economic survey talked about it too, the deepening of the market, cost of capital to be brought down. SEBI itself is now doing incentives for bonds, etc. That's a distinct possibility, I would say.
All right, editors, it's been a fantastic gearing up, completely warmed up for this day. And I request all of you to come back here after 8 in the evening, because we need to decode how much of this came true. Maybe there's something completely different, which is beyond our imagination at this juncture. But thank you for your wisdom, and we look forward to connecting again once the budget is over and done. All right, with that, let's move to our market guests. We've got, of course, Ajit Mishra joining in. We have Shiv Sehgal from Nuvama, Tradip Bhattacharya from Edelweiss Mutual Fund. Let's quickly get them all up on the screen. Ajit, if I could quickly come to trades of the day, what is your advice for people who are looking to trade either the Nifty, Bank Nifty or individual stocks?
Good morning, Surbi. So Surbi, yes, we are entering into the event with a very low expectation, and we are also sitting at a very critical level also when it comes to the overall market positioning, because 200 days of exponential moving average that talks about the long-term trend for the market. So we are currently hovering around that area. In case if there will be any positive surprises and markets make an attempt to cross this strong barrier at 25,600 mark, probably we are out of woods. On the other hand, in case if we fail to hold this 200 days of exponential moving average, means we break 25,150, we are set for the next leg of the down move, and which could be slightly painful, means we are heading towards then 24,300, 600 zone. So as of now, indications are mixed. One should not get carried away with any kind of aggressive positioning before the budget. The best approach is to follow anything like through the option strategies in case if somebody is comfortable with. Otherwise, wait for the event to unfold and look for the positioning in the index. Banking, on the other hand, definitely looks more promising. We are very close to the record highs. The kind of moves that we have seen in PSU banks and the private banking majors, that is something where one can focus on. So on that front, Axis Bank, which post numbers has reclaimed its record highs, we believe that there could be a bit of a consolidation in the near future, but broadly the trend is likely to remain up. 1510 is something that one can look for as a target zone, with 1300 as a stop loss. Another sector which looks promising post budget also is defense, wherein we have started seeing fresh traction of late post the BEL number. So BEL is the outperforming name within the defense basket, wherein we have seen that stock has reclaimed the record highs. Volumes are very strong. So this also indicates that this momentum is likely to stay, and 490 is what we are eyeing as the immediate target. So with stop at 428, one can go long in BEL also.
Okay. All right, Ajit, thank you very much for your trading advice, and hopefully we'll connect again at some point, see how the market actually shapes up today. Thank you for joining in. And now let's get to our fundamental voices. We've got Shiv Sehgal with us from Nuvama, and of course Tradip Bhattacharya from Edelweiss AMC. Gentlemen, good morning. Sorry we took a couple of minutes just to get the Moneycontrol pulse check. But you tell us, Shiv, let me open with you. Quick thoughts. Is it going to be a non-event budget for the market, or could it be a game changer? Right now, this is like a gut feel question. What's your sense?
Good morning, Surbi, and a very happy Sunday, hopefully, to all of us.
I think it's important to understand the context in which this budget is coming to. Last year budget was framed against the backdrop of impending tariff actions. President Trump had just come to office. This year, however, India is approaching the fiscal exercise with much more greater confidence on the export front. I think just before this budget, the government has concluded a very landmark trade agreement with the European Union. But however, this year's budget is coming against the backdrop of heightened political and geopolitical uncertainty. You also mentioned just in your previous segment that it's been an incredibly metals focused start to the year. And however, if you recall, in your own very own markets cafe segment, we had spoken about the dollar debasement issues, which currently seem to be the fulcrum of almost every investment conversation globally. Also, in the last 48 hours, we have a new Fed chairperson at the helm who seems to be hawkish, but I want to remind everyone, but at the fulcrum of that debate is also the fact that in almost 10 trillion of US debt is going to come to be rolled over in 2026. So geopolitically and volatility wise, I think it's a very interesting background for this year's budget. In my view, if last year was about boosting consumption through tax cuts, this year budget will be all about stability and reforms. The government will focus on shifting to reduce the government debt to GDP over the next 5 years. And I think that big spending push is going to be much focused on capex, public capex, divestments, and also on defense. I think defense globally is becoming a major issue for almost all governments alike. And I think the budget push in terms of defense will be very, very large as well from our segment as well.
Well, I have Nandita also joining me right here in the studios. Nandita, it's going to be a long day. I hope you're fully prepared.
I was just telling our editors as well that we'll have to see our faces for the 7th straight day on the trot. No, no choice
days.
there.
It's been a 15-day, twin working week.
Yeah.
But quickly, to get to Tradeep's point as well. Tradeep, morning. So again, same question. What's your feeling? What do you think will be the top 3 headlines from the budget at 12:30?
Meaningful boost to capital spending on the defense side. Some word on currency stability and fiscal consolidation to continue. And maybe this is my wish list, if they can talk about the 8th Central Pay Commission. They don't need to, but if they talk about it, it will be a good forward-looking catalyst for the market.
Tradeep, hi. Nandita also coming in. What would the government really do to boost consumption? Because, last year we had big bank tax reforms. We had GST cuts as well. But, consumption hasn't really fired up in a big way. Is there any announcement in terms of consumption that you will be particularly watching out for?
Sure. So, I don't know whether they will or not, but if they do, it will be good, which is the 8th Central Pay Commission, which is supposed to come about. Sometimes they said it was supposed to roll out from 1st of Jan. We are delayed anyway. The good thing about this is it usually comes with arrears, and hence for central government employees to the tune of about 5 million employees and 7 million pensioners, this could be a meaningful boost from a salary standpoint. Well, I hope they're listening. But at the same time, from an economic standpoint, this could act as a meaningful catalyst for consumption, particularly on the consumer discretionary side. A lot of changes have happened since GST reforms, including inflation, oil coming down, and also interest rate cuts. But some of them have not really fired in the form of consumer spending as yet, barring autos, where we have seen. I think we have to give it a bit of time. But particularly on the 8th Central Pay Commission, I'm looking forward to some sort of maybe cue from the speech or any spending talk about that could be quite beneficial.
Okay, Shiv, now let's come to this tax business, capital gains tax. We had a guest joining us from Raymond James. I don't know if you could hear him earlier, who was saying it's okay, we kind of learn to live with it. But my colleague Mahalakshmi was making a very vehement argument saying it doesn't matter. I mean, even if there is no tax cut, it's fine from a valuation perspective, etc. But you tell us, 12.5%, how strong is the case to cut it?
Yeah, I heard both the segments. It was very interesting and on how contrasting the thoughts were. I think as market participants, obviously, our tax cuts have been the fulcrum of every budget. But the reality is that I think more than the tax cut, it is the stability of long-term uncertainty that needs to be removed. And that's going to be very critical. Of course, you will see a knee-jerk reaction in markets if there is a tax cut in LTCG or even a reduction in STT from that perspective, just making it much more easier for market participants. But it's anybody's guess, I'll be honest with you. Market participants will take it very positively, especially the FPIs, should there be more clarity on the LTCG from an FPI perspective. As you also mentioned in your own segment, we've been seeing an exodus on FPIs. I think that is also taking at the back of mind for the government that there needs to be much more macro stability. The INR has been the weakest currency in emerging markets. So I think there will be a lot more fiscal prudence along with that. It's a tough one. But as I said, a lot of people have been hearing, on segments that the budget is becoming, I guess, on budget day itself is becoming a lot less relevance. It's all about long-term policies. And as market participants, we are also hoping that, there'll be more clarity, that there's not much volatility, and we take this whole debate out of discussing it every year.
Sure. Shiv, this is Nandita as well coming in. Just want to ask you, what according to you could be the structural winners in terms of sectors, this time around? Would it be defense? Would it be renewables? Would it be EV makers? Because a lot of these emerging themes, there could be a lot of announcement in terms of these particular themes. So would you look at these as structural winners if something comes through?
Nandita, the government has been targeting policy allocations under the Viksit Bharat and, in the Make in India umbrella scheme. And I think the production-linked incentive schemes have been the bedrock of this Make in India initiative. And if you just look at the data, the PLI schemes as of end of last year in almost like 14 sectors had attracted investments about 1.8 lakh crore and generated incremental revenue of almost 16.5 lakh crores. And if you look at just the job data, there were approximately 13 lakh direct and indirect jobs created. So I would expect that the flagship announcement out of the PLI scheme would be extended to emerging areas such as AI, robotics, space, medical equipment, and any area that makes India a lot more self-reliant. I think for me, those will be the key areas to watch out for.
Okay. Gentlemen, stay on. We have two ladies joining the conversation as well to bring up the debt market side of it. And of course, what this means for our macros and how is our macro picture overall. We have Shubda Rao with us. Shubda, great to be connected with you again. It's been a while. And we have Lakshmi Iyer also joining in. Lakshmi, good Sunday morning to you. So people want tax cuts and then, there's more spending on defense, there's, more expectations for AI. But Shubda, you give us the math. And I was looking at some numbers, the latest data on taxes, and we know the taxes are running behind estimates. So the net direct tax collections are up about 8.8%. They've reached around 18.4 lakhs, but the budget estimates were over 25 lakhs. So do you think they'll meet the shortfall? Is there money to do more, is the question.
Thanks, Surbi, at the outset. It's wonderful to reconnect with you after a gap. To the questions of the budget, all of us are waiting on a Sunday morning. I think math definitely points for a shortfall in the gross tax revenue. Our own estimate is about 2 lakh crore would be the shortfall on the tax collections, purely because one, nominal GDP is low compared to what was budgeted. Two, more importantly, the steps taken by the government in order to revive consumption implies tax foregone. So these factors are definitely going to result in tax revenues coming off almost by 2 lakh crores. How does one meet it? That is the question. We believe there would be compression even in revenue expenditure to some extent, but more importantly, as we've been pointing out earlier, CAPEX would also see a fair degree of compression. Fortunately, the non-tax revenue has been the savior in the math as far as the revenues are concerned. We have seen RBI dividend support. We have seen the public sector enterprises revenue coming in terms of dividends and profits. So there has been some cushion against that serious shortfall. But overall, we do see tax revenues, remaining pretty much below the budgeted estimate mark.
Okay. Lakshmi, opening thoughts? So the borrowing, I mean, going by different estimates, is not supposed to be, too elevated. I think most people are saying maybe 11.5 to 11.6 lakh crores. But really, what do you think could be the big headline from this budget?
Hi, morning, Surbi, and happy Sunday to all of you. Saturday night party had to kind of get nipped in the
See,
bud.
I was partying with my notes, with all of this. Our phones were up throughout the night. This was my party. Saturday night.
Barely slept.
And belly slept.
Yeah.
Full night party.
Lakshmi, before you start, I just want to ask you: is there any song or dialogue that you would want to, dedicate to the FM as she gears up to present her record historic budget? It's history created by us as well, working on Sunday with a full trading session ahead of us. So, I mean, I know you have some great ways to connect Bollywood, market, songs. Please go ahead. Entertain us a bit this Sunday morning.
Have you seen the movie RRR, Ram Charan movie? Of course. Restraint and the result. I think that's very, very critical. Point number one. And, typically market participants expect budget or, finance minister who's presenting the budget to be like the Kamadhenu, they expect everything of her. I think this is the time to be pragmatic. From the bond market perspective, to your question, Surbi, I think, yes, you're absolutely right. Any number under 12 trillion rupees of net borrowing should not really hamper the market significantly. If you see in the last 2 months, November up until now, average of 6.5% on the 10-year benchmark has already inched up to 6.65%. So I think the lingering overhang concerns, potential slippage in FY 2026 is what the market is expecting, though I'd say that we think they will keep it well within that or just about that 4.4% mark. And of course, how is this burgeoning supply for achieving approximately 12 trillion of net supply? You need the gross borrowing is likely to be about 16 trillion rupees at about 4.2% of fiscal deficit. So I think that's going to be the mood which will probably guide the bond markets also. Post budget, not so much really on the announcement day.
Okay, all right. Just stay on, Shubda and Lakshmi. We have some more, math and the macros to discuss. But before I free up Trideep and Shiv, quick final thoughts. Also from a market perspective, Trideep, let's come to you. Then I'll come to Shiv. It's been a tough year. The government is already, to be fair, it's done a lot. I mean, GST cuts, the right announcements on reforms, the labour codes, income tax. So are we putting too much emphasis on the finance minister again today? From a market perspective, what do you see ahead? Quick take, Trideep.
Yeah, so my sense is that we should be, I think we should give the reforms that they have done a bit of time for it to percolate down to numbers. And 6 to 9 months is usually the time. So I don't expect too much of stimulus again coming the way of consumer. Maybe investment side, capex growth, they show the commitment back to manufacturing. But overall, this will be kind of, given what they have done outside of the budget, this should be a little bit of a non-event from that perspective. And as long as the earnings start to flow through in the right direction, like we have seen in autos, and hopefully it comes through in others as well, I think the market should generally pass on from here. I think one cue that all of us would be clearly watching, one is on the currency front, because we are one of the only currencies which we have depreciated. So some sort of thinking in and around what how we see stability coming through, and some confidence on the budgets, on the capex side would be good enough for markets actually, barring of course the wish list of STTs and whatnot, which will continue ad nauseum.
All right, Shiv, your closing thoughts from you as well. What is that one announcement that could really fire up the markets? We know that, budget day, we haven't really seen big moves. Markets are volatile, but the moves are restricted to, 0.5% to 1% or so. But, how would you, or what would you, actually look out for budget in terms of announcements that could give an immediate, push upwards to the market?
Great question. I think, our channel checks are indicating that the Indian economy itself has been bottoming out. We have seen articulated well, Surbi, that nothing has worked in the last couple of months in terms of market standpoint. We are seeing growth pick up in credit, and there are pockets of consumption gaining traction. But the one thing for me, what the government can provide incentivize is private capex, and a relief from that perspective, because that's something that's been missing in the Indian context. And if there were measures put in place, which is, me thinking out of the box, I think that would really provide an impetus to this, from a market standpoint in your portfolio.
Okay, all right, Shriv, Tradeep, thank you so much for working for us and for the country on Sunday. And we look forward to getting your take on the budget again, either today or perhaps in the coming days. We definitely want to have you back. Thank you so much for joining us today. Shubhda, to get back to the big numbers. Okay, so let's break this down. Let's talk about capex. So capex, as a percentage of GDP, do you expect it to continue to run around this 3% level? Could it be substantially higher given the fiscal tightrope? And in the absolute sense, what kind of numbers are you expecting, and how would it be broken up between direct budgetary support and then the capex through PSUs?
So I think, since COVID, government has been the heavy lifter as far as capex is concerned. And we have seen that as a ratio to GDP, coming close to 3% consistently on the top. How long can it go on doing it? I think this could be probably the final year where we see government capex push remaining at close to 3% of GDP. In absolute numbers, we expect it to be somewhere close to 11.7 lakh crores compared to, it has been around 11.1, 11.2. The reason why we do not see a significant push up to 12 lakh crore or thereabouts, which broadly a few market estimates have been floating around, is one, I believe that absorptive capacity of the 5-year run, constant run in government-sponsored, government-led capex is perhaps now waning, and we need to now put our efforts more towards private capex invigoration rather than just leaning on to one. As I said, this is probably the final year where we see the government with equal focus shifting attention, or rather maintaining attention on capex, because let's not forget, next year is an important year. We will have 8th Pay Commission on board, which will require a fair amount of funding coming from the capex. So probably this could be the last year where we see 11.5, 12 lakh crore kind of a budget on capex, out of which my sense is majority would be the budgetary support and a small share could be for the PSUs. Overall, we definitely need to see that how much more are we going to be able to garner in terms of taxes. Direct taxes are done. We've seen GST done. I think the only piece of an unfinished task that remains is reworking on the customs duty framework, which, including us, most of the market participants are expecting a fair degree of commentary on the roadmap on the customs duties side, particularly in an era where India is focusing on a whole set of trade agreements. It could be free trade agreement, but otherwise as well. So customs duties would be one area that the government would focus on. In terms of the budgetary math, I think we are not seeing a significant increase in terms of the size of the budget from 50,650 billion rupees. We see it about 53,000 billion rupees. So overall, there are going to be some constraints on the budget. Let's not forget this budget is going to be presented under 4 shifting dynamics. One very clearly we saw is, the fiscal deficit indicator moving to debt indicator. So from 56.1, we are anticipating it to come to 55.1 as a ratio to GDP. Second would be that they will take on board the 16th Finance Commission recommendations, which need to be put into operation by 1st April. That is the second. The third would be, as I said, customs duty framework will be, reviewed very intensively. And lastly, I think more important is the math would depend on a whole set of macro parameters coming under revision. Now, we are going to see CPI upfront in February, followed by GDP, and then we are going to see IIP in May. The point I'm trying to make is the nominal GDP, actually, we are looking at, given all the revisions, probably we would look at somewhere close to 10.4% or 10.5%, so that should help some bit of tax buoyancy, tax revenues remaining relatively robust. But the government has a tightrope walk, definitely, because there are not too many free levers available from here on for the government, because debt management will be receiving a fairly high priority.
Right, Lakshmi, I want to come in here and add a fourth R to the RRR that you mentioned, rupee. Very important to discuss that, because we are down to 92 now. What is the trajectory looking like? You think 91 to 92 will be the range going forward? And any specific announcements on the currency front that you would be keenly watching out for?
Pointed, measures for currency in the budget? Probably not. Maybe more in the upcoming monetary policy committee, which is there on 6th. But I'd say that if you look at the basket of 40 currencies now, the rupee, which has been overvalued for the longest time, now is in the realms of more like undervaluation or probably right valuation. Having said that, FPIs have been non-stop sellers in the equity markets, though I know they are marginally like 5 or 1,000 crores net buyers in the month of January itself in the bond markets. But maybe, some sort of a tweak, or I don't know what that is likely to be on the FDI norms will probably have a better bearing on the rupee, I think, rather than having pointed measures for the rupee. That's very unlikely in the budget.
Okay, that's very unlikely. But also, with respect to bond yields, they've also been on an upward trajectory. Any thoughts on where yields are headed?
The FY 2026 borrowing program, up until now, a very strong anchor has been open market bond purchases. Over 6 trillion rupees of bond purchases has really anchored the bond yields. And after that, after rate cuts, CRR, OMOs, you've seen the bond yields move up. There's been a small disappointment that the additional layer of index inclusion, which was most spoken by the markets, did not happen. So I think all of that will continue to weigh in on the bond yields. If some of the mutual fund industry recommendations, even if it finds a mention in the budget for further detailing, any of those measures probably will give anchors to the bond demand at the current juncture. Otherwise, no major fireworks, I would say. So no patakas and no dhamakas as such. So looks like it'll be a range bound kind of a thing. But if the rupee weakness persists, which is not extremely unlikely, the bond yields could see a slightly upward bias before stabilizing around these levels.
Okay. So, Lakshmi, so we also have, let's not forget, it's such a long week. We'll run into policy by the end of this week, right? So, do you see any interlinkages here? Borrowing, as you're saying, is largely, pretty much consensus in the market, right? That should be a bit of a non-market event. So, how do you expect the RBI to take aim next as we get towards Friday?
So obviously RBI will not be groping in the dark, because the budget will give a good segue into the monetary policy continuity. That's point number one. No rate action clearly expected, but more along the lines of the demand levers to be able to. So, will RBI probably indicate explicitly or in an implied manner about the potential OMOs, because inflation is likely to only inch up from the current levels because of base effect, because of composition changes, all of that. So maneuverability on the rate action may be limited, of course, unless US does a hat trick of rate cuts this year. So unless something of those bazookas are shot, I'd say that the monetary policy decision is largely going to be on anticipated lines and more to probably give you some rigor on the liquidity front and, of course, on the rates front as the fourth R that you mentioned.
Okay, all right, ladies, thank you so much for getting us fully prepped up, fully geared up. Let's see what the actual numbers look like for FY26 and the projections for FY27. And once again, we'll rely on your wisdom over the next couple of hours and the next few days to make sense of the announcements that come out today. Thank you so much for joining in. Well, viewers, check out some of the key budget expectations, the key data points that you need to be aware of as we get to the budget speech. It's just about 9 o'clock. 2 hours to go till we hear from the finance minister. We'll be back in just a bit.
सबसे पहले तो जो आम आदमी और पूरी मार्केट की एक्सपेक्टेशंस रहती है वो टैक्स इनकम टैक्स को लेके रहती है. तो वी आर होपिंग कि जैसे लास्ट टाइम काफ़ी मेजर चेंजेस आए थे इनकम टैक्स स्लैब्स में, सो कुछ ना कुछ टैक्स रैशनलाइजेशंस इस बार भी होंगी और थोड़ा और उसको ईजियर किया जाएगा टैक्स स्लैब्स को. दूसरा है जो कैपिटल गेन्स को लेके काफ़ी देर से डिमांड चल रही है कि कैपिटल गेन्स जो लॉन्ग टर्म कैपिटल गेन्स है उन पे भी गवर्नमेंट थोड़ा सा अगर नज़र डाले, क्योंकि उससे क्या है कि लोग ज़्यादा लोग फिर मार्केट में उतरना शुरू करेंगे शेयर्स में और स्टॉक मार्केट में. एमएसएमई एक बहुत इंपॉर्टेंट सेक्टर है इंडिया के लिए. एमएसएमई की भी बहुत सारी एक्सपेक्टेशंस हैं. एमएसएमई को कोविड टाइम से भारत सरकार का सहयोग मिल रहा है, जैसे CGTMSE है जो स्कीम्स हैं जो कोलैटरल फ्री लोन और ये सब की, और एमएसएमई में परचेज प्रेफरेंस रहती है. तो एमएसएमई को लेके भी कुछ ना कुछ बड़ी अनाउंसमेंट्स होंगी, उनका भी हम वेट कर रहे हैं. विमेन एंटरप्रेन्योरशिप के ऊपर लास्ट बजट में काफ़ी कुछ था, तो विमेन एंटरप्रेन्योरशिप और विमेन एंटरप्रेन्योर्स के लिए भी कुछ ना कुछ अच्छा आएगा, उसका भी वेट कर रहे हैं. एग्री सेक्टर में काफ़ी रिफॉर्म्स थे प्रीवियस बजट्स में, तो हमारी उम्मीद है कि अब टेक्नोलॉजी एडॉप्शन और फूड सिक्योरिटी को देखते हुए कुछ ना कुछ अनाउंसमेंट रहेंगी इस बजट में. क्लीन एनर्जी की तरफ पुश रहेगा, क्योंकि हम लोगों की डिपेंडेंसी, हम लोग फॉसिल फ्यूल बेस्ड एनर्जी पे खत्म करना चाह रहे हैं, तो हम श्योर कुछ ना कुछ क्लीन एनर्जी को लेके भी कुछ ना कुछ पुश रहेगा इस बजट में.
We have lot of expectation from the union budget, and especially I think lion's share to be given to the state of Karnataka. A lot of pending projects will be cleared in this budget. Especially we are generating a lot of revenue through GST, but there are a lot of things where GST is not implemented in a very proper scientific manner. For example, for artificial limbs also there are charging 5% GST where they are giving free of cost. In such many sectors, GST is been implemented, but it is on the officer level. I request the Honorable Finance Minister to examine and give reduction wherever possible. Especially while talking about railway budget, we have a lot of pending projects of North Karnataka, especially in this zone. The main thing is Hubli-Ankola broad gauge line. Our late Honorable Prime Minister Shri Atal Bihari Vajpayee ji had laid the foundation stone, and 20 years down the line now still nothing has been happened. Now no new DPR has been created. I request the central government, Railway Ministry and Honorable Prahlad Joshi to intervene and get the clearance for Hubli-Ankola broad gauge line. There is a very big railway land available on Karwar Road. Government was trying to give it on lease out basis, but my request to the central government is to kindly establish a very super specialist AIMS model hospital for the railway employees of this part of Karnataka. We have centenary old workshop in Hubli. The workshop has to be upgraded with the modern technology. Vande Bharat train bogies has to be manufactured, and maintenance of Vande Bharat and high-tech railways has to be implemented. So infrastructure development of the Hubli workshop is very important. There was an announcement of Gulbarga division when Honorable Mallikarjun Kharge sir was the railway minister. I request all the MPs of Karnataka to strengthen Gulbarga and Yadgiri section by announcing Gulbarga division in this railway budget. That is what I request through your media.
At the outset, we would like to acknowledge the strong progress achieved under the India Semiconductor Mission, ECMS, PLI, DLI, C2S and other ESDM initiatives. India has clearly moved from the aspirations to credibility and a trustworthy, emerging as a serious and investable destination for the electronics and semiconductor. As the ecosystem now enters a phase of execution and scale up, it is critical to sustain policy momentum both through the forthcoming union budget and a period after that. Key industry expectations include enhanced budgetary allocation for the timely disbursement of the incentives for ongoing projects, rationalization of the inverted duty structures to improve manufacturing efficiency, PLI benefits to be linked to the value addition to support the growing ecosystem. Additional allocation for the ECMS scheme, which has demonstrated strong traction, along with the export incentives, targeted support for MSME startups, and continued focus for skilling and talent development are also equally important. Next phase of Design Link Incentive Semicon India program under ISM 2.0 is highly anticipated, whether announced during the budget or shortly thereafter. Collectively, these measures will consolidate recent gains, accelerate execution of the approved projects, deepen domestic value addition, and further position India as a globally competitive and a trusted hub for electronics and semiconductor manufacturing.
Well, we have less than 2 hours to go before the Finance Minister presents her 9th budget on the floor of the House. And it's going to be all about taxes. Lots of changes have already happened, whether it's GST or income tax. But could there be more in store? Let's understand the tax landscape. We have 3 experts now joining in. Sunil Padala, partner and head of tax at KPMG India. Sameer Gupta, national tax leader at EY. And Dinesh Kanabar, chairman and CEO of Dhruva Advisors. Gentlemen, good morning. And thank you so much for joining in. Working Sunday for everyone. And taxes the focus. So, Mr. Kanabar, maybe I'll open with you. Given that so much happened on tax in the last 12 months, should we expect anything at all today? Sir.
I think first and foremost, the important question is we have a new Income Tax Act which is coming into effect from 1st April this year. And before the act came, there was a draft, there were a number of representations made. The draft was referred to a parliamentary committee where again number of representations were made, and therefore to expect wholesale changes coming in the law is something.
Dinesh, sorry, just give us 1 second. So we've got the photo op happening at Kartavya Bhavan now. Finance Minister with her entire team of budget makers all set, and that is of course the budget document in e-format, and we're getting those visuals from New Delhi live now. I think after this, she'll make her way to Parliament as well. So there you go. You have all the secretaries, all the key dignitaries and the chief functionaries in the Finance Ministry with the Minister herself. Okay. All right. Let's, apologies. Can we get all our guests on the screen, please? Let's get all of them in the window. Apologies, I'd cut you off, Mr. Kanabar. The only added cue we have now is that she's chosen to go with a red sari. I don't know if that means anything, but please continue.
Well, you can read that much better than I can ever hope to do. But
sorry, go on. You were saying, yeah.
So to expect wholesale changes in the law might not be something which is appropriate. And there is a big difference between what one expects and what fiscal prudence will allow the government to do. So here are a couple of things which I am hoping will happen. One is that we are looking at a lot of AI, lot of semiconductor manufacture, etc. happening in India. And I do hope that there would be some consideration of how we can incentivize R&D and manufacture in India. Both of those are very, very important things. We had incentives for research and development, and maybe because of abuse or whatever else, those incentives have been given a go by. They have had a sunset, and I do think there is a need to revive. Look at it this way, that we have whatever is happening in USA, a possibility that several of high quality educated people might be coming back to India because they can't get a work visa there, H1B visa there. If they're going to come back here and we are going to get them into mainstream, incentivizing R&D is one thing which I'm looking forward to. I'm also looking at how can we look at a manufacture in India being incentivized. Also, I am looking at a lot of changes happening on the custom side, and this seems to be real. This seems to be something happening. So as we see tax laws, a lot of digitization has happened. But the one area where digitization seems to have been given a go by is customs litigation, a lot of pile up of litigation. The estimated amount of monies locked into customs litigation is 1.5 lakh crores. And these are matters running over decades. We need to have two things there. First, we need to have something which is faceless, like we have in income tax, like we have elsewhere. And second, so a lot of paperwork needs to go away. Second, also what we are looking is whether there could be something like a settlement scheme, Vivad Se Vishwas, which has happened on direct taxes, on GST, something like that happening in customs. And finally, what we are looking at is a rationalization of rates. Today, there are 8 different rates, 5 other tariffs. Can that be rationalized into 4 rates such that it's neutral, but will cut down a lot of litigation which is currently happening on the rates, etc., etc. So I'm expecting a lot of changes out there, really.
But you haven't come to the big headline one that everyone's holding their breath on, right? I know you left it out for good reason. So let me go to Samir on that one. Samir, this capital gains tax bogey, there's such a raging debate whether it should be rolled back. It's a tough market. Then there are those who argue you can't keep changing tax architecture and rates every year depending on the market's mood. So your take?
I think you said it. You can't really move back and forth on this. And I think what they did last time was after a lot of thought, and the Revenue Secretary had also explained it that way. Correct, that we've looked at everything. We've rationalized the holding period as well as the rates for everyone. So from a future path perspective, I think there is a challenge in trying to tinker with the rates. But I think fundamentally the duality of levy of long-term capital gains and STT, and we've discussed this earlier also in your show, Surbhi. I think that's definitely something that needs a serious relook at. And to your point on FPI exits, and we've seen, I'm sure there are several structural reasons why FPIs may be exiting. But I think one of the things that they've always struggled with is the duality of the levy, both LTCG as well as STT. Because in many markets, like we've already discussed, there is no capital gains tax per se on portfolio investments. So I think that's definitely one area where there are some expectations. Which way they will go, that's going to be speculative. But that's one area I think definitely that one needs to really look at.
Okay, so capital gains is one part. The other thing, and Sunil, let me throw this one to you. The other debate that's really stirred up in the last couple of weeks is the difference in the way equity is taxed and the way debt is taxed, right? And the sweetener of indexation for debt was taken away for debt mutual funds a couple of years back. And there's a strong argument, and it's actually, I've heard this argument, it's a very strong and maybe a very valid one from wealth planners. And I look at personal finance also very, very carefully. So they argue that, whether we like it or not, tax does end up having a huge role in deciding what people want to do with their money. And because equity taxation is far more favorable, even if, someone, an old senior citizen should be investing more in fixed income, they're driven, they're hoarded towards equity because it's just, better tax, post-tax return. So has the time come to change this or not? Maybe not this year.
No, absolutely. I think personally it is, the time has come to actually change that. And I understand the rationale because I think the reason why it was introduced in that manner was that they wanted to bring all these debt equity mutual fund as well as, let's say, unlisted bonds at par with the bank FDs, etc. But I think there is a merit in considering these investments at par with equity. So today, I think we all know that the interest in the debt mutual fund is coming down for the simple reason that there is a huge amount of tax burden there. Likewise, we do need to deepen our bond market. So whilst we have no concern on the listed bonds because they are treated at par with the equity, but I think as far as the unlisted bonds are concerned, any gains arising from unlisted bonds is considered to be short term, and therefore that is again a very steep tax burden, and therefore these are the two areas that I think need serious consideration.
Mr. Kanabar, let me come to you. I mean, this equity versus debt. I mean, there were years where you wanted to create an equity culture in the country and channelize, savings sitting in banks to the equity market. But we have a thriving equity market now. I mean, the Eco Survey gave us the numbers, right? I mean, local investors now own almost 19% of the market versus I think just 16% owned by FPIs. So equity versus debt, what's the path or what should be the path?
No, so two parts to it. First is Uday Kotak, for example, has been one of the biggest proponents to come back and say that money is going away from the banking system primarily because of lack of tax incentives. And I do agree that there is a need to put parity between the two. But look at it this way. Here we are saying that the equity markets have now done well. People have been investing a lot. Yet we are saying, first of all, capital gains should go away there. That's one demand. And then to come back and say there should be parity. So then are we saying that there should be no capital gains tax either on debt or on equity? What are we trying to say? So again, the two markets are very, very different.
Double upper circuit then, Mr. Kanabar, then double upper circuit in the market if we decide to abolish capital gains. But no, let's not, I mean, let's also be, a little realistic. But if not parity, I mean, I'm saying from an architecture perspective, and that's what I'm saying, maybe not today on this day in this budget, but from an architecture perspective, what is it that the government should start thinking of and moving towards?
I agree with you. There are two parts. One is there's a risk profile which debt has got, and there's a risk profile which equity has got. Overall, from an architecture perspective, I would agree with you that investment, whether it is in debt or in equity, should have the same parity. And I think there's a lot of merit in that. And I'm sure that it is engaging the government. I've personally been part of deliberations where government authorities have come back to say, yes, they are closely looking at it. Whether it will happen in this budget, I don't know.
Samir, you want to weigh in quickly on this debt versus equity debate?
This is something which, industry has been calling out: debt mutual funds, unlisted bonds, unlisted debentures. This was taken away and, deemed as short-term gains. So that's a pretty tall task to put them into the residuary income bracket with the highest marginal tax rate applying. I think that's not something which will augur well for the debt market. And the sentiment is also to build a larger and deeper bond market, right? So with this kind of taxation, I think it doesn't really help from an investor sentiment point of view. So definitely, I think, hopefully there is something in the budget for the debt folks as well. This because they've been asking for this for a while. Just one thing I would add more, Survi. I think from a sentiment point of view, we discussed this even earlier, that, in the aftermath of this Tiger Global ruling, a lot of investors are also trying to see if there is some way in which their fears can be assuaged, about any reopening or anything from the past for cases that have already been closed. So hopefully, while they can't put something specific in the bill, but some statement towards that will also be good for the investor community.
Just allow us a couple of minutes, gentlemen. Markets have opened, so let me quickly dive in and take a look at how the mood is. It's 9:15 and the mood is cautious. We'll get back to our tax conversation in just a second, but what we have on the screen is about a 50-point drop right now on the Nifty. We'll quickly update those rates. Let's see what is falling, and it's metals once again, and this is not a surprise really given what's happened. The massive volatility that we've seen on Friday in overnight action, in global market action. So you've got Hindalco, Tata Steel, JSW Steel. This is stocks on the way down. Let's pull up, if we can, Hindustan Zinc. Stocks like Hindustan Zinc, stocks like Vedanta. Because that's where the crunch was being felt on Friday afternoon itself. A lot of these metal stocks were down in a big manner. And that seems to be continuing this morning as well. Yes, Hindustan Zinc is down 10% as we speak. Metals are sliding. Remember, Hindustan Zinc has perhaps the maximum direct exposure to silver in an equity form that we have in our markets over here. and the 30% plunge that we saw in silver prices is leading to this big decline in some of these stocks. So Hindustan Zinc is down about 10%, like I said, at least at this point in time. Let's take a look at some of the other losers. Vedanta, yes, Vedanta is also down 7 to 8%. So metals as a pack is really tumbling because of what we've seen on Friday in Wall Street action. What else? Let's see. Misho is down after numbers. IOB is slightly lower. Nalco as well. So anything which has an aluminum, look at the Nifty Metals Index, down 4.5%. Anything that has a metal play and definitely a gold and silver play, all those stocks are down. I even saw MCX down quite a bit because of this massive slide in commodities, particularly in metals. MCX itself is losing about 9% as we speak. So pretty dramatic moves coming through. Okay, let's see what else is happening on the Nifty. So metals are down. That's one very, very clear theme. Let's see what's the counter side to it. Sun Pharma after numbers is looking good. Sun Pharma is up about 3.5%. Bajaj Auto's numbers are being very well received by the market. Stocks up about 1.5%. There is some buying in large cap frontline banks as well. So yeah, there you go. That's your green. Those are good result reactions that have come in post market hours on Friday. You've got HDFC Bank, Axis Bank, L&T, some of the heavyweights, which are keeping the optimism intact. And they're good counterweights to the fall in metals. The good news for the Nifty is that the metal stocks are not the most highly weighted on the index. So despite this massive drawdown in the metals part, you're not seeing that reflect on the Nifty so much. Nifty is down only 30 odd points, at least at this juncture. A couple of stocks on the upside then. Let's take a look. What do we have here? We've got MTAR Technologies. We have Shilpa Medicare. These are some of the gainers on the upside. So this is how it's playing out. Quick volume check on some of the top volume counters and see what's happening over here. Hindustan Copper, it's all about metals falling. Those are your large cap names. Let's pull up some of the metals back again. So that's the large cap picture. Power Grid is all right. Power Grid also reported numbers. HDFC Bank, Axis Bank looking okay. The highlight of the morning is the absolute slam dunk in metal stocks. I'm going back to the individual names here. Hindustan Copper should come up for you. 15% down on Hindustan Copper. Metal Index down 4.5%. Hindustan Zinc, Vedanta, Nalco, Tata Steel, all of the metal names are sliding as we speak. The Bank Nifty is showcasing a little bit of green, but that's the big story. Metals down about 4%. We'll get to this with our market experts in just a bit, but let's go back to our tax experts to complete the conversation. So, gentlemen, quick final thoughts. Sunil, if I could come back to you. Okay, we've discussed capital gains at great detail. Mr. Kanabar made the point about dispute resolution. Maybe, we see something like that on the customs side. Anything else outstanding? I mean, there have been changes in buyback taxation, for instance. Is there any further clarification needed anywhere? From a tax rate change perspective, beyond capital gains, would you watch out for anything?
Should be not really. Actually, our corporate tax rates are quite moderate. I don't think we are expecting anything major there. But I think Mr. Kanabar did touch upon briefly on the point of incentives for the manufacturing companies. I think there we are definitely expecting that earlier we used to have this concessional rate of tax applicable to new manufacturing companies and new manufacturing units. Last year's budget we were expecting that that will be brought back, which didn't happen. I think again, basis our conversations with various industry players, I think there's a huge expectation that the concessional rate for the new manufacturing facilities should be brought in. Otherwise, I don't see any other changes happening.
Okay, quick final take, 10-second take. Samir, your big watch points?
I think hopefully there'll be some good, direction in that, both after the aftermath of Tiger Global, as I was saying, as well as for, large commitments which is coming in cloud, data, AI infrastructure. I think, the concessional regime for that or accelerated depreciation, I think those would be good sweet spots to make Indian industry more competitive. Rest of it is more procedural, which I'll not really go into.
Okay. And Mr. Kanabar, before we thank all of you gentlemen, Gift City, we didn't get to gift. Any new measures, any clarification, anything else needed?
He has been 2 steps forward, 3 backward, 2 sideways. So there is a number of things which need to happen out there. Whether it can be used for external investments, how can it be used? There is a need to put that framework in place. Just one quick thing you mentioned about, is there any need for any changes? And I would say there is a real need for changes on reorganization. I'm not expecting that to happen because those representations were also made to the parliamentary committee and nothing has happened. But that's something which is the need of the hour. And finally, we had this Supreme Court judgment on Tiger Global, which has created its own uncertainty. And I am hoping that the finance minister will be able to come up with some guidelines which will take away the impact of Tiger Global.
Okay. All right, gentlemen, thank you so much for joining in. Let's see what the final announcements look like, and we'll come back to you for an analysis once perhaps the speech is over. Thank you very much for taking us through the pre-speech section. Thanks for joining in. Well, with that, let's shift our focus back to the markets. And the market, like I said, at the Nifty level, things are fine. The mid-cap index is where the pain is, and that index is down about 0.7%, and it's all about the slide in the metals complex. Gautam Dugar of Motilal Oswal is joining in. Gautam, good morning. Working Sunday. And what drama. We thought this day will be only about the budget. But it's about this 30% silver crash, this 10% gold crash, and the absolute panic in the metals market. Let's start right there. What do you think is going on? Is it going to be a 5% down on the Nifty Metals Index? Is this a one-day shakeout? Or will people have to go back and rethink their overall positioning on some of these stocks?
Good morning, Sobi. Thanks for having me here. And it's good to see you in the new avatar now. All the best for your journey on the digital foray.
Thank you so much.
As far as commodities are concerned, I had absolutely no clue when they were going up. I didn't predict a year back that silver will double or more than double in a year. So it will be very incorrect on my part to now pretend that I know where this slide will stop. As far as commodities are concerned, it's very difficult to make predictions. It's fair to say that they've had a vertical rise in the last 2 years. So some profit booking is definitely needed. It needed an excuse. It can be dollar index. It can be the announcement of new Fed chief, whatever it is. But the kind of returns that people have made in commodities, precious metals over the last 18-24 months. It just needed an excuse to correct, and that excuse is there right in front of us. Where it will slide, what will lead it to, how much it will slide, where it will stop, what will be the reasons for it. Very difficult to predict.
But I mean, in your model portfolio, did you give a place to any of these metal names? Not purely from a tactical short-term trade perspective, but from a portfolio perspective, did they find any place in your portfolio to begin with? And if yes, then will you be tweaking that positioning?
No, unfortunately, we were underweight on metals, Sobi, because we thought that earnings will underperform, and earnings, while it is underperformed, the rest of the broader markets, in fact. The last 6 months of move in the metals was led more by global considerations rather than domestic earnings and fundamentals. Some of the stocks obviously have had a spectacular rise based on very strong earnings that they posted. For example, Vedanta, Hindalco. We hold Tata Steel in our model portfolio. We just published a big thematic on metals a couple of weeks back, highlighting our preferences in that domain. We like Jindal Steel, JSW Steel, and Tata Steel. Basically, the preference is more towards ferrous. Non-ferrous has had a very sharp rise. Look at Hindalco, which is the second or third best performing stock in Nifty in calendar 25. I mean, if I remember well, from the bottom post that fire thing in their US business, one of the plants, the stock has almost doubled, given the underlying very strong commodity price performance. So we are underweight right now, and we will not hasten to change the view. Given the price volatility that we are seeing right now.
Gautam, let's talk about the typical budget stocks, right? So defense, industrials, railways. Are you expecting, significant announcements? And even if those announcements come in with broad expectation is that we will see higher outlays for these sectors, right? The question is how much is already in the price? Or is there a fresh play here on some of these names, budget related?
So in our budget preview that we published about 3 weeks back, we've highlighted that we're expecting about 10% increase in government capex allocation for FY27, which is a number of about 12.4 lakh crores or 12.4 trillion. Now, do remember that FY19 to FY25, that's a 6-year period, the government's allocation for defense, or rather the broader capex umbrella, has gone from 1.9 lakh crores to close to 11.1 or 11.2 lakh crores. So that's almost a 5.5 times increase in the previous 6 years period. FY26 was the first year where the government put a sort of a break on continuously increasing capex allocation by 25-30%, and rightly so, because the underlying execution wherewithal hasn't changed much. So the same state government and the same bureaucratic process, they were spending 2 lakh crores on capex 5-6 years back. Now they have to spend 11 lakh crore last year, and this year we're expecting about 12.3, 12.4. Execution is always a very challenging thing when it comes to capex. There are a lot of constraints, land, environment, and what have you. So within the 10% increase that we are predicting for capex allocation, we do believe that defense will get a very strong emphasis, given the kind of geopolitical context that we find ourselves in. So we've highlighted defense, select industrial segments where the government could prioritize its spending. So also remember, Subi, from a very top-down perspective, when you look at the budget math, the levers that the government have at their disposal are very limited. We are talking about an overall 6 to 7% expenditure growth for the FY27 at an overall level for the government expenditure. Now, within that, you have to maneuver multiple things, subsidies, the rest of the interest payments, and sticky sort of expenditure line items that the government has to contend with. So therefore, the room or the headroom that you have for maneuvering the rest of the line items on expenditure is very limited. Within that, we expect the overall capex to see a 10% higher allocation and defense to receive a slightly better proportion out there.
Okay. Gautam, since we're talking about capex and these big budget numbers, let's go to our colleague Ishan, and after that, of course, we have Gurmeet Chadha joining in, we have Rohit Srivastava also joining in, so full panel on the markets. But before that, let's just look at these bigger numbers. What were some of the projections for the year that's closing out, which is FY26, and perhaps what could be the likely increase in some of these heads or under some of these heads in FY27? We have Ishan joining in with his budget diary, so to speak, with all the key macro numbers. Ishan, over to you.
Hi, thanks, Surbi. As Gaurav was talking about, 12.3 lakh crore capex. We are at 11.2 lakh crore. If you look at it, that was about 10% increase over the last year. And in FY25, the RE was about 7.3% higher. Now, 12.3 would put the number somewhere around 10% again. Highly unlikely in the sense that what the economists are projecting is about 12 lakh crore. That was our Moneycontrol poll, which is about a 6 to 7% increase. That would be the lowest capex increase in the few years if you look at it from 39, 25, 28 and 10.1. Similarly, on defense capex, Gaurav also mentioned this part. 12.9% increase. We see a jump here, a big jump here again coming from Operation Sindoor and other aspects as well. So this may go up. On the subsidy side, this is where the government has the room to cut actually. It came down to 5,77,000 crore, coming down to about 426. That's about a 0.4% decrease. The government has space there to cut. Although in the fertilizer subsidy, they will have to see what they can do. The main part here is the gross tax revenue. How much can the government ramp up from this? So from FY22, it was about a double-digit growth for the 5 years that you see. Can the government continue that double-digit growth given that it has given cuts on income tax and GST? And finally, the debt to GDP ratio. What is it? 55.2% is what our poll projected. Can the government go that low, or will it go lower to 53 or 54%? Similarly, on the fiscal deficit front, that would be another interesting aspect. There was about a 0.4 percentage point increase in fiscal deficit, decrease in fiscal deficit. Would that continue? Will we reach the 4% mark, which would be the first time since FY19? You can check all these numbers on our Moneycontrol budget hub. You can compare data here. You can actually, for instance, here I'm comparing defense capex with defense as a percentage of GDP. And you see how it's flatlined here, and government would want it to move up. Back to you, Surbhi.
All right, Ishan, thanks very much. Remember, viewers, you can go on to the Moneycontrol budget hub for all of those numbers, and they'll be updated in real time as the budget announcements are made. Okay, so some more visuals coming in, and that's the finance minister with the president before making her presentation on the floor of the House in the Parliament. So some more visuals, customary budget meetings ahead of the presentation of the document itself. All right. Well, let's get back to our panel of experts. Gautam Duggar, we also have Gurmeet Chadda joining in, and Rohit Srivastava to give us some sense in the technicals of a lot of these stocks which are absolutely sliding. Very quickly, Rohit, let me ask you about metals. People who've got open positions have probably had a completely sleepless night, and not because of the budget, because of what happened with Kevin Walsh and what happened with silver in the US, right? What's your advice? Looking at these 7, 8, 9, 10, 15% cuts on metal stocks. Stay put, let this shakeout happen, or cut your longs. What should someone be doing?
Well, for those people, they are lucky that the market is open on a Sunday when we don't have global markets reacting further to that news flow. So I would say that the opportunity today is to really get out of those positions and not suffer further losses as the metals unwind. We've had a spectacular rally in the metal space, and that has started to unwind, and we should not be caught holding on to a falling knife. So the simple advice is get out of that one segment at least for now.
Okay, all right. Gautam, before we let you go, what would your sort of final take be in terms of your budget expectations and your sense on the market itself? I mean, earnings season practically is now drawing down, last 2 weeks to go. How do you rank it? Are we going to get towards that 12-13% mark for FY27? I mean, how much of optimism does this third quarter give you?
So you asked, let me answer them one by one. On budget expectations, we are keeping it very modest given the kind of maths that the government has to work with. However, we do hope that government will make some positive announcements on the capital market related issues that have been discussed ad nauseum for last 1 or 2 months. Insofar as market direction is concerned, we are quite constructive now after 15-18 months of time correction and in some cases price correction as well. Because if you look at NSE 500, the median stock is down anywhere between 20 to 30% from the recent highs, right? The most heartening thing right now that we are seeing is a slight pickup in corporate earnings. We do expect that the second half of FY26 will be better. And the corporate earnings that have been declared so far, about 170 or rather 154 companies that have come in till Friday or Thursday, we've seen about 15% earnings growth versus expectation of 14. So that is broadly in line. For the 26 Nifty companies that have declared numbers, the earnings growth is about 7-8%, which is also in line. The pace of earnings downgrade has come off clearly. We are seeing much lesser downgrade now than what we've been witnessed to for the last 2-3 quarters. Also, the cumulative positive impact of the steps that the government has already announced in the last 9 to 12 months, which is interest rate cut, the income tax cut, and the GST rate cut, I think they will start manifesting themselves in the next 6 to 12 months. So we do have a very good positive backdrop for corporate earnings now. Low base because FY25 corporate earnings were flat at about 3-4%. FY26 also we will end at about 7-8%. So our expectations of FY27 earnings being anywhere between 15 to 16% still stays intact. And even if we see a 2-3% cut out there, and if we get a 12-13% earnings growth for FY27, within that, we are expecting the mid-cap cohort to continue to outperform on earnings. It's a separate thing that mid-cap as a cohort, if you look at the index, the valuations are still very expensive. So as earnings catch up with those valuations, we would see some select bottom-up opportunities emerging if they have not already emerged. So we are quite constructive and we are looking at opportunities in this correction. And there are dime a dozen opportunities which are now emerging. Sectors where we are overweight are consumer discretionary. Technology, we've bet overweight in November. We are overweight on select PFSI, which is the capital market stocks, the NBFC lending names, and also the PSU banks, which has helped us a lot in calendar year 25. Aside of that, we have a positive view on EMS companies, select industrials, and we continue to stay underweight commodities. We have missed the last 6 months of upside, but we are not chasing it anymore.
So just a quick follow-up, Gautam, and that was a very comprehensive summary. Thank you for that. On specific sectors, defense, because you'll always have the accidents. I mean, for instance, look at Bharat Dynamics, quarterly accident. The numbers were not that great, though otherwise we know the story. We know the order book is swelling, and we probably know that they'll keep getting orders. So on defense, what lens are you putting now? stocks are off the peak. But which kind of stocks are you willing to, buy at these levels?
We are very positive on Bharat Electronics. We have it in our model portfolio. It was also part of our top ideas list for calendar year 2025. We are continuing with that. And they've declared a fantastic set of results last week. We've seen an earnings upgrade in that name. Very rarely have we seen in this quarter big earnings upgrade in big stocks. So Bharat Electronics falls in that bucket. So that's the name we like. Apart from that, we also like Hindustan Aeronautics. So those are the two names we are positive on, out of which BEL is in our model portfolio.
Got it. Okay. All right, Gautam, thank you very much for being with us this morning and giving us your sense on the budget, the market, some of these important earnings and how things might shape up. Great conversation. We look forward to chatting up again soon. Okay, quick check on the market as we get to our next set of experts. The Nifty is flat, and that's the interesting story of the day. But don't go by the Nifty. All the drama is going on beyond the Nifty. On the Nifty, by the way, some of the oil and gas names are also perking up and climbing higher. Remember, Brent oil prices are at $70 to the barrel. And you're seeing some of that play now on an ONGC, for instance, 2% up. Sun Pharma continues to react well to the numbers as BEL, Bajaj Auto reacting well to the numbers as well. And L&T and Reliance. So your big boys on the Nifty, they're keeping the balance in place even as the metal slide continues. On the downside, beyond metals, there's also Infosys. There is Nestle and Eternal from the consumer pack as well. So watch out for some of these names. Okay, we've got Gurmeet with us as well. Gurmeet, thank you for waiting by patiently. I first want to start with the metals question again. And really, I mean, people who are watching this are just, I don't even think they're focused on the budget. They're wondering what to do with the stocks in their portfolio. So whoever caught this metal rally and this huge move in, for instance, in a Hindustan Copper or Hindustan Zinc, good for them. But what have you made of that massive shakeout on Friday and what we're seeing today?
I think Surbhi, it was due. I think, if you move up vertically, I think you should expect, the other side also. I think the best thing probably was Vedanta doing the OFS for Hindustan Zinc just at the right time. So you got to be more tactical, especially when you see sharp moves like this. I think a lot of things played out. It was getting overheated. Second, the announcement of the new Fed governor added to the trigger, and there was massive unwinding. Technical guys would tell you more, of the levered positions. So I believe one should be, and I agree with what Rohit said. You have to be a little cautious, and in case since global markets haven't opened today, and if you're already made some money tactically on it, I mean, take a call. We are on the fundamental side, so we are not too much into metals. I think the other opportunity would be in oil and gas space, as you rightly mentioned, especially refiners. We saw the likes of some of the pure refining plays like Chennai Petroleum, etc., do very well, very good set of numbers. Refining capacity has been very limited, and now with these changes in oil mix, Venezuelan oil coming, which is more heavier, complex refiners, tend to gain more. And as I said, the valuations are very reasonable in the space. OMC, I would want to see the part B of the budget in terms of what is the vision part there. How do they want the tax structure in oil pricing to play out? If they could mention a roadmap for the next 4 or 5 years, I think that could be positive for OMCs. But for that, probably we'll have to wait for the budget speech to play out.
Okay. By the way, some budget excitement is showing up on a couple of defense stocks. I can see data patterns rising on the screen, 4-5%. Idea Forge has taken off, the drone maker. Idea Forge, last time I checked, is almost 8-9% higher. So some of these stocks are showing their excitement. There you go, data patterns, Idea Forge. BEL anyway has been, quite buoyant since the start of the morning. Before I introduce our next guest, Saurabh Mukherjee, very quickly on metal, Saurabh is actually joining in, so we're just doing our checks with him. Rohit, on metals once again, I mean, if you look at the international charts, gold, silver, even crypto, all of crypto sold off, right? It was a massive risk-off move. What are the global charts indicating? I mean, has the recent structure been violated, or is this just a long overdue correction?
No, I think it looks like a complete trend reversal as far as the precious metals are concerned. Cryptos were already weak, so they have not really participated in this bull run. So they've been weak and they continue to fall. The real bull run was in the gold silver space, and that actually caused the base metals also to start flying higher. But now that gold and silver have peaked, I don't think the others would participate. In fact, today MCX, I was just checking, MCX is open and gold, silver and copper are 8, 9 and 6% respectively down. So I think that is what is having the impact today. So yeah, I think the structure essentially tells us that you had a, this kind of, wild one-sided move that you see in gold and silver has only occurred at the end of major uptrends or rallies. And its peaking essentially marks the end of the bull wave that probably started not just in the early part of this year, but probably a couple of years on. And so we should be prepared for a period of underperformance in precious metals, which lasts maybe a minimum 12 months, if not longer. So that is the discussion now actually, which you may be seeing between a lot of analysts is this the right time to make a shift from, precious metals to equities? That is, I think, the bigger call.
Okay. Well, let's bring in Saurabh Mukherjee into the conversation. Saurabh, good morning. Thank you for joining us. FM's making everyone work. But guess what? Guess who's competing with our finance minister for attention? It's Kevin Walsh. He's the other huge headline for the market, right? Global markets. So actually, let's start with him. Of course, we'll spend the whole day talking about our budget and our finance minister. But what did you make of this announcement, Walsh, and the way markets had this dramatic reaction? I mean, has it all settled in one day? Do we go back to BAU global markets? Or will this continue to kind of send ripples?
Look, I think at one level, this is classic Donald Trump, right? He'll make you feel as if he'll pull in a counter consensus candidate. But at the end of the day, what he's done is classic central banker from, central casting, as they say. Walsh is well qualified. He's worked in the Fed in senior roles before. He's a quality economist. And most importantly, from India's perspective, he's saying that he wants to cut interest rates. If there's one thing India needs desperately over the next 12 months is lower rates in America so that the RBI can cut further without jeopardizing the rupee. And from that perspective, I think Walsh is good news. And from perspective of the American bond market as well, I think they'll like a governor like this who's qualified, knows his stuff, credible figure on Wall Street. So all around, I think good news for us. I think we as Indians should look forward to Walsh expediting heavy rate cuts over the next couple of years so that the RBI can cut in India and give room to the economy to expand. Because the biggest challenge we face in India today is 3 to 4% tax revenue growth. There's very little any government can do anywhere in the world if your revenues are growing at 3 to 4%. Central Bank in Mint Street and the FM in Delhi will have to pull out all the stops to revive tax revenue growth and earnings growth in our country.
So on that, Saurabh, that's really the big question, right? That you've got these, rate cuts here in India. You've got obviously all the stimulus, GST, income tax, so many other reforms, the labor code, all the right noises. It's not really showing up in consumption in a very big way yet. It's not entirely showing up in corporate earnings. So when will it show up? I mean, that's the first question. And how much more of an impetus would you expect the finance minister to deliver today?
So I think it's actually the reverse. I think what the Indian bond market is telling us, and I think the bond market is sending a very clear message to both people like me in the stock market and the bond market, I think is sending a very clear message to North Block, is that look, you guys are borrowing too much money. Both the state governments for fiscal populism and the central government for capex. The government borrowing numbers are through the roof. The bond market is tightening. So in spite of the RBI cutting rates, the cost of money is rising in our country because between state and center, the borrowing is at such an elevated level, right? And therefore, I think the big to-do for the FM today is not so much to impress the equity market. I don't think impressing the equity market is going to achieve too much. I think impressing the bond market will achieve a great deal. So if we want cost of money to reduce in India, and the chief economic advisor is on the money when he says high cost of capital is a big challenge for India. If we want cost of money to go down, we should hope that the FM fiscally consolidates today. Ideally, to fiscally consolidate, she should cut capex and, if possible, give some relief to debt investors. Debt investors have been hurt in the last 4 or 5 years by paying far higher capital gains tax than equity investors. So give some relief to debt investors, get the cost of debt down, and at the same time fiscally consolidate by cutting capex. If she pulls off all of that by noon today, I think the bond market will be a happier place, and that will help the Indian economy.
Okay. Gurmeet, let's come down to budget stocks, if there is such a thing. So, the usual suspects, right? Railways, defense, electronics manufacturing, and we've discussed some of these in the past many months. Now, where do you, and assuming that there will be favorable announcements for these sectors, where do you think there's still some valuation comfort, where people can still build fresh positions and add them to the portfolio, where there is a compelling valuation and fundamental case to buy stocks?
Thanks, Subi. So, a couple of pockets which we think, the price correction has been quite severe. In fact, I think 50% of the stocks, in my view, in small mid-cap space are in COVID kind of a valuation. The kind of, time and price correction we have seen. I think defense looks good, not just because of the budgetary allocation. If you see in last few weeks on exchange updates, a lot of defense orders coming our way. So something like Solar Industries, for example, yesterday got almost 1,500 crores worth of defense orders. One of them was a large export order. And we've seen so many FTAs being signed. The UAE came for a couple of hours, large defense deal happened. We have a defense framework now with EU as well, and EU is going to rearm, led by Germany. So it opens a huge opportunity. Plus, they've allowed 75% FDI in defense. So you will see a host of things playing out there. Obviously, Bharat Electronics on radar, sensors, communication systems stands out. In fact, one thing I would watch out for is the QRSAM order, which could, if it comes in Q4, it's almost 20,000 crores. And with 27%, kind of margin, it looks very good from an execution point of view. I also think some of the auto ancillaries are looking very good. As the trade things play out, some of them are at 15, 20 times earnings. And the numbers, especially on the two-wheeler side, have been very good. TVS reported stellar set of numbers. Bajaj Auto had a very good run. So we like, something like an Uno Minda, Sandhar Technology, really available at good valuations. And I think some of the consumer discretionary names will make a bit of a comeback, considering that the GST impact and overall things it takes time to play out and reflect in the numbers, and will gradually start reflecting. And fingers crossed, I'm expecting something on, I'm maybe it's a little more optimistic, but I think something will come on capital markets. I think what they do to get FIs back, I think capital outflow is a huge concern. Whether it is withholding tax, whether there is any tweaking required in either STT, LTCG, maybe that's wishful thinking for now, but something will be done. And I think, and that's why capital market plays, in my view, is something I'll be very keenly watching.
I checked the latest numbers, Gurmeet, on STT collections. I was writing down my numbers yesterday, and those collections are looking so handsome at a time when income tax and corporate tax is trending below estimates. STT, they've managed to garner over 45,000 crores already. Budgeting, of course, 70,000 crores plus this year. But let me ask Saurabh. Saurabh, are you hopeful? Any kind of reduction in market-linked taxation?
I'm hopeful that they give bond investors relief. I think India missed a trick by putting bond investors on marginal tax rates for capital gains tax, and by giving equity investors a more attractive tax structure. We swung enormous amounts of money from the bond market into the stock market. The result of that is what we have lived through in the last couple of years, which is heavy OFSs, promoters coming into the stock market, selling their stakes without raising primary capital, and in many cases taking the money out of the country. And in the meantime, the cost of debt, the cost of bonds is going up, which is resulting in an elevated cost of capital. I think we missed a trick there by skewing the tax structure in favor of equities and against bonds. And I'm hopeful in the budget today, the FM remedies that mistake. I think that it was a big miss on all our parts. I think even I, as an equity investor, didn't quite realize how profound the consequences are of shifting money from the bond market to the stock market. I think it's high time we swung flows away from the stock market back into the bond market, get the cost of debt down, so that both for the government itself and for corporate India and for the banking system, cost of money comes down.
So that's the big debate, and we were discussing exactly this with our tax panel earlier, and I think most were in agreement. And now you're the fourth voice saying the same thing, that the time has come to look at some sort of tax parity between equity and debt and not be so pro-equity. I don't know if equity investors would like the sound of that in a tough environment, in a tough year. But gentlemen, Saurabh, just allow me 2-3 minutes. Let me take some final trading cues and calls with Rohit. Now, Rohit, the Nifty, 25,300 thereabouts, range bound. What are you forecasting for the next couple of weeks and maybe months? I mean, just looking at this range and the really rocky start to 2026 so far.
So if I just look at the setup, stepping out of that today's budget day and they can, break things either way. The setup itself indicates that as long as we are below 25,500, we are in a downward path. And we may probably attempt to break the lower end of the range in the coming days, which is close to around 24,940. And if we do break that, then we go and test 24,491. So these are the levels with a downward bias on Nifty. The surprise element could be that, yes, if you have something outsized in the budget, which I don't think anyone's anticipating, then probably it bounces back and goes towards a 25,800. For that, of course, we need to get past the 25,450 mark that I spoke of. But since we are below that, we are maintaining a negative bias for the days ahead.
Okay. And Rohit, in terms of your top bets on the long side, in terms of stocks, and again, this is not an intraday question, but just looking at it from a positional portfolio standpoint, for at least the next couple of weeks, are there any 2 or 3 names that you'd like to call out here, mid caps or large caps?
So out of all the investment calls that we had open and have typically been bullish on metals, we closed those out in the early part of January. The only thing we have open, what you spoke about some time back, is in the defense space. So it's Hindustan Aeronautics, which has sort of held its, channel price action and is ticking up a little bit in the last couple of days along with the rest of the group. So that probably remains, the singular area where we can find some kind of a defensive bet, because defense spending generally continues. And also we know that globally there's a trend towards increased spending by various countries that were doing less of it. And that will also get us, global demand for these companies. So I think the technical setup is not broken for this sector. It looks good. And probably the only one that we can still bet on in what looks like a pretty weak market.
Okay, so defense is the only long. Got that point. Rohit, thank you very much. We'll let you go on that note. I know you're coming back in the afternoon because let's see which way this market swings after that speech, and we'll require your expertise and advice there as well. Gurmeet, let me take this opportunity of thanking you as well. Many thanks for your views and your analysis this morning. Now, Saurabh, just to come back to complete, some overall thoughts. And I'm sort of getting down to brass tacks now. The deeper issues, I mean, those ugly questions that we don't want to raise, but we have to, right? FPIs have not shown any reason to come back to the market here. Let me know if you think that that's going to change anytime soon. And if we have this change in domestic taxation favoring debt, then we're talking about, a very, very different kind of a scenario purely with respect to flows, aren't we?
Yeah. So let's take the issues one by one. I think the FPIs, and many of them are Marcellus's clients, the FPI's main bone of contention is that India has always been expensive. India is still expensive relative to other markets. The challenge today is India doesn't grow faster than other markets, right? In dollar terms, Surbhi, in dollar terms, we are barely growing earnings in India. Profits of Indian corporates have barely grown in the last couple of years. In a world where, for example, the S&P 500 is growing, dollar profits at 11%, right? So it's simply not tenable, say foreign investors, that India will trade at these premium valuations 20 times forward compared to other markets without delivering any earnings growth multiple years in a row, right? So that's the crux of the problem from FPI's perspective. And therefore, if we want foreign investors back, we need to rev up India's earnings engine whilst keeping the rupee somewhere in the low 90s, 92, 93 to the dollar, and rev up India's earnings engine. Now, let's come to the second piece. If you're going to rev up India's earnings engine, consumption has to be boosted. Consumption is 60% of GDP. Without boosting consumption, it is not conceivable that somehow there'll be a sustained recovery in earnings. How do you boost consumption? You need jobs. Where will you get white-collar jobs in the age of AI? It's not obvious to me there's going to be white-collar jobs coming in the age of AI. And therefore, to boost consumption, you need tax cuts for the middle class, and you need a degree of of tax cuts for SMEs. SMEs form 80% of India's job market. They're a big source of consumption as well. So reduce taxes on small businesses, reduce taxes on the middle class. That would be one way to get out of the pickle we find ourselves in. Boost consumption via SMEs and the middle class, thus generate earnings growth, thus pull the foreigners back in, right? So that's one part of the puzzle. I think we're seeking some solutions to that from the FM. The other aspect is the rising cost of money in the bond market. That in turn is linked to both profligacy on state governments' part. State governments have developed a new habit in India in the last 5 years of throwing money, literally distributing cash to the public. That's now almost approaching 1% of GDP. It's a lot of money, close to 80 billion rupees being doled out as cash to the public, and that in turn is boosting the cost of borrowing for state governments in the bond market, which in turn is again compressing growth in our country, right? So how do you get state governments to become more sensible rather than distributing cash for votes? I don't have the answer to that. I suspect even the FM doesn't have the answer to that. So there are parts of the puzzle which I think are in our control. Tax cuts is a way to revive consumption, thus revive earnings growth and bring the foreigner back in. And there are parts of the puzzle around profligacy by state governments. There are, I think, 15 state governments in India who have live schemes underway to throw cash at the public for votes. That part, I think, is beyond the FM. That's a broader political construct in our country, which I think will take longer to fix. But some states, the bond market will have to be given a response as to why should they lend money at cheap rates to profligate state governments and to the government of India at affordable cost of money. So two parts to it. I think one part is solvable, bringing the FII back in. The other part, the profligacy on the government's part, I think that's a longer term discussion that probably can be done post-budget on money control.
So in this environment, in this context, Saurabh, what's the advice to equity investors? They've been keeping the faith. They've been putting in, these 30,000 crore rupees in their SIPs gross month after month. They've not fled the market. But from what you're describing, and if these tax changes indeed happen, and if the foreigners don't come back, then the environment perhaps gets more challenging over the next couple of months. Is that what you're hinting at?
I think if we are not able to deliver earnings growth to foreign investors, I think we will continue seeing pressure on Indian equities. Remember, small caps are already down anywhere between 5 to 25% depending on what small cap you've invested in. So the small cap correction is already underway. The part of the market that's held up is large cap, and specifically in large cap, PSUs have held up well, and to some extent companies that are affiliated to the government's capex ecosystem have held up well. So if the fiscal pressures continue, difficult to see how ad infinitum PSUs can hold up. My suggestion to those who are big devotees of Indian equities is, if you want to find pockets of comfort in India, go towards the quality large caps. There are reasonable valuations. I wouldn't say they're cheap, but quality large caps are at reasonable valuations. Surprisingly, many of them are growing earnings twice as fast as the benchmark index, right? So many of the quality large caps in the private sector are growing earnings twice as fast as the Nifty 50, and they're trading at reasonable valuations. So if you're a devotee of Indian equities, rather than pushing more money into mid caps, focus on quality large caps, and then let's hope and pray that we get fiscal consolidation in Delhi so that the bond market, the bond yields cool. If the bond yields cool, it gives room for corporates to borrow, and separately in parallel, let's hope that the government is able to revive consumption, because it's difficult to see jobs coming back, and that through the private sector route, difficult to see consumption coming back. And therefore, our main prayer today is that the FM is able to boost consumption through tax cuts in some shape or form.
More tax cuts at a time when you're also saying that the government should manage to walk that fiscal tightrope. It's not an enviable position to be in. You need to boost consumption, and you need to ensure that the fisc does not slip. But that's the tall ask ahead of the finance minister. Very well explained, very well put, Saurabh. Great to have you on as always, and we hope to have you back perhaps in the coming days to decode what this budget really means for the market, for consumers and for investors. Thank you for joining us today. All right, we look at the market now. The market has stabilized, but the metal stocks are still down. Mid-cap index is still weak, but it's down only 0.5% now. So it's not a completely runaway slide. Things have kind of stabilized. So take a look at some of the market trades, take a look at the key expectations, and of course some of the visuals that we had earlier of the finance minister meeting the president, and of course with her, her team from the finance ministry. We'll come right back, and then we'll have our panel of experts joining in on the macros, on the big picture, counting down 1 hour to go before the finance minister's speech. Welcome back. You are with us on Money Control's live coverage of the budget. Less than an hour to go. I'm Surabhi Upadhyay, and joining me now in the studios is Shweta Punj. Shweta, great to have you in.
Lovely to be here.
And we have our panel of experts ready. So let me quickly introduce our guests as well. We have Sanjeev Krishnan joining in from PwC for the big picture. And then, of course, we need to go back to the macros, go back to the drawing board on those big numbers. And for that, we have Madan Sabnavis of Bank of Baroda joining in. And we also have with us Radhika Rao of DBS. Thank you very much, ladies and gentlemen, for being with us. Let's get our guests on the screen if we can. Yeah, there we go. Now we can see everyone's. Good morning and happy Sunday to all. Sanjeev, let me open with you. So, the consensus so far this morning on Money Control with all our guests seems to be that, if not more tax cuts, but perhaps more reform, stronger messaging to get those animal spirits going. What would you want the finance minister to do?
I mean, in the next 1.5 hours or so, I'm actually looking forward not so much on the collection side of it, because a lot of that already has happened during the course of the previous year, but as to how the money is going to get spent. And really, the economic survey, if you look at the economic survey as well, I think 3 things. I'm so glad that it talks about some of those things. One is that, we do a lot of, small experiments, sandboxes or whatever. Now it's a question of scaling. We need to scale things. And we need to make sure that the economies, the factor costs really need to come down. The second one is really about productivity enhancements. And I'm so glad again that economic survey has multiple times spoken about it, that we need to focus on productivity enhancement, and the ROI on the spend will go up if the productivity is higher. And that also comes with value addition. And there's a lot of things that need to be done to make sure that happens. And finally, to continue to harness the strength that we have always had, which is services. With all the technology disruptions that are coming in, continuous upskilling, so spending on upskilling of our people to make sure that they feel more confident to take on what's coming to them is important. And that will make sure that the incomes continue to rise and private consumption, which has been the bedrock of Indian economic growth, sustains.
Right. So, we're seeing lovely visuals of the finance minister also, and she's wearing a South silk sari. It's a Kanjivaram sari. She uses her saris really to put out a strong message. And last year we saw a Madhubani. She was wearing a Madhubani. It was before Bihar elections. So
I'm glad you're getting to the finer nuances of the fabric and the style, because in the earlier morning markets panel, we just noted the color. It's a red sari or it's a green sari, and she's going with the red sari. No, it's not red actually. It's I think a deep pink maybe. So maybe the pink of his.
Yeah, but it's interesting because we also have elections coming up in Tamil Nadu, Kerala, Bengal. I want to hi Radhika, Shweta here. Very quickly, Radhika, we know that the 16th Finance Commission report will also be tabled today. How do you see this playing out in terms of, grants to the states? Because state finances have been tricky. Until now, there's been substantial pressure on state finances. Do we see states getting something from the finance minister this time around? Do you think Tamil Nadu, that has always been complaining that they've been left, out of the party, Tamil Nadu might actually get lucky this time around? And what would that mean from a fiscal point of view where, other spending priorities are concerned?
Thanks, Shweta. And I think that was an interesting observation on the sari as well. So coming back to the state finances, see what's happening is that the budget really primarily focus on what's happening with the central government's finances. So this debt consolidation path that we're going to go. So, this FY27 budget is going to talk about the nominal anchor will be the debt to GDP ratio, but that's still talking about the center. Fiscal deficit, also talking about the center. But what you're seeing is that at the state level, the ratios are actually, going the other way, which is that if you see the budget projections for state budget, it's expected to be above 3% of GDP, for the second, third consecutive year. And if you talk about the debt levels have also been stagnating to going up slightly. So net, what is happening? The consolidation on the centers stage, I mean center's end, is kind of being offset with what's happening on the states. So for ideal consolidation purposes, both of them should move in the same direction. Yes, to your point about by May, there are about 4-5 states that are going to go into elections. And I think all of that certainly will play a part into, I would say that will be part of the political framework. But coming back to the math, state finances in terms of the revenues that are being made up are certainly not enough in light of the expenditure commitments. Capex has been slowing a bit slower than expected. You've got more revenue pressure, RevEx pressure, mainly because wherever there have been elections, there have been a bit of populist spending, and I think there is more to come. So net, I think when you talk about the state finances, the central point is it's going the other way, not so much the consolidation path. And I think that pressure is certainly showing in the bond markets to begin with. Higher premiums are being built, borrowings have been going up, and in fact, state borrowings now are making a bigger portion of the total borrowings in the country. Center and state put together, the proportion is going up. So all these are pipeline risks. I think what we expect from the budget today is to show how much of the revenues are going to make its way to the states. GST nuances have also changed. But to my mind, I don't think we will see a huge jump from the current 33 to 35% of the share that states have been typically seeing in the past few years.
On the point of the pressure in the bond markets, I just want to also highlight the biggest debate that we've been having, of course, today here and throughout the last couple of weeks, I think, in the country, is this whole taxation piece. And before we get to Madan on the macros again, Sanjeev, just weigh in on this. Now, I think from a tax perspective, there have been two big headlines. One is, how does India want to tax foreign investors? That's one part. The other is, how does India want to tax equity versus debt? So just give us some parallels from other economies and what's really the practice around the world. Because here the debate has never been louder, I think, in the last couple of years, in my memory, of equity being taxed at 12.5% and fixed income, depending on your tax bracket, can be as high as 37, 38%. So is there a case for a change? And if yes, then what is the path India should take? And is there a global precedence, perhaps, that we should keep in mind?
So I think 2 points there. I think first on the tax part, any investor would hope for tax certainty. Without getting into specifics, I think there is a particular matter which might have riled a lot of investor groups and investor communities. I'm just hoping that is very fact-based and that doesn't become precedence for many other things to follow. And there will be certain clarity, there will be some clarity which will emerge. Or, this budget will be used as a mechanism to soothe the nerves of many of those. Within the whole FPI structure, I think there are multiple possibilities which are there, to activate FPI investments, and there have been a lot of recommendations made in terms of the securities transaction tax and so on and so forth. So I think there is some expectation which is built up there. Now, to the question that you have on debt and equity, I think that's a fair question. Having said that, one has to acknowledge also the fact that with the amount of money which is going in into debt at this point in time, there has to be a balance which has to be drawn as to where is that money going. I mean, the bank's mobilization, a lot of the mobilization that the banks do, there has to be an equal footing created. And in that sense, what has really happened is that over a period of time, in fact, why just that? I mean, look at insurance products also, the way they are getting taxed. Over a period of time, what has happened is that the taxation on those have become far more intense than you would like, because it otherwise the savings mobilization, the savings bank account mobilization, which is very, very important for the banks to fuel future growth, is getting compromised. So I think it's a fine balance now. As to where one should peg it. And in my mind, I think we currently have a mechanism where the tax rates, particularly I think last year they did a lot to sort of streamline a lot of the capital gains tax. I do believe that there is a possibility also to put a little bit more income in the hands of the Indian investors, which have been keeping the market steady, to sort of moderate them a little further. I certainly do believe so. But again, as I said, it's a fine balance, particularly when it comes to debt gains, because you need to keep the bank mobilization also steady.
Yeah, absolutely. Let me bring Mahalakshmi back into the conversation as well. I think she's a lucky charm. She's come back. The market is recovering. And she told us in the earlier part of the conversation that even if there is a capital gains tax hike on equities, it will still be good for the market. So
no, I didn't say it will be good for, I didn't say, let me clarify, I didn't say it will be good for markets. I said it will be good for investors in the long run. Because you are not taking a decision based on tax today and piling on. Because today, anybody you talk to, most of the advisors will tell you equities are slightly overpriced. But if you look at post-tax basis, equities still look a lot more attractive.
Yeah.
So people are taking on higher risk. Only because they feel that post-tax they're still going to make money. No, I think we have to differentiate between what creates market moves in the short term versus what is good investor behavior, which will make them money, and we'll all save enough and make enough money, and we'll have enough money during retirement. So that's a different conversation altogether. So for markets, touching it will be bad. There is no question the market will sell off. Today you have 15% long-term capital gains tax. I think it's a no-brainer. The markets will there'll be pandemonium. So there is no getting away from that. But the larger point I'm saying is that if already you see that an asset class historically in the historical context is at an elevated level, do you really need to incentivize? By the way, after we spoke in the morning, a few people called me saying that, oh my god, you're markets editor and you're saying this and also that you're just picking on small caps. But the fact is, if overall markets are higher, any stock that is coming into the market via IPO, QIP, everything is benchmarked against elevated valuations, right? Everything that is coming to the market, they do a peer comparison, say, hey, this guy is trading at XYZ PE, we are 10%.
And just to add to that argument, and actually if I could, be pragmatic.
And also, Surabhi, I just want the PCR to, pull up that chart of comparison between equity and debt taxation, which I put through, which we have for pretty much all the main countries. And I couldn't see one case where there is a real gap between
such a huge gap between equity and fixed income. And I take your point. Yes, on a valuation basis, you have more and more money being pumped into equities to build this equity cult, and it's fully built. I think there's no two ways about it. The equity cult is here. But you do more and more of that, valuations get inflated. You have stocks trading at 100 PE, gives all the more reasons for FPIs to say, they market chhod do, let's look elsewhere. Exactly. So there's a full fundamental, basis in what you're saying. I completely understand. But Shweta, let's get back to the macros, maybe with Madan as well, because whatever they do on taxes, even if the question is, do they have any room for any further impetus, stimulus in any shape or form?
Absolutely. No, that's what Surabhi, this time around, there's very little fiscal room available for Ms. Sitharaman to really do much. Madan, thank you so much for joining us. How are you reading into the tax situation? We were looking at a tax buoyancy of over 1%, but at the moment it's come down to about 0.6. How much pressure would that put on the budget, and how do you think will she be, will she manage her spending priorities?
The way I look at the way in which the budget is going to be formulated is that you will start off with what should be the fiscal deficit ratio, which will also have bearing on the gross borrowing program of the government, and that's how the market is going to react, the bond market. And then you go back to saying as to how much of revenue can be garnered. So I think this is going to be contingent on the GDP forecast which is made, which we expect to be around 10%, which was similar to what was last time. Looks more credible today because of the fact that low base effect is going to make sure that the nominal GDP growth will be around 10% with the minimum amount of inflation. So I think then comes the challenge as to how exactly are we going to garner these resources in terms of taxation? Can there be any more concessions given? To my mind, there's very limited room out there. I think whatever has to be done was done last year, and we should admit that there would be time lags before the fructification of higher revenue on account of the buoyancy in overall growth in income. And then it's a challenge about how do you actually allocate these resources. So I think that's going to be the thrust of the budget to my mind, because we've had these external pressures. We've seen the fact that MSMEs, exporters, they're the ones who have been under pressure. So therefore, there would be certain allocations made, maybe some kind of a PLI for exporters or for the MSMEs.
something where you're picking up certain thrust areas in the economy, probably the ones which need to be protected on account of the adverse external environment. And I think that's where there would be more concentration of resources. And there could be economy savings in terms of certain social welfare programs on employment, maybe for a farmers scheme. I think that's where I think there is better delivery, which the government has managed so far. So in terms of economies, in terms of outlays and subsidies, as well as social welfare is something which I would be looking to. And maybe those resources would be reallocated for the thrust sectors, which require this kind of support from the government, given the overall economic environment.
See the capex push to continue, because I know that the industry is seeking for a higher capex allocation this time around, but the absorption capacity in the economy, I think it's fairly exhausted now where capex is concerned. Do we see that getting diverted to say more new economy sectors? Radhika and Madan, this is for both of you.
If I could just continue out here, because I feel that what you said is very pertinent about the absorptive capacity of the economy. There's an extent to which the government can increase the capex. So this year, to my mind, there will be more focus on defense and partly on roads. So and in the pecking order, it will be defense, roads, and then probably railways, because the absorptive capacity is a challenge for all governments, not just the center, but also states. It's one thing to announce certain projects, but the ability to implement these projects in this period of 365 days is always an issue, given the processes which are involved, and also the administrative capability of the respective departments. So it will be more on defense and followed by roads and railways. I don't think there's any new area where the government has that kind of capability of entering at this particular point of time.
Okay. Just to get back to the bigger questions, and Sanjeev, this is going back to you. Aside of tax changes, which obviously will be a big headline, the other question is, where should the money be spent? What the priorities should be? And our, panelists earlier spoke about certain areas like, say, GCCs, rare earths, of course, other strategic sectors. So in terms of just the government's priority list, would you expect additional incremental changes, increased allocation to many of these sectors? Would that be a better way to go? Or would you want to hear of, newer headline schemes, bigger schemes, and, something big, so to speak, big bonanza or big bazooka to be announced today?
Well, I mean, I don't know about bazooka, but really, if what people would prefer is more money in their hands, and that can happen only by way of some fiscal giveaways or enabling people to be able to do more. And I do believe that if you look at our IT and professional services businesses, the GCC businesses which you mentioned, I think they've done wonderfully over the last many years. And I think with all that AI and technology changes that are now manifesting themselves, I think it's important that we are able to continue to skill our people in a very different way. So I certainly would think that a relook at our skilling programs and creating enablement for them, which are able to have the last mile impact, so that the quality of our graduates that are coming out, become even better, and they are able to deal. Today, we are saying that for coding, we don't even need people, right? So I think, what is your strength? Our strength is the services sector. In some ways, I do believe that some work needs to be done to make sure that the services sector flourishes. And that will really help if there is soft infrastructure investments happening in both education and healthcare, which eventually, in my mind, will give more money in the hands of people and make me have the confidence to be able to continue to fire the stock markets that you were discussing earlier, etc., because I don't need to change much, right? But I do believe education, healthcare becomes very, very important, and there ought to be enough spending out there. I think the second piece simply is going to be that how do we look at our entire manufacturing? Clearly is a big focus, but how do we make sure that we enable productivity gains to happen there, and more importantly, the factor cost to come down. We have been talking about ease of doing business. I mean, when you talk to businesses, the CEOs and others, the thing is that why is private capex not happening? I think we are seeing some green shoots by way of announcements in many state festivals that are happening, investment festivals that are happening. But how do it reaches the last, the last mile? How does it start happening on the ground? I think labor reform is the great thing. We're talking about land reform, which is a fiscal subject, and some of these things need to then, happen. Possibly in coordination between states and centers, and there has to be some kind of a monitoring mechanism. There has to be like a like if I can give an example, we talk about the eastern neighbor. I mean, there, the mayor of the city is actually really the CEO of the city, which is trying to drive investments, making sure that, whatever is needed in terms of approvals and so on and so forth happens. And I think that kind of, diffusion of policy and is really needed to make sure that the manufacturing sector gets a leg up and is able to drive what it is willing to do, let me say. But I do believe that, otherwise, we take 3 steps forward and maybe 1.5 steps back.
Right. Radhika, I'd like you to come in on this. The private sector continues to be very reticent to invest. There's been a lot that's happened in the year, whether it's GST rate cuts, whether it's corporate tax rate cuts, all of that. But the private sector continues to hold on. Any trigger that you think that Ms. Sitharaman can put out through this budget, which could bring the private sector in? The current allocation of 11.21 lakh crores, do you think that's enough to draw in the private sector? Or, what do you think? I mean, how can she balance between supporting demand and sticking to consolidation and getting the private sector going?
Certainly, I think it's a tall order to to kind of meet that bent. I just want to add here that past couple of years, private sector investments have actually been doing well. Now, private sector you can break down into households and corporates, and you've seen the household private sector, for example, really make its way through the real estate activity. So that's been doing very well, and I think probably in the past few quarters we have seen a bit of a slowdown, but otherwise in the past 3 years it's been doing well. So that's really been propping up what's happening in the overall private sector level. Talking about private sector corporates, I think if you ask about one bazooka, we have done some studies, and what that shows us is that borrowing costs do matter. Generally regulatory environment does matter, but end of the day, what matters the most to what has happened in the past, which is when the cycles when private sector, generally corporate sector, has performed very well, have been instances where there's been visibility on demand locally and globally, right? So I think what the budget could do from this front is build guardrails. The environment will be the most important thing, because beyond that, I think from the budget point of view, there is very little room to influence borrowing costs, for example. Yes, of course, if the budget, the overall borrowings comes down, that would be good for borrowing costs in the sense that bond yields could come. But our view is that I don't think it's going to come down below 16 lakh crores. Given the kind of maturities that are in the pipeline as well. So it would all be about the environment. And not only just saying that the business environment, but also manufacturing environment. Basically, ease of doing business for the manufacturing firms in particular, to remove the friction, to lower, to make sure that they get the right kind of labor, they're able to make the right kind of decision in terms of land, capital. I think that would be what can be done, because really the environment outside is not so favorable at this point. So putting more money in the hands of people, so demand visibility locally, and the other thing would be to remove friction generally for the businesses to work on. Among the private sector, I would say MSMEs typically has been a very important focus piece for budgets, and I do think that will continue this year as well. There could be some inter-subvention schemes. They've already come out with a kind of an online to kind of streamline the processes for the MSME. So I would think that could continue further, along with credit guarantees, for example. So this is how the budget could serve the private sector. But again, I think one final point, we should also differentiate in terms of, it's not broad brush private sector. There are some, in terms of the corporates, some sectors that are really seeing a lot of movement, especially example like EMS, for example, or renewable, defense likely. So those parts are well, I think, but broadly, we don't see a very sharp pickup. And from the budget point of view, again, the environment is what will be very much in focus.
Yeah. No, absolutely great points, Radhika. And thank you for putting the land bit on the table as well. I guess in terms of reforms, if you hear something on that front, that'll be the next major trigger, right? Absolutely. Just digitization of records, easier land acquisition. That could be the next big ask after what we've seen with the labour codes. Thank you very much for joining in. Thank you, Sanjeev, as well. And we look forward to hearing from you and get your take on the budget once the speech is over and done. So see you again in the afternoon. And thank you, Madan. Thank you, Radhika, for joining in as well. Before we get to our next set of guests, just a quick snapshot of the market. Should pull it up because markets actually had a very, very good recovery. The Nifty is 35 points higher, which is fine. It's the mid-cap index that's actually showing the recovery. When we opened at 9:15 this Sunday morning, sounds very strange to even say that, market opening at 9:15 on a Sunday morning. But at 9:15, the mid-cap index was sliding quite a bit. From the lows, there you go, it's on the screen right now. It's looking much, much better. We'll soon get to, I think, Mr. DP Singh of SBI Mutual Fund. But Mahalakshmi, I mean, from a market perspective, I guess if this is a no headline budget in the sense, from a tax perspective or changing the status quo perspective, you think the market will kind of take it in its stride and just move on because the market has enough other headaches to deal with in terms of global headlines, this commodity crash, what's been happening otherwise, with the rupee, with earnings. So the market doesn't seem very nervous, at least at this stage.
The market is nervous for other reasons. The market is not nervous for the budget because all through the month you have been nervous. Yeah. All through 2025 you have seen a correction. Yeah. But let me, one very interesting data point I saw is that, the historic Chidambaram budget in 1997, market went up 6% on that day. That year, that is 1997, the markets actually ended in the negative territory. So a great budget to which the market sort of, sees as a dream budget does not mean that the year is going to be a dream year. So similarly, 2003, Jaswant Singh's budget was also a great budget. And where, by the way, long-term capital gains was abolished. And the market went up 5.5% on that
on the day of the budget.
The following year, the market actually did very well on the strength of very strong foreign investor flows. I'm not correlating the foreign investor flows to the capital gains tax abolition because that was a global reset that was going to happen, the low interest rate regime that was beginning to start and all of that.
And India's infra cycle was really picking up. That was the start of that bull run phase.
2003, it is just about started. I mean, in 2002, you were at 2,800, which was lower than I think 10-15 years before that, I think 1993 levels or something like that. So the point I'm making is how the market does today is just today's story. And it is not going to matter tomorrow morning or for the rest of the year. To that extent, good or bad, we can just take this in our stride and the markets will take it in their stride and move on.
Absolutely.
So ML, just remind me, what did Mr. Chidambaram announce in 1997? That
I think a lot of tax-related stuff.
Yes. But that's something that there is no room available to do in this budget, right? Except LTCG. I think that's something that...
So which is why it's always great to go into any event with low expectations, right?
Absolutely.
So you always have room for some sort of a positive surprise on the upside. Otherwise, you just kind of take it
any
in your
events, life in general. Go
you know what? This fiscal room is also a bit of a. I mean, we should challenge this thing that every year we say the same thing. The fiscal room is always. Of course, leave alone the fact that today I think this is the first year after COVID that you are going to have a gross tax collection shortfall. But at the same time, the GDP reset is also going to give you a bounty, right? So it's going to negate the effect there. But fiscal headroom is always a problem. But there are always innovative ways you can think. I don't know. I'm not.
No, so it's a tough.
You can sort of bring in something that can sort of create something like voluntary disclosure was one of the Chidambaram's thing. I mean, nobody thought of it.
How about accelerating disinvestment, right? The whole disinvestment agenda has been put in the back burner.
So only in hindsight will we be able to say there was some room and this was done innovatively or ingeniously.
Speaking of fiscal room, I think we have the expert now joining in. Let's put that question to you.
Absolutely.
We have Mr. DP Singh, of course, from SBI Mutual Fund. We have Samiran Chakrabarti joining in from Citi. And we have Mr. Jairam Sridharan from Piramal Finance. Thank you so much for being with us. I think we'll have Samiran in the next couple of minutes joining in as well. But, while we get to that fiscal math, Mr. Singh, let's ask you, the biggest debate of this morning so far has been whether there should be lower tax on debt mutual funds or the converse is that you start raising tax on equities. But basically, there needs to be this gap, this yawning gap between these two asset classes, that needs to start reducing. Your thoughts? Are you at all expecting anything on debt mutual funds? I mean, that sweetener of indexation was taken away. I'm not sure why. I mean, we used to get a much better effective tax rate if you held those funds for the 3 years, those investments for 3 years. Are you expecting any change today?
No, honestly speaking, I am not. I'm not expecting any change, because if I go back into the history when the indexation benefit was taken away, and when the preferred tax regime was taken away and it became marginal, it was in the background that the banks were facing a lot of pain. And actually, the position has gone from bad to worse for the banks. And if you look at the growth numbers of bank deposits, is much worse than what it was when it was taken away. So in that light, because banks also need deposits, I don't think, I mean, 6 months back, we were hopeful that there's something will be done. But as of now, as the numbers are coming, how the deposit growth is happening and how the money is coming into this thing, I think no news will be the best news for the mutual funds, because the debt is being played through hybrids, and if there's no tinkering on the tax regime, it will be best for the banks. But yes, there's a room for increasing the exemption limit on the interest, which can be there. But I don't foresee any positive coming for debt funds as of date.
Okay, all right. Now we have Samiran Chakrabarti joining in from Citi. Samiran, so last 20 minutes to go. Put the numbers in perspective for us. First of all, everyone knows there's this, shortfall in direct taxes. There's the GST hole, which is, I think, by most estimates, around 1.2 lakh crore rupees if you analyze it over 12 months. And then there is the constant requirement, capex, defense, etc. So on capex, really, what are you expecting? On the deficit itself, what are you expecting today?
Thanks for having me on in the show. So I guess you have already discussed enough of the numbers. One point that people miss out is that a lot of government's expenditure, including wages, interest payments, some sorts of subsidies, etc., actually don't grow at the rate of the nominal GDP. Nominal GDP assumption would be something in the vicinity of 10%, maybe a couple of notches higher. So what happens is that there's an automatic compression of expenditure to GDP by anywhere between 30 to 50 basis points, just because those expenditure don't grow at the rate of the nominal GDP. And that's where the skillfulness of the budget comes in, that to what extent you distribute that between reducing the fiscal deficit number as percentage of GDP versus allocating that to certain other kinds of expenditure like capex, where you really want to focus on. So our sense is that despite our assumption that in FY27 the fiscal consolidation will be continued and we will have a lower fiscal deficit to GDP number, we think that the capex to GDP number can still be maintained at the current level at least. And that would imply that the capex growth will be in double digits assumed in the budget. I think that's entirely possible to do both the things of having the fiscal consolidation as well as having a capex growth of double digits.
So Samiran, let me ask you, how will that then feed into the GDP projections themselves? Given the fact that, capex, in all probability, you get that double-digit growth in capex between 10-12%, and then all the stimulus that we've already seen in the last 12 months. How does it start adding up? And, what do you see ahead for growth itself over the next couple of quarters? Samiran, I think you might have gone on mute.
Can you hear me now?
Yes, now we can.
Yeah, sorry. So I was saying that FY27 is going to be interesting because in FY26, we did all kinds of stimulus, both fiscal as well as monetary. We don't have the space for that kind of stimulus in FY27. So our estimate is that the total combined fiscal and monetary stimulus for FY26 was more than 1% of GDP. So in that sense, this is on a delta basis going to be a headwind for growth as we move into FY27. But on the other hand, all the global headwinds that we faced in FY26, whether it's tariff or it's AI-related capital outflow, maybe on a delta basis, again, they are not as acute in FY27. So that can ameliorate some of these pressures. So our sense is that having a growth rate around 7% is not going to be too difficult for FY27. So we are going with that real GDP growth assumption for FY27. That would imply that we could get a nominal GDP growth of more than 10% as well.
So that is on growth, Samir. And just one more quick point from my side before I toss it to my my colleagues here. On the export front, the external front and the export front, now there the rupees 92 to the dollar headline is well established. Do you see that as a way of perhaps some sort of a added cushion or stimulus to exporters who are anyway reeling because of various international trade issues? And in this budget, do you expect anything more targeted for exporters? And also what changes? Now we have this mother of all FTAs with the EU. Who knows what's happening with the trade deal with the US? But on the external front, looking at the the agenda ahead from an export perspective, looking at the currency, what should we expect the FM to do or perhaps say or signal?
So I'll put a bit of caveat out there that the correlation between exchange rate and exports is not as obvious in the Indian context as textbooks would suggest. And that's because a large part of our manufacturing exports has a very significantly large component of imports as well. And in that context, the exchange rate just becomes a pass-through. Also, a large part of our exports are done by MSMEs who don't have that kind of pricing power to benefit from the exchange rate depreciation. Having said that, the extent of depreciation, not just against dollar, but if you look at, let's say, against euro in last year has been almost 25%. And that's something which I think is large enough to have an impact on exports and to some extent can reduce the pressure that is coming out of the lack of trade deal with US. But over the more medium term, what is important is to get our bigger structural drivers of exports in place, improving our quality of our export products, getting this inverted duty structure corrected in whichever way possible, and then also look at alternate markets through these FTAs. If we can get all this done, along with the deregulation, obviously, which we are doing, then it's possible to think of exports to be a driver of our growth as well.
Right. Samir, hi, Shweta here. I wanted to get your thoughts in on the substantial payout that's coming up with the 8th pay commission in FY28. How much of an overhang would that be on this budget?
A position to announce anything related to the pay commission in this budget itself or account for it in our budget maths. Having said that, one part which has to be appreciated is that there are some cushions on the revenue side as well. For whichever year the government decides to do that pay commission expenditure, the cushion will primarily come from the RBI dividend side. The RBI can easily bring down its buffers by about a percentage point, which is now allowed by law, and that would release that almost 2 trillion rupees of extra dividend to the government, and that can help in funding that expenditure on the pay commission. But to our mind, that's probably next year's budget story, not this year's.
Let me also go across to Mr. Jairam Sridharan from Piramal Finance. Thank you so much, Jairam, for joining in. So the panel has been talking about this, the higher cost of debt capital in the country, and we've seen that with bond yields hardening over the last couple of months as well. And the larger point about too much money chasing equity and too much local money moving to fixed income. Is that really an impediment for you when you're looking at your cost of capital at all, or is that more an academic issue at this point in time?
Good morning. Thanks for having me. Good morning to all colleague panelists. I think it's a real issue. The fact that the regulator has cut interest rates by 125 basis points, but really folks have barely seen borrowers, corporate borrowers like ourselves, have barely seen 25 to 30 basis points of transmission, tells you that there is a real issue in terms of transmission of policy rates to long-term yields. Having said that, I will say that the bigger issue that the FM is going to be faced with is the fact that the banking system overall is seeing this big dearth of deposits. I think that issue, it's a contra issue to what we've just been talking about, but banks continue to be the biggest lender in this country. Whatever we might want from a bond market perspective, banks are still a bigger player. And the fact that banks are hurting because deposits are not coming in is going to weigh heavily. And if anything, Singh sir was saying before that no news would be good news for mutual funds. I think that's very true. Like, because if anything, I think one might expect something which is deposit positive rather than market positive, and we could see things on the lines of tax treatment of deposits, etc., which will or kind of change in kind of definition of long term, or some of these things which are deposit positive, and try to help the banking system, which continues to be the biggest provider of debt capital to the country, right?
You know, Jairam, you took me back to 2-3 years back, and Mr. Singh, I don't know if you remember that panel or not. I remember asking Mr. Singh when that indexation benefit was taken away, that Mr. Singh, today, I don't think you will be too happy. But Mr. Khara, who was the chairman of State Bank of India at that point in time, he'd be very happy today because the benefit has been taken away from debt mutual fund investors. And, you know, there's parity between mutual funds and fixed deposits. But going back to this big, it's a very deep systemic question, Mr. Singh. You're saying, okay, not today, but, is there a case for any change? And would you advocate, I'm guessing you'd advocate for constant parity between fixed deposits and mutual funds. But I don't know, does it need to be more nuanced than that? Not all FD, depositors invest in funds, vice versa. There's a constant tug of war between mutual funds and banks in terms of who wants to keep that capital.
As far as fixed incomes are concerned, fixed income funds and fixed deposits are already at par. There's no difference as on date. Now the point is being debated is the equity and the fixed deposits. That's a new the discussion which has happened because there's a transitional change. Because a lot more money is chasing the equities rather than the fixed deposit. The risk appetite of the countrymen has gone high. People are ready to take higher risk to have the higher returns. Now, I see, you would have seen the chairman has been talking about this, but I am very sure that the kind of the speed with which this transition has happened has really been very bad for the banks. Because if I look at the numbers, during the current year itself, the net deposit flow and net mutual fund flow, the difference is otherwise. Mutual fund being 1/3 of the banking deposits are having double the growth in the net flows in the current year, 9 months. So that is something which is definitely bothering the bankers, and there has to be something. Maybe the exemption limit, which is very low today, it can be increased to 1 lakh or 2 lakh of tax exemption on the bank deposits. So some other moves will definitely. There's a point from the banker's point of view, which is really genuine.
I want to just make a point, very important point here. I think this is a complete misnomer that, the narrative that has been set that it is, all these bank deposits not growing is because of money moving into mutual funds and SIPs, etc. Decisively, both the economic survey as well as the RBI has put out a note that this is not the case. So, I mean, this again and again debating, I think bankers need to understand. I mean, this might sound a little harsh, but the era of lazy banking is over. The whole premise that low-cost deposits will be a significant source of your ROE for banks is now over, and they have to just reconcile to that.
No, absolutely. And the learning curve is much faster for investors now. There's digital information everywhere. And this is not the era where money will keep sitting in a certain bucket, for endless periods of time. So, absolutely, point well taken, Mahalakshmi. But just to go back to, Jairam. So, now, scaling back and talking about what parts of the economy are really, more hungry for capital. Samiran spoke of certain sectors as well. But when you look at grassroots level, where do you see the growth impetus really coming alive? So in terms of just different sections, where do you expect the budget to focus, and more importantly, ground up? Where do you see those green shoots, those animal spirits, coming through in FY27?
Yeah. See, the big two areas where there is serious challenge and where some help is required and are very large are the export sector impacted by tariffs, and the MSME sector, which has been in increasingly tough shape over the last 2 years. I do expect to see interventions from the government in both of these areas. In the MSME sector, we have all seen what has happened there in terms of growth, in terms of credit availability, credit risk performance of all the borrowing in that sector has been severely impacted, which means that even further people are pulling back. You saw some of the MSME lenders' results over the last few weeks, and they were uniformly terrible. And that tells you that there is a problem in that sector, and it is the largest employer in the country. It has to be given more support. So I do expect to see some action there in the form of maybe extension of some credit guarantee schemes, or maybe expansion of them, or aggregation of 2 or 3 schemes into one, or ways in which export-oriented MSMEs get more advantages in terms of tax benefits, etc. That is something that does need to be done. On the tariff and export side, export-oriented manufacturing and what more can be done there to revitalize that sector, because clearly they are suffering in the new tax situation and a new tariff situation, and they need to be given some level of support. So those are 2 areas where I really feel that attention is required: export-oriented manufacturing and MSMEs in general.
Right. Samiran, I'd like you to come in here. We are barely a few minutes away from the budget speech, and I want you to do a little bit of crystal ball gazing. We pushed out a story yesterday, which we got from very credible sources, that the Part B of the budget speech will place strong emphasis on both short-term and long-term goals, and that it will reflect India's economic vision and priorities, and it will be something that economists and experts in India and around the world will get a lot of attention from. So you're an economist from India and you're with a global back.
What's coming in Part B?
So what's Part B going to look like?
So historically, economists have always focused on Part A and not on Part B. Part B is the matter of tax experts. So I don't know what is going to change this time around. Maybe the nomenclature itself has changed. But on a more serious note, I think the thing that we are all expecting is that now the corporate tax rationalization is done, the personal income tax rationalization is done, GST rationalization is also done. So what is left is the import duty rationalization. So that comes under Part B. So there are 2-3 things out there. One is obviously the Eco Survey has also mentioned that the so-called inverted duty structure, wherever it is present, that inverted duty structure can be removed. The second is that because India is now signing a bunch of FTAs, whereby almost 90-95% of the duty items, we are removing tariff on them. So maybe the government is thinking that it's prudent to actually remove the tariffs in the very first place for everyone. Why just do it for a bunch of FTA countries? So that kind of tariff reduction could also be there. And the third is that this segment, the import duty segment, also requires a lot of simplification. Like we did the simplification on the GST side, there could be a whole bunch of simplification as well. So if I have to guess, I think the Part B, if at all that is the more important part of the budget, then it has to do with the import duty.
Okay, so Part A, Part B, let's see.
This is a first, right? This is a first. We've never seen a leak like this coming like one day before the budget, actually one night before the budget. This is the first time. So they've really set the stage. And so, do you think the markets could get disappointed if it does not live up to the hype, the Part B?
So I don't think the market is working with much hype. Okay. If the market doesn't get another tax hit, the market will be happy. Like Mahalakshmi said, the market has way too many other worries on its head right now beyond the budget. But very quickly, I think last 3 minutes, so one minute each to our experts in terms of what could be the key wish list, though it's too late for wish list, but still we can all hope, right? So from the corporate perspective, lending, corporate India, just, India Inc. at large, Jairam, what would be your key wish list?
The country is good for corporate India. I don't think we should look for anything very specific. Sectorally, as I mentioned, support for MSMEs is, and the housing sector, which for the last 2 years has not been a big focus area. Those two would be probably good to have. But in general, just from the country's perspective, the big numbers, we all know what we are watching for. We should continue to see consolidation on fiscal deficit in the 4.1, 4.2 range, and maybe government borrowing not going past 15.5, 16 lakh crores.
Sure.
If anything more than that, it will be quite tough for us.
Sure. Samiran, very quickly, would you be disappointed if the FM decides to make a big splash? If for 1 year she says, okay, fiscal deficit is not that important, I'll touch that red line because I need to stimulate more. Will that be really such a bad thing?
If you had asked me this question last year, I would have said yes, it's not a big problem. This year, it's more complicated. The bond markets are already under more pressure than what they were last year. So to announce a higher deficit number this year could have more wider repercussions.
Okay, all right. So she needs to walk that fiscal tightrope. That's Samiran's clear message. Mr. DP Singh, coming to you. Finally, for the common taxpayer, investor, when it comes to our investments, just our sense of well-being and wealth creation, what would your top ask or hope or wish list be?
Mention of mutual funds at all. Party is going on, let it continue. And there should be appreciation for small investors who is creating a lot of wealth for the country and bringing a lot of money for the capital markets. I think that this is something which is something appreciable for the small investors, because DIIs have hold on the market capitalization, everything. The small investors have done a great job and they should be appreciated and nothing should be done. That's my wish list.
I think this is the simplest request. Just no mention of his, industry or sector. No mention of mutual funds. That will be the biggest help, so to speak.
The big numbers, Samiran. The big number.
Let's just go with the big numbers. Last 30 seconds.
Yeah, the big number you'll be watching out for.
The fiscal deficit number, which we think should be lower than 4.4, maybe 4.3, 4.2, and the borrowing number, which Jairam was mentioning, somewhere below 16 trillion of gross borrowing would be a positive for bond markets, but it could be slightly higher as well, according to us. So that's something that we'll see. And then obviously the tax rates will be something that people will be watching. And capex growth, we are thinking a double-digit capex growth. So that will also be watched very closely.
As a percentage of GDP, capex trajectory, Samiran?
Is what we are expecting.
3.2. Okay, I think that's what he mentioned. That capex is a percentage of GDP. Hopefully, we'll keep tracking in that vicinity of 3.1, 3.2%. And that is something that will get the budget a thumbs up from the economists. I think we're counting down. In the next couple of minutes, we'll start getting visuals from Parliament as Madam Finance Minister makes her way and gets ready to present her 9th budget. What a run for the Finance Minister herself, right? Remarkable how she steered the Indian economy through many, many years. Consistency,
Absolutely.
At least in policy making, in terms of
the only finance minister to present 9 consecutive budgets. Since we have Samiran with us, okay, start.
Item number 1, माननीय वित्त मंत्री श्रीमती निर्मला सीतारमन जी. Item number 1.
Sir, with your permission, I rise to lay on the table a copy each of the following papers, Hindi and English versions, under Article 281 of the Constitution, Report for 2026 to 2031, Volume 1, Main Report of the 16th Finance Commission. 2. Report for 2026-2031, Volume 2, Annexures of the 16th Finance Commission. Number 3, explanatory memorandum as to the action taken on the recommendations contained in the above report.
Item number 2, माननीय वित्त मंत्री निर्मला सीतारमण जी.
Honorable Speaker, sir, on the sacred occasion of Magh Purnima and the birth anniversary of Guru Ravidas, I present the budget for the year 2026-2027. Since we assumed office 12 years ago, India's economic trajectory has been marked by stability, fiscal discipline, sustained growth, and moderate inflation. This is the result of conscious choices we have made, even in times heightened uncertainty and disruption. Our government, led by Honorable Prime Minister Modi, has decisively and consistently chosen action over ambivalence, reform over rhetoric, and people over populism. We have pursued far-reaching structural reforms, fiscal prudence and monetary stability, whilst maintaining a strong thrust on public investment. Keeping Atmanirbharta as a lodestar, we have built domestic manufacturing capacity, energy security, and reduced critical import dependencies. Simultaneously, we have ensured that citizens benefit from every action of the government, undertaking reforms to support employment generation, agricultural productivity, household purchasing power, and universal services to people. These measures have delivered a high growth rate of around 7% and helped us make substantial strides in poverty reduction and improvement in the lives of our people. Today, we face an external environment in which trade and multilateralism are imperiled and access to resources and supply chains are disrupted. New technologies are transforming production systems while sharply increasing demands on water, energy, and critical minerals. India will continue to take confident steps towards Vikasit Bharat, balancing ambition with inclusion. As a growing economy with expanding trade and capital needs, India must also remain deeply integrated with global markets, exporting more and attracting stable long-term investment. As I begin Part A, I want to express my gratitude to the people for standing firmly with us as we forge our way together towards becoming one of the largest economies of the world. Our aim is to transform aspiration into achievement and potential into performance as we ensure that the dividends of growth reach every farmer, the scheduled caste, the scheduled tribes, the nomads, the youth, the poor, and the women. In Vikasit Bharat Young Leaders Dialogue 2026, several innovative ideas were shared with our Prime Minister, which have inspired many of the proposals, making this a unique Yuva Shakti-driven budget. Our government's sankalp is to focus on our poor, underprivileged, and the disadvantaged. To deliver on this sankalp, and given that this is the first budget prepared in Kartavya Bhavan, we are inspired by three Kartavya. Our first Kartavya is to accelerate and sustain economic growth by enhancing productivity and competitiveness and building resilience to volatile global dynamics. Our second Kartavya is to fulfill aspirations of our people and build their capacity, making them strong partners in India's path to prosperity. Our third kartavya, aligned with our vision of Sabka Saath, Sabka Vikas, is to ensure that every family, community, region, and sector has access to resources, amenities, and opportunities for meaningful participation. This threefold approach requires a supportive ecosystem. The first requirement is to sustain the momentum of structural reforms, continuous, adaptive, and forward-looking. Second, a robust and resilient financial sector is central to mobilizing savings, allocating capital efficiently, and managing risks. Third, cutting-edge technologies, including AI applications, can serve us as force multipliers for better governance. Reform Express. Our government has undertaken comprehensive reforms towards creating employment, boosting productivity, and accelerating growth. After the Prime Minister's announcement on Independence Day in 2025, over 350 reforms have been rolled out. This includes GST simplification, notification of labor codes, and rationalization of mandatory quality control orders. High-level committees have been formed, and in parallel, the central government is working with the state governments on deregulation and reducing compliance requirements. The Reform Express is well on its way and will maintain its momentum to help us fulfill our kartavya. I now move to specific proposals. Under our first kartavya, to accelerate and sustain economic growth, I propose interventions in 6 areas. 1. Scaling up manufacturing in 7 strategic and frontier sectors. 2. Rejuvenating legacy industrial sectors. 3. Creating champion MSMEs. 4. Delivering a powerful push for infrastructure. 5. Ensuring long-term security and stability. And 6. Developing city economic regions. Scaling up of manufacturing in 7 strategic and frontier sectors. Biopharma Shakti, meaning biopharma strategy for health advancement through knowledge, technology, and innovation. India's disease burden is observed to be shifting towards non-communicable diseases like diabetes, cancer, and autoimmune disorders. Biologic medicines are key to longevity and quality of life at affordable costs. To develop India as a global biopharma manufacturing hub, I propose the Biopharma Shakti with an outlay of 10,000 crores over the next 5 years. This will build the ecosystem for domestic production of biologics and biosimilars. The strategy will include a biopharma-focused network with 3 new national institutes of pharmaceutical education and research, popularly known as NIPERs, and upgrading 7 existing ones. It will also create a network of 1,000 accredited India clinical trials sites. We propose to strengthen the Central Drug Standard Control Organization to meet global standards and approve timeframes through and approval timeframes through a dedicated scientific review cadre and specialists. India's Semiconductor Mission 1.0 expanded India's semiconductor sector capabilities. Building on this, we will launch ISM 2.0 to produce equipment and materials, design full-stack Indian IP, and fortify supply chains. We will also focus on industry-led research and training centers to develop technology and skilled workforce. The Electronics Components Manufacturing Scheme, launched in April 2025 with an outlay of 22,919 crores, already has investment commitments at double the targets. We propose to increase the outlay to 40,000 crores to capitalize on this momentum. A scheme for rare earth permanent magnets was launched in 2025 November. We now propose to support the mineral-rich states of Odisha, Kerala, Andhra Pradesh and Tamil Nadu to establish dedicated rare earth corridors to promote mining, processing, research and manufacturing. To enhance domestic chemical production and reduce import dependency, we will launch a scheme to support states in establishing 3 dedicated chemical parks through challenge route on a cluster-based plug-and-play model. Strong capital goods. Strong capital goods capability is a determinant of productivity and quality across different sectors. Towards building this capacity, I propose the following. High-tech tool rooms will be established by central public sector enterprises at 2 locations as digitally enabled automated service bureaus that locally design, test and manufacture high-precision components at scale and at lower cost. 2. A scheme for enhancement of construction and infrastructure equipments will be introduced to strengthen domestic manufacturing of high value and technologically advanced CIE. This can range from lifts in a multi-storied apartment or firefighting equipment in multiplexes, large or small, and to tunnel boring equipments for building metros and high-altitude roads. I also propose a scheme for container manufacturing to create a globally competitive container manufacturing ecosystem with a budgetary allocation of 10,000 crores over a 5-year period. For the labor-intensive textile sector, I propose an integrated program with 5 subparts. 1. The National Fiber Scheme for self-reliance in natural fibers, such as silk, wool and jute, man-made fibers, and new age fibers. Textile expansion and employment scheme to modernize traditional clusters with capital support for machinery, technology upgradation, and common testing and certification centers. 3. The National Handloom and Handicraft Program to integrate and strengthen existing schemes and ensure targeted support for weavers and artisans. Tex Eco Initiative to promote globally competitive and sustainable textiles and apparels. Samarth 2.0 to modernize the upgrade the textile skilling ecosystem through collaboration with industry and academic institutions. Further, I propose to set up mega textile parks in challenge mode. They can also focus on bringing value addition to technical textiles. I propose to launch the Mahatma Gandhi Gram Swaraj initiative to strengthen khadi, handloom and handicrafts. This will help in global market linkage and branding. It will streamline and support training, skilling, quality of process and production. This will benefit our weavers, village industries, One District, One Product ODOP initiative and also our rural youth. India has the potential to emerge as a global hub for high-quality, affordable sports goods. I propose a dedicated initiative for sports goods that will promote manufacturing, research, and innovation in equipment design as well as material sciences. Rejuvenation of legacy industrial clusters. I propose to introduce a scheme to revive 200 legacy industrial clusters to improve their cost competitiveness and efficiency through infrastructure and technology upgradation. Creating champion SMEs and supporting micro enterprises. Recognizing MSMEs as a vital engine of growth, I propose a three-pronged approach to help them grow as champions. Equity support. I propose to introduce a dedicated 10,000 crores SME growth fund to create future champions, incentivizing enterprises based on select criteria. I also propose to top up the Self-Reliant India Fund set up in 2021 with 2,000 crores to continue support to micro enterprises and maintain their access to risk capital. Liquidity support. With TREDS, more than 7 lakh crore has been made available to MSMEs. To leverage its full potential, I propose 4 measures. 1. Mandate TREDS as the transaction settlement platform for all purchases from MSMEs by CPSEs, serving as a benchmark for other corporates. 2. Introduce a credit guarantee support mechanism through CGTMSE for invoice discounting on TREDS platform. 3. Link GEM with TREDS for sharing information with financiers about government purchases from MSMEs, encouraging cheaper and quicker financing. 4. Introduce TREDS receivables as asset-backed securities, helping develop a secondary market, enhancing liquidity and settlement of transactions. Professional support. Government will facilitate professional institutions such as the ICAI, ICSI, ICMAI to design short-term modular courses and practical tools to develop a cadre of corporate mitras, especially in Tier 2 and Tier 3 towns. These accredited para-professionals will help MSMEs meet compliance requirements at affordable costs. Infrastructure. During this past decade, our government has undertaken several initiatives for large-scale enhancement of public infrastructure, including through new financing instruments such as Infrastructure Investment Trust (InvITs) and Real Estate Investment Trust (REITs), and institutions like NIIF and NABFID. We shall continue to focus on developing infrastructure in cities with over 5 lakh population, that is Tier 2, Tier 3 cities, which have expanded to become growth centers. Public capital expenditure has increased manifold from 2 lakh crore in 2014-15 to an allocation of 11.2 lakh crore in BE 25-26. In this coming year, that is financial year 2026-27, I propose to increase it to 12.2 lakh crores to continue the momentum. To strengthen the confidence of private developers regarding risks during infrastructure development and construction phase, I propose to set up an infrastructure risk guarantee fund to provide prudentially calibrated partial credit guarantee to lenders. Over the years, Rights have emerged as a successful instrument for asset monetization. I propose to accelerate recycling of significant real estate assets of the CPSEs through the setting up of dedicated rights. To promote environmentally sustainable movement of cargo, I propose to 1. Establish new dedicated freight corridors connecting Dankuni in the east to Surat in the west. Operationalize 20 new national waterways over the next 5 years. Starting with National Waterways 5 in Orissa to connect mineral-rich areas of Talcher and Angul and industrial centers like Kalinga Nagar to the ports of Paradeep and Dhamra. Training institutes will be set up as regional centers of excellence for development of required manpower for these waterways. This will benefit youth in the entire stretch of the waterways to train and acquire skills. Further, a ship repair ecosystem catering to inland waterways will also be set up at Varanasi and Patna. And C. Launch a coastal cargo promotion scheme for incentivizing a modal shift from rail to road to increase the share of inland waterways and coastal shipping from 6% to 12% by 2047. To enhance last mile and remote connectivity and promote tourism, I propose to give incentives to indigenize manufacturing of seaplanes. A seaplane VGF scheme will be also introduced to provide support for operations. Carbon capture, utilization and storage. Aligning with the roadmap launched in December 2025, the carbon capture, utilization and storage technologies at scale will achieve higher readiness and in end-use application across 5 industrial sectors, including power, steel, cement, refineries, and chemicals. An outlay of 20,000 crore is proposed over the next 5 years for this purpose. City economic regions. Cities are India's engines of growth, innovation, and opportunities. We shall now focus on Tier 2, Tier 3 cities, and even temple towns, which need modern infrastructure and basic amenities. This budget aims to further amplify the potential of cities to deliver the economic power of agglomerations by mapping city economic regions based on their specific growth drivers. An allocation of 5,000 crore per CER over 5 years is proposed for implementing their plans through a challenge mode with a reform-cum-result-based financing mechanism. In order to promote environmentally sustainable passenger systems, we will develop 7 high-speed rail corridors between cities as growth connectors, namely Mumbai to Pune, Pune to Hyderabad, Hyderabad to Bengaluru, Hyderabad to Chennai, Chennai to Bengaluru, Delhi to Varanasi, Varanasi to Siliguri. Financial sector. The Indian banking sector today is characterized by strong balance sheet, historic highs in profitability, improved asset quality, and coverage exceeding 98% of villages in the country. At this juncture, we are well placed to futuristically evaluate the measures needed to continue on the path of reform-led growth of this sector. I propose setting up a high-level committee on banking for Vikasit Bharat. High-level committee on banking for Vikasit Bharat to comprehensively review the sector and align it with India's next phase of growth, while safeguarding financial stability, inclusion, and consumer protection. The vision for NBFCs for Viksit Bharat has been outlined with clear targets for credit disbursement and technology adoption in order to achieve scale and improve efficiency in the public sector NBFCs. As a first step, it is proposed to restructure the Power Finance Corporation and Rural Electrification Corporation. I propose a comprehensive review of the foreign exchange management non-debt instruments rules to create a more contemporary, user-friendly framework for foreign investments consistent with India's evolving economic priorities. Corporate bond market. I propose to introduce a market-making framework with suitable access to funds and derivatives on corporate bond indices. I also propose to introduce total return swaps on corporate bonds. Municipal bonds. To encourage the issuance of municipal bonds of higher value by larger cities, I propose an incentive of 100 crore rupees for a single bond issuance. 100 crore rupees for a single bond issuance of more than 1,000 crore. The current scheme under Amrit which incentivizes issuances up to 200 crores only, will also continue to support smaller and medium towns. That will also continue to support the smaller and medium towns. Ease of doing business. Individual persons resident outside India, PROI, will be permitted to invest in equity instruments of listed Indian companies through the Portfolio Investment Scheme. It is also proposed to increase the investment limit for an individual PROI under the scheme from 5% to 10%, with an overall investment limit for all individual PROIs to 24% from the current 10%. Emerging technologies including AI. 21st century is technology driven. Adoption of technology is for the benefit of all people. Farmers in the field, women in STEM, youth keen to upskill, and Divyangjan to access newer opportunities. The government has taken several steps to support new technologies through AI Mission, National Quantum Mission, Anusandhan National Research Fund, and Research and Development and Innovation Fund. Our second kartavya is to fulfill aspirations and build capacities. Close to 25 crore individuals have come out of multi-dimensional poverty through a decade of our government's sustained and reform-oriented efforts. Our government has therefore decided to place a renewed emphasis on the service sector to provide a pathway to fulfilling aspirations of a youthful India with the following measures. I propose to set up a high-powered Education to Employment and Enterprises Standing Committee to recommend measures that focus on services sector as a core driver of Viksit Bharat. This will make us a global leader in services with a 10% global share by 2047. The committee will prioritize areas to optimize the potential for growth, employment, and exports. They will also assess the impact of emerging technologies, including AI, on jobs and skill requirements, and propose measures thereof. To create a range of skilled career pathways, a new range of skilled career pathways for our youth, I propose interventions in the following sectors. Health. Existing institutions for allied health professionals will be upgraded and new AHP institutions established in private and government sectors. This will cover 10 selected disciplines, including optometry, radiology, anesthesia, OT technology, applied psychology and behavioral health, and add 1 lakh AHPs over the next 5 years. A strong care system covering geriatric and allied care services will be built. A variety of NSQF aligned programs will be developed to train multi-skilled caregivers, combining core care and allied skills such as wellness, yoga, and operation of medical assistive devices. In the coming year, 1.5 lakh caregivers will be trained. Hubs for medical value tourism. To promote India as a hub for medical tourism services, I propose to launch a scheme to support states in establishing 5 regional medical hubs in partnership with the private sector. These hubs will serve as integrated healthcare complexes that combine medical, educational, and research facilities. They will have Ayush centers, medical value tourism facilitation centers, and infrastructure for diagnostics, post-care, and rehabilitation. These hubs will provide diverse opportunities, job opportunities for health professionals, including doctors and AHPs. Ancient Indian yoga, already respected in several parts of the world, was given a mass global recognition when Honorable Prime Minister took it to the UN. Post-COVID, Ayurveda gained a similar global acceptance and recognition. Exporting quality Ayurveda products helps farmers who grow the herbs and youth who process the products. To meet growing global demand, a few more steps are being taken. I propose to 1. Set up 3 new All India Institutes of Ayurveda. 2. Upgrade Ayush pharmacies and drug testing labs for higher standards of certification ecosystem and make available more skilled personnel. 3. Upgrade the WHO Global Traditional Medicine Center in Jamnagar to bolster evidence-based research, training, and awareness for traditional medicine. Animal husbandry. Livestock contributes to close to 16% of farm income, including of poor and marginal households. To scale up availability of veterinary professionals by more than 20,000, I propose to roll out a loan-linked capital subsidy support scheme for establishment of veterinary and para-veterinary colleges, veterinary hospitals, diagnostic laboratories, and breeding facilities in private sector. Collaboration between Indian and foreign institutions will also be facilitated. Orange economy. India's animation, visual effects, gaming and comics sector, AVGC sector, is a growing industry projected to require 2 million professionals by 2030. I propose to support the Indian Institute of Creative Technologies, Mumbai, in setting up AVGC content creator labs in 15,000 secondary schools all over the country and 500 colleges. The Indian design industry is expanding rapidly, and yet there is a shortage of Indian designers. I propose to establish, through Challenge Route, a new National Institute of Design to boost design education and development in the eastern region of India. Education. Our government will support states through Challenge Route in creating 5 university townships in the vicinity of major industrial and logistics corridors. These planned academic zones will host multiple universities, colleges and research institutions, skill centers and residential complexes. In higher education, STEM institutions, prolonged hours of study and laboratory work pose some challenges for girl students. Through VGF, Viability Gap Funding and capital support, one girls' hostel will be established in every district. To promote astrophysics and astronomy via immersive experiences. 4 telescope infrastructure facilities will be set up or upgraded. The National Large Solar Telescope, the National Large Optical Infrared Telescope, the Himalayan Chandra Telescope, and the Cosmos 2 Planetarium. Tourism. The tourism sector has the potential to play a large role in the employment generation, forex earnings, and expanding the local economy. I propose to set up a National Institute of Hospitality by upgrading the existing National Council for Hotel Management and Catering Technology. It will function as a bridge between academia, industry, and government. I also propose a pilot scheme for upskilling 10,000 guides in 20 iconic tourist sites through a standardized, high-quality, 12-week training course in hybrid mode in collaboration with the Indian Institute of Management. A national destination digital knowledge grid will be established to digitally document all places of significance, cultural, spiritual, and heritage. This initiative will create a new ecosystem of jobs for local researchers, historians, content creators, and technology partners. India has the potential and opportunity to offer world-class trekking and hiking experience. We will develop ecologically sustainable mountain trails in Himachal Pradesh, Uttarakhand, and Jammu Kashmir. Also in Araku Valley in the Eastern Ghats and Podigai Malai in the Western Ghats. Turtle trails along key nesting sites in the coastal areas of Odisha, Karnataka, and Kerala. And 3 bird watching trails along the Pulikat Lake in Andhra Pradesh, Tamil Nadu. It's on the border. Under the visionary leadership of Honorable Prime Minister, we established the International Big Cat Alliance in 2024. This year, India is hosting the first ever Global Big Cat Summit, where heads of governments and ministers from 95 range countries will deliberate on collective strategies for conservation. Heritage and culture tourism. I propose to develop 15 archaeological sites, including Lothal, Dholavira, Rakhi Gadi, Adichanallur, Sarnath, Hastinapur, and Leh Palace into vibrant experiential cultural destinations. Excavated landscapes will be open to the public through curated walkways. Immersive storytelling skills and technologies will be introduced to help conservation labs, interpretation centers, and guides. The sports sector provides multiple means of employment, skilling, and job opportunities. Taking forward the systematic nurturing of sports talent, which is set in motion through the Khelo India program earlier, I propose to launch a Khelo India mission to transform the sports sector over the next decade. The mission will facilitate an integrated talent development pathway supported by training centers, which are foundational, intermediate, and elite levels. B, systematic development of coaches and support staff. C, integration of sports science and technology. D, competitions and leagues to promote sports culture and provide platforms. And E, development of sports infrastructure for training and competition. Our third Kartavya aligns with our vision of Sabka Saath, Sabka Vikas towards Vikasit Bharat. This requires targeted efforts for 1. Increasing farmer incomes through productivity enhancement and entrepreneurship, with special attention to small and marginal farmers. B. Empowering Divyangjan through access to livelihood opportunities, training, and high-quality assistive devices. C. Empowering the vulnerable to access mental health and trauma care. D. Focus on the Purvodaya states and the Northeast region to accelerate development and employment opportunities. Fisheries. We will undertake initiatives for integrated development of 500 reservoirs and Amrit Sarovars. 2. Strengthen the fisheries value chain in coastal areas and enable market linkages involving startups and women-led groups together with fish farmer producer organizations. Animal husbandry. To provide quality employment opportunities in rural and peri-urban areas, we will support the animal husbandry sector in entrepreneurship development through A. A credit-linked subsidy program. B. Scaling up and modernization of livestock enterprises. C. Enhanced creation of livestock, dairy, and poultry. Enhanced creation of livestock, dairy, and poultry-focused integrated value chains. And D. Encourage creation of livestock farmer-producer organizations. High-value agriculture. To diversify farm outputs, increase productivity, enhance farmers' incomes, and create new employment opportunities, we will support high-value crops such as coconut, sandalwood, cocoa, cashew in the coastal areas, agar trees in northeast, and nuts such as almonds, walnuts, and pine nuts in our hilly regions. All of them will be supported. India is the world's largest producer of coconuts. About 30 million people, including nearly 10 million farmers, depend on coconuts for their livelihood. To further enhance competitiveness in coconut production, I propose a coconut promotion scheme to increase production and enhance productivity through various interventions, including replacing and non-productive trees with new saplings or plants or varieties in major coconut growing states. A dedicated program is proposed for Indian cashew and cocoa to make India self-reliant in raw cashew and coconut production and processing, enhance export competitiveness, and transform Indian cashew and Indian cocoa into premium global brands by 2030. Sandalwood. Sandalwood is closely linked to India's social and cultural heritage. Our government will partner with state governments to promote focused cultivation and post-harvest processing to restore the glory of the Indian sandalwood ecosystem, to rejuvenate old, low-yielding orchards and expand high-density cultivation of walnuts, almonds and pine nuts. We will support a dedicated program to enhance farmer incomes and in bringing value addition by engaging youth. Bharat Vistar, that is virtually integrated system to access agricultural resources. I propose to launch Bharat Vistar, a multilingual AI tool that shall integrate the AgriStack portals and the ICAR package on agricultural practices with AI systems. This will enhance farm productivity, enable better decisions for farmers, and reduce risk by providing customized advisory support. She Marts for rural women-led enterprises. Building on the success of Lakpati Didi program, I propose to help women take the next step from credit-linked livelihoods to being owners of enterprises. Self-help entrepreneur, She Marts will be set up as community-owned retail outlets within the cluster-level federations through enhanced and innovative financing instruments. Empowering Divyangjan. Divyangjan Kaushal Yojana. Information technology, AVGC sectors, hospitality and food and beverages sectors often offer task-oriented and process-driven roles which are suitable for Divyangjan. We will ensure dignified livelihood opportunities through industry-relevant and customized training specific to each Divyangjan group. Divyang Sahara Yojana. Timely access to high-quality assistive devices for all eligible Divyangjan is a fundamental need. I propose to 1. Support the Artificial Limbs Manufacturing Corporation of India, ALIMCO, to set up and to scale up production of assistive devices, invest in R&D and AI integration, strengthen PM Divyasha Kendras, and support setting up of assistive technology marts as modern retail style centers where Divyangjan and senior citizens can see, try and purchase assistive products. Reaffirming our commitment to mental health and trauma care. There are no national institutes for mental health care in North India. We will therefore set up a NIMHANS 2 and also upgrade national mental health institutes in Ranchi and in Tezpur as regional apex institutions. Emergencies expose families, particularly the poor and vulnerable, to unexpected expenditure. We will strengthen and increase these capacities by 50% in district hospitals by establishing emergency and trauma care centers. Focus on Purvodaya states and northeastern regions. Purvodaya. I propose the development of an integrated East Coast industrial corridor with a well-connected node at Durgapur, creation of 5 tourism destinations in 5 Purvodaya states, and the provision of 4,000 e-buses. Buddhist sites in northeastern region. The northeastern region is a civilizational confluence of Theravada and Mahayana or Vajrayana traditions. I propose to launch a scheme for development of Buddhist circuits in Arunachal Pradesh, Sikkim, Assam, Manipur, Mizoram and Tripura. The scheme will cover preservation of temples and monasteries, pilgrimage interpretation centers, connectivity and pilgrim amenities. 16th Finance Commission. On 17th November 2025, the 16th Finance Commission submitted its report to the President. As mandated under Article 281 of the Constitution, the government is to lay the report along with the explanatory memorandum on the action taken report on the recommendations of the Commission in Parliament, which, Sir, Honourable Speaker, you've allowed me to do at the commencement of this session. The government has accepted the recommendation of the Commission to retain the vertical share of devolution at 41%. As recommended by the Commission, I have provided 1.4 lakh crores of rupees to the states for the year 2026-2027 as Finance Commission grants. These include rural and urban local body and disaster management grants. Fiscal consolidation. Government has been delivering on our fiscal commitments consistently without compromising on social needs. To strive towards accepted standards of fiscal management in Budget 25-26, I had indicated that the central government would target reaching a debt to GDP ratio of 50 plus or minus 1% by 2030-31. In line with this, the debt to GDP ratio is estimated to be 55.6% of GDP in BE 26-27, compared to 56.1% of GDP in RE 25-26. A declining debt to GDP ratio will gradually free up resources for priority sector lending and expenditure by reducing the outgo on interest payments. One of the main operational instruments for debt targeting is the fiscal deficit. I am happy to inform this august House that I fulfilled my commitment made in 2021-2022 to reduce fiscal deficit below 4.5% of GDP by 25-26. In RE 25-26, the fiscal deficit has been estimated at par with BE of 2025-26 at 4.4% of GDP. In line with the new fiscal prudence path of debt consolidation, the fiscal deficit in BE 26-27 is estimated to be 4.3% of the GDP. The revised estimates of the non-debt receipts are 34 lakh crore rupees, of which the centre's net tax receipts are 26.7 lakh crore. The revised estimate of the total expenditure is 49.6 lakh crore rupees, of which the capital expenditure is about 11 lakh crores. Budget estimates 2026 to 2027. Coming to 26-27, the non-debt receipts and the total expenditure are estimated as 36.5 lakh crore and 53.5 lakh crore respectively. The centre's net tax receipts are estimated at 28.7 lakh crore rupees. To finance the fiscal deficit, the net market borrowings from dated securities are estimated at 11.7 lakh crore rupees. The balance financing is expected to come from small savings and other sources. The gross market borrowings are estimated at 17.2 lakh crore rupees. I'll now move to Part B. Part B, direct taxes. Honorable Speaker, sir, I now present my proposals on direct taxes. New Income Tax Act. In July 2024, I announced a comprehensive review of the Income Tax Act 1961. This was completed in a record time, and the Income Tax Act 2025 will come into effect from 1st April 2026. The simplified income tax rules and forms will be notified shortly, giving adequate time to taxpayers to acquaint themselves with its requirements. The forms have been redesigned such that ordinary citizens can comply without difficulty. Ease of living. I propose that any interest awarded by the Motor Accident Claims Tribunal to a natural person will be exempt from income tax, and any TDS on this account will be done away with. I propose to reduce TCS rate on the sale of overseas tour program package from the current 5% and 20% to 2% without any stipulation of amount. I propose to reduce TCS rate for pursuing education and for medical purposes under the Liberalized Remittance Scheme, popularly known as LRS, from 5% to 2%. Supply of manpower services is proposed to be specifically brought within the ambit of payment to contractors for the purpose of TDS to avoid ambiguity. Thus, TDS on these services will be at the rate of either 1% or 2% only. I propose a scheme for small taxpayers, wherein a rule-based automated process will enable obtaining a lower or nil deduction certificate instead of filing an application with the assessing officer. For the ease of taxpayer holding securities in multiple companies, I propose to enable depositories to accept Form 15G or Form 15H from the investor and provide it directly to various relevant companies. I propose to extend time available for revising returns from 31st December to up to 31st March with the payment of a nominal fee. I also propose to stagger the timeline for filing of tax returns. Individuals with ITR 1 and ITR 2 returns will continue to file till 31st July, and non-audit business cases or trusts are proposed to be allowed time till 31st August. TDS on sale of immovable property by a non-resident is proposed to be deducted and deposited through resident buyers and his or her PAN-based challan instead of requiring a TAN, which is a temporary accounting number. To address practical issues of small taxpayers like students, young professionals, tech employees, relocated NRIs, and such others, I propose to introduce a one-time 6-month foreign asset disclosure scheme for these taxpayers to disclose income or assets below a certain size. This scheme would be applicable for two categories of taxpayers, namely A, who did not disclose their overseas income or assets, and B, who disclosed their overseas income and or paid due tax but could not declare the asset acquired. For category A, the limit of undisclosed income or asset is proposed to be up to 1 crore rupees. They need to pay 30% of fair market value of asset or 30% of undisclosed income as tax and 30% as additional income tax in lieu of penalty, and would thereby get immunity from prosecution. For category B, asset value is proposed to be up to 5 crore rupees. Here, immunity from both penalty and prosecution will be available with a payment of fee of 1 lakh rupees. Rationalizing penalty and prosecution. Multiplicity of proceedings are hindrance to the ease of doing business. I propose to integrate assessment and penalty proceedings by way of a common order for both. There will be no interest liability on the taxpayer on the penalty amount for the period of appeal before the first appellate authority, irrespective of the outcome of appeal process. Further, quantum of prepayment is being reduced from 20% to 10% and will continue to be calculated only on core tax demand. As an additional measure for reducing litigation, I propose to allow taxpayers to update their returns even after reassessment proceedings have been initiated, and an additional 10% tax rate over and above the rate applicable for the relevant year. The assessing officer will then use only this updated return in his proceedings. There is already a framework for immunity from penalty and prosecution in the cases of underreporting. I propose to apply this framework for immunity to misreporting too. However, in such a case, the taxpayer will need to pay 100% of the tax amount as an additional income tax over and above the tax and interest due. Penalties for certain technical defaults, such as failure to get accounts audited, non-furnishing of transfer pricing audit report, and default in furnishing statement for financial transactions are proposed to be converted into fee. I propose to rationalize prosecution framework under Income Tax Act while maintaining a careful balance for deterrence in some serious offence. Non-production of books of account and documents and requirement of TDS payment where payment is made in kind are being decriminalized. Further, minor offences will attract fine only. The remaining prosecutions will be graded commensurate with the quantum of offence. They will entail only simple imprisonment with maximum imprisonment reduced to 2 years and power to courts to convert even those into fines. There is no penalty. There is no penalty presently for non-disclosure of non-immovable foreign assets with aggregate value less than 20 lakh rupees. I propose to also provide them with immunity from prosecution with retrospective effect from 1/10/2024. Cooperatives. Deduction is already allowed to a primary cooperative society engaged in supplying milk, oil seeds, fruits or vegetables raised or grown by its members. I propose to extend this deduction to also include supply of cattle feed and cotton seed produced by its members. I propose to allow inter-cooperative society dividend income as deduction under the new tax regime to the extent it is further distributed to its members. I further propose to allow exemption for a period of 3 years to dividend income received by a notified national cooperative federation on their investments made in companies up to 31/1/2026. This exemption would be allowed only for dividends further distributed to its member cooperatives. Supporting IT sector as India's growth engine. India is a global leader in software development services, IT-enabled services, knowledge process outsourcing services, and contract R&D services relating to software development. These businesses and their segments are quite interconnected with each other. All these services are proposed to be clubbed under a single category of information technology services with a common safe harbor margin of 15.5% applicable to all. The threshold for availing safe harbor for IT services is being enhanced substantially from 300 crore rupees to 2,000 crore rupees. Safe harbor for IT services shall be approved by an automated rule-driven process without any need for tax officer to examine and accept the application. Once applied by an IT services company, the same safe harbor can be continued for a period of 5 years at a stretch at its choice. For IT services companies who want to conclude advanced pricing agreement, APA, I propose to fast-track unilateral APA process for IT services and endeavor to conclude it within a period of 2 years. The period of 2 years can be extended by a further period of 6 months on taxpayers' request. I propose to extend the facility of modified returns available to the entity entering APA to its associated entities also. Attracting global business and investment. Recognizing the need to enable critical infrastructure and boost investment in data centers, I propose to provide tax holiday till 2047 to any foreign company that provides cloud services to customers globally by using data center services from India. It will, however, need to provide services to Indian customers through an Indian reseller entity. I also propose to provide a safe harbor of 15% on cost in case the company providing data center services from India is a related entity. To harness the efficiency of just-in-time logistics for electronic manufacturing, I propose to provide safe harbor to non-residents for component warehousing in a bonded warehouse at a profit margin of 2% of the invoice value. The resultant tax of about 0.7% will be much lower than in competing jurisdictions. To provide fillip to toll manufacturing in India, I propose to provide exemption from income tax for 5 years to any non-resident who provides capital goods, equipment, or tooling to any toll manufacturer in a bonded zone. To encourage vast pool of global talent to work in India for a longer period of time, I propose to provide exemption to global, non-India sourced income of a non-resident expert for a stay period of 5 years under notified schemes. I propose to provide exemption from minimum alternate tax, the MAT, to all non-residents who pay tax on presumptive basis. Tax administration. I propose to constitute a joint committee of Ministry of Corporate Affairs and Central Board of Direct Taxes for incorporating the requirements of income computation and disclosure standards, the ICDS, in the Indian Accounting Standards, Ind AS itself. Separate accounting requirement based on ICDS will be done away with from the tax year 27-28. To support Prime Minister Modi's vision of homegrown accounting and advisory firms to become global leaders, I propose to rationalize the definition of accountant for the purposes of safe harbor rules. Other tax proposals. Change in taxation of buyback was brought in to address the improper use of buyback route by promoters. In the interest of minority shareholders, I propose to tax buyback for all types of shareholders as capital gains. However, to disincentivize misuse of tax arbitrage, promoters will pay an additional buyback tax. This will make effective tax 22% for corporate promoters. For non-corporate promoters, the effective tax will be 30%. TCS rate for sellers of specific goods, namely alcoholic liquor, scrap, and minerals, will be rationalized to 2%, and that on Tendu leaves will be reduced from 5% to 2%. I propose to raise the STT on futures to 0.05% from the present 0.02%. STT on options premium and exercise of options are both proposed to be raised to 0.15% from the present rate of 0.1% and 0.125% respectively. We reformed the taxation landscape for corporates in 2019 by providing them a simplified regime with lower tax rate so that they could productively focus on business rather than on claim of deductions and exemptions. To encourage companies to shift to the new regime, set-off of brought forward MAT credit, minimum alternate tax credit, is proposed to be allowed to companies only in the new regime. Set-off using available MAT credit is proposed to be allowed to an extent of 1/4 of the tax liability in the new regime. MAT is proposed to be made final tax, so there will be no further credit accumulation from 1st April 2026. In line with this change, the rate of final tax is being reduced to 14% from the current MAT rate of 15%. The brought forward MAT credit of taxpayers accumulated till 30th March 2026 will continue to be available to them for set-off as above. Indirect taxes. I shall now take up proposals related to indirect taxes. My proposals for customs and central excise aim to further simplify the tariff structure, support domestic manufacturing, promote export competitiveness, and correct inversion in duty. To continue weeding out long continuing customs duty exemptions, I propose to remove certain exemptions on items which are being manufactured in India or where the imports are negligible. Similarly, to further simplify the process of ascertaining the rate of duty applicable on a particular item, I propose to incorporate certain effective rates in various customs notifications to the tariff schedule itself. I shall now take up sector-specific proposals. Promotion of exports of marine, leather, and textile products. I propose to increase the limit for duty-free imports of specified inputs used for processing seafoods for export from the current 1% to 3% of FOB value of the previous year's export turnover. I also propose to allow duty-free imports of specified inputs, which is currently available for exports of leather or synthetic footwear, to exports of shoe uppers as well. I propose to extend the time period for export of final product from the existing 6 months to 1 year for exporters of leather or textile garments, leather or synthetic footwear, and other leather products. Energy transition and security. I propose to extend the basic customs duty exemption given to capital goods used for manufacturing lithium-ion cells for batteries to those used for manufacturing lithium-ion cells for battery energy storage systems also. I propose to exempt basic customs duty on import of sodium antimonate for use in manufacture of solar glass. Nuclear power. I propose to extend the existing basic customs duty exemption on imports of goods required for nuclear power projects till the year 2035 and expand it for all nuclear plants irrespective of their capacity. Critical minerals. It is proposed to provide basic customs duty exemption to the import of capital goods required for the processing of critical minerals in India. Biogas blended CNG. I propose to exclude the entire value of biogas while calculating the central excise duty payable on biogas blended CNG. Civil and defense aviation. I propose to exempt basic customs duty on components and parts required for the manufacture of civilian training and other aircrafts. It is proposed to exempt basic customs duty on raw materials imported for the manufacture of parts of aircraft to be used in maintenance, repair, or overall requirements by units in the defense sector. Electronics. To deepen value addition in the consumer electronics sector, I propose to exempt basic customs duty on specified parts used in the manufacture of microwave ovens. Special economic zone. To address the concerns arising about utilization of capacity by manufacturing units in the special economic zones due to global trade disruptions, I propose as a special one-time measure to facilitate sales by eligible manufacturing units in SEZs to the domestic tariff area at concessional rates of duty. The quantity of such sales will be limited to a prescribed proportion of their exports. Necessary regulatory changes will be undertaken to operationalize the measures while ensuring level playing field for the units working in the DTA. Ease of living. To rationalize the customs duty structure for goods imported for personal use, I propose to reduce the tariff rate on all dutiable goods imported for personal use from 20% to 10%. To provide relief to patients, particularly those suffering from cancer, I propose to exempt basic customs duty on 17 drugs or medicines. I propose also to add 7 more rare diseases for the purposes of exempting import duties on personal imports of drugs, medicines, and food for special medical purposes used in their treatment. Customs process. India's role and share in the global trade is poised for a major leap in line with our ambition and journey towards Viksit Bharat. In this regard, I propose many measures for custom processes to have minimal intervention for smoother and faster movement of goods and greater certainty to the trade. Trust-based systems. I propose to enhance duty deferral period for Tier 2 and Tier 3 authorized economic operators, known as AEOs, from 15 days to 30 days. I propose to provide eligible manufacturer importers the same duty deferral facility. This should encourage them to get themselves accredited as a full-fledged Tier 3 AEO in due course. To provide greater certainty and for better business planning, I propose to extend validity period of advance ruling binding on customs from the present 3 years to 5 years. In the spirit of the whole of government approach, government agencies will be encouraged to leverage AEO accreditation for preferential treatment in clearing their cargo. Regular importers with trusted long-standing supply chains will be recognized in the risk system so that the need for verification of their cargo every time can be minimized. Export cargo using electronic sealing. Export cargo using electronic sealing will be provided through clearance from the factory premises to the ship. for import of goods not needing any compliance, filing of bill of entry by a trusted importer and arrival of goods will automatically notify customs for completing their clearance formalities. This will enable goods to be released immediately on arrival. The customs warehouse framework will be transformed into a warehouse operator-centric system with a self-declarations, electronic tracking, and risk-based audit. These reforms will move away from the current system of officer-dependent approvals and reduce transaction delays and compliance costs. Ease of doing business. Approvals required for cargo clearance from various government agencies will be seamlessly processed through a single and interconnected digital window by the end of the financial year. Processes involved in clearance of food, drugs, plant, and animal and wildlife products, accounting for about 70% of interdicted cargo, will be operationalized on this system by April 2026 itself. For goods not having any compliance requirement, clearance will be done by customs immediately after online registration is completed by the importer, subject to the payment of duty. Customs integrated system will be rolled out in 2 years as a single integrated and scalable platform for all customs processes. Utilization of non-intrusive scanning with advanced imaging and AI technology for risk assessment will be expanded in a phased manner with the objective to scan every container across all the major ports. New export opportunities to support Indian fishermen to fully harness the economic value of marine resources beyond our territorial waters. The following measures will be taken. A. Fish catch by an Indian fishing vessel in exclusive economic zone or on the high seas will be made free of duty. Landing of such fish on foreign port will be treated as export of goods. Safeguards will be put in place to prevent misuse during fish catch, transit, or transshipment. To support aspirations of India's small businesses, artisans, and startups to access global markets through e-commerce, I am pleased to announce complete removal of the current value cap of 10 lakh rupees per consignment on courier exports. In addition, handling of rejected and returned consignments will be improved with effective use of technology for identifying such consignments. I propose to revise provisions governing baggage clearance during international travel to address genuine concerns of passengers. The revised rules will enhance duty-free allowances in line with the present-day travel realities and provide clarity in temporary carriage of goods brought in or taken out. There are honest taxpayers who are willing to settle disputes by paying all their dues, but they get deterred due to negative connotation associated with penalty. They will now be able to close cases by paying an additional amount in lieu of penalty. Honorable Speaker, sir, with this, I commend the budget to this august House. Jai Hind.
One and a half hours.
Item number 3, माननीय वित्त मंत्री जी.
Item number 2, sir.
3.
Sir, with your permission, I rise to lay on the table of the following statements under Section 3, 1 of the Fiscal Responsibility and Budget Management Act of 2003. Medium-term fiscal policy, fiscal policy strategy statement, and macroeconomic framework statement.
Item number 4, माननीय वित्त मंत्री जी.
Sir, with your permission, I move for leave to introduce the Finance Bill 2026.
प्रश्न ये कि विधेयक को पुनर्स्थापित करने की अनुमति प्रदान की जाए. जो सदस्य इस पक्ष में हाँ गए, जो सदस्य विरोध में ना गए, मेरे विचार में निर्णय हाँ वालों के पक्ष में, हाँ वालों के पक्ष में अनुमति प्रदान की जाती है. माननीय मंत्री जी, अब विधेयक पूरे स्थापित करें.
Sir, I introduce the bill.
माननीय सदस्यगण, आपको सूचित किया जाता है कि माननीय वित्त मंत्री जी के बजट भाषण की कॉपी पब्लिकेशन काउंटर पर ली जाती है. बजट भाषण और बजट से संबंधित दस्तावेज आपके मोबाइल फोन और मेंबर पोर्टल्स पर ही उपलब्ध है. सभा की कार्रवाई कल सोमवार दिनांक 2 फरवरी 2026 को प्राप्त 11 बजे तक के लिए स्थगित की जाती है.
Okay, and the budget is done. The market is selling off. We have the main headlines playing for you on the screen. Let's also, keep the Nifty coming back up as well. The Nifty at this point in time is sliding. Market's down about 1.4%. The mid-cap index is down about 2.2%. And the Bank Nifty is leading those declines. Now, first and foremost, the fiscal deficit number that has been projected for FY27, that's a tad higher than street estimates, 4.3% of GDP. That's what the projection is. The market was working with a projection of about 4.2% of GDP. The next sort of issue that seems to have hurt market sentiment is the gross borrowing number. That gross borrowing number at 17.2 lakh crore rupees is also higher than most estimates. Most of the economists were expecting a gross borrowing to be somewhere between 15.8 lakh crores to about 16 lakh crore rupees. So the net borrowing number is in line with estimates and projections at about 11.3 lakh crore rupees. But the fiscal deficit number, higher gross borrowing, has led to a bit of a sell-off. Not just that, there is a hike in securities transaction tax. STT has been hiked from on futures and on options. Futures from 0.05%. It has gone to 0.05% to 0.02%. Likewise, in options, the hike is 0.15% to 0.1%. So a hike in STT, slightly higher than expecting gross market borrowing, and the fiscal deficit projection for the new financial year FY27 not as low as what some experts or some economists would have perhaps liked it to be. There were other announcements coming in, however, positive announcements as well. For the electronics manufacturing and components ecosystem, the outlay is at 40,000 crore rupees. So those are some of the stocks that have been reacting favorably. Also, PFC and REC, restructuring announced for these two large lenders, power sector lenders, and both of those stocks have been up and about as well, PFC and REC. Let's see if we can get our panel of experts to join in, to weigh in on some of these announcements, because even as we speak, the market has sold off 3% down on the mid-cap index. Soumya Kanti Ghosh of SBI is with us. Soumya, thank you for joining in. The market seems a tad disappointed with the fiscal deficit number and this gross borrowing number that's in excess of 17 lakh crores.
I think the net borrowing numbers at 11.7 trillion is mostly in line with the expectations. And if you add the repayments of around 5.5 trillion, the number comes to around 17.2. Anyway, the market was expecting a number anywhere between 16.5 to 17. It has come at 17.2. So that's not significantly higher. So I think that needs to be emphasized. The second point is that if I just back calculate from the non-debt receipts, and the total expenditure with the FM pointed out in her statement, that makes the fit for FY27. We have not the budget papers, around 17 trillion. So basically, the expectations was that, it could be at 4.2 to 4.3%, but possibly the nominal GDP growth rate has been pegged at 10.7%. Again, the number is not available because you have to back calculate and get the fiscal deficit numbers. And as a percentage, if it is 4.3%, the nominal GDP comes at 10.7%. So I think the numbers are mostly in line with the expectations, and gross market borrowing numbers are marginally higher, and net market borrowings are almost in line with the expectations. So I don't think that there should be too much concern about in terms of the budgeted numbers, because fiscal deficit anyway, people were expecting 4.2 to 4.3%. And we need to meet the fine prints to see how much has to be mobilized to the short-term borrowings. It is possible that a higher percentage could be mobilized to the short-term treasury bills. And the other important point, Surabhi, I wanted to mention, I think this is all, we need to look the final numbers. The gross borrowing numbers could also include the GST compensation sales of around 87,000 crore. So that's why it could look a little higher. So overall, I think the numbers are marginally higher, but not significantly beyond the market expectations.
Soumya, so okay, I take your point that slightly higher, but it's not exactly like breaking the bank. I think the stock market is selling off for other reasons as well, because of the hike in securities transaction tax and so on. I mean, in case you managed to pick up, there was no specific mention of divestment. That's another reason why maybe the market is selling off. I mean, no big picture announcements on how to monetize, public sector assets. And no specific mention of big, allocation or a big mention on defense, which is again an expectation that the market was going with. Your thoughts?
No, I think, Surabhi, defense anyway, given the tight budget constraints we are working with, and defense, normally we are also not expecting a significant hike, because that has to come from the overall considerations. So I think that the market may be a little disappointed in terms of, I think, the other reasons like the security transaction tax, also then tax disclosure scheme, which has come in for assets which are not disclosed abroad and other things. But if I see that the FY disinvestment target, they have given it around 80,000 crore. So against around 35,000 crore last year. So I think they have plans for that one, but the market possibly was expecting some sort of an disinvestment, maybe roadmap. But if you look into the government projections last several years, I think they are not giving out any specific disinvestment target.
Yeah, and they're missing the target they're giving out as well, which is what happened, I think, in the previous fiscal. I mean, we're going to be missing that disinvestment target by a wide stretch. FY27, you're saying it's pegged at 80,000 crores from the first.
Some of the where estimates is coming at 80,000 crore.
80,000 crores. So, Soumya, how would you rank the budget on the overall fiscal tight balance that she's had to walk? There are a couple of schemes, for which outlays have gone. For instance, electronic components, she's earmarked 40,000 crores. A couple of other announcements for, setting up these partnership hospitals for medical tourism, so on and so forth. I mean, a couple of sectors have got a mention. What is your overall take on the way in which spends have been, laid out for FY27?
No, I think in terms of the overall budget, I think the FM has been quite conservative in terms of the numbers, because I think getting to some of the markets, some of the markets were thinking that it could be taken down to 4.2% or so. I think she has not walked that path. She has kept it at 4.3%, which is very pragmatic in an uncertain world. And also regarding the disinvestment, I think that the markets are very uncertain across the world. So any disinvestment target or something will be difficult to set and then achieve that. And as has been the case in the last couple of years. So that's point number 2. The third point is that I think whatever the numbers has been given out in the budget, in terms of the in terms of the borrowing numbers, in terms of the net borrowing numbers, and I think the FC recommendations also suggest that the tax devolution remains at the same level. And also I think the FC had suggested maybe there is no RDG grant. So overall, I think the budget has specific objectives which it has set aside. I think some of the announcements which came in the budget regarding the SME sector in terms of the trades receivables are quite positive. That will free up a lot of liquidity position for these sectors. Some of the other sectors, healthcare, tourism, sports, have also got attention. So overall, the budget has tried to maximize the stakeholder interest and ventured into areas which were earlier not there, addressed significantly. So overall, I think it's an it's a budget, and the impact of this will actually be felt over some time. It is not immediate, because if you are increasing the STT, obviously that will be a negative impact on the stock market sentiments. But I believe overall it's a good budget in terms of the overall objective. Anyway, I was not expecting any significant increase in the defense budget also, given the constraints.
Okay. All right, fair. Yeah, Soumya, would you say that the STT hike is directly perhaps linked to the fact that finances are tight for the centre? I mean, there is a shortfall on direct tax revenue. There is the 1.2 lakh crore rupee cut thanks to the GST rationalization. And STT has been the only steady source of, at least tax revenue over the last couple of years. To that extent, the equity market seems disappointed. But, in terms of meeting the fiscal deficit target for next year, will it be the same story, that it's going to be non-tax revenue, which will basically get the finance minister through?
Should be some small corrections. I think the nominal GDP numbers is coming at 10%. I think it's 357.1 trillion, 393 trillion. And the fiscal deficit estimates, if I can see, it's the 16.95 trillion. So I think overall it's not, so it's higher than what it was in FY26. FY26, it was 15.58 trillion. So it has increased in absolute amount, but given the fact that we are going, that GDP, the nominal GDP estimates are also quite rational. So 10% means I think it's quite rational. So I don't see too much of a downside to the estimates, which the markets could be selling off. And hopefully after, there will be greater clarity on the numbers once the entire number is out. Defense also, I think the increase has been very marginal.
Yeah, absolutely. And I think that is one part of the market's disappointment, that the defense outlay does not seem to be like a big bazooka number. And then the gross market borrowing that you spoke of, and the fear that higher government borrowing will keep pressurizing perhaps bond prices. We've got Indranil Pan joining in the conversation as well. Mr. Natarajan Srinivasan also joining in to give us the India Inc. perspective. Mr. Srinivasan, there was a fair amount of, a lot of announcements for, say, the electronics manufacturing sector, announcements for data centers. A full tax holiday to global companies who want to use Indian data centers to provide cloud services. What did you make of some of these, highlight announcements?
So I think the budget will continue to support growth. There is a big push for manufacturing, good allocation for electronics, semiconductors, rare earth, which are actually quite topical today. They have been really taken care. There is also something to do with capital goods. The infrastructure allocation continues to be about 12 lakh crores. And then for the railways also, there's the 7 high-speed corridors. Actually, there has been an announcement. Then as regards disinvestment, of course, there is something has been mentioned about the divestment of real estate assets by the PSUs. This could be quite huge. If they want to garner everything, this could be quite huge. Of course, considering the enormous amount of investment that is being projected to happen in the data center, this announcement of tax holiday will give a big impetus. Overall, I feel the budget has really strengthened the manufacturing and then infrastructure. As you rightly pointed out, we have no good idea about the allocation in defense, though I think we have to get into details. Once we know the details, probably we'll get into some idea.
Right. Indranil Pan is also joining us in this conversation. Indranil, if you can hear me, we were just discussing with Soumya whether this fear around the higher gross borrowing number, whether that is well placed, and what did you think of the overall fiscal deficit projection and the math?
Yeah.
Okay.
So
I think we've got Indranil now. Indranil, can you hear me?
Yeah, I can hear you.
Yes.
Yeah, so please go ahead.
Indranil, I was asking about this fear around the higher gross borrowing number, because most of the estimates that I saw didn't see that gross borrowing number, absolute number, go beyond 16 lakh crores. The FM is talking 17 lakh crores plus. How much of a worry is that?
So, more than the supply side pressure, it is the demand issues that are there. So, first of all, I think deposit growth of the banking sector is on the weaker side, which necessarily means that the SLR requirements or the how the SLR stacks up for the banking sector going ahead on an incremental basis will probably be lower. So that's one issue. In this budget, I was hoping to see some tax relaxations in terms of foreign inflows. That has not really come through. We were also expecting some benefits in terms of the taxes on the savings of the banking sector to enable them to garner more savings, which has not also sort of come through. So from a sort of a year's perspective, I think definitely you have a problem in terms of how the supplies get cleared by the market. Let us not also forget that from the regulatory standpoint, from April 2026, we will have the new LCR rules, which also will reduce the requirement of the banking sector to significantly hold HQLA assets. So that's also a negative. And I think the final point that I need to make is on the state borrowings. And states have been relatively more fiscal indisciplined than the center. And we will have to watch out incrementally what the state fiscal deficits look like to take a holistic view in terms of how the yield curve in India looks like.
Yeah. Very quickly, Indranil, did you pick up the actual increase in defense? Because the market was hoping for a number between 12 to 15% growth in the defense outlay. Did you pick up finally what the projection is for FY27?
No, I'm very sorry I did not. But having said that, if the nominal growth is 10%, it is very difficult for the finance minister to allocate relatively larger amounts towards the defense. Yes, to a certain extent, capital expenditures, the allocation would be larger because the overall capital expenditures has gone up by around close to 1 trillion rupees. Which is an 8.6% growth that is there, lower than previous years. But overall, I think it is quite a tight budget for the finance minister, given also the fact that there are larger outgoes to the states from the finance commission.
Absolutely. Well, let's get to the market now, which is disappointed to say the least. Shankar Sharma is with us. Shankar, so a hike in STT, not much of a bazooka spend on either defense, capex number modest. Pretty higher, gross borrowing number. The market just doesn't like the sound of it, at least right now, in the immediate term. But what's your take?
I mean, anyway, I didn't expect the budget to have much leeway or room to do any miracles because the revenue side has been very constrained. I did not pick up any revenue numbers, what is actually now going to happen for the current fiscal, which ends in March. But whatever numbers I had seen prior to the budget was that there was a revenue decline on the personal taxation side of 3.2%. I don't know what the full year number is going to be for the current year, but I suspect it's not going to be much better than that. It might be even a bigger decline because of far lower capital gains and STT collections. So obviously anybody with basic understanding of fiscal math knew that there was no chance that the finance minister was going to pull out some rabbit out of the hat, give you major giveaways or tax concessions and all that. People were hoping that FIIs will get some concessions or overall the capital gains taxes will come down, but that's ridiculous. I mean, the fact is that as far as my numbers went last year, I mean, for the current budget, when the previous budget was announced for this particular current year, 5.5 lakh crores or so coming from LTCG, STCG, STT, dividend tax. I mean, if you have such a big dependence on the stock market for inflows of taxation, how do you expect the finance minister to give you a concession on precisely that area? In any case, those taxes are not going to be coming because the markets are in a swoon, have been bad for the last 12, 18 months. So I don't know why people were expecting any miracles. I was not. Capex side, 11, 12 lakh crores is now market has factored that in. There is no great, excitement over a 12 lakh crore budget estimate. I mean, forecast for Capex. So overall, if the market was expecting a miracle, I think the market was being foolish. So, and I can we have seen the markets being fairly foolish for extended periods of time. This was one of those periods.
Well, maybe the market was not expecting a miracle, but the market was literally hoping with bated breath that at least don't increase any more tax. But that has happened on STT. How long will this STT disappointment linger, you think, Shankar?
No, but STT doesn't affect the economy or doesn't affect overall, the future of India's growth. Look, STT did not exist in a meaningful form. I'm talking in terms of absolute numbers 10 years ago. Now, suddenly, because of a few million stupid Indian FNO traders, the government has found a great, वो बोलते हैं सोने की मुर्गी, जिससे कि वो अंडे आते रहते हैं. अब the government wants more eggs from the same मुर्गी. Oh, I mean, it's the idiocy of the people. Government is doing what it is supposed to do to tax more the foolishness of people. FNO trading has no place in the average Indian's overall financial allocation. But thanks to the great marketing by our brokers and, of course, the vested interest of, obviously, the exchequer in promoting FNO trading has become a huge part of the government's revenues. I mean, STT was some 85,000 crores a couple of years back. This year, maybe 40,000 crores. Why will the government not milk the stupidity of people? I fully support exploiting the foolishness of an Uber driver or a TV repairman, all of whom have been borrowing to speculate in FNO. We all know the stories at the retail level.
Well, SEBI has been warning about it. Every time it puts out that study saying some 99% people losing money in FNO, and now the FM is taxing more and more of such trades. Let's see what the impact is going to be on volumes. By the way, our team is pointing out that a lot of the stocks, related stocks are falling. Angel, for instance. Shankar.
This is one way to cut down trading in FNO. This is a good way to cut it down. I completely support the FM in increasing STD. Let it increase even more. This product is ruining India's youth. 100%. All FNO brokers are making money hand over fist, which is a direct wealth transfer of the people's losses as commissions to the various brokers. This is ridiculous. This has to stop, but it cannot stop. So at least tax the hell out of it so that it becomes unviable for people to do FNO trading. It's no place for a civilized country of this magnitude, of the kind of scene, of the kind of thing we have seen.
Yeah, let me get to Vetri Subramaniam as well, who's of course the head of UTI AMC. Vetri, thank you so much for joining in. The first reaction from the market was very severe. Now it's kind of recovering a little bit. What did you make of it? There's a bit of this tax issue that the STT hit, but the larger question is that those big picture announcements on defense, on capex, some huge numbers being thrown out. I think that was missing if the market was expecting that.
Yes, Surbi, I think, and this has always been the pattern for many years that, the budget day trading really is all about what happens to STT. It's about what happens to capital gains tax. And therefore, you could attribute the market reaction function to what has been seen as a big hike in the STT on futures. And, I'll just build on one of those points that Shankar made. I often disagree with him, but I would tend to agree with him a lot on the point that he made. Which is to say that, the fact of the matter, and I represent UTI AMC, where we talk about getting investors to hold capital with us for 20 years and 40 years. And if you look at the aggregate profitability of the stockbroking industry, it's way in excess of what the investment management industry makes. And that sort of speaks to the point that, Shankar makes, that there's so much money being lost by investors over there, by traders over there. But just one point. There will be a point at which if you overtag futures and options, you will take away liquidity from the market. That's a fine point. I'm not suggesting we've reached over there, but I'm sure that's something the policy makers would be seized about. To your other point, Surbi, about, big picture announcements, I think the big picture, the big vision has already been laid out for us, right? It's about getting to Viksit Bharat in 2047, which requires us to grow at the sustained levels of growth over a long period of time. That will not be possible unless you ensure macroeconomic stability. And I think we underestimate the value of tax stability and tax policy not being changed from one budget to the other. So I think when you look at it in that context, overall, it's a very pragmatic budget. It keeps its vision on that long-term goal and tries not to disrupt too much for business and industry in the short term. And remember, the invisible benefit of bringing down debt to GDP is that you bring down the interest cost of government, which means there will eventually be more discretionary resources available to government to spend where it needs to. And finally, it frees up resources for the private sector. So I think, in those big touch points, the budget does its job.
Okay, so you don't sound too perturbed overall on some of the macros.
This is the kind of long-term orientation the country needs, and I'm glad to see it.
Okay. Shankar, do you agree that if we go beyond some of these headlines, this is not necessarily a market negative budget if we just go beyond the first hour hiccup? Okay, I think we've just lost that line with Shankar. But Indranil, if I could come back to you on the macro highlights, the fiscal tightrope, I mean, how would you rank the budget, considering that it was a tall order this time with revenues really dwindling?
Well, I think consolidation of the fiscal has been the hallmark of budget making of the current government. And happy to note that they are sort of sticking to that even from the fiscal deficit GDP perspective, even though they need not have, because the benchmarking in terms of fiscal consolidation has now shifted to public debt as a proportion of GDP. Now, obviously, the attempt at the fiscal deficit coming down is important, but just to focus on the capex to the revex ratio, something that we had been talking about during the post-COVID period when capex went up very sharply. That is not really changing between the two budgets, and that has been more or less stagnating over the last 3 years. So within the fiscal, I think from a macro perspective, I would have expected this ratio to have consistently been pushed on the higher side, which is not happening. The second thing, of course, is the amount of borrowings that the government would have to do, even when they are bringing down the fiscal deficit as a proportion of GDP, as well as the public debt as a proportion of GDP. And that, to a certain extent, sort of negates the transmission mechanism that the Reserve Bank of India was consistently expecting through the 125 basis points rate cut. But I understand the yield curve is not directly in India linked to some of the lending structures, including the housing or the lending for the vehicles. But it actually upsets the borrowing cost of the domestic manufacturing, which is something that we will have to consistently look towards the RBI to manage the yields. Either through a liquidity sort of perspective or through its OMOs that they have anyways been doing in the market.
Indranil, good to get that point from you, and thank you so much for clarifying some of those issues. We also have Mr. Umesh Revankar of Shriram Finance joining in. Sir, great to have you on this panel. Before I get to Mr. Revankar and how he sees it from an India Inc. and a lender perspective, Vetri, just to come back to the stock market. Okay, let's leave aside the STT, hiccup, and usually it's digested in a day or two. The larger question is, at a time when FPIs have been fleeing, confidence has been low, sentiment is extremely weak, and sort of the global backdrop is very, very tricky, does this budget provide any additional cushion to the equity market at all?
My counter question to that, Surabhi, is it the role of the budget to address those sort of questions on an annual basis? And I would submit that is not the role of the budget. Having said that, and I think
that's a fair point, Vetri. I completely take your counter. It's just that we want to latch on to every bit of hope, right? In a dark environment, 1 year of very low returns, a very rocky start to 26. I'm only batting for the investor, feeling that investor's pain and sense of confusion. So therefore the question.
I'm batting for the investor in the sense that they should think about this from a long-term perspective. And honestly, in a journey of 20 years, 1 year of no return is hardly anything to get, worried about. We are sort of educating investors that they should be prepared for years in which there will be significant drawdowns. But that's what creates the opportunity to create long-term wealth. So I look at it from that point of view, not from the point of view that just because we have the ability to create a very large economy over the next 21 years, just because of that every year the stock market is going to deliver you returns like clockwork. But I think I'll still answer your one point on tax, Surbi, which is to say, I think many wise commentators have made this point, that there is a need to provide particularly foreign investors with a little bit more certainty about how India is going to handle its tax affairs. Some of this has got to do with recent sort of court related decisions, but I think that's a much longer term consultation process where we can then hopefully put something which gives them a sense of stability in India's tax policy. But I don't think that's the subject of this year's budget.
Okay, Vetri, I request you to stay on for just a few more minutes because I want this panel to rank the budget as well. We have Mr. Revankar, Pankaj Tibrewal of Ikigai has joined in. Let's quickly get a word in from Mr. Revankar. Pankaj, coming to you on the market and the market's blues, or the market's reds rather. But Mr. Revankar, your first thoughts in terms of the overall direction and the announcements, and especially for the BFSI sector, several cues coming in.
Yeah, I think we as per the expectation, because I did wanted some focus on the infrastructure, even though the capex allocation have not increased substantially, but reiterating the infrastructure and logistics, addressing the issue of logistics, and making manufacturing in India much better, creating a bigger market for manufacturers in India by giving linkages to the coastal and having them easy access to the international market. These are the few thoughts I have felt that's very good, very positive in the budget. Even they're talking about the river-linked transportation. So these are all very positive. I think it is going to help in the long term. But in the short term, what I also liked about it is the focus on MSME and also certain new sectors which are being focused, which is very indigenous, likely to make it big, in the sense the biopharmas and all are likely to, because India has been producing very large, it is a large food industry. In the sense, it can produce for itself, it can also export. It can also give some solution to the world as far as the food is concerned. I think these are all the few things are very good, likely to help the rural India. And MSME, yes, the equity, 10,000 crores of equity support, which has been talked about, and how it is going to be executed is something to be seen. But I think that's a lot of positives which I see both in terms of infrastructure and MSME sector.
So very quickly, Mr. Revankar, on the point of cost of borrowing, for a large financial conglomerate like yours, there's a bit of a concern now with the higher gross borrowing number. And then there are other elements, right? Because we're still waiting for, for India to be added in the Bloomberg, global indices. So will cost of capital, local cost of capital at all become a concern? Because overall, with higher state borrowings, anyway, we've seen that pressure on bond yields. How do you see it from your perspective in terms of just your raw material costs over the next couple of months?
See, if I take as individually, our company is well placed, and I think with the rating upgrade and all, it is likely to become much better. We also have been in the international market raising through bond and syndicated loans. So we have access to international market. See, transmission in India has always been slow. It is not as fast as expected, and even by RBI. I think there has been a lot of delay in transmission because various factors. Because the savings also is not growing as much as expected by the bank, and also with the digital technology being there, even the earning from the current account and savings accounts are likely to be much slower. So the advantage of having a current account and savings account and spread over it also is going to become much lesser for the bank. So transmission is going to be slow and it will take time. I feel that for us, our lending rates are likely to come down by 50 to 100 basis point is what we indicated as far as individually our company is concerned. But NBFC as a whole, I think they will be able to manage this situation, but there may not be advantage on the transmission for near future. And they're also talking about the corporate bond market. And one thing that has been mentioned, which we need to really see, market making. If there is a good market making and a corporate bond market gets established in India, become more deeper, then there is going to be a bigger access to the NBFC industry through bond market.
No, absolutely, and that's something we've been discussing for years, I think decades now, to have a real live and thriving corporate bond market. Let me get to Pankaj as well. By the way, the good news from the market is that the market has recovered. It's kind of digested that initial shock. There was some confusion on this buybacks being taxed as capital gains, but I think the consensus now is that it's fine. It just plugs a bit of a tax arbitrage, and that it doesn't hit retail investors in the market. It's largely to do with corporates and promoters. Pankaj, first thoughts. Market, of course, has a lot of issues on its mind, global as well. But budget-wise, how do you rank the day?
So I think the market is overreacting. I think if you look at the buyback part, it's extremely positive because a large part of funds were stuck in the balance sheets and arbitrage funds and the liquid funds. Neither it was getting deployed on the capex, neither it was getting distributed to the shareholders. I think from a marginal tax rate now getting to the capital gains part, and at the promoter level, if it's a corporate entity, it's 22%. If it's an individual, it's 30%. So I think it's a very, very positive thing. I think for equity investors, anything increase on STT should not bother. And if you look at the past, when such things have happened, sentimentally it's negative in the short term. But after 3 months, actually the volume starts to increase. And that doesn't have a very big repercussion on the volumes, which is the fear on the street right now. So I think market has overreacted. We are seeing some kind of coming back again. And when I look at the overall budget, I think it's reasonably well balanced. There could have been a lot of negatives. There was chatter about, marginal tax rate being increased further. I think that has not happened. On the margin, a lot of people were expecting some kind of tweaking down on long-term capital gains or short-term capital gains. That has not happened. And probably in an environment where things are actually not so great, increasing of STT has not been welcomed by the markets. But if you look at from an equity investor perspective, from a medium to long term, it doesn't impact. So I think markets are overreacting right now. It will find its own flow by the end of the day or the next couple of days.
So Pankaj, what would you say is, okay, now let me ask the question the other way. What is the biggest positive from this budget for the equity market?
So no negative is a big positive.
Okay. I think that sums it up really well. So let me get to the whole panel now. Take quick final thoughts from everyone.
Budget
you
had increased LTCG, you had increased STCG, and there was negative. No new big negative is a big positive. And look at the other things on the progression. You spoke about data centers, you spoke about AI, you spoke about electronic manufacturing, you spoke about other parts of infrastructure, which market is not giving that due credit to the government right now, is they are thinking aloud right now in the back. So I would say that don't look at screen and judge your views. I think from an equity market perspective, I don't think it's a very negative budget, if you ask me.
Okay, good to hear that. And you remind me of a conversation we were having with Mr. DP Singh of SBI Mutual Fund just before the speech. And he was like, as long as they don't mention mutual funds, I'll be very happy. That's all I need. They should not mention mutual funds. And she didn't mention mutual funds, at least specifically, right? Okay, let's get the panel to give their final thoughts and maybe some sort of a ranking. Vetri, you go first. I think Pankaj has made his view very clear that this is actually a very, very okay budget for the market. Whether it's debt markets or equity markets, what's your final take and maybe your report card / ranking?
Well, I would say, first of all, we should not be doing this ranking exercise. This is part of that continuity. But I think, what we are underappreciating is the discipline, the commitment this government is continuously reiterating to bringing down the quantum of fiscal deficit as well as debt to GDP. I'm sure you have so many investors come on your channel, Surbi, and talk about, oh, this company is reducing debt. They are preparing themselves. It's a great, indicator of a company trying to do a turnaround. Well, India is doing the same thing. So, why should it be any different? And that is the elephant in the room. 80% of your fiscal deficit for the year is nothing but the interest cost on your debt. And then we fight about, is the budget more capex heavy or is it more revenue heavy? And the elephant in the room you're not talking about, which is the interest cost. So I think, I have no complaint against this budget. I think it's very well thought out in terms of being long term. It's pragmatic. It may not have the buzzwords that people normally like to hear. But remember the finance minister's opening comments that she is committed to ensuring sustainability and an acceleration of growth. I think this budget, keeps that macro platform very, very steady, and you need a strong platform if you want growth to sustain and accelerate. So I think a job well done.
Okay, so we need to look at the pragmatism and not just focus on buzzwords. And you're sounding fairly optimistic, actually, on just the way the finance minister has walked this tightrope. Final word with Mr. Revankar. Very quickly, 10 seconds. Your sort of ranking or your final take on the budget.
I really felt very comfortable because the finance minister stressed on or underlined the NBFC's role as the credit reach to the last mile. I think that is something which is stressed, which is very positive for the NBFC industry. And also, she talked about a panel to be created for a banking reform. I think that they're having some deep thought about how Indian banking would become a world class or very large. Something I think that's very positive.
Absolutely. All right, and Pankaj, final last word. Now, budget is done and dusted. Now we'll talk about Kevin Walsh. We'll talk about this crash in silver prices. We'll talk about what the RBI is going to do next. Where does it leave us overall markets? Budget is not bad, I take your point. What next?
To be after a very, very long time, I am feeling quite positive about markets. I think 16, 18 months of time and price correction has happened. And last 20 days, I am on ground, meeting corporate industry leaders across the country, across sectors. I can only say that the demand pickup over the last 1.5 months has been significant. And this, I am getting sound bites across infra names, cement name, steel name, auto sector, consumption. So I believe that earnings growth will surprise you in the fourth quarter going forward. And market is divorced right now, the way it was on the opposite side in 2024. If you remember, stock prices were high. The actual economy was in a problem. Now it's the reverse. Actual economy is doing extremely well. And after 15th of December, every corporate is saying we don't know what has happened, but demand has started to pick up significantly. And that, I think, is a very, very big positive. Maybe in the next couple of months, you will get this opportunity when the global noise is too high to buy stocks at your own prices. But I believe this is a time to accumulate on equity side rather than be fearful. I think it is time to be greedy rather than fearful.
Well, you gentlemen have definitely filled me up with optimism and hope, and I'm sure all the viewers who are listening into your views as well. It's time to focus on what's really important and not get perhaps distracted by a lot of the noise. Thank you very much for joining us and decoding the budget impact first cut. Vetri, Pankaj and Mr. Revankar, thank you very much for your time and of course for the wisdom that you have shared. Well, as we look at the screen now before Mahalakshmi takes over with the next set of guests, the Nifty's actually recovered quite nicely. Let's just pull up the indices. The mid-cap index at one point in time was down 3%, but now that's also recovered. The cut is only about 1.25%. And I think some of the views that the panelists are also sharing that it's not really a bad budget. You have to go beyond the big headlines. It's not a negative market event. I think that's showing up in prices on the screen as well. So let's do one thing. Let's hear some of the FM top highlights and headlines, and we'll be back with our next set of experts.
propose to set up a National Institute of Hospitality by upgrading the existing National Council for Hotel Management and Catering Technology. It will function as a bridge between academia, industry, and government. I also propose a pilot scheme for upskilling 10,000 guides in 20 iconic tourist sites through a standardized, high-quality, 12-week training course in hybrid mode in collaboration with the Indian Institute of Management. A national destination digital knowledge grid will be established to digitally document all places of significance, cultural, spiritual, and heritage. This initiative will create a new ecosystem of jobs for local researchers, historians, content creators, and technology partners. Propose to develop 15 archaeological sites, including Lothal, Dolavira, Rakhi Gadi, Adichanallur, Saranath, Hastinapur, and Leh Palace into vibrant experiential cultural destinations. Excavated landscapes will be open to the public through curated walkways. Immersive storytelling skills and technologies be introduced to help conservation labs, interpretation centers, and guides. India's semiconductor mission 1.0 expanded India's semiconductor sector capabilities. Building on this, we will launch ISM 2.0 to produce equipment and materials, design full-stack Indian IP, and fortify supply chains. We will also focus on industry-led research and training centers to develop technology and skilled workforce. The Electronics Components Manufacturing Scheme, launched in April 2025 with an outlay of 22,919 crores, already has investment commitments at double the targets. We propose to increase the outlay to 40,000 crores to capitalize on this momentum.
Hello and welcome back. Well, the budget is delivered till the point the finance minister said hike in STT, the markets were doing pretty well. At least there was no huge loss. Till that time, every single thing that the market that we have been talking for so many days, expectations on, new economy sectors, new age sectors like semiconductors, rare earth materials, all of that. Something we talked about in the morning, the global IT services, all of that was taken care of. The capex number came in exactly as expected. The fiscal deficit number was met, but this STT hike has completely taken everybody with surprise. We have with us Rashesh Shah to decode this budget and how do we decode this from a stock market perspective. Thank you so much, Rashesh, for joining in. What is your first reaction to the budget?
I think it's a steady, steady budget. More, I would call business as usual. The things on fiscal consolidation are BAU. Obviously, stock market always expects a lot. The STT has been, but I think FNO has really been a large part of the concern. So increasing STT on that would also is not something I am completely taken by surprise. I think the good thing I liked was this emphasis on bond market, especially corporate bond, doing the repo, doing total return swap, the municipal bond market. I think this is a sign that we are moving away from just an equity market as capital market to an equity plus bond market as capital market. So that's a good sign. We obviously have to see the details and implementation, but I think there is a little bit of everything and there is no real big bang on anything, which is also okay because last few years this has been more business as usual.
Right. Rashesh, it's interesting because this whole muni bonds REITs that she talked about, I mean, it is an effort that has been, policy effort that has been going on for some time, but somehow that market doesn't seem to be picking up. And even in the economic survey, there was talk about deepening the bond market. It's been a conversation that has been happening for quite some time. But do you see the momentum really shifting away from equities into debt or REITs from here on?
I don't think it will be away from equity into bonds. See, equity will be dependent on earnings growth. So I think we are seeing some early signs. I do hope that corporate earnings growth starts picking up in the next couple of quarters. We do think the earnings slowdown which was there has bottomed out. But equity market will react to corporate earnings and growth. I think the bond market, because banks deposits have been slowing down, a lot of money is flowing into capital market, into AIFs, into mutual funds, into REITs and InvITs, but a lot of that is going towards equity only. And in any economy, what we need is equity plus credit. Now, either credit comes from banks or they come from the capital markets. So I think trying to start credit flow through the capital market is a beginning. I think this was a long awaited one. As you said, economic survey also spoke about that, because we need to go from this single engine equity capital market to a double engine equity plus bond kind of capital market. I think it's a start of that. I'm actually pretty optimistic. When we have state government bonds and municipal bonds coming in, the bond market will really get broadened.
No, fair enough. So this point is well taken. There is definitely, there has been a singular move, especially after the pandemic. Most of the money has chased equity markets, and we are seeing some kind of a moderation in returns. And this conversation that it is becoming very skewed towards equity is well taken. What does it mean for the market trajectory itself? Because in terms of policy, in terms of having more capital diverted to debt markets, REITs, etc., is well taken. But in terms of momentum, what is your own sense? Because you have built an enterprise which is founded in equities also, right? A significant part of your business itself is equity. You are pretty much conversant with, what creates the conditions for equity markets to thrive and give you returns.
In India, capital markets is equal to equity markets. But I think that is starting to change. If you've seen the growth in REITs and InvITs, even the demand for corporate bonds have been growing a lot faster than banking credit, though from a smaller base. So I think we now need to have credit coming from banks, from bond market, from REITs and InvIT. I think the REIT proposal of all the public sector enterprises putting the real estate into REIT will be a great one. I think the entire asset recycling program that is there, which is also yield oriented. See, basically, Mahalakshmi, all investors need growth and they need yield. I think equity markets gives you growth and the bond market gives you yield. So I think we will start being able to offer all the products to all kinds of, because ultimately all investors are doing asset allocation between growth oriented investments and yield oriented investments. So on that count, I remain positive. To answer your question, what will take equity market? See, equity market last year in India, between mutual funds and pension funds and insurance companies, the local household savings which came into equity was more than 8 lakh crores. So we are almost getting close to $100 billion of real money coming into equity markets. So that is quite a bit of money. So I don't think the equity market is starved of the demand for money. I think we need to see growth coming back. So equity market will start growing again when corporate earnings start growing and when the corporate capex starts picking up, for which the demand has to come through. And I think this particular budget per se, following on the GST reforms the government has done in the last quarter, we do think the underlying growth is coming back. The consumption growth, when I talk to people in the corporate sector, in auto and manufacturing and all, there seems to be a feeling that growth, the early green shoots of growth are there. So we'll have to wait for the next couple of quarters for that growth to start coming into the equity earnings growth. And when the earnings growth happens, whether STT or no STT, I think equity markets will do well. They are always very highly correlated to growth.
True that, true that. So, two questions. One is, you said, growth is coming back. What is your own sense in terms of how credit growth is going to pan out in the next few months? Do you see a change in the earnings trajectory of banks? Do you see, now we don't know how the rates will go from here on, because we have a new Fed chair who is an inflation hawk. So what is the global setup now going to look like, as well as, the borrowing program is slightly more than what the market has anticipated. So you don't know whether, what is coming from the RBI. What is your sense on the rate outlook, on credit growth, and therefore what does it mean for banks' earnings trajectory and stocks?
So see, in order to maintain growth, since the government is maintaining the fiscal consolidation path, which means the government is not in a fiscal expansionary mode, I think monetary expansion will be a requirement. As I said, about 5-6 years ago, India started on three things. We did monetary tightening, fiscal tightening, and regulatory tightening. Now, I think the fiscal consolidation is still going on, but I'm hoping we'll see a lot of deregulation, the regulatory loosening up will happen and the monetary loosening will happen. I, for one, believe that RBI has room to cut rates and also pump in liquidity, because that will be essential to growth, especially when government is still maintaining fiscal prudence. RBI should become more aggressive, more bold. Of course, that will have impact on the rupee, because if the US is also not, cutting rates, if the US Fed cuts rates, then it will be ideal, because then India has room to cut rates. But I think between growth and rupee, we should choose growth and allow the rupee to find its own this thing. Anyway, it will help the exporters if the rupee falls a little bit. Of course, it has its own pain. But of the options we have, I think allowing the rupee to fall and cutting rates and increasing liquidity, a real monetary expansion is the need of the hour after this.
Right, understood. But again, is that not a huge negative? Because today, whoever you talk to, of course, foreign investors have been anyway selling. But with rupee depreciating more and more, doesn't it sort of, make this whole narrative even more negative? Or you're saying that
the local equity buying last year was 8.5 lakh crore. The foreigner selling was about 1.5 lakh crores. So I think on that basis, if you add the primary market and the secondary market, the foreigners sold about, close to, 1.4 lakh crores. So when you add that up, I don't think the foreigners are a big driver of the market. Of course, they will keep on putting pressure. But again, I think India is also linked to the global markets. If there is a steadiness in the global equity markets, India will start looking attractive again. India's current problem is, I think our equity valuations are much higher than what the growth is. So unless growth comes back, I think a lot of the foreigners will either wait and watch or they'll continue to exit. But the Indian capital, household savings that is coming into equity markets is actually the key driver of the markets going forward.
Fair enough. We have with us Sunil Singhania, founder and CIO of Abacus, joining us. Sunil, your first take on the budget.
I think budget every year comes, and the good thing was this time there was no expectations. But at least when the budget speech was being announced, I always say this, that no expectations were also not met. But I think as we dive deep, and frankly, we all go on TV just after the budget as if we are some robot and we have read all the fine prints. But now, as we see, I think the good thing is that the planned expenditure has been increased. The outlay for infra, defense, a lot of other things have been increased. And to that extent, that's the reason why the markets have sort of, recovered from the panic lows. But having said that, I think, Mahalakshmi, one thing at least which we would like is that, there is consistency in whatever we do, particularly as far as the capital markets related announcements are concerned, And I think that would allay the sharp moves which we see on the budget day and some uncertainty which creeps in. The other thing is, obviously, I'm very sure that the Honorable Finance Minister and the government is also cognizant of the fact that capital markets are very important. And if we have to reach from 4 trillion to 8 trillion, we need a very, very buoyant ecosystem where companies are able to raise equity as well as fixed income. And to that extent, there is some encouragement which is given as far as capital markets are concerned. I think over the last 4-5 years, that has been one thing which has been slightly low, maybe on the horizon when the budget comes in. So we need to encourage that too.
Sure. Sunil, have you, this year, FY26, we will end with, 5 to 6% earnings growth on the Nifty. Next year, people are projecting, so analysts are projecting about 12% growth on the Nifty. Does this budget, in some ways, give you the sense that we will be able to do a above 10% kind of earnings growth for Nifty for next year?
Is going to be the indicator which will make us increase or decrease the corporate earnings. However, at the same time, one thing which the budget has been very consistent last 4-5 years is a focus on Atmanirbharta or Make in India, whether it is through the PLI route or even in this budget, we have now new sectors like, semiconductors, data centers, which have been given some outlay. But I think that is one sector which can obviously lead to some improvement as far as the corporate profit is concerned. However, I would repeat that we need to get this tariff issue sorted as soon as possible because obviously we do export $100 billion worth every year to the US. And in some sectors, particularly the employment generating sectors like textiles and so many others, there is uncertainty and we need to get that behind us. So I would say that would be a more positive thing if it gets done in terms of increasing our view as far as corporate profit growth is concerned for the next year.
Sunil, there were a bunch of announcements related to all these emerging sectors, for example, rare earth materials, semiconductors. She talked about biosimilars. In all of these, and by the way, I was just seeing the numbers, the defense allocation is, capex is hiked by about 19%. Do any of these sectors from a stock picking perspective, do you look at them as opportunities or, what are the price levels and valuations looking like in some of these sectors? I know that some of these sectors are don't even have very good representation in the stock market, but whatever we have, can you just map these for us in terms of buying opportunities?
No, so as far as a lot of these sectors which you mentioned, I think on the listed space, there aren't too many opportunities. Obviously, on the defense side, we have quite a few companies. We do also own a few of them, I think, but a lot of these companies which are listed, the valuations are not very comforting. However, given the dynamics of the world and given the fact of Atmanirbharta, which I mentioned, particularly in these core sectors, I think there is a lot of opportunity going forward, but one has to be very selective. In terms of some of the other names, biosimilar, obviously, there are a few companies which are catering to the US and, that is pretty okay. But semiconductors, particularly, there are not too many listed companies and it's a very high capital intensive sector. So most of the opportunities would be on the unlisted space, but there are allied opportunity which comes in, whether it's on the data center side or even semiconductor side, they are allied or they are ancillaries to this. I think some of them are very interesting and we do have a few of them.
Okay. On the industrial side, again, do you think, of course, 8 to 9% is what the market also expected. I mean, I don't think there was any outlandish expectation with respect to how much you will raise capital expenditure. It clearly means that obviously some level of order momentum can be sustained. Again, from a stock market perspective, is industrials a space that you can today, are stocks at a level that you can actually buy them today?
No, huge opportunity. Frankly, domestic also, when you look at industrial, I think it's a very, very broad sector. So, one is obviously the power equipment and the ancillary side, and then you have a lot of these EPC companies. And last few months, I would say last 1 year, quite a few EPC / the domestic industrial companies were suffering because order flow from the government had slowed down significantly. And in some sectors, money release or fund release from the government was also pretty slow. Good thing is that this budget continues to have a good allocation to this sector, and hopefully the fund flow from the government will also start. Prices in a lot of these companies have corrected. On the capital good, product companies, even after price fall, stocks are not very cheap. But given the fact that this power generation, power transmission, even now new age sectors coming up like data centers and semiconductors, all will need a lot of these products and the engineering slash EPC companies to come in. So I think this is a good sector and definitely merits a much closer look.
Sure. Sunil, you also have overweight on banks. So much of these, would you today look at banks as a relatively better opportunity to play the industrial growth, or you would say that there are enough opportunities to directly play industrials and investing in banks could just mean that you are already accepting muted returns?
I think banks, the good thing about banks in the near term has been that this is one sector where earnings growth has been much more predictable, and I think to that extent banks have done well also. But I don't think banks can be a proxy to playing the industrial. Yes, capex is a big, I would say, driver of credit growth for banks. But increasingly, I think if you look at any banks, whether private or public, I think now their advance side is pretty much spread across corporates as well as retail and even some of the sectors like agri and so on and so forth. So I don't think they're direct proxy. Yes, there will be a little bit of incremental credit growth which might happen if industrials do well. But banks should be treated more as a diverse economy-related sector with slightly more earnings predictability in the medium term.
So quickly, what are your top three trades from a slightly, next quarter or two? What do you think will be the best place?
Mahalakshmi, I don't think things change for us because of the budget. Financials as well as financialization of savings will continue to be good. Pharma has been, I would say, a boring sector for the last 1.5 years, but that is again where we are putting in incremental energy. Yes, engineering sector merits a look, but it's not that one would like to buy everything today. I think there is still some way to go before there is clarity in terms of capex picking up, as well as some of these companies also export, particularly to the US. So on the tariff front also, we need clarity. But I would say that these would be the sectors. I think metal stocks have corrected much sharper than was warranted because obviously there was a little bit of euphoria being built up, particularly in the precious metals. I would say metal stocks at these prices also merit enhanced, I would say, allocation.
Okay. One last question for you, Sunil. Capital market stocks, because this STT sort of is not something that investors were budgeting in at all. Did it come as a surprise for you? And what do you see as the, collateral damage? Does this mean any kind of collateral damage?
I think the logic was pretty good. A lot of retail investors are dabbling in derivatives, and to sort of discourage them, this STT has been increased. But having said that, I mentioned earlier, I think whatever needs to be done once and for all. And then, you can make a statement that for the next 3-4 years, there will be no tweaking. But having said that, we are more positive on the NVT-led capital market plays, which would include the wealth managers and the asset managers, rather than the transaction related plays, which would include exchanges as well as brokers.
Thank you. Thank you so much, Sunil, for joining us this afternoon. We have with us next Jigar Mistry from Buoyant Capital. Jigar, what is your first take? Has anything changed for you in terms of, how you map the market from 3 hours ago? What has changed?
Hi, Mahalakshmi. Am I audible?
Yes.
Right. Thank you as always for inviting me. So I think the broad key takeaways are, I would say, classify as four. One, the fiscal prudence now appears paramount. Everything else will get adjusted in trying to achieve the numbers that have been stated, 4.4 and 4.3. And we can, delve on each of these subjects as we proceed. Second, and the bigger issue is looking like that the rate cuts in India especially may not happen in a hurry. Three, the budget arithmetic for the first time since COVID will be a task to achieve by the end of the year, is what my first sense is if you look at the numbers. And lastly, I think government is also now looking at capital allocation in the right way, the way in which sort of the buyback versus STT has been arranged, and what Sunil sir was also mentioning. So I would say these are the four broad takeaways. We can expand on all of them if you like. But I think on an overall basis, it's not as relevant a budget as sort of market is making out to be, as bad or as good. I think it's par for the course.
Cool. Hold that thought, Jigar. We also have with us Sushil Kedia. Sushil ji, your first reaction to the budget, did you expect this sell-off? Whatever may be the reason, because you're not looking at announcements, you're looking at the chart formations to see what could surprise the market. Was this part of your equation?
No, I definitely look for all the information as well as the chart formations. When the chart formations broke down, because the finance minister did not choose to pamper the capital markets. So like, a rotten spoiled child, we all sold off. But after that sell-off, the kind of smart recovery that has happened, it's fair and justified. See, we have already had such a strong downtrend for a good while. And maybe today is that cathartic moment. And then sense returns back to the markets that, if fiscal deficit has been pruned down further, there's a generous increment, 20% in defense, 15% in railways, capex has been enhanced. So there's been pretty much a matured macro doling out. If because of the US trade deal still not out of the woods, if this government has chosen to play poker better than we would have expected, and it has not gone down giving us sector by sector breakdowns, because one major part of the global trade structure, the US trade deal, because of which our current account deficit also collapsed so much. So I think given the very tight geopolitical headwinds and such other factors, it's a very smart and tactful layout of maintaining some stoicism on policy details. So net, great budget for the country, and capital markets as usual have been going through pain, and maybe we went through a catharsis. In a day or two, I'll come to know when, if markets actually start trading about 25,500, if the worst is behind us. But it looks like this is not the moment to go short across the board, except maybe PSU banks that were extremely overbought, and metals, of course, have gone through the roof and the global correction has set in. So except those two, we are pretty much waiting to find firm buy signals across the board in all other sectors.
So you're saying that we have to still wait for another 2 days to really see where we go from here? It's too early to take a call on where markets go from here?
Traders will have to wait to find good structure for stop losses. But I think for investors who don't care about 2% fluctuation, when the Goras will come back tomorrow, the FPIs come back tomorrow. So those who are playing for a 40-50% haul, I think today was a field day for doing some bargain shopping. But for trading where stop losses are important, maybe, the formations will get even stronger once we are out and back above the intraday high of today.
Okay, from a medium term, let's say, if you're just talking about next quarter or two, what do you think? You talked about, it's a great day to go around shopping. What are the pockets that are looking actually strong to you? I mean, where should we shop?
To say last month or so, the theme that we've been maintaining, and if 20% increment has come in defense, so across the board, there will be buys in defense. Same, we've been betting big on railways. So if today the stock market per se did not get any sops, the business of trading into stocks did not get any sops, and that's what rattled things. Nothing has changed, Greater incremental allocation to defense and railways makes it even more attractive. In fact, so many other sectors are bottomed out. And tomorrow, once after the US trade deal comes out, maybe textiles will be a big buy. We continue to maintain our experiential consumerism thing. So let's put it in a simpler word. Let's put it out in a simpler phrase. Except for PSU banks and except for metal stocks, where I see much more danger than opportunity, rest of the whole market is looking like is an opportunity. And day by day, there will be greater confirmations coming into various sectors with changes in trends.
Understood. An interesting thing I'm just noticing on the heat map right now is, in the morning we had many of these companies, Coal India, ONGC, BEL, all of them were actually the top gainers. Now I see them all in the bottom of the pack. Why is that? Because, if anything, for SBI or for ONGC or for Coal India, for BEL, some of these stocks, the announcements were not so bad. Or is it that for bank stocks, the borrowing is actually spooking them, the borrowing number? So what is your technical call on bank stocks and some of the other PSUs that right now are bottom of the pack, and in the morning they were trading pretty much at the top of the table?
Okay. So there are four parts to this. The change in sentiment between morning and now, and then the differentiation between public sector banks and the broader public sector. So see, for the public sector banks, for quite some time, we've been warning our clients and investors, if anything becomes unsavory in the budget, or the budget is tepid or lukewarm or really a non-event, the first set of stocks to go short will be the PSU banks. So they have also ricocheted back a lot from the bottom. But that is different, A beginning of a big downtrend has happened in them, according to us. But stocks like an ONGC, Coal India, or a BHEL, or a Bharati, BEML, etc., I would put them as of now that it's all collateral damage of the day. When sentiment is charged and, it's like a boxing match, jisko jo mila usko utha ke thok diya. So in that sense, all of these stocks got noisy. But for the day's noise, to club all the PSU banks and all other PSUs together for the next 1 month or next 3 months or next 6 months is what we are not willing to do. We are looking to buy into all the energy stocks, not the refineries, of course, not the oil marketing companies, the oil companies. Or we're looking to buy, all the engineering companies or the defense or the railways. So the only PSUs where we see a very matured uptrend, which was perhaps pegged with an idea that the finance minister might offer an increased FDI in PSU banks, which we never agreed with. And since that has not come, so we'll continue to sell the PSU banks and pretty much one by one getting into buying every other type of PSU, more so in railways, defense, engineering, and energy space.
Understood. Thank you so much, Sushil ji, for joining me this afternoon. Jigar, back to you. Anything that stands out from a stock opportunity in some of the sectors that she mentioned? For example, biosimilars. There are a bunch of stocks. Again, in power, in data centers, all the stuff that sort of was mentioned by the finance minister in terms of either a allocation, higher allocation, or some special scheme. Anything that stood out for you in terms of a sector or stocks that are ignored could now sort of get revitalized?
I think, see, this is sort of a broader policy framework for what has been under implementation for a while now. And if you look at the capex, data centers is one of the priority areas. And sadly, the amounts that are mentioned is not something that will make or break a sector. But from a direction standpoint, this is where the country was heading, and the budget simply reinforces it.
Understood. One last question on metals. What is your take on metals? Because that's been really at the receiving end. Even right now, I'm seeing that, most of the metal stocks are actually in the red. Otherwise, also, they've been under pressure.
Right. I think the precious metals sort of, metal per se run through their own demand supply, except to an extent, precious metals is something that doesn't really have a cost curve to go through, and the belief in the prices is what drives the prices either directions. So if the belief is shaken, which looks like to be the case with the movement, then there is a common thread connecting those metals, which is the presence of the futures and options in the international markets. And then when they correct, they all correct together. So I think that is about it. We have some amount of exposure, but not a very large one. So it's not something which is out of the ordinary.
Thank you so much, Jigar, for joining us this afternoon. I have with me Navneet Munot now, CEO of HDFC Mutual Fund. Navneet, are you disappointed or are you elated?
The global environment, where the only thing I can say with certainty is uncertainty. We are dealing with Trump, tariff, and turbulence. I think the government has shown tenacity that will continue with the reforms momentum, continue to support be it consumption or the investment, and continue to make life easier for its citizens as well as ease of doing business for its entrepreneurs. So I'm overall positive. Of course, in a country like India, where we are at $2,500 per capita and a long way to go, the expectations are very high from all corners of the society. But I think Finance Minister has to juggle many balls, and she has done a very, very good job at that.
All right. Why is it? Were you surprised by the government borrowing number? Why is it that SBI has seen a 4% cut? As I see the screen, it's a 4% cut. Why is it so disappointing?
In Angel, maybe something like a 16,70,000 crores. So a 17,20,000 crores on dated government borrowing is higher than expectations. On the net side also, it's few thousand crores higher. I hope that as the year progresses, the overall budget numbers, the projections are reasonable, and government has a scope to cut down on borrowing in the second half. That will soothe the nerves of the bond market.
All right. We also have with us Nilesh Shah from Kotak Mutual Fund. Nilesh, your take, first thoughts on the budget and specifically on the borrowing number. What does it mean for the bond market? Is it a legitimate fear that rate cuts may not happen and the bond markets may be under pressure?
So we do expect interest rates to inch up a little, not substantially, but by few basis point here and there. This is primarily driven by the fact that the borrowing program has come at the upper end of market expectation. More importantly, there is a significant drop in small savings borrowing from 4 big handle to 3 big handle. There is also increase in treasury bill issuances by about 30,000 crore. Net, there is likelihood that debt market will react by taking yields little higher. But a lot will depend upon RBI. For debt market, more than the size of the borrowing program, day-to-day liquidity is more important.
Fair enough. Navneet, one of the big concerns from a FII, standpoint is that, there was this long-standing conversation around, capital gains tax, if it should be done away with for FPI. And a bigger pain point has been the rupee, right? How do you see this trajectory moving forward? Given that now we have a large borrowing program, the yields will strengthen. How do you see all of this playing out? And what is your take on, will FIIs continue to be large sellers in the market? Will it stabilize? Your thoughts on this?
So you said the rupee depreciation is a pain point, but actually it improves the entry point for an investor today. Anybody investing into India, the valuations have turned better because one, that markets have corrected. On the other side, rupee is cheaper, it's depreciated, so your entry point is better. Also, I think it helps exporters in a way to hedge against the challenges that have come in the form of higher tariffs in the US in particular. Rupee has become undervalued, and I think overall it's going to be positive for the economy. Incrementally, flows turn both on the FDI side because of certain reforms that have been taken, and the FPI flows at some point in time. We would see an appreciation in the rupee this year.
Sure. Nilesh, anything else that stood out for you from the budget from a stock market perspective? And I have another question on, this REITs, this has been a constant thrust even from SEBI's perspective. Finance Minister has talked about it. I think the economic survey has also been talking about it. Do you see any substantial issuances from here on? could that be a big portion of mutual fund? I mean, will future products from mutual fund stables like you and HDFC be around REITs? How do you see that opportunity evolving?
About this budget, which is truly commendable, is that the capital expenditure at 12,10,000 crore is more than the net market borrowing program at 11,70,000 crore. This has been narrowing for last few years, but now capex is more than the net market borrowing program. I hope one day our capex is more than the net market borrowing program as well as small savings borrowing. Coming to the REIT, we all know Government of India is the largest landowner. They are sitting on huge amount of real estate. Some of the PSU company like MTNL is sitting on prime properties. These properties today are getting dilapidated in absence of maintenance. REIT will be a structure by which PSU's land real estate can be recycled. This is an acceptable instrument in many countries, bigger than the overall market capitalization or becoming very substantial part between saver and commercial real estate. SEBI, our regulator, has been innovative and encouraging us to invest in REIT and InvIT. Very recently, REIT were included in the benchmark indices also. I'm sure as the government pushes REIT for PSU enterprises, SEBI as a regulator will allow mutual fund to channelize retail savings into appropriate REIT.
Right. Navneet, how do you see this evolving? Because, all these policy changes are happening around REITs now, the, equity status and so on also. But somehow the issuances have not really taken off in a big way. And with anything with government, there is always a lag between, what is the regulatory intent or the policy intent versus how quickly things change on the ground. In this year, do you see the landscape for REITs really changing?
So it took mutual fund industry to reach a size of 10 lakh crores after like 25 years or so. And from 10, we have become 18 last 10, 11 years. I think REITs are where mutual fund industry size was 10, 11 years back. They've crossed 10 lakh crores in assets. REITs and InvITs put together. And over a period of time, I agree with Nilesh Bhai that if you look at the experience in many other countries where they reformed to make this asset class more popular, I think India will have a similar journey. Particularly the government's move today to unlock the value of land with the public sector enterprises will go a long way in monetizing that assets. And over a period of time, I strongly believe that both REITs as well as the infrastructure investment trust are going to be a significant asset classes. There's large amount of household wealth which is locked into real estate, gold and silver. I would be happy at some point in time we also find ways to monetize the gold and silver and bring that into more productive usage in the stock market, into the capital market.
Right. I have a question for both of you, Nilesh and Navneet. And Navneet, you can go first. Essentially, this whole ecosystem now, increasingly both SEBI and now the finance minister also are indicating that, this F&O, excessive investment in F&O should actually go down. So all the policies that SEBI has made to sort of rein in the speculative element there and retail participation there, they have done their bit. In this budget, the FM has also done a little bit to rein in that. What does it mean? So increasingly, because of these measures, the models for, let's say, broking houses, for exchanges, they are bearing the brunt of it. Do you see somewhere conversion of those people who are acquainted with equity markets through trading will get at some stage turn to mutual funds? Will that create some additional momentum for fund flows into mutual funds, or am I reading too much into it?
So, Mahalakshmi, you have covered the SEBI reports that I think the first report said that 89% of the investors or traders lose money in F&O. The second one said that 93% of those lose money, and they lose money against few of the hedge funds, algo traders, and few of the other large traders. And I think over the last couple of years, government has taken a lot of steps to ensure that money gets channelized into productive assets, get channelized into the markets for long run, and how to curb the volatility, how to curb the speculative interest. And I think this is also a step in that direction. We have seen the ban on the gaming apps. I think we are seeing a higher STT on the F&O. Now, there could be counter argument that whether this will have impact on the liquidity, which will also impact the overall valuation. But I think both the interests need to be balanced. On one side, markets need to be deep and liquid, but on the other side, if there is greater speculative fervor at the cost of promoting the long-term investment, the government needs to take a more balanced view.
True, but from a business perspective today, and even from a stock market perspective, Navneet, would you buy your own stocks compared to broking stocks? Of course, you don't have to buy, you get ESOPs, so you don't have to additionally buy. But what I'm saying is that quarter wealth management kind of companies, asset management companies, are they structurally better bets than broking and capital market oriented stocks?
Mahalakshmi, we are at very early stage of financialization of savings. I think digitalization of finance, formalization of the economy, financialization of assets that we talked about earlier, all of these augur well for asset management and wealth management industry in the long run.
Sure. Nilesh, your thoughts, would you favor asset management companies today as opposed to other capital market stocks?
Mahalakshmi, you don't invest based on one announcement. And both me and Navneet have made our choice clear by remaining in asset management industry over the last 30 years. I think our choice is very clear. I did go to sell-side job. I regretted that and came back to the asset management industry. Hopefully that gives the answer.
Cool. From a fund perspective, Nilesh, how do you see investor sentiment really changing from here on, if at all? Because last 1.5 years, in fact 2 years, equities have not really performed very well. Last 1 year, gold and silver went through the roof, and on Friday you've also seen it's a fall that could have given people a heart attack if you had some substantial savings in ETFs, gold ETFs or silver ETFs and so on. Now, from an asset allocation perspective, first of all, what is your recommendation? Most people say be evenly allocated to all risk assets and safe assets. One is the allocation call. Second is that do you see more and more money flowing away, even within the mutual fund space, moving away from equity schemes into other kinds of schemes?
Confused between speculator and investor. We also get confused between saver and investor. Many people are saver, but few graduate to investor. There was one survey which said 53% of the people are aware about financial product, but only 9% people actually execute the investment strategy. So I just hope and pray people transit from saver to investor. And Navneet Bhai had launched a beautiful campaign. आप बरनी में पैसा मत रखिए, आप उसे निवेश करिए. The second thing is difference between speculator and investor. Now, if you are an investor, last year was not bad. Equity still delivered positive return over inflation. The multi-asset allocation fund, thanks to investment in precious metal, delivered fantastic return. Now, people are not willing to consider that every year can't be 4s and 6. When they go to watch even T20 match, they are happy if Ishan Kishan hits 10 sixes. But they don't complain that he didn't hit a 6 every ball. He didn't hit a 6 every over, 6 sixes in an over. the appreciation which is given to a batsman for hitting few sixes is not reserved for market when it delivers, normalized return. For 10 years in a row, Indian markets have delivered positive return. Very few markets in the world will be in that range. So my only request is please follow your asset allocation principle. At this point of time, Indian equity markets are fairly valued. You have to moderate your return expectation. If you are expecting
सेंट्रल बजट तो
जो पाथ ब्रेकिंग रिफॉर्म्स किए गए वो एस्पिरेशन से भरे हुए भारत के साहसिक टैलेंटेड युवाओं को उड़ने के लिए खुला आसमान देते हैं। ये बजट ट्रस्ट बेस्ड गवर्नेंस और ह्यूमन सेंट्रिक अर्थरचना के विजन को साकार करता है। एक ऐसा यूनिक बजट है जिसमें फिस्कल डेफिसिट कम करने, इन्फ्लेशन कंट्रोल करने पर फोकस है और इसके साथ ही बजट में हाई कैपेक्स और हाई ग्रोथ का भी समन्वय है। साथियों, ये बजट भारत की वैश्विक भूमिका को नए सिरे से सशक्त करता है। भारत के 140 करोड़ नागरिक फास्टेस्ट ग्रोइंग इकोनॉमी बनकर ही संतुष्ट नहीं है। हम जल्द से जल्द दुनिया की तीसरी सबसे बड़ी अर्थव्यवस्था बनना चाहते हैं। ये करोड़ों देशवासियों का संकल्प है। दुनिया के एक ट्रस्टेड डेमोक्रेटिक पार्टनर और ट्रस्टेड क्वालिटी सप्लायर के रूप में भारत की भूमिका लगातार बढ़ रही है। हाल में जो बड़ी बड़ी ट्रेड डील्स भारत ने की है, मदर ऑफ ऑल डील्स, उसका मैक्सिमम बेनिफिट भारत के युवाओं को मिले, भारत के लघु और मध्यम उद्योग वालों को मिले। इस दिशा में बजट में बड़े बड़े कदम उठाए गए हैं। साथियों, इस बजट में मेक इन इंडिया और आत्मनिर्भर भारत अभियान को नई रफ्तार के लिए महत्वाकांक्षी रोड मैप प्रस्तुत किया गया है। इस बजट में नई उभरती इंडस्ट्रीज यानी सनराइज सेक्टर्स को जिस मजबूती के साथ समर्थन दिया गया है वह अभूतपूर्व है। बायोफार्मा शक्ति मिशन, सेमीकंडक्टर मिशन 2.0, इलेक्ट्रॉनिक कंपोनेंट मैन्युफैक्चरिंग स्कीम, रेयर अर्थ कॉरिडोर का निर्माण, क्रिटिकल मिनरल्स पर बल, टेक्सटाइल सेक्टर में नई स्कीम, हाईटेक टूल मैन्युफैक्चरिंग को बढ़ावा, चैंपियन एमएसएमईज तैयार करना, ये फ्यूचरिस्टिक है, देश की वर्तमान और भविष्य की आवश्यकताओं का ध्यान रखती है। एमएसएमईज को, हमारे लघु और कुटीर उद्योगों को जो समर्थन इस बजट में मिला है वह उन्हें लोकल से ग्लोबल बनने की नई ताकत देगा। साथियों, बजट में इंफ्रास्ट्रक्चर को मजबूत करने के लिए कई बड़े कदम उठाए गए हैं। डेडिकेटेड फ्रेट कॉरिडोर, देश भर में वाटरवेज का विस्तार, हाई स्पीड रेल कॉरिडोर, टियर 2 और टियर 3 शहरों के विकास पर विशेष ध्यान और शहरों को मजबूत आर्थिक आधार देने के लिए म्युनिसिपल बॉन्ड्स को बढ़ावा, ये सारे कदम विकसित भारत की यात्रा की गति को और तेज करेंगे। साथियों, किसी भी देश की सबसे बड़ी पूंजी उसके नागरिक होते हैं। बीते वर्षों में हमारी सरकार ने देश के नागरिकों के सामर्थ्य को बढ़ाने पर अभूतपूर्व निवेश किया है। हमारा प्रयास स्किल, स्केल और सस्टेनेबिलिटी को निरंतर बल देने का रहा है। जैसा कि आज पार्लियामेंट में निर्मला जी ने कहा है, यह युवा शक्ति बजट है। उसमें युवा की सोच भी है, युवा के सपने भी हैं, युवा का संकल्प भी है और साथ साथ युवा की गति भी है। बजट में जो प्रावधान किए गए हैं उससे अलग अलग सेक्टर्स में लीडर्स, इनोवेटर्स और क्रिएटर्स तैयार होंगे। मेडिकल हब्स के निर्माण से, एलाइड हेल्थ प्रोफेशनल्स के माध्यम से, ऑरेंज इकोनॉमी यानी ऑडियो विजुअल गेमिंग को बढ़ावा देकर, पर्यटन को प्रोत्साहन देकर और खेलो इंडिया मिशन के माध्यम से युवाओं के लिए नए अवसरों के द्वार खुलेंगे। भारत को दुनिया का डेटा सेंटर हब बनाने के लिए टैक्स में बड़ी छूट की घोषणा भी की गई है। मैं भारत के युवाओं को विशेष तौर पर इस बजट की बहुत बहुत बधाई देता हूं, क्योंकि इससे एम्प्लॉयमेंट जनरेशन को बड़ा बूस्ट मिलेगा। मुझे बहुत खुशी है कि इस बजट में टूरिज्म और विशेषकर नॉर्थ ईस्ट में टूरिज्म को बढ़ावा देने के लिए भी ठोस कदम उठाए गए हैं। भारत के अलग अलग राज्यों को ताकतवर बनाकर संतुलित विकास की नींव भी इस बजट में मजबूत की गई है। साथियों, हमारे देश में 10 करोड़ से ज्यादा महिलाएं सेल्फ हेल्प ग्रुप से जुड़ी हैं और बड़ा सफल अभियान रहा है। महिलाओं द्वारा निर्मित, महिलाओं द्वारा संचालित सेल्फ हेल्प ग्रुप्स का आधुनिक इकोसिस्टम बने, बजट में इसे प्राथमिकता दी गई है। कोशिश यही है कि हर घर लक्ष्मी जी पधारे। हर जिले में छात्राओं के लिए नए हॉस्टल बनाने का अभियान भी शिक्षा को सुलभ बनाएगा। साथियों, भारत की कृषि, डेयरी सेक्टर, फिशरीज, इन्हें हमारी सरकार ने हमेशा सर्वोच्च प्राथमिकता दी है। इस बजट में भी नारियल, काजू, कोको और चंदन की पैदावार से जुड़े किसानों के लिए अनेक अहम कदम उठाए गए हैं। भारत विस्तार एआई, इस टूल से किसानों को उनकी भाषा में जानकारी मिलने से उन्हें बहुत मदद मिलेगी। फिशरीज और पशुपालन में उद्यमिता, उसको बढ़ावा देने से गांव में ही रोजगार और स्वरोजगार के और ज्यादा अवसर बनेंगे। साथियों, ये बजट एम्बिशियस भी है और ये बजट देश की एस्पिरेशन को भी एड्रेस करता है। मैं एक बार फिर निर्मला जी और उनकी पूरी टीम को इस फ्यूचरिस्टिक बजट के लिए, संवेदनशील बजट के लिए, गांव, गरीब, किसान का कल्याण करने वाले बजट के लिए बहुत बहुत बधाई देता हूं। बहुत बहुत धन्यवाद।
Okay, I think the Prime Minister is listing some very important positives in the budget. Clearly, the encouragement or the incentives promised to biopharma companies, to electronics, to rare earths, to semiconductors are all very important. Likewise, data centers invested in by foreigners will not attract tax if they sell the data outside or send the data outside. CDMO companies, who just import, value add and export, SEZ kind of companies, they also get a longer tax holiday. So all these are very good for investments, but the market is looking at the near term. The market is worried that it has to pay more for trading, and therefore I've got some market experts with me right now. Deepak Shenoy of Capital Mind is with me, Harendra Kumar of Elara Capital, and in a bit we also have Sanjeev Krishan, the chairman of PwC with me. Let me first go to Deepak. Deepak, market in a big sulk. Will it get over this STT increase in a bit and move on once we get to Monday or Tuesday?
Thanks, Vata. I think, one of the biggest problems in this is just understanding the impact of it. I think retailers aren't as badly impacted right now. Honestly, the market is a aberration today because most institutions aren't participating. If you look at the participation rates, we're looking at there's almost no mutual funds participating. Most insurance companies or even FIIs may not be participating. So the moves may be exaggerated because of the lack of participants. But also, these are the participants that perhaps don't participate as much in futures. They do in options. And in options, for the most part, they're playing a little bit more on the option premium, which is anyway a tiny amount. So it's like, I don't think it's a meaningful change for them. What will hurt, of course, is that, arbitrage mutual funds perhaps will have a 0.5% lower return in the whole year because of this increased STT from 0.01 to 0.05. Effectively, this is a 60 basis point or a 50 basis point of approximately hit in the whole year on selling their futures. So that, that will reduce arbitrage fund returns. FPIs also typically try to take their positions in the futures markets and then convert those futures into stock on expiry. Both of these transactions have a higher STT. So they are the ones more affected. It's not the retailers that are participating today. So I think the real impact of that will be.
Okay, that's good. You told us about the arbitrage mutual funds, something we haven't discussed so far. Harendra, if what Deepak says is right, and when we come another day, we are going to be less worried about the STT and the market will be deeper. What may be the pockets of attraction because of this biopharma, electronics? You think there is some buy element? Will FPIs buy? And if they do, what?
So I think 2-3 aspects that you should consider is, if you would have seen the economic survey, Mr. Nageshwaran said that the potential growth rate of India has moved up to 7%, right? And with the organic capital that we generate out of taxation, we could grow only so much. So for us to grow at 8 to 9%, it's a
Harendra, I think your frame has frozen. We'll come back to you in just a minute. Let me get to Sanjeev Krishan. I'm actually waiting to go to him. Sanjeev, this is not a budget for the immediate market trader. It is a budget for the long haul. Mr. B.V.R. Subramaniam of Niti Aayog called it the services budget. Your thoughts, which sectors of the economy are getting a boost?
No, so first of all, I would agree. I think there is, I think when we talk about long-term sustainability.
Sanjeev, I think you're on mute. Okay, now we can hear you. Go ahead.
So no, Lata, I was saying that I certainly agree. I think there are multiple things in this budget which should keep us in good stead over a period of time. I think focusing on skills and focusing on making sure that the demographic profile that we have, which gets leveraged through the GCC and the IT sector, is one big leverage. And creating some amount of clarity on taxes and how they will apply to some of the GCCs is certainly a big enabler. I think enabling a data center where a significant amount of investments have already been committed is again, to my mind, a very significant boost. The one thing which was said earlier, and I completely agree. While we are focusing very significantly on what we do with our STEM graduates, we also talk about how do we make sure that the non-STEM kids that come through our colleges and schools, they get employed. And I think the focus that we have on tourism, on medical, and so on and so forth, I think these are areas which are very, very critical, because some of these areas also cannot get impacted by AI, right? And, we always believe that India could be a huge tourism hub. We see the amount of foreign exchange also that it can generate for the country. So, and likewise, medical tourism can do for India as well. So I think the focus on some of these things are very, very critical. Then the third thing that I would like to call out is a focus on development of the cities, because urbanization has been a key thing, and we need to make sure that more and more people are able to move towards cities so that we can make towns cities, and in some ways make sure that the movement of the people is for inclusive development. I mean, with the aim of Viksit Bharat, we need to be able to get more and more cities and the infrastructure in them to be a top class. And I think that focus which has come through is also something which is standing out for me. I think the whole
I agree with you.
Yeah,
I think Sanjeev, I'll just come back to you. I take your point on the positives in terms of deepening of the infrastructure and development of the human capital that India has in abundance is well taken. But there are areas of worry. Deepak, on that point, see the excise duty. If you look at the number, the union excise duty is applicable largely to petroleum products, and that has gone up by 6%. The total BE of next year compared to RE of this year, it seems to signify that they're going to increase excise duty on petroleum products. It usually goes up by about 2-3%, but 6% is making me a little worried and making the market worried. Your thoughts?
Would be an increase in the price of crude oil that they might be expecting, because the price of crude oil is already up a little bit compared to perhaps the earlier parts of this year, right? So there's maybe that part has played a little role. I hope they don't increase it even more, because I think, we never got the benefit of the big fall. So if there's an increase of crude prices here, I hope the bill at the petrol pump does not increase for us. And that will stoke inflation. That will, the government's interest costs today. If inflation goes up, interest rates will go up. The government's interest cost today 14 lakh crores. This is more than double the second highest cost, which, by the way, has now moved from defense to transport. So it's a good thing we are investing, but it's like 5.5 lakh crores or 5,70,000 crores which are spending on transport, and 14 lakh crores being spent on it. We have to get inflation under control. And getting the rupee slide and having crude prices increase and therefore petrol prices, I don't think this is going to help us too much.
Okay. Yeah, one hopes that at the pump there isn't much of a difference. But let's wait and see. Harendra is back with us. We just lost your voice, Harendra. I was looking for pockets of where you may look to buy, or FPIs may look to buy.
Yeah, I think first and foremost is what we should look at is the tech sector. Valuations are reasonable, and the government is enabling, the data center piece. Now, obviously, you have the tech stack, the last stack being the application stack, which is already picking up momentum with the Indian IT services companies. Now, with the government also locking up the buyback, escape route for promoters to buy back, I think they'll be compelled to invest in data centers in areas out there. So if all in all you look at that, large sector, liquid, good valuation, where you're compelling them to reinvest and generate more returns, and an AI trade, which India was missing, will come into play here. So I think all in all, the IT sector as one large sector becomes attractive at this given point of time. That's one. Second, of course, we've spoken about textiles. Then you have the aquaculture industry. I think the whole ecosystem is developing really well in India. And the government has been infusing a lot of capital into this space. So again, all sectors underlying focused on the FTAs have been catalyzed. I think that's where one has to look at very closely for your opportunities.
Okay, fair enough. Sanjeev, on you mentioned this in passing, and I wanted your greater attention on that, because you must be handling this GCCs. The very fact that this safe harbor is extended to companies up to 2,000 crores, do you see a bunch of GCCs coming? As well, this data center, it is the tax holidays are available for a very long period, 2047, but only if the data is sold outside, from what I understood. It will be taxed if you sold, if you kept the data center, rented it to domestic companies. Your thoughts on both? Should we expect inflows?
No, certainly. I think on the GCC side, I certainly think so. I think we're at least following the value creation which is currently happening. And I think this was an ask from the industry, and I certainly think that it'll add to the 1,600 GCCs or the 1,900 GCCs that we already have. We already see now even financial sponsors and others setting up their data centers and back offices in India, and not just doing limited cost arbitrage work, but maybe value additive work, which is making them very more respected in their global headquarters. So I think the GCC thing is certainly going to help. And I do believe that we will see more and more of those, which is going to enable the demographic profile of India to come through. I think as far as the data center piece is concerned, I'm a bit unclear yet, because it's a very long exemption period which has been given, and in some ways, not only is it too long, but as to what extent will it apply? I mean, obviously there is a lot of data center capacity which is being set up in India, and there are a lot of commitments which have come in from the hyperscalers. The fact is that will it enable them? Will it enable the whole ecosystem to make sure that if the data is hosted in India, and why not? I mean, it can happen. It can very well happen, and there are many parts of the world which can be served by Indian data centers. So the first thing really was to make sure the data center investments come to India and do not go to other geographies, maybe at times which are geographically better located next to the sea and so on and so forth. So the India data center story is enabled. I think that's the first thing. But I think the fine print on to where the exemption will apply, I am not yet clear at the moment.
Okay. I'll take you up on that when things become a little more clearer. We will be speaking to the secretaries in a bit, and maybe we will get more clarity at that time. Thank you very much, Sanjeev Krishnan, for joining with your first thoughts. I'll take a rain check from you to invite you for more questions as we understand these nitty-gritties better. Deepak, the same question like I asked Harendra. At the moment, because of the budget, are you attracted to any sector, like chemicals, special chemicals and semiconductors? CG Power is doing very well, or these tolling companies where there is a longer tax holiday, or any of them. I mean, biopharma, any sectors you are attracted to?
The budget's actually very, very positive on a very broad swath of sectors that involve domestic manufacturing. The increase in focus on building more capacity inside in India, the whole rare earth supply chain, the semiconductor focus, the focus on changing the chemical infrastructure also. I think these are all very attractive sectors, and we'll have to actually go down a little more in detail into what some of these things actually mean. But they've already reduced the customs duties on a lot of imports related to parts required to build these industries. The domestic industry itself, the capex plans, both at defense and some of the other elements as well, will actually promote a lot more domestic manufacturing. So high precision manufacturing, I think semiconductors, some parts
of nuclear. You may buy any of these stocks.
Sorry, could you say that again?
You may buy any of these stocks now?
I mean, we will consider those. Of course, there's, I think, some of our portfolios will have to, go through the fund managers going through all of this stuff in some more detail. But these actually sound very interesting, especially with outlays. We didn't expect this level of interest, especially in rare earth.
And in rare earth, we haven't seen any announcements yet, other than the PSUs, right? So now you can do the private.
No,
Yeah, so that is where I think the announcements in at least from now going forward will be very interesting. We do have India is the third largest rare earth, we have a lot of rare earths. We have thorium, where when you process thorium, you get you can get the components that can be used to make permanent magnets as well. But the processing is very expensive. So that's where
Deepak, I'll have to come back to you because an all-important person has joined us, Shailendra Jingan, the head of Treasury at ICICI. And I'm saying all-important because the market is not quite sure how to interpret the borrowing number. The net borrowing number has come exactly as my poll said, 76 lakh crore. But the gross borrowing number at 17.2 lakh crore has kind of surprised people. Will it get lesser because the government may announce an unexpected buyback or an expected buyback? Shailendra Jingan, you tell us, how are you looking at the entire math of borrowing?
So, sorry, Lata. Just a sec, yeah. So, no, you're right. I mean, in terms of the gross number, it's a bit of a disappointment. We were expecting 16.5 and the number has come at 17.2. See, when you look at, why your net the net borrowing number is tallying is because what has happened is that the proportion of short-term borrowings has increased. I mean, that's become 1.3 trillion. So so even though the fiscal deficit number, when you would have done the poll would have been 4.2, it's come in 40,000 crores higher at 4.3% of the GDP. So that number is higher, but the net borrowing number is similar because the collections expected from T-bills have gone up. So and the other assumption which the market had made was in terms of RBI doing a switch with the government to the extent of 1.2 trillion of securities which they hold, and that hasn't come through. So the repayment number is at 5.5. I think market was assuming a lower number. So overall 17.2 versus an expectation of somewhere in the region of 16.5. It's a bit of a disappointment.
Okay, but is it not possible, and has it not happened in past years, that they don't announce a buyback, but they can do an unexpected buyback, and so the borrowing would be the number you're talking about, a 70,000 crore buyback announced.
No, I think can you hear me? Hello?
Yes, Shailendra, go ahead.
Yeah. No, so I think, recently what's happened is that RBI has been doing the market operations as and when the securities mature in their, in their books. So, we saw 40,000 crores of secondary market buying when, one of the papers had matured in the month of December. So I think we expect that as and when these maturities happen in the books of RBI, they will come and buy those, to a similar extent if they don't want to curtail the size of their balance sheet. So I think that's going to happen. So in that sense, I mean, the number actually hitting the market could be lower at around 16 trillion.
Okay, and that seems to be the market's guess from the few whom I could speak over WhatsApp, since your market is not trading today. I want to come back to you for the dollar rupee as well. In just a minute, let me ask Harendra. Harendra, what have you made of finance stocks? You said you're positive on them. They have announced this banking committee as well. And my sense is that even the voting rights cap of 26% could be up for, at least discussion, if not change. Will that, propel you to buy any of the finance stocks, the committee itself?
Not the committee itself, but see, overall, if you look at the STT tax, it was playing up on the savings number as well. So while it would impact a MCX and a BSE, it's an overall positive for gross tax collections, the bank savings, as well as the consumption number that will hit. So when we did our number, it was around close to 70,000 crores if actually, it was disincentivized, the F&O trading. So that's a positive overall. I think the credit to GDP has already to start to pick up. And with the manufacturing impetus that's come all through, I think the number that we need to see is the credit to GDP going up. And that is where the FIs will start to look at. So with what I hear and, understood from the budget, I think this number should see an uptick, which will be positive for financials.
Okay. Okay. Now I'm coming back to you, Shailendra. What is a reasonable 10-year bond yield we should go with? And secondly, on the rupee, is there continuation of what happened on Friday? We were touching 92, and I think the Reserve Bank came in at about 91, 98 thereabouts. It is just a continuation, or will these data center announcements, GCC announcements change sentiment a bit?
I think over the medium term, I mean, if I look at what really came out in the budget, I think there is a great emphasis on self-reliance. I mean, you look at the sectors which are getting the benefits, right from services to textiles to medical tourism. These are things where India is competitive, and over a medium term, we should see a change, in terms of the current account picture. And I think last time we had discussed that, India, if we are not getting capital flows, at least we should try to move to a current account balance position. I mean, that old regime. And I think even the economic survey makes a mention of it that, we should not strive to run a current account deficit. And in a world where there's so much uncertainty with tariffs and geopolitics, I mean, it's the best thing India can do is to move towards a current account surplus, or at least have a balance on the current account. And I think over the medium term, these measures are going to work. I don't think anything changes really in the near term because of these things, because, all these structural measures happen over time. I mean, we know that, there are lags in terms of, how the things change. But overall, I think it is definitely positive. I mean, there's a lot of, impetus on the external facing sectors, and that should help in terms of the current account. And overall, I mean, from a rupee picture, I think in the near term, rupee will take cues from the stock market. I mean, if stocks are falling and if you're getting FPI outflows, I think there could be some pressure. But I think over a slightly longer term, if I think of the picture, I think the current account situation should improve. I think some of the data in the last few days has been encouraging. The December number for services surplus, was revised sharply upwards from 18 billion to 22.7. Then we got the RBI's forward book also, which has fallen incidentally from 66 billion in November to 62 billion by December. So, so all these are positive signs for the rupee. I think rupee should, in the near term, it might get distracted by the way equities are doing. But overall, I think directionally it should be positive for the rupee.
Okay. Okay, Shailendra, just stay on for a minute. Deepak, I'll let you go. Thank you very much for joining us at a very crucial time and giving us your thoughts on what sectors look good and what doesn't look that good. Shailendra, the other question I asked you, bond yields can go up to 6.8, or you think 6.75 will find some buying?
No, I think bond yields go up a little. I think on Monday we are expecting maybe 5 basis higher. But I think the range is shifting. So, the range keeps shifting upwards because, we know the factors. I mean, that, there is a challenge in terms of demand supply for bonds. I think next year the situation should be a little better with, a lot of investors coming back into the bond market who were shifting to equity this year. But overall, I think I would give a range of something like 660 to 685 in the near term. Till March. But yeah, I take your point. I think 680, 85 is highly likely by March.
Okay, okay. Thanks a lot for that. That is what is keeping the banks in pain, Shailendra. Thank you very much for joining and giving us some much needed clarity on how to look at all these numbers. Long-term positives are there for the dollar, but it's not as if people are going to come with dollars to invest in data centers tomorrow, or for that matter, the GCCs. We need dollars now, and there isn't minorly expected, or minority was expecting maybe the FPIs get some tax, capital gains tax relief, and that may have some relief rally. That's that immediate relief for the rupee or for stocks is not on the anvil at the moment. Thank you very much, Harendra, for joining us. Harendra, on that point, the banks, the downside is what exactly Shailendra is saying. If you're going to see the G6 go to 6.85, you will see the state loans go even higher. You will see corporate loans go even higher, which means there is a mark-to-market loss. So do you think Q4 numbers are under threat or anything? or even cost of capital for NBFCs goes up, should we have these worries about finance companies?
But I think currently it's in the repricing mode for NBFCs. The NBFCs we speak to are looking at lower cost of funding. So that could slow down a little bit if this moves happens. But I think all historical data shows that credit to GDP number or growth in credit is what leads to re-rating. So pain in margins and lower profits is in the price now. Expectation is Q4 will be soft for the banks, etc. But I think from there on, the financial sector should start doing well with the correction in the whole balance sheet. So with if tech and banks rally, market should be okay, is our view.
Okay, and what else would you buy?
Oh, I think we missed the point with respect to the power sector.
Okay.
If you can see that the works for the data center with respect to import of nuclear equipment and the recalibration of PFC REC, the alignment is happening to repower the power sector, and this is a global theme. I think the power stocks and allied industry will start to see action once again.
Okay. Okay, Harendra, thank you very much for those thoughts as well. We have got to look at the positives. Okay, Harendra, before you go, any reason why Gokuldas should be up 11.94%? I mean, almost 12%.
Yeah, see, we've discussed this before. The FTA piece, that the government is catalyzing with respect to textiles, the improvement in custom regulations, labor laws. That is kind of getting recognized by the market. So there's the first immediate plays is Gokuldas and KPR, which are in the garmenting space, which will see an immediate trigger with respect to the usage or growth numbers. Of course, the rest of the players will start to play in, as well. So I think, like we mentioned, aquaculture, textiles, gems and jewelry, all of them will come into play. But these are the immediate names that the market seems to be respecting and recognizing.
Okay. All right. Thank you very much, Harendra, for giving us some exact names and for what to look forward to in the days to come. Thank you very much for joining us at a crucial moment. We have two more experts joining us. Nilesh Shah of Envision Capital is with us. Nilesh, deeply grateful for your time on what should be a busy day for you. I know all of us journalists are trying to grab your time. You refused to get into sectors when we asked you earlier in the morning. You said that overall manufacturing should improve, and they have done a lot for overall, biopharma, for chemicals, for semiconductors, rare earths. What are you taking home in terms of the feeling for earnings growth?
So clearly, I think from an earnings growth point of view, it's going to be this budget plus all the other policy reforms which have happened over the last year or so. So continue to believe that with a targeted nominal GDP growth rate of 10%, that to me is a great starting point. And the fact that the fiscal deficit is targeted to be at 4.3%, I think that augurs well for cost of capital. So we have growth inching up. We have cost of capital coming down. And then we have some engines of the economy which will continue to fire, like consumption, capital goods, infrastructure spend. So these are some of the key things which will ensure that the earnings growth, which has been in the single digit, will start kind of looking more like kind of the mid-teens to the double digit kind of earnings growth. So I think on the whole, it's going to be back to micro fundamentals, and it's going to be back to essentially the business as usual mode for the economy and for earnings.
No, fair enough. Max Healthcare has done well, I would assume, because of the profuse pronouncements on healthcare. But Sun Pharma is doing well because Sun Pharma has done well. The numbers that came on Friday were very good. So, I mean, would you want to point out? I know you don't talk stocks, but if you can mention any, or if you can mention sectors that you would be very happy about, or you would look at the micros of those sectors a little more carefully.
So obviously textiles is something which looks to be well poised. It's going to be a very big beneficiary for this. The whole focus on having more high-speed rail corridors is going to be a very big positive for any company in the railway value chain. In addition to that, some of the other infra plays will also be big beneficiaries of this. So these are some of the sectors which clearly stand out. In addition to that, there was something along the lines of basically probably the ER&D companies in IT services, which is the engineering R&D services companies within the IT services space, which possibly are likely to also benefit from this. And then the whole data centers who seem to have got a tax holiday as well. So there's been a variety of sectors on infrastructure, on textiles and manufacturing, critical minerals, and then ER&D, product development in IT services, and the data centers pack. So it's basically a whole gamut of sectors which will benefit because of various provisions of the budget.
Okay. If you could stay on for a minute, I've got Sajid Chinoy with me, and he'll perhaps be able to clarify something on the macro setup as well. Sajid, the first question I want to ask you is, nominal GDP is a nominal assumption, modest assumption of 10%. We are going to have a new CPI series which clearly looks like pushing up the CPI by about 20-30 basis points, and we have a new GDP series coming where also the expectation is that maybe if we have put it at 395 trillion, it may come at 397 or 398 trillion. That's seen as a likely expectation. If that happens, do you think that the government will actually at the end of February or on March 1st actually have more elbow room and a higher nominal GDP?
Lata, I think that's possible. So if you think of where we are this year, nominal GDP is at 8%. But if you look at gross taxes and adjust for the compensation cess, that's really important, I think, because comparing year across year, you have to clean out the compensation cess, which goes into both the tax numbers as well as the revenue expenditure numbers. We're looking at gross taxes growing around 9.5%. So that's reasonable in a year where you've got tax cuts, where buoyancy was, 1.1, 1.2. Now, next year, 10% I think is achievable. I'm not saying it's in the bag, because you can also be in a situation where if this year's GDP is marked up, you've got a higher base to work with. If CPI numbers in the next few months are marked up, you've got a higher base to work with. But 10% is not impossible to get next year. I think what the government's been to be quite conservative is gross tax collections, ex-GST compensation cess, are growing up, slated to grow at 10.4% next year. So the buoyancy is less than 1. And so they've left a little bit of room so that even if nominal GDP undershoots 10%, the tax collections, will not be that ambitious. I'll just say one more point. If you look closely at the fine print, I won't be shocked when the final accounts come out that this year's fiscal deficit number of 4.4 could actually even be lower. Because in the next 3 months, the asking rate on expenditures is slated to be very high, much higher than the expenditure rate so far. So we could be in a situation where we can't spend so much, and so the starting point itself from a fiscal deficit perspective is lower this year.
Okay, then that definitely will be a positive. Also, if you can tell us about cost of capital. I just had head of treasury with me, and the expectation is that this 7.2 trillion borrowing was not something the market was prepared for. My own poll was actually 16.2 trillion gross borrowing, and I was prepared for 16.5 because there was a wide range even when I polled people, but there was no 17.2 actually, there was 17. So will that kind of rattle? The expectation from that expert was that we could even go up to 6.8, 6.85 on the 10-year. So is that a kind of a negative for growth?
So a couple of things, Lata. I think the spot reaction could be one of disappointment because, as you rightly said, I think this was on the upper end of what was being expected. So, the initial reaction could be that this is higher, but there are at least a couple of known unknowns here. The first is, that we don't know if the RBI at some point can come in and do a switch, right, which will take that number down. Secondly, if you look at the small savings assumptions, they're very conservatively budgeted. I understand that, rates have begun to inflect. So you could be in a situation later in the year where, if small savings, outperforms, then there'll be less gross and net borrowing. So there are two caveats over here. There's a third way to look at this is to step back. I know there's been a lot of hand-wringing about how bond yields have evolved in the last 3 months or so. Yeah. But if you just step back and look historically, what has been the difference between the 10-year bond yield and the 1-year treasury bill or the 3-month treasury bill? And if you take the COVID period out, that difference is quite normal levels. At the end of a monetary easing cycle, these things tend to go up, and we're not completely out of whack just as yet. So while in absolute terms, yields may go up, if you take a bigger, broader view of things, things are not completely out of whack.
Okay. Stay on for a minute. I have some more questions on the currency as well for you and the Reserve Bank dividend. Nilesh, from what you're picking up on how the bond markets may react and the cost of money may behave, what would your attitude to finance companies be? Banks, non-banks, everyone?
I think it's going to be a combination of both banks and non-banks as well. Non-banks are going to be, of course, more the specialized plays. They focus on specific verticals, domains. But I guess it looks like that probably the banks will benefit more because what I see is essentially is companies getting back into an investment mode. I see more working capital cycle getting a little elongated. Working capital requirements are going to increase. So on the whole, it looks like that banks would benefit probably more than just pure play NBFCs here.
Oh, okay, okay. In banking, the big issue is this banking committee they are appointing. Is that something that's whetting your appetite, Nilesh? I mean, even the 26% cap on voting rights could be up for grabs. I don't know what they will advise. But, the market, the government, the RBI and the market and the banks themselves are feeling very confident in terms of their quality. Even discoms have turned profitable this year. I mean, in my career, in your career, have you heard that? As a whole, of course, there are pockets of loss makers. So do you think that we can expect some dramatic changes over there? And that would be a very good sector to look at, private sector banks and even PSUs.
No, absolutely. I think clearly banks is the way forward. And they are very well placed. You talked about discoms, and yes, that's I think a great place. I think that's where they would be encouraged to basically lend more. In addition to that, the key provision in this budget or the announcement has been a 25,000 crore risk kind of a fund, which will basically pretty much be like the credit guarantee fund, which means that if anybody lends to the infrastructure sector, there's going to be credit guarantee for that. Obviously, we have to look at the modalities and the details of that, but conceptually and as an idea, I think it's a great step forward. So I think banks with the size of the balance sheet, the room to lend, and the appetite for more risk, I think seem to be relatively more well positioned to take advantage of the credit growth from here on.
Okay, so you would be positive on financials?
Yes, absolutely. Absolutely.
Okay, okay. Sajid, I know this is a slightly out of syllabus question for you, but banking and this committee being appointed, what is your ecosystem telling you? I mean, the entire JP Morgan ecosystem. Does it look like it's pointing out to some possibly brave reforms that will come? Maybe even for public sector banks. I mean, they've been mollycoddled, they've been kept under control. I have this vision that one day they will move from this Nationalization of Banking Companies Act and be pushed under Companies Act. Then, there will be independent directors and the works. The CEO is no longer appointed by the government, but appointed by the board of directors. I envision when I see a committee like that, are you hearing brave or are you, what's your ecosystem guessing?
Well, it's very similar to what you're saying, Lata, which is that it's very early days, so it's not right to speculate so early. But I think the finance minister did emphasize a couple of times the high-level banking committee, which suggests that these could be deeper, more structural reforms. And I think that is the zeitgeist at the moment, right? That we cleaned up income tax. There were a lot of efforts today at customs taxes. I hope that also gets more holistically cleaned up. But I think there's a sense now that we have to plan for the next 5 or 10 years. I think that was the leitmotif also of the economic survey, that the world has changed. Only economic reforms can shield us. We have to start doing bigger things. So I'm hoping that the setting up of this committee is a harbinger towards that.
Okay. Yeah, and the fact that, it's not been set up at the Reserve Bank, which means the law is given and they will only tinker with, directions. It has been set by the government, which means the very grammar of, what you allow private sector banks to do and how you design the public sector bank, command structure. I always give this example. The, RBL Bank and Yes Bank were not really the best of banks. But with, because they are in the private sector, you put two public sector bankers in charge of it. And one of them got 26,000 crores capital and the other one has got some 10,000 crore capital. Whereas the government has not been able to sell IDBI. Some things is done well in the private sector is always my belief. Some things the government does better. But okay, that's just my editorial value. Sajid, I wanted a view on the rupee. We continue the way we did till Friday?
as I said, there's just so many things going on globally, Lata, that a lot of currencies in the world are, impacted by what's happening with the DXY. We saw the DXY move again after the announcement of a Fed chair. But I think the broader issue is,
This is the customary press conference that we hold with all the secretaries. You've heard the entire budget being presented in the Parliament. So as opening remarks, I'll just highlight some of the points which we want to draw your attention to. But subsequently, of course, we'll answer all your questions. All the secretaries are here with me. So this budget being the first one, as the Honorable Prime Minister said 2 days ago, this being the first one for the second quarter of this century, also leading towards Vikasit Bharat 2047. We are laying the path and giving a push to the economy to maintain the growth momentum. And for that growth momentum or sustained economic growth, which we want to ensure, primarily we are looking at building the ecosystem with structural reforms which will go on. Reforms have been carried out. We are continuing to do the reform activities, so it will continue with an aim to make sure that we create enough environment for improving productivity and making sure employment is generated. Also, technology, 21st century, this century is completely driven by technology. So we will ensure that technology is brought in to benefit the common man, to make sure common man benefits in the sense of ease of doing living, or for his businesses to prosper, or for farmers for greater productivity, or better logistics, whatever. So technology for benefiting every common man. And above all, with all this, inclusive development. Sabka Saath, Sabka Vikas, and that is why you heard me bringing in schemes which have good allocations for bringing better health facilities, creating a cadre of people, not cadre in that sense, but a bulk of people who can come in as health workers. Also making sure we are able to provide dignified opportunities for Divyangjan. Mental health has also received a lot of attention. So these are the side for Vikasit Bharat and making sure Sabka Vikas hoega. But the idea is the advantage and the momentum that we gained since after COVID by increasing public capital expenditure will continue. We've announced that 12.2 lakh crores are coming through public expenditure this time. It is 4.4% of the GDP. I'd like you all to please notice that, which is the highest, at least in the last 10 years. It could even be highest if you were to take data earlier. No increment in capital expenditure, sustained fashion, has happened ever before. This one marking 4.4% of the GDP. Then what are the kind of things which will happen through it? You will have dedicated freight corridors. I've named Dankuni in the east, Surat in the west. Then I've also highlighted that 20 new national waterways, not national highways, national waterways are being planned. Orissa, where the mineral-rich state, you have the waterways taking it to the port, and the two ports have been identified, Paradip and Dhamra. Similarly, we are also making sure that the coastal cargo movements will be enabled through a cargo route, so that through the coastal area we are able to cut down on cost of movement of goods. City economic regions, developing them is a very big new measure that we are coming up with. And for that, an allocation of 5,000 crore per city economic region. Imagine the amount, 5,000 crores in 5 years, 1,000 crore per year per city is being given, and the emphasis is going to be largely on tier 2, tier 3 cities. And then talking of infrastructure further, with the capital expenditure coming with the big number, you're having also the high-speed rail corridors. 7 of them announced. The destinations are clear, so that they become the bridge for all these economical robust centers. So
those are for making sure that the infrastructure and the capital expenditure are getting tied up, and the country benefits from the ripple effects that these can bring in. The 7 strategic and frontier sectors in which we've highlighted that will increase productivity and also have new investments come in and give emphasis for India's own brand on those things is on the biopharma sector. I think that's going to be a big change in the way in which we are looking at giving capacity for those who are able to research, who are able to undertake research and development. So 10,000 crore initiative again over five years for domestic biologics and biosimilar production. This is a clear message and backed with enough substance that India's lead in the pharmaceutical sector should be kept intact, but at the same time bring in newer ways of helping the pharma sector, and also because it has an impact on human health. Semiconductor mission had 2 major announcements that will improve the India stack and also the IP related matters. Electronic components manufacturing scheme for 40,000 crores is a major encouragement for electronics to become self-sufficient. We have also announced establishing rare earth corridors so that India can face and be able to meet its own requirements with its materials. So once we identify and are able to explore these minerals and process them, make them available for us, our dependency on external sources for bringing in the rare earths will be lesser, and we've identified the states where we want to establish this rare earth corridors. They are going to be in Orissa, Kerala, Andhra Pradesh, where we want to establish this rare earth corridors. They are going to be in Orissa, Kerala, Andhra Pradesh and Tamil Nadu. So these are very important developments, and they are going to have multiple decadal impact on the Indian economy. Our dependence on magnets and rare earths will be brought down. 3 dedicated chemical parks, again for reducing our import dependence. High-tech tool rooms for research, that will be set up in 2 locations. Very important thing is about the construction equipment being imported. That could be for building tunnels or metros or high energy and also heavy duty equipments which we are relying on imports. We want to manufacture them in India, and that is why I said, how does it affect a common man? It affects because firefighters today have novel, new, big ticket and small, very small firefighting tools and weapons or equipments. We don't have them in this country. That's why if there is a fire accident in some very congested area, our equipments are not able to reach those points, whereas there are equipments which today are produced abroad, which can navigate those small corridors and go save people's lives. Whether they or huge ones, all of which we want to make sure that we will have production in this country itself, whether they are tunnel boring or anything else. From small to big, we want to bring in those very impactful infrastructure into India. So we'll support domestic manufacturing. Then container manufacturing is another which we'll support. I think I've gone in detail talking about the textile support in various forms. One very important announcement was made, Mahatma Gandhi Gram Swaraj initiative, which will make sure khadi, handloom, handicrafts will all be brought in, and one district, one product will all be brought in this initiative, and we'll be able to support rural artisans, rural workers and handloom weavers in those areas. Legacy industrial corridors have got saturated. Manufacturing happening there is now very constricted because they are not able to bring in newer robotics and others. So we want to upgrade these legacy industrial clusters so that they become cost competitive and efficiency comes into these places. Even more important is the champion MSMEs, small and medium industries, entrepreneurs, MSMEs. who are going to be given all the support, and three-pronged approach is being taken up there. We are giving equity support, we are giving also liquidity support, above all professional support for them, so that MSMEs, the equity support is supported by a 10,000 crore SME fund, growth fund. Above all, we are also topping up the Self-Reliant India Fund with 2,000 crores. So MSMEs should not feel any dearth of resources for equity. Similarly, they shouldn't feel any difficulty for liquidity in their hands, because the TREADS platform will now be treated almost as a backed up, security backed up instrument with which they'll be able to discount and get their monies. For professional support, we are working with the chartered accountant and cost accountant institutes so that they can create corporate mitras who can help these MSMEs in filing their returns, doing their accounts, and so on. Above all, for youth and training, there's so much. You've heard this speech, so I won't want to take your time on it. High-powered education to employment enterprise, standing committees being formed so that they can recommend measures for service sector as a core driver of Vikasit Bharat. Part B concentrated a lot on tax and related concessions that are being offered. More importantly is the process simplification which has been announced. So elaborate measures have been taken. You will be able to also seek clarification if you want. New export opportunities for fishermen who can go into the economic India's zones, high seas, and also assess and access the global markets. The one very touching, and I really was moved by this proposal, is where we have identified 17 drugs or medicines which are going to be basic custom duty exempt, which are important for cancer patients. Similarly, 7 more rare diseases are added to the import exemption list of the import duties. Baggage clearance and personal items which you bring in when you travel are all being given enhanced duty-free allowance. Besides that, there are quite a few direct tax and indirect tax proposals. Decriminalizing the penalty proceedings and support to the IT sector are some of the high points. As an opening remark, I'll conclude here. I'm sure you'll be able to ask questions and seek clarification. Thank you for coming.
Thank you, ma'am. I'll start this question, taking the questions. First question is 17.
Good afternoon, ma'am. Shishir here from Hindu Business Line. Ma'am, my question is that under the miscellaneous capital receipt, the provision is 80,000 crore rupees. And last year, the provision was 47,000 crore, which has been reduced to 37,000 crore rupees now. Does this mean that there will be more equity monetization this year, or there will be more focus on the asset monetization of CPSEs?
So you've got it rightly. The intent is that we will have a very strong asset monetization plan in place. Last year, ma'am had announced in the budget that there will be a pipeline prepared, which is being done. So we hope to reap the dividends from that.
238.
Ma'am, Timsi Jaipuria, this side from CNBC TV 18. I just wanted to know the rationale behind the hike in STT in futures and options.
So, first of all, I believe some confusion. In fact, the question that you have asked rightly reflects the announcement itself, that the only change made in STT is in the future and options. All the other STT rates remain the same. The primary objective of raising the tax rates on STT has been that it is felt that when you look at the volume of transactions in futures and options, it whether you compare it to the size of GDP or size of the underlying securities market, it is largely in the realm of heavy speculation, which results in losses to small, retail, unsophisticated investors. And the government's intention is to discourage speculative tendencies, and the increase in rate is essentially in that direction. So it is meant to essentially handle the systemic risk in derivative markets. Even after this increase, however, the rates of STT will remain modest compared to the volume of the transactions that is happening there. This is the reason.
54. मैम तरुण शर्मा फ्रॉम जी बिजनेस। मैम आपने पूरा बजट जो है वो न्यू एमर्जिंग सेक्टर पे बड़ा फोकस रखा है। मैम मेरा सवाल आपसे दो हैं, यदि आप अलाउ करें। एक, मैम आपने जो एक्साइज ड्यूटी का कैलकुलेशन किया है वो पिछले बजट एस्टिमेट से इस बजट एस्टिमेट में तकरीबन 22% की ग्रोथ देखने को मिली है। दूसरा, मैम जो आपने एमएसएमई के लिए कहा कि जो ट्रांजैक्शंस होंगे उसके लिए आप एक्सचेंज प्लेटफॉर्म का यूज करना होगा, तो क्या मैम ये सीपीएसईज के लिए कंपलसरी होगा जो डिस्काउंट ट्रेडिंग की जो बात है? थैंक यू।
I'll take the second question, मैम। सो हाँ, ये सीपीएसईज के लिए मैंडेटरी होगा कि डिस्काउंटिंग एज वेल एज नॉन डिस्काउंटेड बिल्स दोनों को ही ट्रेड्स पे करना होगा, ताकि वो 45 दिन में भुगतान एमएसएमई को कर पाएं। और ये हर तरह से चेक कर लिया गया है कि ये हो सकता है। सो वी वांट टू मेक सीपीएसईज एज पायनियर्स। We hope, like ma'am has said in her speech also, that other corporates will also follow.
On excise?
Increased by 22%, sir, from last year B to this year B.
Because there is from 1st of February, all the tobacco products have come back into excise, and all those revenues will account for the increase of the next year.
209.
Ma'am, Prakash Predashi from ET now. The budget has announced restructuring of PFC and REC. What will this restructuring look like? And does this also mean that these NBFC will be merged going forward?
What is the later part of your question? That these NBFCs are not going to
merged going forward?
Yeah, I've said we are rationalizing it. You'll get to know as we go forward. We want to streamline it, and therefore we'll be taking some steps. We'll let you know the moment we decide how to go about it.
234.
Hello ma'am, Harsh Kumar from Business Standard. Ma'am, two questions. One is, you said that a high level committee will be formed on the banking reforms in order to 2047. Are we going further for any kind of merger or something, since government is continuously saying that we need at least two of the big banks, in at least of the top 20 banks. So are we going towards that?
No, first of all, when I say that it's going to be a high-level committee which is going to look into it, the terms of reference will be prepared, and we are looking at committee to go into the entire expanse of the banking sector so that they come up with recommendations which help us to plan for banking for 2047. We need, by the time we become a Vikasit Bharat, 2047 is our goal. We need to understand what are the other steps that we need to take in the banking area, and based on the recommendations we'll go forward. But we have the Secretary Department of Financial Services. We'll ask him to also give us, please.
Ma'am, I think you have rightly responded. There are a large number of aspects relating to the banking requirement. For example, the credit to the GDP, commercial credit to the GDP ratio low, and the expansion of the banking network, and what kind of procedures currently we have that is impeding both the deposits as well as credit. All those aspects will be looked at by an expert panel, a committee, and we'll definitely have TUR, and then also consult the all the stakeholders, and the government will take a view on how to lay strong foundation for 2047 Viksit Bharat.
Ma'am, one more question. 229. Left side, yes.
Ma'am, Premangshu from Ananda Bazar Patrika. Ma'am, have you consciously avoided announcing any bonanza for the poll-bound states? And secondly, can you elaborate on this East Coast corridor?
Very critical for supply chains. We need a predictable mineral, rare earth and magnet related products to be made available for India's manufacturing. Whether it's lithium ion, whether it's automobile sector, whether it's the new age solar, you need these rare earths to be processed and be made available. We have enough raw materials. The coastal
All right, that was the Finance Minister and of course the panel of secretaries answering the press's questions. And of course the market continues its roller coaster trajectory. Let's pull up the indices once again, because it seemed like things were stabilizing, but now as we are in the final 20 minutes of trade, there's a bit of a slip and slide underway again. Well, we have our next set of guests joining in, Prashant Khemka of White Oak, and we have Ashish Gupta of Axis Mutual Fund joining in. Gentlemen, great to have you both with us. So we thought it was very bad. Then, then market experts and tax experts said it's not so bad, it's pretty okay. Now the market's falling again. Let's get your first take on just purely from a market perspective. How do you find the budget, Prashant? Prashant, I think you're on mute.
Sorry about that, Subi. Thank you for having me on the show. See, I think it's a expectations thing. Sometimes when even if a company reports earnings that is in line with what it has been delivering, still the stock can take a beating. So 10, 12%, if someone's reporting and reports 10, 12, if the expectations were for more, I think given that all that's been going on in the market, first of all, where Indian markets underperformed by about 40% relative to other emerging markets, and generally underperformed developed markets as well. So that was one on the markets front. Secondly, with the geopolitical situation, ongoing trade tariff related uncertainty, with all that the US counterparts have been saying, and also the geopolitical situation in terms of the Sindoor operation and what's going on elsewhere in the world. There was probably an expectation that this is the opportunity to, or this was a time where the government would do something, nothing necessarily concrete in anybody's mind, but something that would be out of the ordinary. Let's say capital gains tax. There's always this hope that capital gains tax would be removed from foreign investors. Now, odds of that are always very low. It was never like odds were very likely that would happen, but whatever the odds.
But no, Prashant, allow me to come in over here, and I take your point that at least we didn't get any major, capital gains tax increase. But the nature of stocks falling now, I mean, we're talking about SBI falling, Bank of Baroda falling 6-7%. A lot of these PSU banks are down. Defense stocks, which was seen as the only sort of beacon of hope in the market, there the disappointment is really showing up, right? 6-8% down. We'll get the stocks up. And then that question to Ashish and to Prashant, and that's why I'm asking that yes, it might be a good big picture budget, but in the here and now, the market seems disappointed. Ashish, quick take, and I'm going to go back to Prashant on this. Ashish?
Sure. Sorry, I could not hear what Prashant has been saying. So in case I'm being repetitive, or apologies, Prashant, if I'm too contradictory to your views. But no,
views
I think
count. Bull, bear, north, south, left, right, all views count.
Great. So, see, my view is that there is certainly a sense of disappointment in the market on account of two reasons. One is vis-a-vis expectations, and some of the expectations, frankly, were unrealistic. There was expectation that tax rates on deposits will come down, for example. And if you see, the government is operating with a lot of constraints, right? If you look at the forecast of the budget, it is forecasting a 10% nominal GDP growth, tax revenue growth of just about 7%. Right. So we have to look at what is the degrees of freedom when your top line growth is relatively modest. And therefore, to expect any major tax benefit, whether on deposits or on debt instruments, was unlikely, and probably some of the reaction in the market is to that. I think the F&O part is also the disappointment, given that the market was already weak and sentimentally this is negative. And really, in the secretary's press conference you had, they laid out their strategic rationale for that, but the market is disappointed with the timing. And while the cash market, there's no change in STT, but in India there is a lot of cash market volumes are relatively thin. And frankly, the concern is that if F&O market volumes come down, what is the cascading impact on the cash market where the volumes are also relatively thin to start with? So I think those are a couple of concerns, but I think if there was a big expectation of some consumption stimulus or a stimulus to the stock market, and that has not come through, and probably that's why the market is down the way it is.
No, okay, fair point. I take your point, but Prashant, that's what I'm asking. I mean, I don't think anyone was expecting a very big consumption stimulus. We've already had those tax cuts, right? But the fall in bank stocks, particularly a lot of the PSU banks, that's telling us that at least for now, the market is uneasy with the fisc and with the gross borrowing. Now, either the market is getting too worried for no reason, or there is some justification for this kind of a fall. What would you say?
Surabhi, on banks, I'm also struggling to understand the fall today beyond what you just outlined, for reasons beyond what you outlined. On defense, though, the other sector that you had pointed out is down. I think, look, given the events that happened during the year and what's going on globally, a much higher increase was not a unjustifiable expectation. I was expecting a much higher increase in defense, but again, this also is a substantial increase, and the details we don't know. We'll only know over the coming months on how much of it is going to be indigenized, and if the indigenization component is much stronger, then for defense listed stocks, it could still be positive. Just one thing I do want to point out on this STT, I don't believe, and sorry, Ashish, I'm somewhat of a contradiction here to what you're saying or what I'm hearing on media. I don't think much of the fall or any of the fall today is related to the STT on F&O. I'm personally actually very much like this way of regulating or controlling, if you will, rather than coming with non-tariff, if you will, or non-tax measures that suppress the speculative activity, let's call it. Speculation is a very basic to human nature. So just like you taxed smoking, we haven't banned smoking as a country. Like, we've taxed it, and that raises revenue for the government. It's better to control it by taxing it. It raises revenue for the government and also allows people, those who want to speculate or trade or otherwise take it as a gainful activity, to continue to do so. So I don't think, personally, I think it's a good thing, and also I don't think that from the market's perspective, that's the big negative that is hitting the market.
What about the other aspects of it? That the capex number, at over 12 lakh crores along expected lines, but I think the market's saying that it didn't get much of a wow factor in defense. That is definitely showing up in many of these stocks. So was that a surprise? Quick take, 10 seconds, maybe, Prashant, you go on defense and then I'll ask Ashish.
and was expecting a bigger increase in defense budget, though going by the past 10 years trajectory, it is a substantial increase in the defense budget. But with everything that's going on in around the world, a lot higher could have been expected. And I hope this year's increase is first of many such years going forward.
Ashish, your take on overall, I mean, stocks like L&T are down, right? And the market was primed to at least see these guys move higher. In general, banks, in general, industrials, defense. You know, this was almost a quote-unquote no-brainer trade, budget trade. But that trade hasn't worked out.
So, and again, I take the point that we should not take the market immediate reaction to be really an indicator of how the sector has benefited or lost from the budget, right? So again, if you look at the overall capex number, it is up 11 odd %. As I mentioned, nominal GDP growth is 10 and tax revenue growth is 7, right? So both as a percentage of GDP, the allocation to capex is actually higher. If we look at from an intent perspective, clearly the government is focusing even when you don't have that much of a tax growth. Similarly, in defense, the defense capex numbers, I believe, are up nearly 21% year on year. That too from a revised estimate where compared to the budget estimate last year, the defense spending had to be increased. So I don't think we should take the immediate reaction of stocks to suggest that something is very positive or very negative for the sector. Same thing for the public sector banks. Because even if we take the view that at the margin, given the borrowing number is probably a bit higher than where the market was, these banks' earnings are not that predicated on profits or losses from bonds. So yes, at the margin it might impact, but their core profitability is much, much stronger and it will not move the needle in any meaningful way in terms of their EPS estimates. So I think we have to disaggregate the market reaction that we are seeing in some of stocks versus really what the budget entails for them.
Fair point, fair point. I mean, one day's reaction cannot be the judgment on a policy statement for the whole year. I take that point. Gentlemen, just hold on because we'll have two titans from the auto sector joining in for a very quick take as well. Hyundai India and BMW. Let's see if the manufacturing giants are happy with what they've heard so far. Before I get to them, Ajay Srivastava is with us. Ajay, now for those people, so whatever trades were working in the market, right? Metals was working, that's been torpedoed because of external factor. Now defense, people were hoping it was going to work, but again, there is no special surprise. Likewise for industrials. So what's left? What's the new trade?
And for the PSU banks, because they were the stellar for the last year.
And the banks, these were the only things working in the market.
You know, I think
all three are sharply lower. I mean, I don't know if it's just a one-day thing and then we move on. What's your sense?
No, I think the point is that at the end of the day, if you look at the budget numbers as you go down the path, between the fertilizer subsidy, there's no reduction. There is almost the same number as last year, and it keeps going up every time. The food subsidy remains the same number, and I think the devolution to the states is almost the same. So and the interest cost has gone up by 1.5 crores. So essentially, what's telling you the story is that the high growth re-rating with the market is actually factoring into the PE of Indian stocks. Is now needs to be looked at in a much longer term perspective. Okay, short term, we thought we have not, we had got a higher PE and we should be growing economy 7% higher and so on. That re-rating is coming about, is accentuated by your margins, which have come on to literally doubled for, futures and options. And I think someone is saying was speculative, someone is saying something, but people don't understand. These are used as hedges as well. And this is the base of a capital market. This concept in India is that these are speculators. These are, kind of gamblers. People think they're gamblers. No, they're not gamblers. These are people who give sustenance to capital market. Look at US. That's why the capital markets got depth. You got 1 year options there. You got only 1 month options in India. And we just paint the brush and say, oh my God, these are speculators. And I think our panel members actually said, oh, it's like tobacco consumption. Oh my goodness, no. I'm a serious guy. I don't smoke, but I do hedge my positions on futures options. I trade in them, and that's a capital market instrument. It's a genuinely serious capital market instrument.
Fair,
When you
fair.
play around
think,
with that.
No, Ajay, I hear you. I hear you. But like I said, all views are extremely important. So it's good to get your view as well. We had Shankar Sharma actually right after the speech. He was saying, I'm very happy with the STT hike. I don't care about the market fall today because the Satta business needs to shut down. So we have extreme views on this very touchy subject.
No, people can have any opinions about it. I'm happy, you are happy. The point is, the capital market sustained India in the last 24 months. A number of IPOs, number of the issues, futures and options trades, and people coming in trade. That's what sustains it. You take it out of the system and let's remove futures and options from it altogether from India, and we have only cash share trades, and you'll see.
So this is a separate. So Ajay, on this, we're going to do a separate panel altogether in the coming days, I'm sure. But my concern today, and that's what I was asking our experts earlier as well, that it's not about Angel One or Grow or these capital market stocks falling alone. My bigger concern was defense, manufacturing, banks, these stocks falling, because these were sort of the backbone that was holding things together in a difficult last 1 year. Speaking of manufacturing, we have Mr. Hardeep Singh Brar joining in. He's President and CEO of the BMW Group here in India. We'll have Mr. Tarun Garg of Hyundai joining in the next couple of seconds as well. Mr. Brar, stock market has its problems. The economists have said it's not a bad budget. From a manufacturer's perspective, how do you, rate and rank what you've heard from the finance minister today? And the bigger question, I think, is that the GST boost is probably done, for the auto sector. But is consumption in the auto space, will the buyers continue to queue up at the showrooms, at the mid to premium segment?
So first of all, thank you for having me on the show. So if you look at the overall the growth story of the Indian automotive sector, pre-GST, the growth was only about less than 2%. But after GST, the growth has really zoomed up, and the calendar year closed at about 9 to 10% growth, which means the last 4 months actually grew by more than 20%, close to 20%. And the growth continues even in the month of January. It has just gone past, and the numbers are positive. I think we'll get the final numbers in a couple of days, but the performance has been quite strong. Even in this budget, if we see the infrastructure capex spending has been increased, which is expected to support the improved road networks, better connectivity, which will help us in the cars distribution and even the after sales operations. A very small point from the advanced ruling validity, that has been increased from 3 to 5 years since we are importing CBUs. It offers us great policy predictability for long-term planning. So that's, again, a very, very big positive. And just to add, I think I was listening to you and you mentioned the stock market is going down, and I think we are not able to find out what is really happening. But if you look at the auto sector, auto companies, I think the auto index is probably one of the best performing index today, and it is actually growing. And the reason what I could read is that it is the infrastructure capex spending which is really fueling this growth, because better roads, more cars on the road, more bikes on the road, very good for the commercial vehicle industry. So I think the stock market is really giving thumbs up to whatever initiatives have been announced in this budget by our finance minister. So and there are a few more points in terms of green mobility. I think we were apprehensive because the GST on the electric vehicle is just 5% as against 40% for the bigger SUVs. There was some apprehension whether it will continue, and fortunately nothing has happened, and that's a very, very positive.
Mr. Brar, just allow us a couple of minutes with our market experts, because the market's running into a close, and if you go by the screen right now, at least today will go down as a disappointing day. Not a single sectoral index is closing in positive territory. Capital market is down 6%. The defense index is down 4.5%. PSU banks 3.5%. The metal index is down 3%. So all in all, it's turned out to be a damn squib. The Nifty, by the way, has lost. Let's put up the hot boards once again very quickly as we are running into the close. The Nifty has lost the 25,000 mark, and the close is going to be around 24,750 thereabouts. So that's the kind of market that we are in the midst of. So now, Prashant and Ashish, I want to come back to you, because investors are going to be watching this, and they've anyway been tested. They've kept the faith and kept the patience. I'm talking about local retail, right? What would be your message to them, Ashish?
The message has to be that we have spoken about the stock market volatility. I think most investors last few days have been worried about the volatility in the middle sector. And the message is that you have to keep yourself diversified. Don't chase return and just don't chase only momentum. So I think that is the lesson that is reinforced to us every few weeks, and I think last few days have seen that play out again.
But you're not really putting it out there. Lower markets ahead, or time correction flat, or what? Directionally.
See, I think I think the challenge for this year is going to continue. I think last year was a challenging year, and the challenge will continue this year as well. We haven't really seen any change in sentiment towards Indian equities now for the last 14-15 months. And I think unless that sentiment changes, it's difficult for the Indian market to perform, even if domestic flow stays robust. There is very large pipeline of IPOs ahead of us in the next few months as well. So I think the outlook for the market in the near term is going to remain challenging.
Prashant, coming to you now. I mean, and this is just Sunday done. Now we wake up tomorrow. The bell is just gone, by the way. I'll just quickly recap. Let's put up the final rates on the Nifty. 553 points lower today. That's the Nifty. The Sensex is lower by almost 1,800 points. The mid-cap index is down about 2.3%. And no surprises here. The advanced decline ratio is quite negative, of course, for the market today. Let's keep showing our hot boards as our experts speak. So, Prashant, now this is just Sunday done, imagine. And I already feel like we've been going through the whole working week, right? Tomorrow we have to react to what global markets are making of this whole Kevin wash and, dollar rising and, this huge sell-off in metals. That's the next headache now. So, what are we in for? It's been probably the worst January, and the start of February, at least the start, has been ominous, to say the least.
So generally, Surbhi, I must caveat that I'm always, whether markets are down 2-3% or up 2-3%, my view, I don't think has changed in the past basis such events, that equities remain the best asset class for a passive investor. Now, they can decide what allocation to make, but that should be a structural decision, not changing or flip-flop with such day-to-day, moves in the market. I personally remain 100% in equities. Yeah, and no precious metals, no debt, or nothing. So, I'm biased, you can say, but if you look at past such events, be it budget days, be it election outcome days, and so on, there is volatility, heightened volatility around such days. Sometimes they're up 2, 3, 5, 10%, sometimes they're down. But from next day onwards, there's no predictive power of the move on that day on future direction of the market. Just because the market's gone down 2% today did not mean that it sets a negative tone for the days to come or months or years to come. Sometimes it would set a positive. It would turn out to be positive, sometimes negative. Net, between positive and negative, post such events, the markets, if you were to do the analysis, I haven't done, but I'm very sure it would show that markets deliver double-digit return on an annualized basis, even following days like this. And that's where I would put my money, which is to stay invested in the market. No better time than right now.
Okay, all right. In the stock market and in life, we have to be optimistic, right? What else can we be? But Ashish's advice is also well taken, that maybe diversification is not a bad idea. That's what 2025 taught us. Though diversification also with care and caution, not with FOMO, because we know what FOMO leads to. We saw that overnight in silver prices, right? Thank you so much, Prashant and Ashish, for joining in and giving us some very important context on a rather important day for the stock market. I can't say enjoy your weekend or enjoy the rest of your Sunday, maybe, whatever is left of it, and we'll connect again soon. Thank you for joining in. Thank you very much. Okay, well, we've got Mr. Brar with us. I think Mr. Tarun Garg of Hyundai is also joining in the next couple of seconds. So, Mr. Brar, you made an important point, and I agree that I think the auto sector, the impetus that we've seen post those GST cuts, that remains one good story at least to speak about. Also throw in some context on the EU FTA on whether that changes anything on ground, because those duty reductions only come in for completely built up units, right? So what does it mean for consumers and for competitive intensity here in the Indian market?
Yeah, before we get on to the CPUs, the first important thing is that for at least next 18 to 24 months, nothing is going to happen, because EU has to go back to all the 24 countries, get them on board, and then get the FTA ratified. I think the earliest I expect is mid of 2027, or it can even go up to end of 27. So nothing is going to happen for the next 18 to 24 months. And when it starts to happen, yes, as you rightly said, it is going to impact CBUs, which is just about 5% of the overall industry today. It may, because there are a lot of cars which we are not able to import because the taxes are 110%. Once it gets implemented, the taxes will reduce from 110 to 40%. And that's when we will see some of these big cars coming at a lower price. And maybe this 5% can increase to 7 to 8%. But largely 90 to 92% is not going to get impacted. In fact, I expect the prices to go up over the next 2 years, because the way Indian rupee is behaving versus euro, the forex fluctuation is really putting a lot of pressure on the pricing, and we are taking while we don't want to take any price increase given the GST reduction, but the forex is really pushing us hard to take this price increase.
Okay, I think, we will get Mr. Tarun Garg in just a bit. In the meantime, we've got Jay Bala of Cash the Chaos also joining in. As we wait for Tarun to join in, Jay, what a day. Market went in with low expectations, but it's still, disappointed to say the least. What's your sense looking at the fall today?
Absolutely. You don't have much to get disappointed. If India is the promised land now, Narendra Modi wanted people to work 70 hours a week, and S.N. Subramaniam wanted people to work on a Sunday. That's coming true today. So you don't have to despair. So jokes apart, I've been pointing to the markets dropping close to 24,400 from when the markets were hitting all-time high earlier in December last year. See, once the markets drops closer to those levels, and we have seen 24,500 as a spike low today. Once markets complete 24,500 to 24,400 and slightly below that, the bull run, which I pointed out in April when people were despairing during Trump's tariff tantrum, called for record highs and to 29,000 in the Nifty. That still holds. So we just are looking for the markets to take out the low of today and then possibly bottom out and resume the uptrend that began in April 2025.
Okay. I think we also have Vinny Mehta from the Automotive Component Manufacturing Association. Vinny, thanks so much for being with us. Your quick take from a manufacturing ecosystem perspective. What were the highlights that you noted?
Well, I think first of all, from our perspective, the focus on infrastructure spend is really very, very critical. And that is something really very, very good. And I think there were quite a few specifics from an automotive sector's perspective. When you look at the allocation perspective, there is a continuation of the thrust of the government on the PME drive scheme. There's a 1,500 crore allocation there. There is focus on the PLI scheme that continues, the ACC battery PLI that continues. There is, of course, we very focused on resilient value chain. So the corridor for rare earth magnets and, of course, duties on import of critical rare earth elements that has been abolished. focus on capital goods manufacturing in the country. That's again very, very critical for the entire manufacturing segments. And of course, when we talk about the green fuels, there is some concession in terms of, the bio CNG incentive, where excise duty will not be charged on the biogas portion of the biogas blended CNG, if I may say so. And of course, there is a focus on skilling, which the entire country needs. So all in all, I would say pretty good. You cannot expect a bonanza every single year, as long as directionally it is very, very strong and it continues to build on the earlier budgets. I think we are very happy.
Mr. Brar, quick final take from you as well, sir. On the rare earths scheme that has been announced, and a couple of southern states have been kind of called out. And in any case, I mean, the drive towards Atmanirbharta on the rare earth magnet side, that's been well advertised in the past as well. What is required to make it succeed? If we could have Mr. Brar for a quick take on that. Okay, I think we don't have that line with him. But Vinny, again, that question to you as well. Announcing the scheme is fantastic, but what will make it work?
No, I think if you recall, we had a scheme that had around 7,000 crores of allocation earlier on that was announced. That was for manufacturing of rare earth magnets. And we are now going a step deeper. We are now looking at corridors to incentivize mining and refining of rare earth minerals that will go into manufacturing of rare earth magnets. So we're absolutely focused on creating a resilient value chain within the country. It's again self-reliant in that perspective, or Atmanirbharta, that we are focusing on. And I believe we should be able to get onto manufacturing of rare earth magnets in 18 months to 24 months time frame. That is the gestation period we would require. But of course, there is already some degree of mining or refining that happens in the country. And this will give boost to all the coastal states where you get the rare earth materials. Yeah.
Okay. All right, Vinny, thank you very much for that quick take on what this budget and the policy announcements overall, what they mean for the automotive sector. Thank you very much for being with us. Okay, Jay, now let's do some rapid fire on the markets. First and foremost, let's talk indices. Nifty, Bank Nifty, where are we with respect to levels now, given the fall that we've seen today?
24,800 is where we are, and I think 24,400 to 24,000 is likely to be the bottom for this correction that started from the all-time highs. The banking index is a little stronger. I would expect 57,000 to hold up.
Jay, I missed the level. Sorry. So today we've closed around 24,800. Where did you say the bottom is for this current correction?
24,400, possibly slightly below.
Just 400 points away. You're saying we're close to a bottom.
That's right. And max 24,000, not beyond that. Yeah. So that's my opinion for the moment. Likewise, banking is a little bit more stronger than Nifty. I want to expect 57,000 to get taken out. But even if that get taken out, this opinion won't change. So we are heading for 29,000 the second half of Nifty. Second half of 2026. So the 29,000 objective remains unchanged. And I would expect Nifty IT to be starting the next leg of the move. It's not yet put in a bottom, but it's very close to putting in a bottom. Nifty IT is the most unexpected quarter. So probably that's where the rally is going to come from.
Okay. Interesting. What about the massive meltdown in metals, in silver in particular? Now, that was violent. I guess those who are in the market knew that it's going to come, but I think it was a little more violent than what people anticipated. What did you make of that? Silver International, gold, and what's the recommendation now?
I was on CNBC on Tuesday. So I told them that action and reaction are equal and opposite. Remember that when it comes to precious metals, and that's exactly what happened on Friday. And the long-term trend is still up for both gold and silver, but we're going to see some terrific amount of volatility in the short term. I would expect silver to go back to something like $65 maybe even slightly below that, and gold to drop somewhere close to 3,400 to 3,100, and then resume the long-term uptrend. So, the short term is a bit volatile and it's biased to the downside, but the long term is still intact. As a market timer, I would still wait for the precious metal markets to come down there, and then I'll start putting in money there. So, I don't know what others would do. So the long-term trend is still intact, but the short-term can get volatile.
And what about the stocks? Metal stocks, brutal correction Friday and today. I mean, how much of it is done, Jay? Or is there more? What's the advice to people? I mean, either people got completely stopped out and they've exited their trades, but those who kind of built portfolio positions and who are watching the savage fall, what's your advice to them? Ferrous, non-ferrous, stocks like Hindustan Zinc, etc., which have a big exposure to silver.
Yeah, see, the Nifty Metals Index is possibly going to test the 10,000 odds level from 11,300 where it is now. And then it's still got one more leg up, in my opinion. So the long term, I've been bullish on Hindustan Copper since May 2025, and it's been the star performer here. It's gone past 700. So watch out for it. The correction's pretty similar to the COMEX Copper. It's going to be sharp. We're going to see it see a decline somewhere close to about 475, maybe slightly below 500, and then recover. So metals index as such, I would start getting bullish around the 10,000 mark. Right now, it's still trending lower. I'll wait for the correction to complete.
Okay, we've got Rohit Srivastava also joining in. He's back. Rohit, we were discussing this in the morning. Final verdict, and I'm not saying that overall, but just the quality and the nature of stocks that fell today, that make it disappointing. You've got large PSU banks, you've got the industrial names. You've got defense stocks falling, and these were the only last remaining pillars, so to speak. You were anyway telling us that, you've kind of closed out a lot of your longs already in the market. What's your sense looking at the overall screen today at the end of the day's play?
So it's not good. To me, this is the final confirmation that we have entered a bear market. In Elliott wave language, we call it a 5-wave decline. Breaking off the last week's lows has developed a 5-wave decline from the top that we made on 5th of January. And what this means is wherever this fall ends, even when you bounce back, maybe next week or in the 10 days, that bounce will only be a counter trend move. So that will only be another opportunity for people to sell into. We don't know where it will come from. So of course we need to wait first for the first bottom to occur. But like I said, this is the first signal that the bullish phase in the market is over for quite some time. And you need to be extremely careful, keep high levels of cash and wait for the right time, which could be months away. So there's no hurry now to really get back into the markets.
That's a really important statement, and it's actually an opposing view to what Jay just told us, which is fine because we need a bull and a bear to make the market. Jay was just telling us that he feels that this leg of the correction probably another 400-500 points down, and we're probably done. But Jay, were you saying that that's going to be an interim stop? Because Rohit's point is that this is the start of maybe a bear market. So just contextualize your call, saying that we're probably close to a bottom.
Rohit, from the point of view, calling it a 5-step decline, that it is a 5-step decline, and I've been anticipating a 5-step decline. And this 5-step decline is an irregular wave correction from the July highs. And it's like you said, it's a slightly differing opinion. And I think the market is the ultimate arbiter, and we can see that. So I'm still believing that the bubble that we are seeing in the US markets, even that is not popped, and it's likely to shock a lot of people. Bubbles continue longer than people anticipate, and we always have our risk managements in place. So if you go back to my December interviews, I was calling for the Nifty to drop to 24,400, and I still hold that view, and then recover to 29,000. That still remains the case.
Okay, all right. So a bull and a bear view, but Rohit, to come back to you because you are obviously very, very cautious. So, is it too early to think of short trades? Will that be too adventurous? What do? Do you just close long, stay out for a bit? And again, what are the levels which will start confirming some kind of a trade on either side?
We have many short trades open, 6 ahead of the budget, 2 added right today as the market was trading. So this is as per what we give in our research products to clients. So we have already started the short side. So there were opportunities at a stock specific level, and we are essentially chasing weakness because see, that is the process that when you're bullish, you chase strength, and when you're bearish, you chase weakness. We don't try to catch the ones that are outperforming and at the top. But there's a large fractured market where, there are a lot of stocks that have been falling for 1 month, 2 month, 3 month. And those, whenever they are pulling back to the averages or wherever to key resistance levels, we are looking at those to short. So that keeps us, in a safer place. Whenever the market bounces back, then they don't pose too much of a risk because they're already in a downtrend. So that's the approach we are taking at a, stock specific level.
Rohit, is this call extending to global markets as well? The US market itself, for all things happening between what President Trump is doing and not doing, whether he's taking over Venezuela or Greenland and so on and so forth, the US market itself hasn't really started showing any violent cracks. Just tie in what you're seeing globally as well.
Yeah. No, so here's something that is what we call as intermarket analysis. The topping process between various global markets never happens at once. That is why it's called classic. That if, we go back to classic Dow theory, Charles Dow, way back 1890, he said like when the industrials, start moving up, do the transports confirm or don't? And that led to what we call as intermarket theory. So this now happens even between different global markets. So if we compare with 2008, US peaked in October of 2007, India in Jan of 2008, and some of the commodity-led markets that continued to do well, like Australia, peaked only by maybe May or June of that year. So we had that variation, and I think the same thing is probably happening now, except with India taking the lead. It's unfortunate that India is the first market to top out. In the US market, we do see a lot of negative divergences, potential to roll over, but we haven't got meaningful cracks yet. So to that extent, Jay is right that the US market is still holding on. But we are watching it closely because the weekly indicators and all are diverging to the sell side, but we need some additional confirmation. What we've also seen is Asia do extremely well. Now, some parts of Asia have small cracks in the last 2-3 days, whether it's Indonesia, we saw a little bit of that yesterday in Taiwan. And we'll be watching whether it spreads to other parts of Asia as well, because Asia has been one of the best performing parts of the emerging market basket. Some of the markets moving up 50, 60, 80% in the last year. And that's the next thing to watch. But I think the trigger, if you really think about it, the pin here is what you saw in the commodity part of the cycle. You saw an exponential move in gold and silver. It was not that wild in other metals, not in oil. So it was not widespread, but the fast runaway move in gold and silver that extended beyond what we saw in December, put it into bubble territory. In December, if you ask me, I would have said gold is topping out only for a temporary correction. But because it went on with such ferocity, it ended up reaching cycle degree peaking process. And that means that, when everybody's gone so overboard and you start talking of things like shortages, that is usually the end of the commodity cycle. When you say there'll be no copper available, I'll say you're going to get all the copper you want. So I'm out of commodities. You shouldn't own anything in the commodity related sector. And that's the pin. That's like the first sign that the reflation that we were seeing post-COVID is coming to an end. Now that will percolate to other markets one at a time. So that's the thing to watch out for.
Oh, so it's not a cautious view, it's a bearish view, but well, you're saying it as you're seeing it. That's what you have to do. So we've taken your advice on board completely, Rohit. Thank you very much for that. Jay, quick last take with you on the markets before we talk real estate with our next guest. Now, since Jay, you're a little more optimistic, so let's give viewers both sides of the story. They can pick and choose which trade they want to follow. So Jay, now, would you buy into the weakness? I mean, look at the complete breakdown in defense stocks today. Banks, the way they are melting. I'm not even talking about capital market names like Grow and Angel One and so on and so forth. But if you're expecting the market to turn after another 500-600 points, where would you start buying?
As a market timer, I don't preempt the market. I wait for the markets to do what I'm anticipating it to do. And as I've been anticipating since December, for the market to drop to 24,400, I would wait for the markets to come there and then put in one reversal candle. And it's good that Rohit pointed out about Dow theory. In fact, first time after 2021, the Dow transports is hitting record highs along with the Dow, and that's clearly saying the granddaddy of technical analysis saying that we are in a bullish environment. And the semiconductor stocks, which has been the driver for the whole bull market since 2022, that's at record highs. Russell 2000 is at record highs. So the well, we're going to probably get a shallow dip for the US markets too, and then all of them will rise together. So I'm positive that the markets are heading for higher levels. But at your question, that will I buy now? I will not buy now. I'll wait for the correction to complete. It's got one more lower lows to come through. Once that's done, I'll probably start getting quite bullish.
Perfect combination of a bull and a bear. That's exactly what makes the market. And I don't trade, obviously, we don't trade at all. It's only good old mutual funds. But if I was listening to both of you, I'd probably be dancing close to the exit door, still dancing in the party. But maybe just keep myself a little close to the exit door, just in case, right? Thank you so much, Rohit and Jay. Very, very interesting conversation and very interesting perspectives. We hope to keep chatting in the coming days as well. Thank you for joining in. Well, as we come to our last leg of the market coverage, how can we end this conversation without talking about the other big market, which is real estate? And we have Anshuman Magazine of CBRE joining in for exactly that. Anshuman, great to connect. It's been a while. Equity markets sulking, metal markets sulking, precious metals, gold and silver are crashing. The budget, markets just not in the mood. But from a real estate perspective, what was your takeaway? And, how are you feeling? I mean, what's the mood in the realty market really? On budget day and otherwise?
Times, what happens to the market is also because expectations are really high, and it takes time to read the fine print of the budget, and it takes time to really gauge what the impact is. Overall, I'll say for the real estate sector, of course, there were some misses, but if I look at the larger picture, there were some needle movers. For example, the increase in capex on infrastructure. Anything going into infrastructure has an impact on real estate and everything. So, for example, the FM talk about tier 2, tier 3 cities. That'll make a big difference. Talked about connecting waterways and freight corridors and highways. That itself will bring in a lot of development, be it real estate and otherwise. There's a risk fund for people, developers who are putting money in infrastructure. So, and one very, important one in this budget, and I'm not sure if it got really captured or people have understood, is the REIT and InvIT structure for CPSEs. It really means if this model works, Government of India is the largest owner of real estate, land, assets, and if those can be monetized, or if they could be optimized, it can really move the needle in amount of funds which can come into the economy. A lot of these assets are non-productive and they become productive. So starting with the CPSEs, the central, government's assets, if the REIT and InvIT structure really works, it will be a big game changer. But of course, that time will tell that. But at least it will be also can be applied to many other state central government ministries and assets. The other, apart from real estate, two other areas was special economic zones, where now, because there are several special economic zones which are kind of struggling, allowing them to work in the domestic or sell to the domestic tariff areas will make a difference. Data center was another big one, where, as you know, India needs to expand its data center capacity significantly. And data centers are capital intensive, takes time to build that capacity. By giving the tax holiday till 2047, I think should encourage investments in data centers, both domestic and especially the foreign investment, because we need a lot of funds and investment to develop data centers. So, and of course, talking about another in the industrial sector, 200 legacy industrial, clusters, which needs to be, which the budget has mentioned, they'll allocate money for redevelopment, will make a big difference. So overall, some needle movers, I think some great announcements. Where the misses have been, of course, there's no talk about affordable housing. There was an expectation there'll be tax benefits both for developers and for the end user to on the taxation side in the housing. That was a complete miss. But again, if I look at focus on manufacturing, on infrastructure, data centers, and also this REIT and InvIT announcement. Of course, talking about tourism sector, and also on the services side, clustering IT, ITS services. I think all of this put together I'm quite confident will have a positive impact.
Okay, so you're saying overall the budget is likely to be positive for the sector. But typically, Anshuman, equity market sentiment always spills over to the real estate market. It always happens, right? When the equity market is buoyant, you also see the real estate market absolutely thriving, and you get those press releases, right, that sold in literally like 2 hours, all the high value premium housing. That has started cooling off, and we've seen several listed developers also admit that they're either revising their guidance, or some of them have come out and said that we may not meet our guidance as well. What X of the budget? Where is the cycle, and where are we overall? I'm talking only housing right now, residential.
Yeah. So the housing market, in certain micro markets, the prices have gone up significantly. So that will always have an impact. As the price goes up, it has got an inverse relationship to sales. But across India, it would not be like a common trend, because if you look at some of the South India cities, sales have been good. Prices have not gone up in that proportion, so they are more sustainable. There could be some clusters in North and West, and that too in micro markets in Mumbai or Gurgaon and NCR, where prices have gone up significantly since last few years. So you would see slowdown in sales there. But overall, if you look at the residential market, size of our population of 1.47 billion, if you look at overall apartment sales in the top cities in India, it's not 2.5 lakh units. It's nothing, it's very small. So like anywhere else, there will be cycles, but I feel there are still micro markets in almost all cities where the sales will continue to happen. And in certain micro markets where the prices have really shot up, there will be slowdown in sales. But overall, I don't think there'll be a major impact, because our overall numbers are still small compared to what the real demand should have been.
Okay, well, we'll see how these things play up as we go along. Interesting times and an interesting start to 2026 for sure. Anshuman, thank you for joining in and giving us your quick first take and first reaction to Budget 2026. Well, with that, we're winding down on our markets coverage of the big event. It's been a very eventful Sunday for sure. From a market perspective, disappointment yesterday. Now, is this disappointment going to linger, or is it a one-day reaction? We'll have to wait and find out. But yes, we've got the market which has ended at the lowest point of the day, and almost all parts of the market have ended lower. Nothing has been spared. So wherever the market didn't go into this event with big expectations, but there was some expectations, say, in defense. And that's where the disappointment is really showing up. Defense stocks down between 6, 7, 8, 9, in some cases 10%. Let's pull up the Nifty Defense Index. It will come up for you. It's one of the biggest casualties of the day. The other space, obviously, is banking and financials. Worries and fears around higher government borrowing. Can the government really manage its fisc? And that led to the drawdown in financial stocks, particularly into the PSU banking side. 5.5% deep gashes coming in over there. And then, of course, we have the whole global situation playing out with the crash in precious metal prices, because of which the Nifty Metals Index has continued to fall. It was down 4-5% on Friday, by the way. Another 4% today. Brutal correction playing out in the metal space. In fact, speaking of metals, it's probably a great time for me to hand over to Manisha Gupta to make sense of all the commodity cues that we got from the budget today, and even otherwise, plenty of headache for those who are investing in commodities, whether the hard commodities or futures or investing via stocks. What a couple of days in the commodity markets, Manisha.
Oh, absolutely, Sudhbi. And the only positive that we are taking from the budget today, though, is that there is no CTT. You might be, of course, reacting to those STT concerns going forward, but the commodity transaction tax, well, we haven't seen that come in, and that is a big positive. Of course, the markets will still wait for the clarity documents to understand on what this really means going forward. But yes, when you look at the global volatility that we have seen, that is something that the markets will start reacting to in the day tomorrow as well. There has been a very sharp correction in precious metals and base metals, and that perhaps would continue on Monday morning as the Asian markets open therein. But we have to take a look at the budget right now, and I want to start with agriculture here, because whether it was about high cash crops or whether it was about improving farmers' incomes, strengthening export potential, and about promoting sustainable agriculture and strategic crops are some of the headlines that we got from agriculture there. But interesting stuff clearly coming in from the high cash crops, and that is what the government has made a push for. So whether it has been about sandalwood, cocoa, coconut, cashews, pine nuts, almonds, it was all in headlines there in case of agriculture there. So joining us then is Gunjan Jain. He is the president at National Dry Fruit Council. Gunjan, hi. Finally, a budget that addresses basically all of those names there. What is your initial reaction to it?
Hi, Manisha. Thank you for the invite. And I think it's a very positive thing. We have been talking about, as the Nuts and Dry Fruit Council, we've been talking about a whole campaign of Grow in India, and we've been discussing that with our honorable government. And it's a very happy moment for us that we are taking heed to that, because of the fact that India used to be a net exporter of walnuts, and India is still the largest processor of cashew nuts in the world. But our crops were not enough to actually help all the factories give. And India became a net importer. So especially in case of walnuts, India has a crop of 30,000 tons, and India is consuming themselves about 90,000 tons. And we were at one point of time in the late 90s exporting about 20,000 tons. So I think the government's whole initiative of trying to now get it back in agriculture and get these high cash crops in will be a very welcome step, because there's a huge potential there. This is what we had our event, marquee event, Mewa, just 2 weeks back, and we had the Honorable Agriculture Minister there, and it was the same talk. Our talk was how to grow in India, how to make it big. So it's really heartening for us to see that. Same for cashew nuts. India's been importing. India produces about 8 lakh tons, but imports about 12 lakh tons of raw cashew nuts. So, and now it's getting difficult with African nations talking about having restrictions to export raw cashew nut to India because they want to make in Africa. So I think this will be a very excellent step if we are able to make in India and make India back the biggest exporter of cashew nuts that it used to be. So a very welcome step indeed.
So while of course the conversation has been across about dry fruits, but when it comes to cashews, the push or the thrust has been quite strong. Dedicated program proposed for India cashew market, whether it's production, processing, export competitiveness, and a premium global brand by 2030. Now, we've always seen government come out with these time targets, allocations, etc. When you look at the time target of 2030 and establishing India as a global brand by then, how achievable or how ambitious is that?
So I think as a global brand, India already exists. India is a global brand when it comes to cashew nuts. Everybody knows Indian quality as premium. So that is not a problem at all. I think the only thing is now we have to start working on growing. So I don't think it can be achieved all by 2030. But if we move in the right direction, yes, 5-8 years from now, there is a huge potential that will make it happen.
When we talk about the other high value crops like cocoa perhaps, and that is something that you guys have started to look into as well, almonds, walnuts, pine nuts, how are you looking at India increasing production in all of these? How feasible does that seem to you?
See, same for cocoa. India is a large net importer because India is a big consumer and a lot of foreign exchange going there. So all that can be looked at coming back into India. And same for almonds. India is a very large consumer. India is the largest consumer of almonds in the world. We are consuming about 3 lakh tons of almonds a year. So all this, even if we are able to do even 25% of our imports, if we are able to shift to this, the biggest thing is an Indian farmer, if they grow these crops, they get a lot more cash than they would by growing wheat or rice. But the only challenge, and that's what we want our honorable government to address, is that these are long gestation crops. A walnut orchard, if planted, will give you fruit in the year 6 or year 7. So we have to figure out a way how, I mean, in theory, I mean, the intent is there, but we have to figure out how to get the farmer incentivized enough how to subsidize the farmer for the first 5-6 years, so he's able to actually grow these crops, which can become perennial income for them for the next 50-60 years. Because a walnut tree, once it's planted, cashew tree, once it's planted, these are perennial crops which really keep giving you crop for the years to come, for your next generation even.
Gunjan, I can tell you that a lot of hard work has been put out by your council, and you've been able to achieve what you let out to achieve in this budget therein. Tell us on what really is the demand for dry fruits on a per annum basis, and do you see it increasing with the kind of change in health and diet and understanding of various foods that India seems to be showing?
That's exactly what is happening. This segment, the consumption of nuts and dried fruits, which are nature's health pills, and the world, India realizes it now. That's great for health. It's increasing at a CAGR of about 12 to 15%. Now, with that happening, what it is leading to is increased import bill, because we are importing a lot of that. So, I mean, if we are able to have a part of it grow in India, it will be great for the segment. So just to give you numbers, India consumption has increased from 18,000 tons to 90,000 tons in walnuts in the last 7 years. Our consumption of pistachios has increased from 9,000 tons to 40,000 tons in the last 6 years. Our consumption of almonds has been increasingly steadily at a 10%, 15% growth rate. All healthy food stuff like pumpkin seeds has increased from 200 tons at the time of COVID to about 12,000 tons now. So anything and everything in this segment, the consumption is really increasing.
Well, great market, great timing, and good news coming in from budget as well. So dry fruits is an area which really seems to be cheering on this budget. Gunjan, thank you so much for joining in with your sense onto that one. Well, from dry fruits to crypto then, and this is yet another segment which we did hear about in the budget. Not the same way Dilip Shenoy would have liked to see it though, because we did not see the taxes go down. We did not see a framework come in. What we did hear was, well, there's going to be a penalty provision now, whether it's about non-furnishing of information or furnishing inaccurate information. How are you reading this budget for the segment?
So I think, Manisha, thank you again for having me here. And given that we are always been in the midst of getting a kind of a discussion paper going, so therefore, expecting anything major in the budget to come out was perhaps, not that, realistic. But, BWA has always been supporting compliance. And if you notice that in this budget, they have actually come out with this provision that if you don't declare or make inaccurate declarations, you are liable to a per day penalty and also a fine. So this is a very important step. It's in terms of compliance, BW always and our member always request all their clients and consumers to comply with the law. But I think it's very interesting. At the same time, when they announced this, they've also announced the provision for revision of your returns. And therefore, if you revise your returns and declare it, you could comply and not really face this provision. So I think, it's a very interesting thing. There's another provision in the budget which is not too clear whether it applies, which is this, asset declaration framework which they have actually announced. But I think we'll have to read the fine print to see whether that actually is, applied to this sector or not.
Oh, I understand that. I'm assuming the next couple of days is going to be all about reading that clarity document, Mr. Shenoy. But from what we read right now and what the Indian markets have been in 2025, how would you read that? The kind of participation India has globally, the asset that has been increasing. The volatility, of course, in the last 2 or 3 days is something that we've seen across asset classes. But what's your sense for 2026 from where we stand?
So I think, this is a very, crucial part for, phase for this industry and this sector. As you rightly mentioned, there's huge volatility, and it's not really directed because of this sector, but it's linked to global clues and other happenings around, and also, in the kind of people are looking at where to invest, and currently metals, and even metals over the past few days have actually gone ups and downs, but they're looking at investing in those. So the choice of investment class and asset class is also varying. But, India is the highest adopter of this asset class, according to, the chain analysis report, and we've been that for the past 3 years. How this market will go forward and what will happen if we are in a cycle. If you currently look at the crypto index and the crypto fear index, we are around, I think, 26 or 27, which is the fear fear category. But medium and long term, I think everybody is kind of projecting that the cycle will take a turn, and we will hopefully before a few months see an upturn in this segment. I think people have to be patient, not looking at quick gains. And of course, globally regulation is looking at different aspects, and depending how fast the US regulation comes in, the US regulation has been stalled. So looking at it, it may significantly impact the market. And if it comes in, I think it will be an upward trend for the market going forward.
As you said, Mr. Shenoy, while we have seen the penalty provisions come in, a lot desired on the positive side. The framework is on, the discussion paper is on. What are the 5 top things that you would want to see come in for the segment for this year now?
Actually, Manisha, if you look at this Annexure A of the budget, that looks about this transition from education to enterprise, and all talks about building in capability and a global base for AI and emerging technologies. We hope that that blockchain would be one of these technologies included in that, because already we are the second largest manpower base in the world, and tokenization and real world asset tokenization, financial sector tokenization, or MSME build tokenization is going to take off in a big way in India. So that's the second thing that we see happening here. And the third is hopefully the discussion paper should be out, and we should have discussions on that and look at how best to actually address this. Because in addition to the trading activity, which we tend to focus on a lot, there's a lot of developer activity happening here, which is somehow also caught in the same bind. Just like the whole aspect in AI is to attract talent back. Even a lot of blockchain and virtual digital asset talent has gone to other countries, and we are contributing to their economic growth. And this is going to be an essential technology coming forward. Hopefully, the fourth point is that this sector should also be included in that, and we should find ways to get people back into India and develop projects. And the fifth thing is CDAC has a national blockchain project. I believe that when you're looking at the whole decarbonization of the economy and those models, there should be large-scale pilots and full-scale things, maybe an energy stack based on blockchain going forward. Right. So that's what I look forward to.
All right, we got something in the budget, but not on the positive side, and there's a long list really. But as Dilip Shenoy tells us that there is a discussion paper in the offing, and that is something that we'll wait for. Thank you so much, Mr. Shenoy, for joining in and for your initial comments on the budget there. Well, moving on, let's talk about the agriculture overall, and joining us to talk about that is Mr. Siraj Hussain. He's ex-Agri Secretary, Government of India. Mr. Hussain, hi, thank you so much. 3 major points is what the budget threw up when it comes to agriculture: to improve farmers' income, to strengthen export potential, and to promote sustainable agriculture. How have you read all of these 3 points, and what are your initial comments from the budget this time?
We always expect more and we get less, so that is what it is. But in any case, it is good that the Finance Minister has talked about fisheries sector, because the marine sector has suffered a lot due to imposition of 50% tariff by the US, and they have been exploring new markets. So it is good that some investment will be made by the government in improving the supply chain of fisheries and marine products. It is also good that coconut has received attention of the government, probably because of forthcoming elections in Kerala. Because last year it was Bihar, so we had Makhana. So this year we have Kerala, so we have coconut. It is good. Coconut Development Board is already there. Our coconut exports are facing tough competition from Thailand, and there is a need to upgrade the processing of coconut so that we can tap the export markets. So these 2 things are good, but what
I missed in the budget was basically a reference to crop sector and especially the horticulture sector, which has been a great success story.
Oh, yes. Mr. Hussain, you talked about livestock, dairy, poultry, focus, integrated. There's a conversation about creating a livestock FPO, an FPO that also is about fishery farmers FPOs. Are we looking at segregated FPOs for all of these segments now? And how viable or feasible is that?
Actually, most of the fisheries farmers may not be in cultivation of crops. So, it is not a bad idea to have their separate organizations. But the thing is that fisheries as a sector needs a lot of investment in creating cold chain facilities, transportation facilities, processing facilities, etc. So that kind of investment has to be supported by the government. In agriculture sector, the main thing, Manisha, is that the government support comes by way of interest subvention. In case of railways, defense, airports, etc., you have this year, for example, 12 trillion rupees allocated for that. For agriculture, that support does not come directly from the union budget. It comes in the form of interest subvention on loans from Agricultural Infrastructure Fund. So I have been writing that, our airports are now world class. Some airports are world class, but none of our APMCs is world class. So why would the government not invest in APMC in Delhi and Mumbai, for example, to make them world-class facilities?
Mr. Hussain, the other line that catches my attention is the budget talked about dedicated program to enhance farmer income and in bringing value addition by engaging youth. How are you reading it?
No, that is okay. The thing is that doubling of farmers' income has gone off the radar, so there is no mention of that. And it is good that at least one sentence has been found for farmers' income. But I think on the whole, we can say that agriculture and allied sectors have to wait for another day. And similarly for rural development, we have not found much for that also.
Mr. Hussain, I remember talking to you last time and you said not much should be expected because we will be looking at the defense budget going higher, and that's exactly what we've seen, nearly 21% of an increase from the last year there. Agri budget, when you look at that, how are you looking at the overall numbers then?
The overall numbers, there is hardly an increase, and the sad thing, which saddens me is that there is a slight decrease in the allocation for Department of Agricultural Research and Education. Now, the progress in agriculture comes from better seeds, better, practices for climate resilient technologies and so on. Whatever we have seen, the progress in whether it is rice export or whether it is maize, new seeds, hybrid seeds, whether it is horticulture, it is because of investment made by the private sector, contribution of private sector. And here the budget for Department of Agriculture Research has gone down.
Mr. Hussain, if you had to take two things positive and two things which really did not come and the sector needed it and perhaps should be worked upon, how would you rate that?
I think the positive thing is that the government, the finance minister has talked about nuts. These are the things which are never talked about. Almonds, for example.
High cash crops.
Yeah, so it is good. And I hope that some schemes will be formulated, some investment will be made, there will be talk about that. So, for example, last year, because of elections in Bihar, the government devoted a lot of time, energy, money to makhana. And I think that has done well. So, similar intervention we can see probably in almond, because our import of almond and walnut, etc. has been going up. The better off sections of society are consuming more. So I think that is a good initiative. And as far as what I am missing is, as I wrote and as I spoke to you earlier, we want direct support from the union budget for infrastructure in agriculture. We cannot depend only on interest subvention schemes.
Mr. Hussain, are you also disappointed that we did not hear anything on the oil palm mission or pulses imports or self-sufficiency in various crops?
Actually, I am happy that the economic survey has talked about these things in great detail.
So at least there is someone in the government who has really written a long chapter on all these things. So I'm sure that it is in the knowledge of finance minister, and at some point of time going forward, they will receive the attention. As you know, I have always been saying, and the economic survey acknowledges that the emphasis on ethanol is promoting maize in preference to other crops, which is not a good thing. There is, quite a lot of space devoted to this in the economic survey. I am happy about that. I would like to thank Chief Economic Advisor for that. And I hope government will take some steps to promote cultivation of protein crops rather than only the fuel crops.
My final question to you then, sir. Are you surprised that essential commodities were not spoken about, but rather we saw high value crops being talked about? Or do you think that that is where the gap was?
That is not a bad idea. Actually, high value crop farmers have been shifting to that. Horticulture crops provide higher value, higher income to farmers. Private sector has been investing. Another thing is, in 2024 budget speech, the finance minister had spoken of challenge mode of research in agriculture. We haven't heard anything about that after that. Today, in today's speech, she has talked of challenge mode in several other respects, but not about agriculture. But we must appreciate that finance minister cannot be talking about everything in the budget speech. So many of these things will follow. And Manisha, you have a bad throat, like me.
Well, that's about the weather though. But thank you so much, Mr. Hussain, as always, for joining in and with your sense or your initial comments really about the budget there. But thank you, always a pleasure speaking to you. Well, with that, it's all about commodities here, but let's also listen in to Mr. Jay Panda on his initial reactions on the budget that came in today.
Well, we have with us Mr. Bijan Panda, National Vice President of the BJP, joining us. Mr. Panda, thank you so much, and congratulations on what is being termed as a very sensible budget by many people I've spoken to today. But first things first, the markets have been in a tizzy since the budget was announced. They were volatile even in the morning before the budget announcement. And I was speaking to an active market player who was saying that the government can show us some love. It's always tough love that they show us. हमेशा ही डंडा दिखाते हैं, कभी प्यार नहीं दिखाते. So, any specific reason behind this, Mr. Panda? Why did we see the revision in STT on futures and options? Is there a reason why the markets are feeling sidelined at the moment?
Markets are very short-term oriented. They look at day-to-day issues, and perhaps some had been looking for some kind of SOPs. But let me tell you, the changes that have been brought about will have a hugely positive impact on the economy, which will inevitably translate into the markets picking up. Let me give you the example of how the exact same thing happened. If you remember during COVID times, when other countries were throwing money left, right, and center, the Modi government was very clear that its expenditure had to be focused and targeted at the poor and the vulnerable. And markets at that time also had a similar reaction that if US is throwing money, others are throwing. See, what is the end result? The end result is today, we have arguably the best performing large economy in the world. It is the fastest growing for many, many years now. It also has the lowest inflation, and it has huge amounts of job creation and huge amount of numbers of people being pulled out of poverty. And let me sum it up by saying, look at the fiscal deficit. I must compliment the finance minister for meeting the targets year after year, and this year it has come down below 4.5%. Now remember, this is when the US fiscal deficit is more than 50% higher than India's. Look at the debt to GDP ratio. India at 55% is phenomenal when you compare that, usually well-managed countries like Japan, US, UK, Singapore are all heavily indebted and not able to make the investments necessary for their infrastructure and for their growth. And despite this, Nirmala ji has committed to bringing down the fiscal deficit further next year and to bringing down the debt to GDP ratio to 50%. So keep in mind, all of this kind of focused developmental oriented budgets over the years have led India to become the best performing large economy in the world. And so let us not worry about the market's immediate reaction. I'm willing to bet with you that a few weeks and months down the road, the markets will recognize the value of the long-term benefits of this budget and react appropriately.
Interesting. Interesting that you say that. The economists, of course, are happy looking at the macro numbers. Also, one of the
Precisely.
you're right, and one of the things that this government has done has been to bring in a lot of transparency in the way the macro numbers have been put in the budget, and overall in the calculations there are no off-budget borrowings and all of that. I wanted to talk to you about when you look at the budget, you see a lot of good things in the budget. I started off by saying looks like a very sensible budget. You're focusing on future-ready sectors. Execution will be key, Mr. Panda, and I think that's where the focus will have to come from the government and all the other stakeholders involved. I just wanted to get a sense from you on, what is the thinking in the government on the execution front? Because we've seen even in the past that, the intent is there, but it's where the execution, when execution comes into play, that's where we tend to falter a bit.
So I think you are asking a very important question. And it harks back to the bad old days before the Modi government, when people used to talk about how there were so many outlays, but the outcomes were not up to par. Now, if you look at the Prime Minister's track record of his time as a head of government, take all the way back to Gujarat, and now for 12 years as the head of the national government, it is precisely because the execution and the implementation has been on target that India has become the fastest growing large economy. That is precisely why we have tamed inflation. This is precisely why 250 million people have been pulled out of poverty. And this is precisely why, because we have doubled the number of airports in just a decade. Whatever had been achieved in the previous 70 years, or 75 years was been doubled in just one decade. If you look at the roads and the highways, if you look at all other kinds of infrastructure, the track record is there for execution on target. So I think that's a valid question that you are asking. And this is why I'm exuding optimism. Now look at job creation. For decades, we used to have these targets of job creation, which used to be missed. Whereas in recent years, we have been meeting the job creation targets. Our auto industry has become the third largest in the world. Now look at you talked about future ready. Now, straight off the bat, I can think of some 3 million jobs that are going to be created by the targeted efforts and outlays of this budget. So you've got lakhs of healthcare professionals, you've got caregivers, you've got tech professionals in animation, gaming, and related areas for which very specific outlays are going to be made. And you're going to see these job creation. Then the tourism, the infrastructure. Look at the 7 high-speed rail corridors. So after our first high-speed rail in connecting Gujarat to Maharashtra, now you're having them all across the country. It's a phenomenal commitment to shifting the gears to even a faster rate of growth.
So 3 million jobs, that's what you're saying will be...
I just added up 2.8 million jobs as follows. 1 lakh in AHPs, that is healthcare professionals, 1.5 lakhs in caregivers, 2 million job potential in animation, gaming, etc. These are just some of the specific numbers targeted with specific amounts targeted for facilitating these job creation. But the unnamed or the unspecified numbers, for example, when these 7 high-speed rail corridors are built, connecting large numbers of states, it's like building an airport along each stop. And you can imagine the numbers of jobs that will be created across the country by that alone. If you look at the other tourism-related efforts that are being made, tourism is the highest job creator of any sector. And actually, I was just giving you the 3 million as something very specific, targeted, but actually it's going to be, order of magnitude higher than that, tens of times more than that.
So there's one thing that one notices in this budget is a lot of focus on nurturing a services-led economy. Until now, we've really laid a lot of emphasis on manufacturing-led growth. We've had PLIs and so on. But this time around, what I see is that there's a lot of emphasis on capitalizing on India's services-led growth. Is that a formal strategy that the government is working with?
If you think about it, for many years before the Modi government, India seemed to have given up on manufacturing, and services were something that were organically growing. For example, the IT sector grew, as many people have written, not because the previous governments were nurturing it, but because the previous government had not noticed it. Wherever the previous governments had noticed something and got interested, they ruined that sector, such as steel from the 1950s onwards. But what the Modi government did in the first few years of its last 12 years has shown that India can be a manufacturing superpower. I gave you the example of the auto industry, now third largest in the world. If you look at homemade defense industry, the Atmanirbhar Bharat thrust, there's lots happening. If you look at the startup sector, there are lots not just in IT, but also in manufacturing. Now, having said that, clearly, we have a huge strength in the services sector. India has become the back office to the world. India has become a powerhouse in IT-enabled services. So obviously, we should take advantage of that and leverage it. So this budget really targets taking advantage, because you needed to have reached a certain level before you can scale up. And that scaling up is happening today in services in a very big way.
Also, this tax holiday that the government will offer to global companies to come and set up data centers here, I think that's got huge implications for India in a very good way, whether it's skills, whether it's jobs.
If you think about it, this is related to a variety of issues. One of the issues that has been sort of a sticking point in discussions with many other nations is data security and privacy, where on one hand we have been looking to protect the data of Indians from being misused, and many other countries resisting, saying that data has to flow freely. Now here you're killing two birds with one stone. With this particular policy initiative, India is a huge market. It is either the largest, second largest market for many of the major IT companies in terms of subscribers, in terms of customers, in terms of scale, because of their India business flourishing, whereas they are doing badly in other parts of the world. So with such a heavy consumption of data, today, broadband has become available at every panchayat center, now every village. So this inducement to investors to bring data centers and cloud services to India solves many of those issues, and it creates another big boost to our economic growth.
When do you see? Yeah, is there an estimate on the timelines, Mr. Panda? Is there? Have we been getting a lot of interest from other countries and companies? Would you have any details on that, like in terms of the timelines that we could look and we could work with on, getting GCCs and more GCCs and companies to come and set up here? Any number that, we can work with?
Look, if you're talking specifically about this last topic regarding cloud computing and data centers, even without this policy decision, many had been setting up in India, including Indian companies, and some international companies have been looking at it. Now this makes it a no-brainer. It makes it a no-brainer to set up data centers and cloud services in India. I would imagine there will be a scramble to be the first and the second mover. And if there isn't, those who don't, they will miss out in a very big way. So I would, my expectation is we will see traction on this front very, very quickly. Okay. But in terms of otherwise investment, India continues to rake in the investment, whereas other countries, our peers in mid-income countries as well as developed countries, they're either stagnating or faltering.
My last question, Mr. Panda, is that the middle class, the salaried class, we're always expecting tax cuts, but there weren't any this time around. So what can the middle class hope for, from this budget?
Last time there was a very fundamental shift with the massive upward shift of the floor for taxation to 12 lakh rupees. Now, since then, the focus has been on tax reform. And I'm particularly grateful to the Finance Minister and the Prime Minister for having implemented the new income tax bill, which I had the privilege of chairing the select committee, which had presented reforms. Now, the simplicity and the ease of use of the tax system was a key criteria. And you've noticed that the FM has mentioned that the notification of the new Income Tax Act will be on schedule in April as had been planned. And also the new easy forms make life a lot easier. And also the many other policy decisions taken which make life easier, the decriminalization of a whole host of minor errors, the ease of living index in India, and for the huge number of taxpayers approaching 100 million people is going to be enormously beneficial. So there's major changes. If you talk to taxpayers now and you talk to taxpayers in 6 months' time, you will see the fundamental shift in it becomes a lot more easy to be a genuine taxpayer.
All right. Thank you so much for that, Mr. Panda. We really appreciate you joining us to break down the budget for us. And we'll, of course, come back to you with more questions on the markets, maybe a few months from now, to see whether the market sentiment has turned or not. Thank you so much.
Thank you.
Hello and a very warm welcome to our continuing coverage on the budget right here on Moneycontrol. We've been getting you all the analysis, all the insights on the budget that was presented by Ms. Sitharaman just a short while ago. Well, just to quickly take you through the numbers, the budget is projecting a 7% GDP growth. The highest ever infrastructure spend at 12.2 lakh crore has been allocated. There's a tax holiday for foreign companies to come and set up data centers in India. A massive skilling push towards healthcare professionals. There's been an announcement of rare earth minerals corridors. The budget pretty much ticks all the right boxes when it comes to making India future ready. I was talking to someone who was saying that, better late than never, der aaye darust aaye. At least we've made some progress in, embracing AI and nurturing innovation. However, having said that, even with the macro stability that Ms. Sitharaman has brought to the budget and to the country, the equity markets have not reacted very kindly to the budget, but then that's not new. Markets are rarely happy with what the finance minister has presented over the last few years. Well, to understand and to decode what this budget means for us, what does it mean for India as a country, where are we headed from here, the big signals coming out. I have with me a power-packed panel, and right here with me I have in the studio Gaurav Chaudhary, consulting editor with Network 18, and we have Saket Mishra, a banker, joining us with all the insights. Gaurav, very quickly, the one thing that stands out for you in this budget?
I think, well, on the positive side, I think the fiscal consolidation, she has demonstrated, the finance minister has demonstrated the government's intent to walk the talk regardless. So this has been flagged and underlined as a non-negotiable glide path, something that the government is not going to deviate from. Since last year, we have moved from the fiscal deficit being as the single most metric for determining the fiscal of the fiscal policy architecture, but we have moved on, pivoted to a new fiscal policy architecture where debt to GDP ratio is going to be the primary marker. And over time, as was established in the last fiscal policy during the budget last time, by 2031 the government intends to bring down central government debt to less than 50% of GDP plus minus 1%. It looks on course because for FY27 the debt GDP ratio has been fixed at 55.6%. It's lower than 56.1% of the current year. Right. And fiscal deficit, of course, has been projected to come down from 4.4% estimated this year to 4.3% next year. What, however, has gone up is, of course, the government's gross borrowing from about 14.9 lakh crore to 17 lakh crore, which is one of the reasons that has spooked the markets, besides, of course, what the announcement has happened on the securities transaction tax front.
Right. So the markets today have had their biggest budget day fall in 6 years. Sensex ended about 1,550 points lower. Nifty was below 24,850, and about 11 lakh crore mid-cap has been wiped out. Saket, when you see this, when you see these numbers, do you think the markets are overreacting? I'd spoken with Mr. Bijen Panda a little while ago, and he did say that the markets will come around and that they really have no reason to be reacting the way they are reacting.
Absolutely. Look, I mean, I don't think this is a reaction to the budget per se. The signs of global markets on Friday were very soft indeed. So therefore, I think it's a mixed bag. The steps that we've had in the budget in terms of key priority areas, and I think, building on Gaurav's point, what we have today is a focused budget. So wherever she wanted to make an intervention, she's made an intervention and allocated resources to it. So which is a good thing versus sort of woolly schemes all over the place. So I'm sure the markets will come back to whatever is the right place. This budget is a long-term directional budget, and I think in that sense it's a good solid budget, remains disciplined, and I'm very sanguine about the markets.
Okay, all right. We also have Mr. Amitabh Kant joining us. Mr. Kant, thank you so much. You have been, part of the policy making, part of budget making even. What advice are you going to be giving to your clients after this budget on whether they should come into the country and invest or not?
I think it's a very fiscally prudent budget. It's we are in the midst of great global turmoil. There's huge disruption taking place across the world, and global supply chains are broken. And in the midst of all this, it's very important that we remain fiscally responsible. To have brought down the fiscal deficit down to 4.3%, and to have brought down the debt to GDP ratio to 55.6%, while taking up the infrastructure spend to 12.2 lakh crore, which in effect means 4.4% of your effective of your GDP. That to my mind is the right course to be taken. The budget also focuses a lot on manufacturing and infrastructure, and in the long run, these have multiplier impacts for both growth and for jobs. And therefore, my view is that the budget needs to be looked at from a long-term perspective, needs to be looked at India in the midst of a global turmoil. Budget needs to be looked at in terms of how it's handling the issue of Trumpian tariff, since the budget focuses on sectors like textile, footwear, and leather, as well as marine sector, which have implications for jobs. And it focuses on, to my mind, this focus on cities, which will be the tier 2 tier cities, and connecting the 7 high-speed corridors, which will connect it, will eventually give a big thrust and drive to urbanization, which will be critical. So I think we need to take a long-term perspective on this budget. It's a budget which is on course for Viksit Bharat in 2047, and which really is a continuation to what it's a budget of great continuity.
Right. Mr. Kant, as someone who has been intrinsically linked to India's policy making, you have been behind several very landmark policy initiatives of India. I want to ask you, like I said, this budget ticks all the boxes. It talks about good things, but execution will remain key in this. Mr. Kant, what advice would you like to give to the government where execution is concerned? Because in the past also we've seen that there has been intent, but when it comes to execution, we tend to fall short on that. Somewhere, we are not able to just get it together and push things through unless they are done in mission mode, like you have implemented some marquee projects of the government. What advice would you like to give to the Modi government now on the execution piece of the puzzle?
I'd only say that execution is the key and critical thing, because many of you would recall that there was 1 lakh crores for cities announced in the budget last year, which has not yet been implemented. And you have a scheme for cities this year, and you have the high-speed corridors. You would also recall that the dedicated freight corridors were implemented by railways with a lag of almost a decade. You will also realize that high-speed corridor is running late, very substantially late, and therefore implementation and whatever we do must be to world-class standards. Nothing should be second class. This requires huge amount of planning. This requires a great amount of detailing. This requires working with the best project managers in the world, and whatever we do should be world-class.
Yeah, you're absolutely right about that, because, I remember when we had heard announcements of smart cities. And now when you go to those smart cities, they still look like urban slums. Let me bring in Saket and Gaurav here. Going forward from here, so that was the whole idea behind this budget, that the long-term vision for India, where India is headed next, would be set. And that's the story that we did yesterday, and that's a story that we got from, that's what we picked up from sources in the government. So what is the vision that you see coming from this budget speech? What's the big idea in this budget?
See, the big idea is that the government is not going to go for come under any kind of pressure for incrementalism. There are certain programs that have been announced in this budget, particularly the focus on tier 2 and tier 3 cities. Urbanization is going to be one of India's one of the strongest edifices of India growth story, particularly in newer, currently smaller towns, and that's going to pick pace. And once that picks pace, as Mr. Khan said, that if execution is actually accelerated, urbanization projects is going to unleash its own multiplier effects, and that's going to have economy-wide benefits. However, I have a feeling that the real boost to consumption spending and some kind of a stimulus of sorts is going to come next year when the pay commission payouts are given, because it's going to hit with areas effective from January 1, 2026, and that's going to hit people's banks sometime in CY calendar year 27. That is when a lot of money will actually come into people's hands, and state governments, taking a cue from centre, as we have seen previously also, will also execute similar or announce similar commissions for their own employees. Government employees constitute a large chunk of India's salaried middle class. Once their spending ability goes up, that will have a significant stimulus effect on the consumption sphere.
Right. Let me also bring in Mr. Kant, who's standing by. Mr. Kant, I wanted to get your thoughts in on the tax holiday that the government has announced for foreign companies looking at setting up data centers in India. What the FM announced was 100% tax exemption for data centers until 2047, Viksit Bharat. How specifically can this transition help India's transition into an AI-driven economy? How are you reading into this, and what will we really need to do to ensure that the companies actually come? Because we've announced this tax holiday, but then I'm sure there's a lot of process reforms that probably need to be brought about to make this happen.
Well, to my mind, this is the smartest move in the budget. Because worldwide, 75% of the global investments that are taking place in the field of artificial intelligence. And if you are able to provide this tax exemption in 2047, which the FM has done, this would mean that you will be able to get cloud infrastructure, you will be able to get AI models, you will be able to use the Indian data and the Indian talent to do world-class AI from India. And this is path-breaking because almost 70 billion worth of data centers have already been announced in Vizag, in one city. And you will have many more data centers, and India can really be the center of of driving AI and data centers and cloud infrastructure with a lot of computing power from India for the free world. And this has huge ramifications. Only thing we have to take care of that it should be driven by good renewable energy with SMR, nuclear, small modular reactors as the base, and we'll have to upgrade our grid. So transmission and grid will be very critical. It's the play of battery storage, it's the play of transmission grid, it's the play of cutting edge technology in power supply as well, and a play of great renewables. But it's a smart move.
Gaurav, you had a question.
No, I had a point to make. I'll just, reinforcing what Mr. Kant said. Data centers are the is the heart of artificial intelligence. Artificial intelligence, that's the fuel, and the fuel for data centers is uninterrupted power supply. I think we have a great natural advantage there. It's for us to exploit and take advantage, particularly in states like, as an example, I'm saying states like Rajasthan. Rajasthan has about 325 days of sunny days during a year, and that's a natural advantage that very few countries or very few geographies are actually can enjoy of. There is a great opportunity to create geographies within India, clusters within India, as solar capitals of the world, on the lines with a massive scale, of course, on the lines of what Netherlands is to wind power. I think we have an opportunity there, and if we can create uninterrupted power supply, very reliable, high quality, I think data centers will come towards India.
So there's a lot of work that we need to do on that. Sakit, if I could request you to come in here. You have, advocated for shifting from the jugaad mindset that we have to a more R&D and an innovation-led economy. Are you happy with what you see on that front in this budget? Do you think that we are nurturing and creating an ecosystem for innovation?
I am absolutely happy, actually. So, if I break up this budget into three parts, one part is what you all have discussed just now, improving living, urban centers, etc. Second part is we have actually looked at providing employment through healthcare and education cities, etc. Third part is where I think the big difference, whether it's in terms of the benefits that have been provided to biopharma or to artificial intelligence or to semiconductor, what we're doing is creating something that's fit for purpose for the future. Now it's up to us finally to decide, once the data centers are there, how we use the data from within the country to actually create something. And the second part of that jugaad economy that needs to be changed was to actually start looking at something beyond. So consumer demand as a driver was always a jugaad. Long-term growth requires investment, and I think what the government has done is, the third part is, it will continue to invest selectively in particular sectors where they will supplement or complement private sector investments and drive the economy for the future in a more sustainable manner. Because that, your consumer demand, is another 3 months. I mean, you can only buy X number of TVs. While if you are actually investing in the future, in R&D, so the R&D part the government's going to do, the real investment hopefully in terms of manufacturing, in terms of other products, will come from the private sector, and therefore I think that movement is exactly what we require.
Okay, let me quickly bring in Mr. Kant on this. Mr. Kant, do you think the budget does enough to get the private sector back in terms of, we're seeing the highest ever allocation for capital expenditure? Would that be enough to get the private sector excited and come back, or as they say, unleashing the animal spirits, as it were?
So the government has done its bit by putting resources into capex spend over the last few years. My view is that long-term growth of India has to be driven by Indian private sector. It needs, you would recall that a couple of years back, we reduced the corporate tax, 1 lakh 45,000 crores were given away to the private sector, and their balance sheet is booming. I think we need, in the long term, the challenge for India is really to grow at 8 to 9% per annum over the next 22 years to be a Viksit Bharat by 2047. That can't be done on the back of public spending. The public spending has already reached its peak. You need private sector to drive India's growth story in the long run. My view is that we need to get private sector back into infrastructure. My view is that we need to do a little more on the consumption story, a little more, and we need to get foreign direct investment back in a very, very big way. And we need to promote and market India far more in a far more comprehensive manner.
Yeah, absolutely. So will the FPIs and the FIIs buy the India story that's been put out today by the finance minister? We've seen a very transparent accounting out there. We've seen macro stability. We've seen just the right, policies to push investment. But will the FPIs and FIIs buy the story? Saket, what's your sense?
Look, I think the FPI and FII investments are primarily short term. So they'll be always comparing it vis-a-vis, let's say, US dollar returns, what's the risk premium in India. Where I think this budget moves the meter is in terms of FDI investment, because if we are able to offer predictability, for instance, the tax predictability on things like data center, that's when people are taking a 30-year view, 40-year view on investing in India will actually start to look at putting money in. And this kind of certainty we are offering is also, it also helps to contrast sort of to some extent cushion the impact of this repeated claim of going back on taxes and making rules that are not predictable. And it's Vodafone was an albatross around our neck for I'd say almost 20 years, and the recent judgment has also created a similar sort of noise. Right. So what this does is, I think it's a much more FDI oriented budget rather than a short term stock market budget.
All right. I think that's heartening to hear, while I'm sure the market watchers are not very happy. But yeah, it's a long-term budget. That's what Saket Mishra is telling us. With that, thank you so much, Mr. Kant, for joining in. Really appreciate you taking up the time and, explaining what this budget means for the India manufacturing story. I have with me now Aditi Nair, who is joining us from ICRA. We also have Deepti Deshpande from CRISIL, and we have Rishi Agarwal from RecTech team leads. Rishi, of course, has done a lot of work on ease of business and ease of compliances. First up, coming to you, Aditi, if you were to rate this budget on 10, how much would you give it?
Rating agency economists to give a rating to a budget is not a very good idea. So let me just talk about what I liked and what really stood out for me in the budget. So firstly, in terms of the fiscal deficit, very much in line with what we were expecting, sticking to the 4.4% for the current year and bringing it down to 4.3% for next year. I think most of the revenue assumptions are quite realistic. Maybe a little bit of a quibble we have with things like the excise duty growth penciled in for next year. In terms of the borrowing number, I think there's a bit of confusion. While the net borrowing number is looking lower than what we had expected, on the gross market borrowings, I think there's a little bit of confusion as to why the number is higher than what was being expected. However, I think that there is a palliative in the form of the small savings figures, which we think are going to beat the revised estimate for FY26, and therefore there should be more cash that the government will carry into FY27 that may help to actually bring down the borrowing number. So I think that's, on the fiscal side, those are some of the sort of highlights. And on expenditure, CapEx, the number is a little lower than what I would have liked, but there's a lot of money which has actually been put for the grants in aid for capital assets. And even the increase in the capex, a lot of it is going into the capex loan, the 50-year interest-free capex loan for the state governments, and union territories have also been added. So actually, the onus of actually doing the heavy lifting on the additional capex is moving quite a bit to the states in this budget from remaining with the government of India. Now, that's very interesting because it broadens the scope in terms of what kind of capex can actually be undertaken. But then you have to make sure that the states actually are able to do that heavy lifting going ahead.
Absolutely. Let me also bring in Deepti. Deepti, we saw a budget which the economists and several people we've been speaking with are saying that on the macro front, it's looking good. I want to get your thoughts in on this. We spoke about how states might have to drive a lot of capex as well, and you've been talking about the fiscal indiscipline of states. Do you think the budget addresses that issue somewhat?
Yeah, I think to some extent, I think it's got a lot to do with, supporting the entire environment and how states will perform here on. To me, I believe there are three things which clearly stand out. The budget clearly resisted any temptation to push growth higher this fiscal or even firefight the global situation immediately. And I think that's important because we've got the macro house in order, and that gives us space enough to look beyond the short term growth compulsions. So it's clearly guided by long term growth objectives and motives. And I think the Finance Commission report that has come alongside and has been taken into consideration ensures that the states now have a bigger role to play, with a lot more now going from the center to the states. The second thing which I want to really highlight is I also looked at the last couple of years' budget, and interestingly, what comes out is there's a clear progression in the government's priorities. I mean, a couple of years back, we were talking about the primary infra focus, the spending, the outlays, etc. And like how Mr. Kant was also talking about a little while ago, we probably hit a place where we want more, stakeholders to really come in. So the reforms that we've seen in the last 2 to 3 budgets are now such that they can absorb this infra build out. And I think that's what's required. This budget to me is a way to strengthen competitiveness in manufacturing and services. So it's a gradual transition from ensuring that only public is investing to ensuring that every other stakeholder, be it states, be it private sector, etc., is coming in. And what's encouraging is that all of this is really happening without disturbing the fiscal cart. So the mild reduction in fiscal deficit is appreciated. We wouldn't have been very happy if fiscal deficit was significantly brought down. We are still continuing on the fiscal path. There is no capex compromise. There's an improved, expenditure mix. You see fertilizer, food subsidies axed a little bit, and you see a lot more capex going through, roads, power, also states like I mentioned, and a number of affordable housing, all of that. So the goal post shift has accorded us this discretion. The macro situation being stable has allowed us to, for a change, look beyond the next upcoming year in particular and onto longer term objectives.
Right. Let me bring Rishi Agarwal in on this conversation. Rishi, you and I were chatting before the budget, and you said that there's been so much focus and talk about decriminalization and simplification of procedures, and that you would like to see a budgetary allocation towards all of this, because talk is not enough. You need funds to support things. So now that the budget has been presented, you've gone through the documents, are you happy with what you're seeing on the simplification front?
Sure, Shweta, well, thank you for having me on the show. If you're looking for a flashy Big Bang headline from the budget, you're probably going to be disappointed. But here's the thing. While the headlines might feel quiet, the trenches are incredibly busy. And I'm happy that Finance Minister is choosing boring, persistent, and reform over a dramatic policy theater. What we are seeing right now, Shweta, is policy continuity, and that's what I'm very happy about. The government is moving away from a rhetoric and doing deep work required for the long haul. So if you look at the last few months, the cumulative impact of these reforms is actually quite massive. And I'm glad that the budget has signaled the continuity for ease of doing business in the country. I mean, take Income Tax Act of 2025. We finally retired the 64-year-old relic from the 1961. Starting this April, literally half its size, down from about 800 sections to about 500 odd sections, written in plain English to stop, endless cycle of litigation, is going live. Then there's GST 2.0. We finally moved towards a 2-slab dream. We've simplified it to 5 and 18% bracket, removing so much confusion. That happened. Then came the labor codes on 21st of November. I'm glad that happened. And 29.
So we know of all that, Rishi. We know of all that. We know about the labor codes. We know about the GST. I want to ask you about the ease of compliances. The recommendations that you all had made, have they been accepted? Do we see them in the budget?
Yes, I mean, a lot of them, as I said, is in the trenches. No headlines. We hear about so many announcements around decriminalization, reducing hostility, deeply embedded in the business laws. There's continuity of thinking around deregulation. There's a 10,000 crore MSME fund focused around growth. Shweta, you and I were talking about India having only 260,000 factories, 1 in 5 factories having more than 100 employees. And that all comes down to deeply entrenched regulatory cholesterol that ails our system. And a lot of work that is currently being done, even before the budget and budget providing continuity, is all movement in that direction. 10,000 crore MSME growth fund is specially designed to turn small businesses into future champions. The customs overhaul, moving to a warehouse operator-centric system, is all about trust. So it's probably not a headline budget, but it sets the foundation for long-term growth.
Okay, let's bring in Dr. Rajiv Kumar, who's joining us from Pehle India Foundation. But earlier he was with the Vice Chairperson of Niti Aayog, so very much in the trenches. Dr. Kumar, thank you so much for taking out the time to join us. How are you reading into this budget, Dr. Kumar? What's the one thing that stood out for you? Everyone's calling it not a headline budget, but it's a sensible budget. Markets are very unhappy with it. However, it ticks the right boxes. How are you looking at it?
Shweta, quite honestly, I was hoping that this budget will actually do something substantial to build up the private sector investment. Because the private sector investment has been weak. The gross capital formation ratio to GDP has been weak, going down. And I think however much you may hike up the public capex, you can't do without private sector growth, investment growth. And I think there I'm honestly a bit disappointed because maybe these are not budget items where but the sort of statement to say that the government is focusing on examining and identifying why the private sector growth has been weak or why there has been a capital outflow from the country, which is quite significant, so that the net FDI is negative. I think that is something that would have cheered the market, that would have cheered the investors. And I think in the absence of that, you find the market disappointed. So that's my take from the budget.
Gaurav, we were talking about this, that the budget, while it's something that it has something for everyone, that it does, but overarchingly speaking, as Dr. Kumar has pointed out, does it give the private sector a push? Does it give that nudge that the sector has been waiting in the sidelines for, to start investing? The last budget was a very consumption focused budget. This time around, when we speak to people within the government, they say that not every budget needs to be a consumption focused budget, and that there will be a spillover effect of all the reforms that we've seen in the last 1 year, and that consumption is picking up. The Eco Survey also talks about it. What according to you, and this is a question for both of you, what according to you could the FM have done differently to get the private sector excited about investing?
So one of the things that the FM could have done to actually hike the capex even more, public sector, because the government has been doing the heavy lifting on capital expenditure over the last few years, and we have seen that double-digit growth in capital expenditure year on year is a very good direction to have. But having said that, it hasn't really crowded in private investment as was anticipated over the last 2 years. Even this year too, it has a private sector investment or private sector capital expenditure in terms of adding additional capacity lines or creating new greenfield capacities have not really crowded in, despite the government public expenditure, capital expenditure on several infrastructure projects. So what the government could have done, in the absence of private sector investment in capital investment, the government should have actually there was an opportunity to increase it even more, even if it probably would have resulted in a little bit of more slippage on the fiscal deficit front. I think that was quite, in my view, that is a risk, a fiscal risk that the government, that the finance minister should have taken, because if a trade-off has to be made between more capital expenditure and accelerating investment in infrastructure projects to actually crowd in more private sector investment, then a little bit of slippage on the fiscal deficit front probably could have been made. On that front, I think there is something that the government probably would have missed an opportunity there. The other thing that there are a couple of known unknowns there, and it's that those assumptions could be tested as we move along, particularly as early as this month itself, in the last week. One would not know whether the nominal GDP growth rate of 10% that has been assumed is according to the new base. The new GDP base here will come in, will be announced in the last week of this month. Are the budget estimates going to be changed in wake of the new data? That is something that needs to be taken into consideration. If that, and we have seen last year also, the nominal GDP growth in the last budget was budgeted at 10.1%, but the advance estimates in January showed that nominal GDP has actually slowed down to 8%. If that is the case, then if nominal GDP actually doesn't hold according to assumptions, because that's a function of several things, including what's happening geopolitically, also on our export front, and how consumption, household spending grows. All of that, if it doesn't add up, then the budget numbers could actually go a little awry.
Okay, all right. Saket, your thoughts on this?
So first of all, I'm perhaps quite lonely in the thing, on the side of saying that I don't think fiscal deficit is so important. If we did 0.2 or 0.3 more, as long as we're using it productively, and that to my mind is the key thing, I'm perfectly fine with a higher fiscal deficit. In terms of difference, I think I would have sought a bit more innovation. So for example, if you're putting 100 rupees into a single project, one option could be that we divide that 100 up into 10 different AI projects where we involve the private sector, and we say, guess what, this is the problem statement that you have. Now go out and do the research and set up the capex to actually, where we will give you 10 rupees of support from the budget, and find something new, because what that does is it gets that 10 rupees going to a TCS or going to a good pharma company trying to do research will create something that will get us ahead of everybody else for the next 5 or 10 years. And it sets in motion, I mean, the leverage effect of that versus, let's say, one big project or one another road which is status quo, right? It's just incremental. I think we could have sought a slightly more innovative way of crowding in or pulling in the private sector by getting them involved in this entire new economy push.
Right. No, but Aditi, to bring you in on this, and also Dr. Kumar, now if we see a lot of the initiatives that have been launched, right, you've got this whole tax-free invitation to all the companies to come and set shop in India and set up data centers. You've got a scheme for biopharma. So there is a push. We've seen in the last few budgets, we've seen production-linked incentive schemes that have been given a lot of push. Then we've seen the tax rates rationalization. So somewhere does one get a sense that the private sector also needs to take on the baton, as it were, because I think there is only so much that the government can also do. It's become a bit like a chicken and egg situation, because the private sector says that there isn't enough demand and we'll respond to demand, but then if they expand capacity, they create jobs, and that's how demand will get created. So it's a tough one. It's a tightrope walk. Dr. Kumar, can I get your thoughts in on this first?
Entry for all the data center people up to 20. The good thing is that it's been announced up to 2047. So that's a long-term thing, and there's a good certainty there. But data centers also require huge amount of energy, and they will require huge amounts of green energy here. Nothing in the budget to tell us that that's what's going to happen. So then that's something that will hopefully come later. On the private sector taking up the baton, that there are some sectors in which private sector gets interested. One, for example, is real estate. and therefore, the low-cost housing, workers' housing, middle-class housing could have been incentivized to say that, look, this is what this is what the builders will get. If I don't know if there are problems with RERA, but there are, then that could have been sorted out. Look for sectors in which the private sector will expand capacity. Real estate is one. Textiles and garments is the other. So there is a announcement of a 5-part integral textile sort of package, but and a mega industrial park. But then the thing would be in the execution of that. How long? How will that happen? Then again, as I think Saket was saying, that you can leverage your money to get the private sector going ahead on different sectors. Yes, and there's one announcement in which the finance minister said that the government will work with the private sector, to get the, I think this, I forget in which area it was. That's a sort of public-private partnership that we want to achieve. Now, the last bit is that, we need to bring disinvestment back on the table. We need to bring back asset monetization on the table. Revenue deficit is still 1.5%. And revenue deficit means that the government continues to borrow to spend on consumption. Now that's not healthy. So therefore nobody talks about these things. But I think it is important to talk about these things, because that's the move towards a healthy budget. So fiscal deficit is one number, but revenue deficit, I think, is another one. So therefore overall, again, as I said earlier, I would have expected a greater focus on incentivizing the private sector. How does this government come out and say, we are in support of the private sector, and let them do what they can do, and we will support them, in every area, whether it's exports or real estate, or R&D. I've not seen that announcement, and I think it's time, with Prime Minister Modi having said this long time ago, that if you're going to do, if the government does not have any business to be in business, as he had said earlier, then this is the time to have done it, and let's hope it will happen, maybe next year.
Right, as in you're absolutely right, because when Prime Minister Modi was voted to power the first time, this was his big slogan: minimum government and maximum governance. Aditi, let's bring in a macroeconomist perspective in on this. Aditi, if you were to, from a macro perspective, from the numbers that you've seen today, and I will not ask you to rate the budget or rank the budget, but on the macro front, it does look like Ms. Sitharaman has done the best she could have, or would you have liked to see something more?
Let me just give you a few more numbers. Of course, everybody's been talking about the 4.4% of GDP fiscal deficit coming down to 4.3%, with the revenue deficit remaining flat at 1.5%. But there's another metric that we've been using for the last, I don't know, I think it's a couple of decades now. It's called the effective revenue deficit, which takes into account the grants that are given to the states for creating capital assets. That number is budgeted to come down. It's budgeted to half to 0.3% of GDP in FY27 from 0.6% of GDP in FY26. If that goes through, I think that's a significant fiscal improvement within an FD number that is barely coming down, and an RD number which is steady. So that is one positive. At the same time, when I look at the interest payments number, that's actually growing by double digits as well in FY27, similar to the kind of double digit growth we've got for capital expenditure. So while everything else we like, but the fact is that we are spending a lot more money on interest payments. And if we look at the pure Government of India capex versus their interest payments number, interest payments are actually higher than their own capex. This is setting aside the grants in aid for capital assets number. So when I look at the quality of expenditure, definitely there are positives, but I think there are also some bits which are unpalatable, especially the fact that interest payments are still growing at double digits. And coming back to whether the fiscal deficit could have been a little higher than this, obviously it is for capital assets, nobody would disagree. But the fact is we are sitting on bond yields that are stubbornly high right now. We've had so much of rate cuts. We have so much of liquidity measures that are being pumped in by the central bank at regular intervals. Yet the bond yields are quite elevated. Uh, in this situation, I don't think we could have gone in for a higher fiscal deficit because ultimately that's what is going to keep your borrowing, your interest payments elevated for a much longer period of time. Once the weighted average maturity of this year's borrowings, if I'm not mistaken, is 19 years. So if you get yields to go up further because the fiscal deficit is going to be a little higher than what the bond market is ready to accept, then you're basically for the next like average of 19 years setting yourself up for interest payments that are going to be on the higher side. So I think it's a very difficult tightrope that has to be walked, and perhaps this was the best that could be done within these circumstances.
Okay, let's quickly just go over the big numbers once again that Aditi alluded to. 55.6% is the debt to GDP ratio, 17.2 lakh crore is the gross market borrowing, 4.3% is the fiscal deficit, 12.2 lakh crore capital expenditure, and 10% nominal growth. We have with us Mr. Niranjan Hiranandani joining us. Mr. Hiranandani, thank you so much for joining us on Moneycontrol. You know, we've been talking about why isn't the private sector investing and how the budget misses the boat on getting the private sector excited. I want to ask you, as one of India's most illustrious industrialists and someone who has seen many budgets across several decades, as a business leader, how would you rate this time in India when it comes to investments, when it comes to expansion, when it comes to generating opportunities? You've seen it all. You've seen the license Raj, you've seen very controlled times, and you are here with us today where, India, like many other countries, is going through a lot of churn because of geopolitical uncertainty, and, there are just no easy answers out there.
I think the budget is really strong on long-term investments. And I think capital investments in terms of infrastructure, data centers, chips, defense, manufacturing, long-term issues in terms of it, I think it's very, very, very strong. We don't see any short-term benefits which comes up immediately, which is being able to see in terms of it. So I think many of the industries will have to wait, invest, grow, and get the benefit of it. The overall growth story and the deficit, the GDP growth is very, very positive. Hence, the long-term growth in terms of the country, including real estate, looking very, very possible. Two negatives that I see. First negative that I see is affordable housing. In the last 18 to 24 months, we have seen a 20% drop in affordable housing sales. And I thought that something would come into the budget which would push it. PMAY scheme is already operational, but it is not completely effective in terms of getting the numbers up. So I think we needed to tweak that scheme in terms of it. The second part is there are some retrospective amendments, Section 148 and clarificatory issues. 1,000 cases have been ruled against the Revenue Department in the last 5 years. In Section 148, the matter is pending before the Supreme Court. Now, to set at negative 1,000 people who have fought cases up to Supreme Court will suddenly find themselves negative in the Section 148 cases because of this amendment and clarification that is sought to be issued. So I think that type of bureaucratic work should not happen in terms of it, because 1,000 institutions who have fought up to Supreme Court now is asked to say that whatever has been done and interpreted both by the tribunals, both by the high courts, and now vesting with the Supreme Court is sought to be brought to an end. So long term, beautiful, very forward looking, looking after the headwinds against India. Prime Minister's objective of becoming Atmanirbhar is pushed to the hilt. I think there's a very, very positive element that we see. So many sectors where the multiplier effect and job effectiveness is going to be useful. Real estate and housing, which does actually second largest employer in the country has sought to grow at least 10 to 12% this year. And all the other aspects of it are very, very positive. So I look at short-term problem with some of these issues which are not taken up or taken up negatively. But long-term, the budget looks very good.
All right. That's something that we often hear from industry, that long term the budget looks very good, and that's become there's uniformity in that reaction, right, Gaurav? Whenever we've spoken to industry after the budget, we do get a sense that. But thank you so much, Mr. Hiranandani, for pointing out how bureaucracy and in terms of ease of compliance, that's actually not happening, and affordable housing, a very interesting point that's been raised. Because when we speak about ease of living, ease of affordable housing is such an integral part of that story. We've been talking about smart cities. We've been speaking about so much about, empowering the Aam Aadmi. But this crucial piece in this whole puzzle is missing this time around, Gaurav. Why do you think that is? Because at the end of the day, there are no income tax changes, which were there last budget, but there aren't any this time around. So the middle class might just feel that what's in it for me?
See, affordability clearly is a very, very valid point, and affordability has to be a function of dynamic factors. It cannot be frozen for a decade or so at the same level, because tomorrow's aspirationals or today's aspirationals are going to be tomorrow's essentials, and we have seen that in all of our lives. Air condition AC is an example of that. It was an aspirational product until say 15 years ago. Now it is an essential product, and the fact that consumer durable products are people are buying more consumer durable products is a function of two things. One, it has become essential, and two, people's spending ability has gone up, so affordability has increased. That should also be true for sectors such as housing, because the price of housing from an affordable definition point of view cannot remain frozen about say 40 or 45 lakhs for about 5 years or so, because the inputs that are going into the building of a house or an apartment, the prices of those inputs have gone up. Cement, for instance, steel, everything else that goes into the building of an apartment goes up, or a house goes up. So to that effect, I think there is a very strong case, and I think it's a compelling case that the definition of affordable housing will have to undergo a change, and it has to be dynamic in nature. Instead of waiting for a budget, I think that definition needs to be put into some kind of an indexation system.
Okay. I guess we are running out of time right now. Thank you so much, Dr. Kumar, Aditi Nair, Rishi Agarwal, and Deepthi Deshpande, if she's still there, for joining us. Before we go away, I'd like our viewers to just listen in. I had a conversation with Mr. Bijen Panda, the National Vice President of the BJP, on the budget. If I can request the PCR to please play that interview.
Now with us, Mr. Bijen Panda, National Vice President of the BJP, joining us. Mr. Panda, thank you so much, and congratulations on what is being termed as a very sensible budget by many people I've spoken to today. But first things first, the markets have been in a tizzy since the budget was announced. They were volatile even in the morning before the budget announcement. And I was speaking to an active market player who was saying that the government can show us some love. It's always tough love that they show us. हमेशा ही डंडा दिखाते हैं, कभी प्यार नहीं दिखाते. So any specific reason behind this, Mr. Panda? Why did we see the revision in STT on futures and options? Is there a reason why the markets are feeling sidelined at the moment?
Markets are very short-term oriented. They look at day-to-day issues, and perhaps some had been looking for some kind of SOPs. But let me tell you, the changes that have been brought about will have a hugely positive impact on the economy, which will inevitably translate into the markets picking up. Let me give you the example of how the exact same thing happened. If you remember during COVID times, when other countries were throwing money left, right, and center, the Modi government was very clear that its expenditure had to be focused and targeted at the poor and the vulnerable. And markets at that time also had a similar reaction, that if US is throwing money, others are throwing. See, what is the end result? The end result is today we have arguably the best performing large economy in the world. It is the fastest growing for many, many years now. It also has the lowest inflation, and it has huge amounts of job creation and huge amount of numbers of people being pulled out of poverty. And let me sum it up by saying, look at the fiscal deficit. I must compliment the finance minister for meeting the targets year after year, and this year it has come down below 4.5%. Now remember, this is when the US fiscal deficit is more than 50% higher than India's. Look at the debt to GDP ratio. India at 55% is phenomenal when you compare that, usually well-managed countries like Japan, US, UK, Singapore are all heavily indebted and not able to make the investments necessary for their infrastructure and for their growth. And despite this, Nirmala ji has committed to bringing down the fiscal deficit further next year and to bringing down the debt to GDP ratio to 50%. So keep in mind, all of this kind of focused, developmental oriented budgets over the years have led India to become the best performing large economy in the world. And so let us not worry about the market's immediate reaction. I'm willing to bet with you that a few weeks and months down the road, the markets will recognize the value of the long-term benefits of this budget and react appropriately.
Interesting. Interesting that you say that. The economists, of course, are happy looking at the macro numbers. Also, one of the
precisely.
You're right, and one of the things that this government has done has been to bring in a lot of transparency in the way the macro numbers have been put in the budget, and overall in the calculations there are no off-budget borrowings and all of that. I wanted to talk to you about when you look at the budget, you see a lot of good things in the budget. I started off by saying looks like a very sensible budget. You're focusing on future-ready sectors. Execution will be key, Mr. Panda, and I think that's where the focus will have to come from the government and all the other stakeholders involved. I just wanted to get a sense from you on, what is the thinking in the government on the execution front? Because we've seen even in the past that, the intent is there, but it's where the execution, when execution comes into play, that's where we tend to falter a bit.
So I think you are asking a very important question. And it harks back to the bad old days before the Modi government, when people used to talk about how there were so many outlays, but the outcomes were not up to par. Now, if you look at the Prime Minister's track record of his time as a head of government, take all the way back to Gujarat, and now for 12 years as the head of the national government, it is precisely because the execution and the implementation has been on target that India has become the fastest growing large economy. That is precisely why we have tamed inflation. This is precisely why 250 million people have been pulled out of poverty. And this is precisely why, because we have doubled the number of airports in just a decade. Whatever had been achieved in the previous 70 years, or 75 years was been doubled in just one decade. If you look at the roads and the highways, if you look at all other kinds of infrastructure, the track record is there for execution on target. So I think that's a valid question that you are asking. And this is why I'm exuding optimism. Now look at job creation. For decades, we used to have these targets of job creation, which used to be missed. Whereas in recent years, we have been meeting the job creation targets. Our auto industry has become the third largest in the world. Now look at you talked about future ready. Now, straight off the bat, I can think of some 3 million jobs that are going to be created by the targeted efforts and outlays of this budget. So you've got lakhs of healthcare professionals, you've got caregivers, you've got tech professionals in animation, gaming, and related areas for which very specific outlays are going to be made. And you're going to see these job creation. Then the tourism, the infrastructure. Look at the 7 high-speed rail corridors. So after our first high-speed rail in connecting Gujarat to Maharashtra, now you're having them all across the country. it's a phenomenal commitment to shifting the gears to even a faster rate of growth.
So 3 million jobs, that's what you're saying will be
I just added up 2.8 million jobs as follows. 1 lakh in AHPs, that is healthcare professionals, 1.5 lakhs in caregivers, 2 million job potential in animation, gaming, etc. These are just some of the specific numbers targeted with specific amounts targeted for facilitating these job creation. But the unnamed or the unspecified numbers, for example, when these 7 high-speed rail corridors are built, connecting large numbers of states, it's like building an airport along each stop. And you can imagine the numbers of jobs that will be created across the country by that alone. If you look at the other tourism-related efforts that are being made, tourism is the highest job creator of any sector. And so, actually, I was just giving you the 3 million as something very specific, targeted, but actually it's going to be, order of magnitude higher than that, tens of times more than that.
So there's one thing that, one notices in this budget is a lot of focus on nurturing a services-led economy. Until now, we've really laid a lot of emphasis on manufacturing-led growth. We've had PLIs and so on. But this time around, what I see is that there's a lot of emphasis on capitalizing on India's services-led growth. Is that a formal strategy that the government is working with?
If you think about it, for many years before the Modi government, India seemed to have given up on manufacturing. And services were something that were organically growing. For example, the IT sector grew, as many people have written, not because the previous governments were nurturing it, but because the previous government had not noticed it. Wherever the previous governments had noticed something and got interested, they ruined that sector, such as steel from the 1950s onwards. But what the Modi government did in the first few years of its last 12 years, it has shown that India can be a manufacturing superpower. I gave you the example of the auto industry, now third largest in the world. If you look at homemade defense industry, the Atmanirbhar Bharat thrust, there's lots happening. If you look at the startup sector, there are lots not just in IT, but also in manufacturing. Now, having said that, clearly, we have a huge strength in the services sector. India has become the back office to the world. India has become a powerhouse in IT-enabled services. So obviously, we should take advantage of that and leverage it. So this budget really targets taking advantage, because you needed to have reached a certain level before you can scale up. And that scaling up is happening today in services in a very big way.
Also, this tax holiday that the government will offer to global companies to come and set up data centers here, I think that's got huge implications for India in a very good way, whether it's skills, whether it's jobs.
If you think about it, this is related to a variety of issues. One of the issues that has been sort of a sticking point in discussions with many other nations is data security and privacy, where on one hand we have been looking to protect the data of Indians from being misused, and many other countries resisting, saying that data has to flow freely. Now here you're killing two birds with one stone. With this particular policy initiative, India is a huge market. It's either the largest, second largest market for many of the major IT companies in terms of subscribers, in terms of customers, in terms of scale, because of their India business flourishing, whereas they're doing badly in other parts of the world. So with such a heavy consumption of data, today, broadband has become available at every panchayat center, now every village. So this inducement to investors to bring data centers and cloud services to India solves many of those issues, and it creates another big boost to our economic growth.
When do you see? Yeah, is there an estimate on the timelines, Mr. Panda? Is there? Have we been getting a lot of interest from other countries and companies? Would you have any details on that, like in terms of the timelines that we could look and we could work with on, getting GCCs and more GCCs and companies to come and set up here? Any number that, we can work with?
Look, if you're talking specifically about this last topic regarding cloud computing and data centers, even without this policy decision, many had been setting up in India, including Indian companies and some international companies have been looking at it. Now this makes it a no-brainer. It makes it a no-brainer to set up data centers and cloud services in India. I would imagine there will be a scramble to be the first and the second mover. And if there isn't, those who don't, they will miss out in a very big way. So I would, my expectation is we will see traction on this front very, very quickly. Okay. But in terms of otherwise investment, India continues to rake in the investment, whereas other countries, our peers in mid-level, mid-income countries as well as developed countries, they're either stagnating or faltering.
My last question, Mr. Panda, is that the middle class, the salaried class, we're always expecting tax cuts, but there weren't any this time around. So what can the middle class hope for, from this budget?
Last time there was a very fundamental shift with the massive upward shift of the floor for taxation to 12 lakh rupees. Now, since then, the focus has been on tax reform. And I'm particularly grateful to the Finance Minister and the Prime Minister for having implemented the new income tax bill, which I had the privilege of chairing the select committee, which had presented reforms. Now, the simplicity and the ease of use of the tax system was a key criteria. And you've noticed that the FM has mentioned that the notification of the new Income Tax Act will be on schedule in April as had been planned. And also the new easy forms make life a lot easier. And also the many other policy decisions taken which make life easier, the decriminalization of a whole host of minor errors, the ease of living index in India, and for the huge number of taxpayers approaching 100 million people is going to be enormously beneficial. So there's major changes. If you talk to taxpayers now and you talk to taxpayers in 6 months' time, you will see the fundamental shift in it becomes a lot more easy to be a genuine taxpayer.
All right. Thank you so much for that, Mr. Panda. We really appreciate you joining us to break down the budget for us. And we'll, of course, come back to you with more questions on the markets, maybe a few months from now, to see whether the market sentiment has turned or not. Thank you so much.
Thank you.
Hello and a very warm welcome. Welcome back. Well, we were discussing the macroeconomy, the political economy of the budget, the big message from the budget. Now we'll zero in on the startup sector, the sector that often feels a little left out. Joining me on the show right now is I have with me Dinesh Bansal, CFO of Meesho, and I have with me Sandeep Jetwani, right? Hi Sandeep, and hi Dinesh. Thank you so much for joining us. Very quickly, my question is to both of you. The startup sector, I'm sure there are big hopes and big expectations from this space. And this time around, however, one gets a sense that the budget didn't really give as much. Having said that, there has been a lot of emphasis this time around on giving incentives to companies to come and set up data centers in India. There's also a lot of emphasis on building AI capabilities and so on. So Dinesh, how are you viewing this? So if you were to rate this budget on a 1 to 10, how much would you give it?
Sure. I think maybe I can start with the salient things and then I'll come to the rating. And like you rightly said, I think for startups and especially those in kind of technology area, one of the largest spends that we have is around technology and cloud infrastructure in particular. So we do hope that the incentives that are being given, the fiscal incentives that are being given to companies to set up their data centers in India, not only kind of ends up creating more jobs here and more technology capabilities, but acts as a sort of catalyst for improved efficiency even for existing startups who are using these technologies. So I think that has definitely been a step in the right direction. Apart from that, I think there has been a lot of continuity in terms of some of the areas that were a focus earlier on in the past budgets as well, including focuses on the biopharma fund, the funds around kind of SME champions, something that kind of particularly impacts a lot of entrepreneurship creation, and that's the funnel from which we see a lot of new startups kind of come about. So overall, a good budget from startup standpoint, I would say maybe 8.5 on 10.
8.5 on 10. I think that's not bad. That's a pretty decent number out there. Sandeep, how much of a dampener is this, from a market investor standpoint and for wealth tech firms in general?
Shweta, thanks for having me. I think if you think about it, before I respond to that specific question, I want everyone to think about this number. This budget indicated that our GDP at the end of this period will be 400 lakh crores. If I just go back 20 years when I started my career, we were in the ballpark of 36 lakh crores. We've grown more than 10 times in 20 years. And in that context, I think a lot of things that the government has done with this budget have been oriented towards addressing that scale. And when I think about scale, it's in 5 parts. It's S for stability, C for the capex that the government has done, A for the acceleration that they've provided, L for the long-term thought process, and E for the ease of doing business. And we can peel that onion in a bit, Shweta. But if you think about the wealth tech sector, I think the government has played the role of a good wealth manager. Essentially, what they've tried to do through the budget is tell people that, look, short-term trading may not be the best for your portfolio. Speculative activity is not great. We've seen the SEBI report, which says over 91% of traders are losing money in equity markets in F&O, whereas you should be focusing on the long-term side. And you see the long-term side, for the last year or 2 years, they've held the capital gains tax rate stable. One of the big anomalies of the previous budgets was the tax on buybacks. That has now been addressed. It has not only been addressed for retail investors, but also for public investors in unlisted companies below 10%. So essentially, we are now looking at a 12.5% tax even on buybacks. And I think that's excellent because it has enabled more ability of companies to return capital to their investors. So all in all, I think while in the short term, this may have created some volatility in the markets, some pressure on the prices of companies which are involved in equity trading, I think long term, this is a great thing from an investor standpoint.
Interesting. Dinesh, coming back to you, there's talk about creating MSME champions. There's also talk about creating textile clusters and textile parks, where there's been talk about using more sophisticated machinery to really add and grow our value chain, go up in the value chain. So how are you viewing that, and what does that mean for startups such as yours? What does that mean for Meesho?
Yeah, I think again, if you kind of even look at the way the whole EU-India FTA happened and concluded recently, and the impetus that is being put on creating that export corridor from India for the world in the areas of textile, I think this is again a step in that direction in general. I think more specifically for someone like us, there is obviously a lot of, I think textile is the second largest employment creator in the country after agriculture. So when we see entrepreneurs, SME champions in different areas, I think textiles kind of has the largest share there. And whenever any step is taken in that area, we've seen great success stories sort of come out of that. Right now, the hubs are kind of limited to a few cities in the west and sort of south of India. And as that kind of expands into more places with sort of more advanced sort of fabrics and other technologies being used, I'm sure it will see a more widespread sort of growth in the country.
Interesting. Sandeep, coming to you, the budget now treats all buybacks as capital gains for shareholders. Now, will this provide a clean exit framework needed to boost investor confidence in growth age startups?
Absolutely, Shweta. And as more companies become profitable and are offering the ability of investors to take back their capital, I think this will be an excellent initiative. In fact, when you think about what are the second order benefits that will happen as a result of it, more investments will flow into companies. You had this strange disparity where if a large company did a buyback, only mutual funds could participate because the tax differential for other investors was very high. I think that anomaly has been removed. As more companies generate cash, they will return that cash to investors. Those capital will again get back invested into the markets, either the public side or the private side. And we all understand that India is a country that needs more capital formation. So I think all in all, that will have not only the first order benefit of investors who are currently invested benefiting, but I think newer companies will be able to raise capital more easier.
Okay. Dinesh, coming to you, this removal of this 10 lakh rupee value cap on courier exports, that's a massive win for companies like yours, because would you say that this signals the beginning of a true cross-border for Bharat kind of era for small Indian artisans? It opens up huge markets.
Yeah, no, absolutely. And I think if you look at China and some of the other Southeast Asian markets which have, taken a more export-led approach to growth, some of these exist. Some of these fiscal incentives already exist for participants in those economies. So I think cross-border is going to be a big, area where Indian firms can take what is being produced here. We have a large 30 million odd diaspora population outside of India as well. But even otherwise, there was a lot of focus on exporting goods and services from India, be it Ayurveda or kind of the handloom and artisan and weavers, all of the products that they're kind of producing. So it definitely sets out a growth path. I think there will be more things that both corporates like ours and the government will do along the way. But I would say over the last 12 months, especially the whole framework of law around cross-border exports has been eased out, and with this fiscal kind of incentives as well, it is starting to look like an interesting opportunity.
You don't sound as excited about it though. Is it that I am missing something that you know of?
No, I think there's still a lot more to be done in terms of just kind of getting that demand visibility for Indian products outside, right? And I think that is going to be a long journey. But the frameworks for what will enable this to become available throughout the world, Indian products to become available, and what kind of stimulus or incentives exist for that, I think we'll have to match all of that when we compare it to other export-led economies.
Let me, I just want to get in Sandeep's thoughts in on this whole new Income Tax Act, which will take effect in April 2026, where, you will see more simplified rules. Now, how do you see the simplified rules impacting the impatience you've often noted in first-generation investors?
Shweta, one of the pillars of our response to the budget was scale, and E within scale stood for ease. I think within that, especially for our set of clients, which are first generation wealth creators, the ease on the income tax side is remarkable. First of all, we are shifting now to a new Income Tax Act, which will simplify how the forms are designed, the submission of investment or information, etc. I think a lot of that has been cleaned up. That's number one. Secondly, I think, and we noted this foreign asset disclosure clarifications that came out. a lot of our clients are folks who have foreign assets which they had earned when they were employed abroad. These are technologists who've operated in the top 8 or 10 technology companies of the world and have come back to India to contribute back to India's growth. I think for them this has been a huge pain being taken away. There's also extension of timelines that has been done for people who have business income, especially people who have professional income. They now have at least a month more to file their income tax. So I think all in all, a lot of clarity that is emerging as a result of it. We're seeing actually now in second order effects of things like account aggregator, the AIS information which is coming through for investors to be able to cleanly report their gains. Overall, I think the government has moved not just in this budget, but over the last few years to simplifying the tax regime. And we are seeing our clients talk about that. They're saying it's much easier than it was a few years ago. Can it get better? Absolutely, yes. Will technology be used to improve it? I think certainly in the next few years. But overall, I think we're in a great place right now.
Okay, and this easing up of individual persons resident outside of India limits in listed companies that have increased to 10%. How are you viewing that? And do you think this could act like a cushion for India against global outflows?
I think, Shweta, look, I think there will be some inflows that will happen as a result of it. We should, however, recognize that to open a domestic account for the PROI or persons resident outside India is still a time-consuming exercise. There are possibly easier ways for them to participate in the Indian markets through the GIFT City or the IFSCA framework. I think there a lot of ease of onboarding has happened. We've seen KYC regulations become seamless. They have been transferable or interoperable in some sense on the IFSCA side. So I think I still feel a lot of capital will flow in through the GIFT City route. But I think this is certainly an enabler. This will allow PROIs to get specific exposure into companies that they want to access. So if somebody wants to invest specifically into a manufacturing company in India, they should be able to do it. So more targeted investments will come in from this route, whereas from the portfolio side, I think that will come in from the GIFT City side.
Coming to you, Dinesh, considering the massive 12.2 lakh crores that we've seen on infrastructure, how do you see that? We're talking about high-speed rail corridors, we're talking about freight corridors, we're talking about more highways and a big push towards creation of infrastructure. Do you see that having an impact on costs of logistics? And have we seen a change? Have you seen a change in the last few years? And are you optimistic that logistics costs will continue to come down? Or do you think that conceptually at the moment, this money looks good on paper, but by the time we see a spillover effect, it would be some time?
No, I think this has been, I think, again, over the last, I would say, 5 to 6 years now, government capex has been, supporting all of the growth more broadly, not just kind of in terms of, the infrastructure that it is creating, but the jobs and opportunities that are getting created out of that. So before coming to logistics, I think keeping that path alive, keeping that capex kind of in the same ballpark or slightly increasing it by about 10%, which has been the case in this year, will continue to create more and more jobs, which further lead to consumption economy in the country being healthy. And that, I think, is important for all of us, and especially the kind of customers that we serve who are more price sensitive in nature. I think this creates a lot of opportunities for them to kind of find the right kind of livelihoods. Now, coming to logistics, I think over the years, I would say the middle mile, which is typically the highways and the infrastructure around that, has continued to improve, and that has led to significant cost improvement for us, for our third-party logistics partners, and that has been broadly passed on as cost efficiencies to our customers who find things now more affordable. So I think steps in that direction where you keep on creating more and more infrastructure, get it to, already in most places, in quite a few places, it is world standard. But as we keep doing more, the cost of logistics will certainly come down, and that will increase the efficiency of, logistics for someone like us who ships things from pretty much one end of the country to the other end of the country for any kind of order placed on us. And those efficiencies will then get passed on to the customers in the form of lower pricing.
All right. Well, Dinesh, stay with us. Many thanks, Sandeep, for joining us. So we have with us Prashant joining in. Prashant Prakash, founding partner of Axel India. Prashant, welcome to the show. Thank you so much. Your first thoughts on the budget. We've been asking experts from across industries, economists, policymakers on what they think of the budget, how would they rank it, and I'm hoping for an honest and a candid response from you on this.
Yeah, I think it's primarily a budget that is focused on strategic autonomy for the country. So I think this whole idea of strategic independence can only come through initiatives in deep tech. And I think there is a huge emphasis on deep tech, both through the 40,000 crore outlay for the new semiconductor mission and rare earth materials, defense-related catalyzing elements for defense and advanced manufacturing. So across the board, the idea is how do we as an ecosystem prepare ourselves for global vulnerabilities, which is a day-to-day reality today. So how do we get full stack in our domestic value chains? This at a high level, that has been the focus, and I think they have hit all the right notes for that.
And we've seen that there was a lot of focus on, in fact, a tax holiday that's being offered to foreign companies to come and set up data centers here. What do you see? I mean, how soon do you think will we be able to see an impact on that, on say job creation, on companies coming in, on skills transfers happening in India?
Important initiative. I think
yeah.
Can you hear me?
Yes, I can hear you. Yes.
So I think this initiative is more an infra initiative. It's not so much on the job front. I think the job front initiatives are all linked to MSME and advanced manufacturing initiatives that they have in place. So I think there's a huge emphasis on areas such as energy transition, where we need to build a domestic base in lithium-ion batteries, in high efficiency PV cells, electronic switchgear, and also the electronic component manufacturing ecosystem. So these have been the focus areas when it comes to job creation. The area that you're talking about, which is setting up these data centers, I think this gives us lower cost compute and will strategically help a lot of our startups and our companies to access AI infrastructure at a low cost to be able to serve AI efficiently and democratize the value of AI across the country. So it's more of a AI enabler is where I see value for setting up these data centers in the country.
Interesting. Well, thank you so much, Dinesh, for standing by. My last question to you is that is there something that you would have liked to see in the budget, a wish list that was given to you, that was given by you to the finance minister and that was not accepted? Can we have Dinesh back up, please? I think he's logged off. All right, we have with us Mr. Ashok Chandok joining us of IESA. Mr. Chandok, thank you so much for joining in. Very quickly, First up, your first thoughts on the budget. Do you think the budget does enough to push India's capabilities in the semiconductor space, in the electronic component space?
I would say it's quite good approach right now in the budget, and there is something which is probably missing. I would highlight that as well. So I would call from a sector perspective, electronic semiconductor. After building the trust and laying the foundation in 2025, we are gearing up for execution and scaling up in 26-27. So overall, there has been a strong momentum, and this would continue now as per the budget announcement. And there are multiple things here, but two topics I want to highlight. Those are extremely important. One is the announcement about the ISM 2.0. Though it is not spelled out, the quantum of the support that it would get, I assume it will be updated later. But this itself is a very good signal, I would call, because this policy has been bit asked by industry and has been pending the final decision. It would move India's semiconductor ambition from a fab and OSAT centric approach to a full value chain strategy. So which would cover not only fabs, OSATs, but also equipments, material, chemicals, gases, and various supply chain. And that way, we could move towards becoming a structural player and not just one of the participants.
Interesting.
And second point here is about the electronics and the ECMS scheme, which was announced last year, month of, I think, April, May, has already taken a fast track approach with 46 projects were approved and hundreds of applications were there. 22,000 crore allocation has been increased now to 40,000 crore. So this is also a clear example of a government which looks at the trend and acts very fast. So policy announced, projects approved, and incremental 22,000 to 40,000 crore is a clear indication of the priorities from government perspective. And entire industry is quite happy because this, along with the Semicon program, creates the major value addition approach in the country. So more value addition, it's a better economic value retained in the country, and that way this becomes quite important actually. In addition to that, I would call there are several additional measures. Those are bits and pieces, but that also adds up. There is a unique 2% profit margin support for electronics manufacturer. There is a special approach for component warehousing and a logistic hub, which helps in terms of keeping the goods, imported items into the bonded area and pull out whenever required to increase the manufacturing efficiencies and also global competitiveness. There is talk about customs simplification. There is a clear focus for MSMEs and ease of doing business. So these are all reforms-led manufacturing growth that gives the major impetus.
Do you think
in addition, I'll just take 30 seconds, maybe more. In addition, there is also a mention about technology adoption. If there is an emphasis on technology adoption, that is clearly visible in job creations and some of the strategic initiatives like AI mission, quantum mission, R&D and innovation funding. There is an energy storage topic, solar sector. All those things particularly keep adding up actually. And overall, I would say it's a very good support to this sector. Yes, the quantum for ISM need to be clarified. I assume it will happen in due course of time. But it's a good progress, very good momentum, and very clear signal from the government that it really want to harness the opportunities and semiconductor electronic sector, considering we are targeting $400 billion electronics industry by 2030. So all good.
Right. Absolutely. Do you believe that an initial allocation of 1,000 crores for FY27 for this, is this funding sufficient to kickstart the equipment and materials manufacturing ecosystem, given that this is a fairly capital intensive industry?
My understanding is we need to revalidate this number. I am also checking actually, because my understanding is for ISM 2.0, the final major quantum is not specified as of now. It has to be in several $billion. It's not clarified. What I read already, though, is an additional allocation from this year's spend, we call the spend budget, is about 8,000 crore for the sector. That includes 2,000 crore for fabs and about 5,000 crores for OSATs 900 crores for SCL modernization. So that's more of the allocation, what will come as an incentive payouts. But what you are referring as 1,000 crore for ISM 2.0 as a whole scheme, I'm not too sure about it. We need to revalidate it. I don't think so.
Fair enough. Fair enough. Also, this electronics component manufacturing scheme, the allocation for that has nearly been doubled to 40,000 crores. What specific component categories, according to you, should the industry prioritize to meet the goal of this 40% local addition?
See, I would say right now in a first phase, already there are several PCB plants. PCB is one of the most important item which is required for electronics manufacturing. And there are a large number of projects already approved. So I would say PCB is well taken care. What we need now is going forward, the display related components and modules, because these are used in every product, electronic product. What I need more is on a passive components, both the connectors, the resistor, capacitors, other thing, and even the low cost capacitor like 1 or 2 cents they cost, but billions and billions of pieces are required actually and used. And India does not have right now a right technology, so dependent on the global players. So those need to be done. Plus, I would also call the electronic subsystems and module making would also be quite interest in terms of the components.
Okay, let me also bring in Prashant on this one. Prashant, a 40,000 crore scheme for electronics component manufacturing. Do you see India finally producing its first advanced manufacturing unicorns in sectors like aerospace and robotics by 2027? Do you think this could really give it that push?
Yes, I think the demand is there, whether it is being able to substitute a lot of the imports, which is the focus in defense, aerospace. That's where a lot of the demand is going to come from for startups to be able to grow their revenue. And I think the other interesting area, I think Ashok also touched upon this whole idea of going full stack in our component design. The idea of DLI, design linked incentives. I wish they had put a larger budget. It's a small budget, but it's a good start where startups will be given support to be able to design full stack IP products from India. So that's a very good initiative. So I think a combination of these initiatives plus the demand both in the aerospace and the defense sectors, I think will enable both exports of these now advanced manufacturing components and technologies from India, and also substituting for imports. So I think both these will provide the capability for startups now to build 1,000 to 3,000 crore kind of revenues, which will make them unicorns.
Also, the rare earth corridors, the dedicated rare earth corridors that have been announced in Odisha and Tamil Nadu, how critical are these for upstream capabilities that have been identified as essential for strategic autonomy like chemicals and materials? Do you want to take a dig at that, Prashant?
I mentioned both in the aerospace, EV, and the defense industry. All of them very, very dependent on these rare earth materials. So we won't be able to actually do the substitution or do these critical component exports from India if we are dependent on these global supply chains when it comes to rare earth materials. So I think this takes time. So I think it's good that we are starting now because it takes time to explore. It takes time to then manufacture and build the processes to be able to manufacture these. So I would say in the next, hopefully 2 to 3 years, we will have the domestic self-sufficiency when it comes to these rare earth materials. The other big initiative I think they're talking about is also, new manufacturing, advanced manufacturing parks and clusters. So I think that's a great initiative where we had these parks when it comes to some of the software areas and some of those, but these advanced manufacturing clusters and advanced manufacturing parks are also great for startups to be able to easily get started and lower the friction and improve the ease of doing business in these manufacturing clusters.
Interesting. Mr. Chandok, your thoughts on this?
India has a major potential in the rare earth materials. We have not harnessed it. There are a lot of materials that exist in the country, but not at the desired purity level as it required. So building this capacity and a capability is important for the downstream value addition as well as the quality consciousness. And I would say that there are several countries, those can come together to create a pool of this precious rare earth materials. Because every country cannot produce everything. So there is an interdependency if it is created among multiple countries by building whatever materials we can build in India, some other partner country like Australia, for example, and others. That creates a very good pull. Because recently, as everybody is aware, one country has really taken everybody by doing arm twisting on a rare earth materials and created kind of a line downs and manufacturing issues in multiple locations and multiple continents. So the rare earth material becomes very important, and it's good that we get a focus on this now. And my view is, as a next step, we have to build that kind of a informal consortium or a cooperation among multiple countries where we just do give and take, because each country cannot produce everything what they need.
All right. Well, with that, thank you so much, gentlemen, for joining us, with that very insightful perspective. And of course, a lot of what has been announced today will depend on execution, and that's where lies the key. A rare earth corridor sounds great, but hopefully things will move quickly and we'll be able to capitalize on our strengths. Thank you so much for joining us. It was mayhem in the markets today following the budget speech. Not surprising, because we heard the finance minister increase the securities transaction tax on futures and options trading. Let's quickly listen in on to some reactions coming in from the markets.
Overall, the budget is one of stability and continuity in a world where we are seeing a lot of uncertainty and change. India has emerged as one space where macroeconomic comfort, macroeconomic stability has been very high. Inflation is under control. This budget only builds on the past messages, on the past focus areas of the government. It gives a very high focus on a macro view as well as the micro few sectors that the government wants to focus. Reform Express continues. Manufacturing continues to be a high priority area. There is this time very pleasant to see some focus on FDI coming back into the country, looking at areas such as data centers and tax holidays for MNCs to come in, as well as making life for NRIs easier to get possibly talent back into the country. Balanced with that, fiscal deficit is something which has been, targets have been met. 4.4% fiscal deficit is extremely positive to see, and it gives us confidence that since whatever has been said in the last 5 years has been met, gives a lot of confidence that the next few years will continue to be one where targets that have been set are going to be met.
देखिए, जैसा मैंने आपको बताया कि एक तो पैसा, खुदरा व्यापार में सबसे बड़ी तकलीफ थी पैसे की। ये एनबीएफसी के लिए स्कीम अलग से बना रहे और एमएसएमई को पैसे मिले उसके लिए स्कीम अलग से बना रहे, बिल डिस्काउंट हो जाए उसके लिए स्कीम अलग से बना रहे, इनकम टैक्स में नए सरलीकरण के फॉर्म आ गए, तारीखें आ गई, वहां पर जो डराने का प्रोसिक्यूशन का था वो समाप्त हो गया। तो ऐसा एक एक सेक्टर को ध्यान में रखते हुए ये बजट बनाया गया है। मतलब ईज ऑफ डूइंग बिजनेस, कॉस्ट ऑफ डूइंग बिजनेस दोनों कम हो जाएगा, इससे आम लोगों को बहुत फायदा। और जब मैं आपको ओपनिंग स्टेटमेंट क्या बता रहा हूँ, युवा शक्ति ड्रिवन बजट, कि युवा शक्ति कौन होगी, जैन जी को फोकस करके पूरा बजट बनाया गया है। और जो पारंपरिक तरीके से होता था इसको खुश करो उसको खुश करो, नहीं, स्किल डेवलपमेंट किसका होगा, टूरिज्म के लिए स्किल डेवलपमेंट, विदेशी भाषा युवा के लिए होगा, कोस्टल एरिया में डेवलपमेंट युवा के लिए होगा। यानी अलग अलग जगह जहां जहां युवा है, सिटी बी, सिटी सी, इनके लिए भी विशेष प्रावधान 5,000 करोड़ रुपए एक एक शहर को विकसित करने के लिए दे रहे हैं, उसका फायदा सीधा होगा।
एक तरह से सबसे ज्यादा बजट प्रेजेंट करने वाले वित्त मंत्री जी आदरणीय श्रीमती निर्मला सीतारमन जी बन गए हैं। यह एक आत्मविश्वासपूर्ण और फॉरवर्ड लुकिंग बजट है जिसका उद्देश्य फ्यूचर रेडी इकोनॉमी का निर्माण करना है, जिसकी शुरुआत सेमीकंडक्टर्स, आर्टिफिशियल इंटेलिजेंस, एडवांस मैन्युफैक्चरिंग, बायोफार्मा, रेयर अर्थ प्रोसेसिंग और ग्लोबल डेटा सेंटर्स जैसे हाईटेक प्रायोरिटीज से होती है। साथ ही टूरिज्म, गारमेंट, टेक्सटाइल्स जैसे अन्य ग्रोथ इंजिन्स पर भी ध्यान दिया गया है जो एम्प्लॉयमेंट और एक्सपोर्ट को कई तरह से स्केल कर सकते हैं। महत्वपूर्ण रूप से यह बजट एम्बिशन को डिसिप्लिन के साथ जोड़ता है। फिस्कल डेफिसिट जो 4.4% से घटकर 4.3% होने का अनुमान है, जबकि डेट टू जीडीपी रेशियो 56.1% से घटकर 55.6% रहने का प्रावधान है। इससे भारत के 30-31 के जो बजट है जिसका लक्ष्य हमने 50% रखा हुआ है, उसको मीडियम टर्म कंसोलिडेशन गोल की दिशा में ले जा रहा है और मैक्रो स्टेबिलिटी के साथ हायर प्रोडक्टिव स्पेंडिंग के लिए भी एक तरह का स्पेस बन जाता है।
I would, the union budget that's been presented by the Honorable Finance Minister, I would say the things that CII has been focusing on, first is to focus on the macroeconomic fundamentals and particularly linking the fiscal deficit to the debt to GDP ratio. I think that's been retained, that's very positive. The second is the focus on reforms that have been laid out, and these proposals that they've broken up into 6 categories. I think that's been very positive. So focus on reforms, focus on manufacturing, focus on simplification. We wanted some sectors to be clearly identified. I think the focusing on the 7 strategic sectors, I think that's been very positive. The championing of MSMEs, particularly the fund, the incremental fund that's been created to provide equity support, I think that's come out very positively. On the infrastructure side also, the allocation has gone up. Again, that's positive. Particularly, I think we've been recommending on high-speed rails and others. That's been very positive. And I think for the first time, we saw a lot of focus on the middle income India. So a lot of focus on IT services, a lot of focus on tourism, a lot of focus on people who are getting into those areas and those jobs. From a tax standpoint, I would say a lot of focus on simplification. I think some of the things that have been introduced in terms of safe harbors, benefits on data centers, some issues that were there for electronics manufacturing, I think they have been sorted out. On the customs duty, I think there has been some rationalization of imports in certain areas of capex where massive capex is going to happen, particularly in terms of nuclear power, encouraging MROs and others. I think there also the benefits have been provided. So I'm happy to answer questions, but I would say very positive budget, macroeconomic discipline, focus on structural reforms, clearly identified sectors, focus on infrastructure, focus on MSMEs, and also, this entire thing of city economic regions, I think that's also very positive. So no, I think that's positive. I think that's something that we have been focusing on, and I think rare earth is a big positive thing. So I think to encourage that, to provide the relief that is required and the incentives that are required is positive. And sir, how do I think again, capex increase of 1 lakh crores is again very positive. It was 11.2 lakh, although they said 11 lakh crores is what being spent. So if you look at that, it's a 10 to 12% increase, which is very positive. I think more than that is also difficult to absorb. And I think maintaining the fiscal discipline and ensuring that the capex, growth is also maintained, that's good. And areas that they've identified is also very good. So I think a lot of focus on high-speed rails, on semiconductors and other areas, I think that's good.
I think it is consistent with the objectives of the government and with all the measures that they have installed over the last couple of years, and it is also focused on continued growth. So I would say it is consistent and growth oriented. So I think the focus that the government has put on capital expenditure in infrastructure by raising the allocation from 11.2 lakh crores to 12.2 lakh crores is very, very welcome. That will be the foundation to drive private sector spending in capital expenditure. Also, as part of that as well, the focus on data centers and building greater cloud services over here and bringing in fresh technologies and digital technologies with AI is also very, very welcome. Creating economic regions is also another welcome move. All of these are measures that are critical to boost the economy. Well, I do believe the capital expenditure allocation of 12.2 lakh crores, there will be an increased allocation for railways, for highways, for ports, for airports, all of which will continue to bringing logistic costs from where they were at 13% of GDP to where we are today at 10% of GDP to probably 7 or 8% down. And this is the consistency that I'm talking about in the budget presentation today.
डिटेल्स तो बहुत कम मिले ना, जैसे कि 3-4 हेडलाइंस है, लेकिन जब हम इंतजार कर रहे थे कि ऑल इंडिया इंस्टीट्यूट ऑफ आयुर्वेदा कहाँ आएगी, हमारे केरला में चाहिए हमें, हमारे तो बहुत लंबी ट्रेडिशन आयुर्वेदा के, लेकिन केरला का नाम नहीं सुना। फिशर कोकोनट तो शायद केरला ही हो सकते हैं, क्योंकि मेरे ख्याल में भारत